This is a complete A to Z beginner's guide on how to start day trading in 2026, and I can promise you one thing. This is the last trading video you will ever need to watch in your trading career. After taking thousands of losing trades, enduring every emotional high and low in the markets, and building a seven-figure trading career over the past 6 years, I'm gonna give you over 8 hours of trading education completely for free. And I'm not exaggerating when I say this free course is genuinely better than 95% of paid courses out there that gurus charge thousands of dollars for. And I know that for two different reasons. Number one, because of the amount of time, effort, and real world experience that I have poured into this course so you can become a profitable trader. I genuinely want you to succeed with this. And number two, over 60,000 students have already watched this free course, applied the information, and they have seen transformative results in the way that they trade. In fact, thousands of those students went on to become consistently profitable traders from this free course alone. In this video, I'm going to cover everything. I'm covering price action fundamentals, strategies, risk management, trade management, scanning, how to use indicators, support and resistance, and much, much more. This is truly the final blueprint that you need to turn your dream of becoming a profitable trader into a structured, systematic approach to the markets. Now, before we get into a couple of things that you need to know, YouTube actually caps video length at 12 hours. So there's even more trading education that I wasn't able to fit into this video. So if you want the complete, unedited 12+ hour trading course, you can get free access to it directly below this video in the description. And once you get access to my free course community, I also host free bi-weekly live trainings where you can join the classes live and ask me questions. And if you are someone who is serious about their trading, you want trading to be a legitimate income source for you, and you really resonate with all of my free education, I also personally help scale and coach traders from zero to consistently profitable, where I take my students under my wing and they learn how to trade by actually doing it with me on a daily basis. So if you're someone who's serious and you want a hands-on mentor, you could also apply for my mentorship and book a free consultation call also below this video in the description if that's what you're looking for. So before we actually get into the education, I want to give you guys a quick little introduction of who I am so you know exactly who's going to be teaching you. My name is Emmanuel. I've been a full-time day trader for about 6 years. I'm a Georgia Tech graduate, and my father is actually the one who taught me how to trade. He was my trading mentor 6 years ago, and he is the reason why I'm a profitable trader today. It took my dad over a decade to learn how to trade because he was figuring it out by himself. He had to experiment with different strategies. He had to lose a lot of money before he actually became profitable. But after he taught me, it only took me 3.5 months before I started making money with trading. And it's because I had the right framework from the very beginning. I actually had a mentor, and I learned what to do in the markets, but I also learned what not to do. And I never really built any bad habits from the beginning because I learned the right way from my father. So I owe it all to him. I would not be a profitable trader without his help. And my dad and I actually trade together today. So real quick, I also want to be as transparent as possible. This is my Charles Schwab brokerage account, and in 2025 I made a little bit over $461,000 day trading stocks. I trade on Thinkorswim, and if you think this is Photoshop or a screenshot that I edited, I will go ahead and refresh the page on my Charles Schwab account, and there's the $460,000. I actually have another YouTube video on this channel that breaks down my 2025 trading results, and I show my brokerage statements, and you can see exactly how I did, every single month. But I also want to go, as far back as possible on Charles Schwab. So I can't really show my results from March or April. I just can't really click on any of these numbers, but I can show you my results from May 13th of 2024 to December 31st of 2025. And I made a little bit less than $700,000 during that span. So I just want to show you my track record. And year to date, guys, I am up a little bit over 6 figures, so about $105,000 so far in 2026. And you're probably noticing that it's a little bit of a slow start to the year, and it absolutely is by my standards. And I am expecting a much better second half to the year, but I want to be transparent and also talk about why it's been a slow start. And these are not excuses. I don't believe in excuses. I'm just giving you the reality of what this year has been like. So a couple of things. Number one, I've had a lot of personal stuff happen in my life. I've had a couple of losses in my family. So unfortunately, I had to take time away from trading. And on top of that, that impacted my mindset, my trading psychology. And yeah, it's difficult to trade when you have that sort of stuff going on in your family. It just is what it is. And it's unfortunate, but it's a part of life. But the second reason why it's been a slow start to the year is because I've actually really adapted my trading strategy this year. And I have other videos where I talk about that. I'm going to talk about that in this course as well. But yeah, I've made a lot of new adaptations. I've changed my style a bit. Before, I was a lot more of a scalper, and now I'm more of not necessarily a home run trader, but I'm going for higher R to R trades. And, this difference in style has taken me time to adapt to. And, that's ultimately our job as traders, is to adapt to the markets and always learn new things and make sure you're always sharpening the tools within your trading toolkit. So that's exactly what I'm working on this year. And, when I decided to make these new adaptations, I knew I was going to take one step back to ultimately make 2 or 3 steps forward. So hopefully that makes sense, but this is something, this is what I've been doing for 6 years. This is my passion. This is my full-time career. This is what I do every single day. And I love trading. I love teaching. And I really hope that you guys enjoy this free course, because I genuinely put so much effort into it. So take advantage. It honestly has the potential to completely change your trading career. So let's get into the first video, and we're going to start with trading fundamentals. Let us begin this free course by talking about the fundamentals of trading. Let's talk about the basics, and let us first define what trading actually is. And trading is when you're buying and selling a financial asset, whether it's a stock or a crypto, or it's gold or silver or oil or wheat, or it's an options contract. You're buying and selling a financial asset based on technical analysis and price action. This should not be confused with investing. I see a lot of people confuse the two. A lot of people think that trading is investing. It is not. As investors, we try to determine the intrinsic value of the asset that we're looking at. And based off that intrinsic value, we can determine whether the asset is overvalued or undervalued, right? And in order to figure out the intrinsic value, most of us look at the financial documents of a company. We look at balance sheets, income statements. We're looking at industry trends. We're looking at the news. We're reading analyst reports. We're understanding the cash flow the company has. We're understanding the assets that's on the balance sheet. We're looking at the fundamentals of the company or of the asset that we're analyzing. And based off those fundamentals, we determine, is it overvalued or undervalued, right? When you think of investing, you should think of Warren Buffett. What he does is invest in companies long term, and that's how he makes his money. He is not trading. When you are trading, you are solely looking at price action. You're not looking at any financial documents or news or fundamentals or anything. We solely look at the price action. And in this course, I'm going to dive really deep into what price action is, and there's going to be other videos that go over company fundamentals and investing and the real differences between technical analysis and fundamental analysis. But a short little summary: price action is the study of how prices move. And what we do as traders is we analyze how prices have moved in the past. We analyze what prices are doing right now, how they're moving currently, to analyze, to speculate, and to ultimately make money on what prices are going to do in the future. That's what we focus on as traders. We focus on technical analysis and price action. That is it. A question that I get asked all the time is trading gambling? And in order to answer this question, we need to define what gambling is. And by definition, gambling is betting on the uncertain outcome of a future event, meaning you don't know what's going to happen in the future, and you're betting that prices are either going to go up or prices are going to go down. By definition, trading is gambling. However, the connotation around gambling is that it's impossible to become successful as a gambler, I guess. And I don't really like to call trading gambling. I think trading is really similar to poker or blackjack in casinos, where if you're a really good poker and blackjack player, if you understand what you're looking for, if you have an actual edge, you're going to make money. And the same thing applies for trading. And in trading, just like in blackjack, we shift the probabilities of the trade in our favor by developing what is called an edge. And you've probably heard that before. Every trader has his or her edge. And more likely than not, you have multiple edges that make you a profitable trader. So let's define what an edge is. That is a statistical or behavioral advantage in the market. An edge is an advantage. It's something that makes you better than other traders who are unprofitable. It's the reason why over hundreds of trades, you're going to make more money than you lose. You have to understand that an edge, a statistical advantage, is played out not over 5 or 10 trades. It's played out over thousands of trades. And that's why it's so important to develop a sample size for your trading so you can actually extract data and then use that data to refine and build your trading plan, which, by the way, I'm going to cover all of this later on in the course. Okay, so you need to focus on building an edge, and that edge is going to make you money long term after you take hundreds and hundreds of trades. So very good. So is trading gambling? You could call it gambling because you're betting on an uncertain outcome of a future event. You don't know if prices are going to go up or down, and you're betting on that prices are going to go up by going long or that prices are going to go down by going short. And the way you shift the probabilities in your favor is by developing an edge. So that begs the question, what types of edges even exist? And there's a bunch of different edges. Number one, technical edge. Technical edge is an edge when it comes to reading the price action, mastering the chart setups, understanding the relationship between the buyers and the sellers, understanding volume, understanding support and resistance, understanding what separates a high quality setup from a low quality setup, understanding how to calculate reward to risk so you're only picking the setups that have a high likelihood of making you money. There's also a psychological edge. This is a trader that's able to control his or her emotions. They're able to stay disciplined, and they're able to execute on their plan even when it feels uncomfortable. And this is when you're able to control yourself. You're able to also control your impulses, and you're able to consistently follow your plan without having your emotions impact you. Next, we have a risk management edge. And there's a really kind of funny expression that I've heard in trading, and you'll have to excuse my French, but most traders eat like birds and shit like elephants. And essentially what that means is a majority of traders don't make much money on their winning trades when they're right, but they lose a lot on their losing trades when they're wrong. And as a trader, you want to reverse that outcome. You want to be capitalizing heavily on the trades where you are right. On the winning trades, you want to be making a disproportionate amount of money. And then on your losing trades, you want to focus on limiting your losses. And that's the risk management edge. And I'll tell you straight up, for me, the reason I am such a good trader today, I am really good at risk management. I rarely have losing weeks. I've never had a losing month in my entire career. Of course, I have losing days, but I'm really good at limiting my losses on my losing trades, and I'm very good on capitalizing on my winners. But specifically, I'm really, really good at managing my losses. I'm a really good loser, and that's what makes me a really good trader. Now, of course, I do have the other edges as well, but I would say my risk management edge is probably the most important edge in my own trading. And a lot of the times, you could have an excellent strategy. You could be an excellent trader, but if your risk management sucks, you're never going to become profitable, right? Your first priority as a trader is to actually preserve the capital in your account. You'll learn about that later in the course. Number 4, execution edge. This is the edge where you have a really good trading plan. You are very good at reading price action. You're good at identifying high quality setups. You're good with the risk management, but you're also excellent at executing it and being able to actually make money off of your trading plan in real time. You know how to quickly execute on your platform and get out of trades really quickly, enter into trades really quickly. You're able to manage trades in real time without making emotional decisions. And it's your ability to act on your plan without hesitation. And in this course, by the time this video ends, you will know exactly how to turn every single one of these edges that I just talked about into a system. You're going to learn the specific details that you need to know to master every single one of these edges. So hopefully it can transform the way that you trade forever. And that's exactly why I created this free course, to give you an edge in your technicals, with your psychology, with your risk management, and with your execution. Let's go over the different types of markets that you could trade in 2026. And for me personally, I day trade stocks. I don't trade crypto. I don't trade Forex. I don't trade futures or options. I am day trading stocks only. And I trade small caps, mid caps, large caps. I even trade penny stocks. And I personally trade on a margin account. Now, the one thing about trading on a margin account is that the PDT rule is going to apply. And the PDT rule, the pattern day trader rule, it requires you to have at least $25,000 in your margin account if you want to take more than 3 trades per week. If you have less than $25,000 in your margin account, then you're limited to only 3 trades per week. Now, the reason why a margin account is so useful is, number one, on a margin account, I can go long and I can go short. On a cash account, which is a very common alternative, you cannot go short on a cash account. And there are also other limitations that I'm going to talk about later in this free course. And with a margin account, you also have access to 4x additional intraday buying power. What that means is if I have $25,000 in my margin account, I could day trade with $100,000 worth of capital. If I have 30K in my account, I could trade with $120,000 worth of capital. And you might think that's really risky, or maybe you're associating the word margin with someone that you know who lost a lot of money. But margin is only risky if you don't know how to control your risk. If you just YOLO every play, you have no idea what margin is, you don't know how to size your positions, of course it's risky. If you don't know what you're doing, yeah, trading is going to be risky. Anything is going to be risky if you don't know what you're doing. You can't imagine driving a car without knowing how to drive, right? Obviously, that's going to be risky, but that's why you learn the proper precautions. You learn how to drive a car effectively, and that's when you go out on the highway, right? So same thing with trading. There are ways to minimize your risk and for you to control your risk, which is, that's exactly why you're watching free course. I'm going to teach you how to do that. Now, I personally trade on a margin account because I'm able to take more than 3 trades per week. And of course, I have way more than $25,000 in my account. However, when it comes to how much money you need to start day trading, you only need about $25,000. In fact, I would probably add a little bit just to have a buffer, because if you go below $25,000, even if it's $24,999, you'll be below the 25K and you'll be limited to 3 trades per week. So I'd recommend having maybe $25,500 in your account, or $26,000 or $27,000, just so you have a small little buffer, so you're not constantly worried that your account balance is going to fall below $25,000. I also think that day trading stocks, what I do, it's a lot easier and more straightforward to manage your risk. In fact, I think it's overall way more beginner friendly than trading options or futures or even crypto. I really think day trading stocks is the most beginner friendly, and it's the easiest to actually control your risk as long as you know what you're doing, okay? Number 2, crypto. This is when you're trading Bitcoin or altcoins such as Ethereum, Solana, or other coins. With crypto, you could use actually an insane amount of leverage. There are some platforms that allow you to trade with up to 200x leverage, which is just insane. I don't really recommend day trading crypto. I think it's way better for swing trading. Now, the thing is, with crypto, it's a 24-hour market. And what I don't like about trading in a 24-hour market is that I really like that as a day trader, the stock market closes at 4 p.m. Eastern, meaning once 4 p.m. hits, the market's closed, I can't trade anymore. And I like that. I like, Once 4 p.m. hits, I'm out of all my positions as a day trader. I don't have to worry about overnight risk. I don't have to worry about, oh, well, where's my stock opening at the next morning? Am I up or am I down? I don't worry about that. 4 p.m. hits, I'm done with the day, and I don't think about trading unless I'm journaling or reviewing my trades until the next morning, which I like that. With crypto, it's a 24/7 market, so you might be waking up in the middle of the night and checking on your positions and just constantly being stressed because there's crazy fluctuations in the crypto markets. I don't like that, okay? I like trading in a market that closes at 4 p.m. Eastern, okay? However, there's a lot of volatility in crypto. A lot of traders do like that. What I don't like about crypto as well is that during slower times, like during bear markets or when the market's not doing anything, or when Bitcoin is just chopping around, right? Volume can kind of dry up and it can be pretty slow. So yeah, crypto is a whole nother animal. I personally like day trading stocks, but I do invest in crypto. I'm a big, big believer in Bitcoin and Ethereum long term. Next, futures. I'll be honest with you guys, I don't have a lot of futures experience, but that's like trading NQ, ES, oil, gold, and other leveraged instruments. It's very prop firm heavy. A lot of people who trade futures use prop firms, which I'm also going to cover in this course. And I think trading futures, it's easier to scale your profits once you're really good at trading futures. However, there's a lot more of a learning curve to get started because I think it's a lot harder to manage your risk with futures compared to day trading stocks. And that's why I recommend for most beginners to just, start with stocks, and later on you can move on to futures. And yeah, I think I don't have much experience with it, so you could still apply a lot of my education that I teach in this course towards futures. I just don't personally trade it. Forex, never trade Forex, never will. I think it's a really heavily manipulated market. I just don't recommend trading Forex. Why would you trade Forex when you could trade, stocks or futures or crypto? Just stick to those. Personally, I day trade stocks, but it doesn't matter. You could apply everything that I teach in this video towards all markets. So if you want to use my education for futures, great, you can do that. You want to use it for crypto, great, you could do that. For stocks, fantastic, that's exactly what I trade. Even if you want to trade Forex, no problem. You could still use all of these principles and fundamentals and price action concepts that I'm going to teach for your trading. Let's go over the tools, software, platforms that you need in order to trade. And I actually have personal experience with a lot of the platforms I'm going to talk about, so I'm going to give you my honest opinion. Number one on my ranking is Thinkorswim by Charles Schwab. This is actually the platform that I personally use for my own day trading. And whenever you're creating a Schwab account, make sure you enable margin and you enable Thinkorswim access when you are applying. And let's go over the pros first. Number one, the execution is overall really good. It's a great platform to scalp stocks on. Of course, every platform is going to have delays and it's going to be slow from time to time, but overall, Thinkorswim is consistently fast with the execution. And I think the platform overall is actually pretty intuitive at first. It's going to seem really strange because it looks a lot different than other trading platforms. However, once you get the hang of it, it's super intuitive. I really like the charting. It's great for shorting, has a really good hard to borrow list, and the hard to borrow fees aren't too expensive. So you have a lot of different options when it comes to shorting stocks. And it's available internationally, right? It's available almost everywhere around the world. In Europe, it's available in South America, it's available in certain parts of Asia, it's available in certain parts of the Middle East. So if you're watching this and you're not from the United States, I would just do a simple Google search, look up, is Schwab available in my country? And if it is, go to the Schwab International site and you should be able to find your country and you'll be able to apply for an account. And overall, I love using Thinkorswim. Another huge pro is they have excellent price improvement, and that's when they give you a better fill than you were supposed to get on your trades, which could be a massive edge on some of your trades. So the price improvement is excellent as well. I would say the biggest con is the fact that the paper trading platform has limitations. So if you're a beginner and you don't want to jump into real money right away, you want to paper trade first, the paper trading platform honestly kind of sucks. There's huge delays. The execution isn't good. The fills aren't good. So that's the one con I would say. Funny enough, all those delays that exist with paper trading, they don't exist with real money. And in fact, it could even be looked at as a pro, because I've actually had students that paper traded on Thinkorswim for a few months. They became profitable paper trading. And once they transitioned into real money, they actually performed even better with real money, because paper trading on Thinkorswim is almost like trading on hard mode. It's like playing Mario Kart on max difficulty, where it's super, super hard, right? But then once you go to real trading and you don't have those same delays, and you actually have really good execution and good fills, trading feels a lot easier. So it's kind of actually a good thing, where you can kind of trade on hard mode as a beginner, and then when you go to trading with real money, it feels a lot easier execution-wise. So I highly recommend Thinkorswim. I don't even have an affiliate link. I'm just recommending what I personally use. Next is TradeStation. I used to use TradeStation back in the day. TradeStation is solid. I would say it's just a worse version of Thinkorswim. The execution is actually great. The platform can be a little bit glitchy when it comes to charting, but overall, it's actually really similar to Thinkorswim. It's a great platform. The biggest con for me personally is the fact that the short list is limited. You can't short as many stocks on TradeStation as you can on Thinkorswim, and locating shares can be super annoying. So if you're choosing between TradeStation or Thinkorswim, I would just use Thinkorswim personally. Now let's go over Webull. I've never used Webull actually. However, I've had students that have used Webull. It's a pretty good platform execution-wise, but similar to TradeStation, the short list is limited. I don't think they really have that good of price improvement, and the customer service is non-existent. Okay, so if you're stuck in a trade and you want to call their front desk, no one's going to pick up. Yeah, the customer service just isn't good. So between Webull, TradeStation, and Thinkorswim, I would obviously use Thinkorswim, but Webull is still a solid option. Interactive Brokers, it has commissions. So if you're in a country where no other, you don't have access to any of these other platforms, and Interactive Brokers is fine. However, it has commissions, and I know the platform isn't very intuitive. Next, we have Lightspeed, and there's a bunch of platforms similar to Lightspeed, also like Cobra Trading. And the only issue with Lightspeed is that they have big commissions, but the execution on Lightspeed is amazing. So the execution is amazing. And I think it's actually pretty complicated for a new trader. That's another con. And you could also customize your routing on Lightspeed. So I would say if you're a trader who's trading massive size, where you don't really care about paying 500 to 2,000 a day in commissions, you're trading massive size, you're going for 20, 30, 40, 50K days, Lightspeed is probably your best option. However, the commissions are super rough, but the execution is excellent. So that's what I would recommend. Personally, I would just go with Think or Swim platform out of all of these. And if you're international, I think you could actually pair Interactive Brokers with TradeStation if you don't have Thinkorswim available in your country. And if you're a beginner, or unless you're trading massive size, I just wouldn't use Lightspeed, right? Because the commissions are just overwhelming. Other tools, you could use TradingView.com. You don't need to purchase a paid account. I use the free account. I don't use this for my personal day trading. I use this after trading hours if I want to review charts. I use this to look at crypto. I use this on my phone whenever I want to check out a chart. It's a really easy charting software. I don't think there's a need to pay for premium though. You could also use a trading journaling software where you could actually link the platform where you execute your trades to this software, and your trades would actually carry over, and the software would give you feedback based off your win rate or your reward to risk, and it can give you very valuable information about your trading. So it can be super useful. The most popular one is TradeZella. Now, I don't personally use one right now. However, I've had a lot of students that have used TradeZella and other ones, and they found it really beneficial for their trading. I would just do a Google search and look up best trading journaling softwares, and from there just pick the one that makes the most amount of sense for you. And when it comes to actual trading setup, my biggest recommendation is to just keep it simple. Now, you can trade on a laptop, that's fine. When I started, I actually traded on a small little Dell laptop. However, I do recommend a 25-inch plus monitor just so you do have the screen space. And I'd recommend either a desktop computer, or you could actually link your laptop to the monitor. You need a mouse and a keyboard, And of course, you need a great Wi-Fi connection. That's all you really need, okay? There are a lot of traders that have like crazy curved screens. They have 5 different monitors, and it looks like a really complicated and professional and fancy setup. You don't need that, okay? Especially as a beginner. If you have a 25-inch monitor, a normal computer, and a good Wi-Fi connection, and a mouse and a keyboard, that is all you need. Start small, and then you could upgrade your setup as you become more profitable. Let's talk about order types and order execution. Whenever you are placing a trade, you need to submit an order. And the best way to think about this is the orders that you place is kind of like the language between you and your trading platform. And you're going to be placing different types of orders depending on the trade and depending on what you want to accomplish. So you're going to be placing different orders if you're going long or short, or whether you want to buy at a certain price or exit at a certain price. And it's really important to master the language between you and your trading platform so you could trade quickly and you could trade efficiently. So let's go ahead and talk about all of these types of orders so you can become a master and you could really understand the types of orders that you want to execute. So let's go and start with a market order. And this is probably the most basic type of order. And by definition, a market order buys or sells a stock immediately at the best available price. So if you're trading on your platform and you press market buy, you are going to get filled right away at the best available price. If you're in it long, let's say you're in a position, it's long, it's moving up, and you want to sell that position as quickly as possible, you would place a sell market order and it would fill your position at the best price available, the current price. So this is an order that you would use if you want to get out as quick as possible. You want to exit right now, you would place a market order to sell if you're long, or you would place a market order to cover your shares if you're in it short. So let's say, for example, Apple is trading at $180 and you place a market buy order. That order is going to fill you right away. However, it's not going to fill you at your desired price. It's not going to fill you, or it's not guaranteed to fill you at your desired price. Meaning, let's say the price is at 180, you press a market order to buy. Maybe by the time your order executes, the price moves and it'll fill you either at 180.02, or maybe if it's really moving fast, it's going to fill you way late and it's going to fill you at 180.20. Or maybe it'll fill you, below that price, where it fills you at 179.98 or 179.90. And that is really going to depend on how quickly the stock is moving. It's going to depend on the spread, which you're going to learn about later. It's also going to depend on the liquidity. So this is like saying, I'll pay whatever the current price is, just get me in right now or get me out right now. Okay, so what does a market order really mean? So you're going to get really fast execution because it's going to fill you immediately, whether you're getting in or whether you're getting out. However, it's not guaranteed to give you the best price. For example, let's say Apple is moving up and it's starting to consolidate. And let's say I want to buy it when it hits 180, like this example, right? And let's say as soon as it hits 180, that's your trigger to buy it, and you place a market order to go long, right? By the time your order executes, maybe the stock has already moved really quickly and it's here by this point where it really moved up, and you place an order at 180, market order to buy, but it ends up filling you at, let's say, 180.30, right? That could happen where you get filled 30 cents late than when you actually placed the order. And of course, that's going to depend on liquidity, it's going to depend on the spread, and it's going to depend on how quickly the stock is moving. So that's the downside. You're not always going to get the best price. You can't control the price that you get filled at because it's just going to fill you at the best available price, right? So for me personally, I rarely use market orders to enter into trades. Pretty rare. I would say maybe 5% of the time I'm going to enter into a trade using a market order. However, I always use market orders to exit my trades, right? Even if it's a stop loss, right? A stop loss order actually triggers and executes like a market order, and I'm going to explain that in a second. But whenever I'm exiting, I'm always using a market order to exit. I rarely use market orders to get in, because whenever I'm entering into a trade, I want to make sure I get my desired price. I don't want to get in late, okay? Because if I get in late, let's say I want to get in a 180, I place a market order right here, and it fills me a 180.30, well, I'm 30 cents late. That's going to impact the size of my stop loss, which you will learn about later in this free course. And it's also going to impact my reward to risk, which you will also learn later. So yeah, when it comes to market orders, I don't like to use them to get into trades. However, I always use them to exit out of trades, and it's going to fill you at the best available price. However, you're not guaranteed to get the exact price that you want. So this is more for instant execution. Let's go over what a limit order is. A limit order lets you set the maximum price you're willing to pay when it comes to going long, or the minimum price you're willing to sell when you're going short or when you are selling. So the best way to explain this is to go over an example. So let's say you want to buy Tesla at $240. However, the current price is $245. So let's say Tesla is basing, and right here, it's $245. Okay, great. However, you think that's a little bit too expensive. You don't want to pay $245 for your shares of Tesla. You want to pay $240 or less, right? You don't want to pay anything more than $240. So you're okay with paying $240. You're okay with paying $235 for Tesla. You're okay with paying $200 for Tesla. You just don't want it to be more than $240. Great. In this example, you would set a limit order at $240. So you'd place a limit order right here, let's say, at $240. So 240, you place a limit buy. Okay, I'll just write limit buy. Fantastic. So now the only way that you would get filled on your limit buy order is if the prices went down to either 240 or below 240, where maybe let's say Tesla reported earnings and the earnings weren't very good at all, and the stock gapped down overnight, had an overnight change in price to the downside and opened lower the next day. Let's say it opened lower at 230, right? Would it fill your order? Well, is 230 less than 240? Is it a better price than 240? Yes, it is. 230 is less than 240. It's a better price. So therefore, you would get filled, right? If it gapped to 220, would you get filled? Well, 220 is less than 240. You placed a limit buy 240, so you want to pay 240 or better. 220 is better than 240. Yes, you'd get filled. Let's say it opened instead at 242. Would you get filled? Would you? And the answer is no, you wouldn't, because you only want to buy this at 240 or lower, 240 or better. So you will not get filled. So you get filled at 240, yes, 230, yes, 220, yes, right? And you know, the downside is, right, you control the price, you control exactly where you want to get in. However, you might not get filled, right? Maybe the prices don't go down to 240 and instead the prices just continue going higher. In that case, you're not in the trade, right? So this is like telling your broker, I want you to buy these shares, I want you to buy this stock, but only if it gets cheap enough, okay? And the same thing applies if it's the opposite way and you're going short. It's the same exact thing, okay? So when it comes to limit orders, I actually use limit orders 95% of the time when I'm entering my trades. And I place limit orders on the current ask price when going long, and I place sell limit orders on the current bid price when going short. So there's probably going to be a video later on in this free course that really explains the bid and the ask. But basically, you know, when it comes to trading, it's basically kind of like an auction. You have a bid and you have the ask, right? The ask is the best price the sellers are willing to sell at, and the bid is the best price the buyers are willing to buy at, right? So for example, let's say the bid is at $7 and the ask is at $7.01. So right off the bat, the difference between the bid and the ask is called the spread. So $7.01 minus $7 is 1 cent. That means there's 1 cent spread here. That still sounds confusing. Don't worry, I'm going to cover it later in this free course, okay? So if I want to buy a stock I am going to get filled where? Well, who am I buying from? I'm buying from the sellers. And the sellers, well, their price is at 701. The sellers are willing to sell this stock at 701. So when I'm buying, I'm going to get filled on the ask. I'm going to get filled on the ask price. Whenever I'm selling, well, who am I selling to? I'm selling to the buyers on the bid. So if I sell something, I'm going to get filled on the bid at $7. So for example, let's say I buy 1,000 shares of stock, right, at this current price. Well, I'm going to get filled for where? I'm going to get filled on the ask. So I buy 1,000 shares. I'm going to get filled at 701 when I'm going long. Okay. Now, if I was to sell immediately, let's say the price doesn't move and I just sell this immediately. Well, if I sell, I'm going to get filled on the bid, right? So now I'm selling 1,000 and I'm going to get filled at 701. Oh, I'm sorry. I'm going to get filled at $7. $7, not 701. I got filled at 701 when I bought it, and then when I'm selling it, I get filled on the bid, so I get filled at $7. So how much am I losing here? Well, right off the bat, I'm losing 1 cent, right? Because $7.01, when I got in long, I got filled on the ask. When I sold it, I got filled on the bid, so I lost 1 cent in this trade, right? 1 cent on 1,000 shares is $10. So that means by just me getting into this stock and without it moving, I'm automatically down $10. I'm automatically down 1 cent on every single share that I bought. Coincidentally, 1 cent is also the spread. And that's exactly why spread is significant. That's why we want to trade stocks that have tight spread, right? Because if I'm buying, let's say, something that's super spready, let's say instead this is at 707, this is at $7, right? So the bid is at $7. It's the best price the buyers are willing to buy at, but the ask is at 707. This is the best price the sellers are willing to sell at. That means, what's the spread? Well, 707 minus $7 is 7 cent spread, because that's the difference between the bid and the offer. That means if I was to buy this stock, where would I get filled? 1,000 shares, I want to buy it. I would get filled on the offer. So I'd get filled at 707. And then let's say the price doesn't move and I want to sell it. Okay, I sell 1,000. Where would I get filled? At $7. So how much did I lose here? I lost 7 cents per share. How many shares did I buy? 1,000. So I would lose $70. So basically the spread is significant because that's the exact amount that you're down whenever you enter into a trade without it moving, right? Like if you enter into a trade, right away you're down whatever the spread is. You're down 1 cent times how many shares you have. Or in this case, down 7 cents because the spread is 7 cents. Does that make sense? So that's actually a little bit of a crash course when it comes to spread. It's not really important yet. You don't need to know that yet, but just so you have some background, let me go ahead and erase this. So let me explain how I place my limit orders. Okay, let me just erase all this. Okay. So when it comes to placing my limit orders, and I'm looking, and by the way, you would use the level 2 to see the bid and the ask, but most platforms are going to tell you this. So again, this is the bid, this is the ask, okay? So if I get in, let's say the bid is at $7 again, and the offer is at 701. When I buy it, where am I going to get filled? I'm going to get filled on the ask. So what I will do whenever I'm getting in is I place a buy limit order on the current ask price. So if I want to buy this right now and I don't want to pay more than 701, I will place a buy limit order at 701. Okay? And whenever I want to sell, I can either go market, right, which is I'll just get out immediately at the best price available, or I could place a sell limit order on the bid. So whenever I'm buying on the ask. Whenever I'm selling on the bid. So that's what I would do, right? So if I'm going short, I want you to think about it. If I'm going short, what kind of order am I going to place? Well, I'm going to be placing a sell limit order where? A sell limit order on the bid, okay? In that case, I'm paying this price or better. So if the price goes down, I'm not going to get filled late, right? Or let's say I place a buy limit order. Where am I going to place that? On the ask. I'll place it at 701. In that case, if prices jump to 702 or 703 or 704, I'm not going to get filled late because it's a limit order. I'm only willing to pay that or lower. So if I place a limit order at 701, that means I only want to get filled at 701 or better. So I can get filled at 701 at $7 or $6.99, right? But I'm not going to get filled at 702. And that's what ensures I won't get filled late. So that's exactly why I place buy limit orders on the current ask, or whenever I'm going short, I will place a sell limit order on the current bid. Now, that honestly might sound a little bit confusing, especially if you're a beginner. Don't worry. That's fine, okay? If this still sounds confusing, don't worry. I'm going to cover it later in this free course. But that was basically a crash course on how the bid and the ask works and how spread works and how I place my orders. I place buy limit orders on whatever the current offer is to make sure I get filled here or better and I don't get filled late. Whenever I'm going short, I place sell limit orders on the bid price, and that ensures I either get filled at $7 or better and I don't get filled late if the price continues to drop, okay? Hopefully that makes sense. And my recommendation is to just practice this, okay? And let me know in the comments if you do have any more questions about this. Happy to clarify anything. Fantastic. Let's go ahead and talk about what a stop order is. And you've probably heard of this because I'm sure you've heard of stop loss. Well, a stop loss order is a stop order, okay? So by definition, a stop order becomes a market order once the price hits your stop level. Most people use this to protect themselves from big losses. So hypothetically, you bought NVIDIA at $120, okay? NVIDIA triggers a breakout and you bought it at 120 right here. And you set a stop order at 115. Let's say your stop order is at 115 right here. And this is a sell stop order, okay? If the price drops to 115, it will trigger a market order to sell your shares. That's really important. So let's say that again. If the price drops to 115, that means the price drops to 115, it will trigger a market order to sell your shares. So it will exit you as soon as your stop order is hit when prices hit 115. Now, keep in mind, because it will trigger as a market order, it's not guaranteed to fill you at exactly 115. It might fill you at 115. It might also fill you at 114.80 or 114.90 or 115.10 or 115.15, right? Because it's a market order. We already talked about that a market order gets you out at the best available price. And we already talked about that. If it's an illiquid stock, or if there's a lot of spread, or if it's a really fast moving stock, it might not fill you at the exact price where you placed your order, okay? So if you place a stop order at 115 and it triggers, it might not actually fill you at 115. It will fill you at whatever the best available price is when the order executes, which could be 114.90, it could be 114.60, it could be 115.10, right? It completely depends, okay? So let's go over another example. You could also place stop orders when you want to enter into a trade. So let's say NVIDIA is at $120. Okay, let's erase this example. Let's say NVIDIA is already at $120 right here. Okay, but you want to enter the trade if the price hits 130. Meaning, let's say it's at 120. You don't want to get in at 120. You want to get in at 130 right here, because let's say, I don't know, if it hits 130, it officially triggers a weekly setup. And there's a breakout on the weekly time frame. You only want to get in if prices hit 130. So what you can do is you place a buy stop order at 130, and this will only trigger if prices move up and hit 130. Okay? So you could place, stop orders when it comes to protecting yourself, where you're in it long and you place a stop loss order wherever your stop loss is, or maybe you're in it short. Maybe it's a breakdown, right? You get in right here at 120, and let's say your stop loss is at 130, hypothetically, you would place a stop loss at 130, and then if prices go back up to 130, it would exit you out of your position, okay? So you could either do it to exit your trades, or you could even do it to enter into your trades, where, like in this example, prices are at 120, but you only want to get in if prices hit 130. So you would place a buy stop order at 130 and it would only execute once prices move from 120 to 130. So this could help you limit losses, but it may execute slightly below your stop due to volatility, right? We just talked about that, how because it's a market order, you're not guaranteed to get filled at the exact price that you want, right? And same thing with this. If you place a buy stop order at 130 and prices move up and hit 130, it might not fill you at 130. It might fill you at 129.50. It might fill you at 130.30, right? Again, depending on how fast the stock is moving. So this allows you to place orders ahead of time if price hits a certain level, right? So if prices go to 130, it'll fill my order and it'll trigger me into the trade. Or let's say it's a short, right? Let's say this is 100. You only want to get in if prices hit 90, right? In that case, you'd place a sell stop order at 90 and then prices need to go down to 90 to fill your order and you would get executed here as a market order, okay? So you could use stop orders either to exit out of trades by using just a traditional stop loss order, like probably what you've heard of, that we just showed, where you're in a trade, you place a stop loss. If it hits your stop, you're out of the trade to protect yourself from further downside. Or you can even use it to enter into trades where you want prices to move up to a certain key level to get filled. Or if you're in it short, you want prices to drop to a certain key level before you get in the trade short. So hopefully that makes sense. And yeah, make sure you rewatch this clip and the other clip, the limit order, a couple of times to really understand what this means. And my suggestion is to go and practice this. Open up your platform and start taking stop order trades and start taking limit trades as well, just to get a feel of it and just to get some practice in. Let's go ahead and talk about what a stop limit order is. And just like the name suggests, a stop limit order combines a stop order and a limit order. So once your stop price is reached, instead of it triggering as a market order, like I talked about in the last example, instead it triggers as a limit order. So instead of a market order, it triggers as a limit order. So let me explain why this is important and how it works. So let's say you're watching NVIDIA at $120. You've identified a resistance level at 125. Price has tested it multiple times, but it hasn't broken through yet, okay? So let's say you're looking at NVIDIA, you see a consolidation and the current price is $120. And this key resistance level is right here at, let's say, 125. Fantastic. You strongly believe that if it breaks over 125, it could rally quickly to 130. So let's say this is your target at 130. You're confident that if prices break 125 and it breaks out of this resistance area, it could easily go to 130. Great. So what you can do to execute on this order is you could place a buy stop limit order. Okay, so your stop price would be 125, right? Just like in the other example that we just went over when we went over what a stop order is, you could place your stop order at 125, right? So meaning if prices go up to 125, it would trigger your stop order and you would get into the trade. Now, a traditional stop order, that order would trigger and execute as a market order, meaning you might get filled at 125. You also might get filled at 125.10 or 125.30 or 125.70 or even 126. It might fill you late because this stop order is triggering like a market order, right? Maybe it fills you even below. Who knows? It depends how the stock moves. But the point is, you're not going to get your exact price at 125. You might get above your exact price or below your exact price. And that uncertainty is unsettling for a lot of traders. Who knows? Maybe the stock moves really quickly, right? It hits your stop order at 125, triggers a market order, and it fills you at 127, right? It fills you at 127. And now you're in the trade $2 late, and you don't like that. So what you can do to protect yourself from that situation is, instead of using a stop order, you would be using a stop limit order. So when you add the limit part of this into the equation, right, what you could do is you place your stop price at 125. Great. So when prices hit 125, great. Instead of it triggering a market order, it would trigger a limit order, and you could do a buy limit order at 125.50. So let's say that happens. Let's say you place an order, a stop order at 125, and when the stop is hit, then the limit order activates at 125.50. So keep in mind, what does a limit order do? Let's go ahead and remind ourselves what a limit order does. A limit order sets the maximum price you're willing to pay when you're buying. It sets the maximum price. So basically, with this limit order triggering at 125.50, it's either going to fill you at 125.50 or lower, meaning that let's say the stock moves really fast, and by the time this triggers, it pops really fast to 125.70 or 126 or 127. It's not going to fill you up there. It's not going to fill you late. It's only going to fill you at 125.50 or lower, okay? So if NVIDIA's price hits 125, your buy stop triggers, your limit order activates, right? So your buy stop would trigger, and as soon as that's triggered, it would activate your limit order. And you will only get filled if the price is at 125.50 or lower. You will not get filled if the price spikes too fast and too high. You won't get filled at 126 or 127. You're only going to get filled at 125.50 or lower. It's like me saying, if the stock proves itself and breaks above resistance, right? If it breaks above 125, I want to get in. However, I only want to get in if I can get a reasonable fill. I only want to get in if it fills me at a reasonable price. And you could set what that reasonable price is. You could set this instead of 125.50, you could set this at 125.10, right? In that case, if this triggers, your limit order activates, right? You're only going to get filled at either 125.10 or better. You won't get filled late. Now, the downside is maybe it's fast. Maybe it goes up right away and it doesn't even, it just flies by your limit order. In that case, you won't get filled. However, at least you're not in it late versus, if you used a regular stop order, it would fill you market and you might be super late on the trade. Okay, does that make sense? So in summary, I know that might be a little bit confusing. In summary, whenever you're placing this type of, stop limit order, it's always going to ask you, what's your stop price? Like on your platform, it's always going to ask you, what's your stop price and what's your limit price? Okay? So you have to put in the stop price first. In this case, I want to potentially get in if it breaks above this resistance, right? If it breaks above 125, that's the trigger for my setup. I want to get in. So your stop price would be 125. However, I don't want to pay 126 for this. I don't want to pay 127. I don't want to get in late at 128. I want to make sure that if it hits my stop at 125, right, I want to make sure that my average price is no greater than 125.50. I'm okay with being 20 cents late, 30 cents late, even 50 cents late. However, I'm not okay with being even 60 cents late, which would be at 125.60. I'm not okay with being $1 late, which would be at 126. No, I want to get filled at 125.50 or better. And this allows you to control the price that you get filled at. So it's a really useful way to make sure that if you're getting into a trade using a stop order, well, you're not going to get filled super late when it ends up triggering as a market order. You could place a stop limit order and you'll get filled, you make sure you won't get filled at too high of a price. Okay, I don't recommend doing this when it comes to exiting a trade, right? Like let's say you're already in a position. Let's say you're in this breakout long. I don't recommend placing a stop limit order here, right? Because if you're exiting a trade, you want to get in, you want to get out as soon as possible. You don't want to, imagine you leave your desk and you have a stop limit order here. Who knows, it might not fill you. And all of a sudden you're in the trade as it's going against you. So when it comes to exiting, I would just use a regular stop order where it'll just fill you market at whatever the price is. But whenever you're entering, you also have the option of using a stop limit order to make sure you control the price that you get filled at. Okay, hopefully that makes sense. And my recommendation, guys, is Based off my explanation here, I would load up your trading platform. I would rewatch every single one of these explanations. And as I'm explaining it, I would literally, do what I am explaining. I would literally go on your platform and place these types of orders. You could do it on maybe on a simulation with paper trading, so you're not risking real money. And you could practice and you could see how it all plays out in real time. That's my suggestion. So do that, and yeah, I'll see you in the next video. Becoming a profitable trader is actually much simpler than you think it is. And before I give you a full framework on exactly what I would do today to become profitable and exactly what I did almost 6 years ago to achieve profitability, I want to emphasize that when I say trading is simple, I don't mean that it's easy. Trading is very difficult. This is not a get-rich-quick scheme. This is not easy money. And the best way that I would think about this is, imagine you want to get a six-pack. You want to get abs. The process of achieving abs is actually pretty straightforward. What do you need to do? You have to go to the gym probably 3 to 4 days a week and hit abs. You need to be on a caloric deficit where you can't be eating junk food. You have to eat clean. And of course, you probably need to do a whole lot of cardio. And if you do those 3 things and you do that for 3 to 6 months, you can achieve abs. The process is simple. You know exactly what you need to do to actually get abs. Now, the reason it's difficult is because no one wants to execute that process. No one wants to put in the work. No one wants to be disciplined, and no one wants to stop eating junk food and actually go to the gym 3 to 4 days a week. And that's why actually achieving it is difficult, but the process is simple. And the same exact thing applies for trading. The process of becoming profitable is a straightforward process. Despite the fact that a lot of traders make it seem extremely complicated, it really isn't. And that's the first purpose of this video, to give you a step-by-step simple process so you know exactly what you need to do to achieve profitability. And from there, I also want to give you some tips, some advice, things that I personally did to make that process a whole lot easier. Before I get into this video, a little introduction about me if you're brand new to the channel. My name is Emmanuel. I've been day trading for almost 6 years. I'm a Georgia Tech graduate, and I made just shy of $500,000 in 2025 day trading stocks. And the reason I'm sharing that isn't to boast or to brag about my results, but I want to be as transparent and as real as possible. I show my brokerage login in nearly every single video that I post. I've showed my brokerage statements on my YouTube channel as well. I think transparency is really important. And I think the first step that you need to know in order to become a profitable trader is you need to be ready mentally for this process. You need to understand that you have to go into this journey ready to be committed. You have to be ready to put in the work. You have to be ready to be patient. And most importantly, you have to be ready to be disciplined, because this is not going to be easy. This is going to challenge you mentally. It's going to challenge you emotionally, and it's going to challenge your own psychology. It's going to force you to become an elite version of yourself. And in order to do that in the first place, you have to begin adopting the right habits. You have to decide right now, are you all in on becoming a profitable trader, or are you not? Right? There's no in between. You cannot kind of half-ass it. You can't be in between, well, I want to become profitable, but it's too hard, but maybe I should. No, you cannot do that. It's either you're all in or you're not. So I want you to decide right now before you continue watching this video. Are you all in? Fantastic. So for all the people who are not all in, well, just click off of this video right now. But for all the people who are, let's go ahead and continue. Step number 2, and I'm going to be as honest as possible here. If you want to see genuine success with trading in a relatively short amount of time, you need a trading mentor. And I'm going to be transparent here. The reason I'm a profitable trader today, it's not because I'm a genius and I figured it out all by myself. No, my dad taught me how to trade. He was my trading mentor 5.5 years ago, and it took my dad over a decade to become profitable because he did it all by himself. He had to experiment with strategies. He had to lose a whole lot of money. He had to figure out risk management. He had to develop his own system, and it literally took him a decade to become profitable. But after he taught me how to trade, it only took me 3.5 months before I started making money with trading. And again, it's not because I'm a genius. It's because my dad literally showed me exactly what to do. He was my mentor. For the first 3.5 months, I sat next to my dad, this was during COVID, and I would watch him trade and I would paper trade next to him and I would just basically copy him, right? At first, I would copy him. I would ask him questions. Why did you make that decision? You know, what made you like this setup? What do I do here, right? And that's how I would learn. I would sit next to him, watch him trade, do it myself, and ask questions. And I did that for about 3.5 months. And then at some point, my dad said, hey, you know what? I think you're ready to begin trading with real money. You're gonna start off really, really small, but I think you're ready to move on from paper trading. And I'm very grateful and I'm very blessed because my dad funded my account, okay? He gave me the capital to begin trading. And on my first day trading with real money, I made a little bit over $700. And that just changed my entire perspective about trading. I saw my dad make money in front of me, but it didn't become real until I had my first winning day. But again, the reason that happened is because of my father. He was my trading mentor, okay? And it took him a decade because he tried to figure it out all by himself, but it took me 3.5 months because he taught me. So you need a mentor. I'm not saying it has to be me either. That's not like the purpose of this video to frame it, oh, well, here's my mentorship. Like, no, that's not the reason. I don't care who you choose as a mentor, whether it's me, whether it's someone else, whether it's your grandmother, it doesn't matter to me, okay? But you need a mentor, and whoever you choose, make sure that person is credible. Make sure they're live trading every single day and you're learning from them as they're live trading. And number 3, make sure that they're transparent with their results. Make sure they're actually showing you their statements. They're showing you that they're actually successful doing this, okay? I don't care who it is, but you need a mentor. It's going to expedite this entire process of becoming profitable, because otherwise you're gonna go through the same journey that my dad did, where he had to figure it out all by himself. He had to experiment with this system, with that strategy. He had to experiment how to size his positions correctly, right? And he lost a lot of money throughout that journey. And you don't wanna do that. You don't wanna figure it out by yourself because it's going to take 10x as long. You have to expedite the process. So find a trading mentor. And either way, think about it like this. If you were to figure it out by yourself anyway, you would probably lose a whole lot of money trying to experiment and figure it out. Invest that money you would lose towards an actual mentor that could show you the ropes. And if you do want to learn from me, well, you can learn from me for completely free. I have hundreds of hours of free education on the internet, not only on this YouTube channel that you're watching right now, but I also have a free 10+ hour trading course that is genuinely better than most paid courses on the internet. It's gonna teach you my system, it's gonna teach you my strategies, and it's gonna help build the foundation for your success. So you could find it directly below this video in the description. It's 100% free. Take advantage of it. Step number 3, before you deposit any money into your account and you get excited to begin live trading, I want you to take a step back and focus on your education. Focus on learning your core methodology, and your methodology is going to drive all of the decisions that you make in the markets. What you need is a system. You need a systematic approach to the markets where you're walking in every day with a game plan. You know where you're going to be entering. You know how to scan for your plays. You know where you should be exiting your trades. You know how you should be managing your positions. And most importantly, you should know exactly how much you're risking before you take the trade in the first place. You have to know the exact worst case scenario. You have to know that if this trade hits my stop loss, how much am I going to lose? And you have to make sure you're sizing your positions for that risk. So you have to focus on your education, because after the education comes the application process. But there's nothing to apply if you don't have that education in the first place. And this is where a lot of traders fail. They don't want to do the education. They find it too tedious. They don't want to put in the work, and they just jump into live trading and they start making random decisions without an edge. Keep in mind, without the education, you're not going to have an edge in the markets, and without an edge, you're never going to become profitable. And also keep in mind that random decisions are going to lead to random results. And that is not the formula for you becoming consistently profitable. If you want to make money on a consistent basis, you need to have consistent input in your trading. Consistent action leads to consistent results. And the only way to have consistent actions is to have that methodology, to have the system behind your trading. Step number 4, it's time to begin the application process, where you're going to begin applying everything you learned in your education. And this is really when the journey begins. And the first thing you want to do is start with paper trading. Paper trading is trading with fake money. It's simulation trading. It's a great way to practice your strategies without incurring any risk. But more importantly, it's a great way to become familiar with your platform, to understand the ins and outs of your setup, to be able to execute without making really simple and avoidable mistakes. And that's really the true purpose of paper trading, to get accustomed to your platform. With paper trading, there are differences in the psychology of paper trading versus trading with real money. Because with real money, well, you're going to take it a lot more seriously, and you're going to have different emotions when you're trading with real money that you may not have with paper trading, because ultimately you know it's fake. You know it's not real money. So you might end up over risking on paper trading, and you end up making decisions with paper money that you wouldn't make with real money. And that's exactly why I recommend paper trading until you are familiar with your platform. And whether that takes a couple of days or a couple of weeks or maybe even a month, right? That doesn't really matter. That's up to you. That's personal preference. I know a lot of traders who treat paper trading very seriously. For them, there's not that much of a psychological difference, and they treat paper money just like they would with real money. And they paper trade for a couple of months and then they transition to real capital. That's fine. I know other traders who paper trade for like 3 days and then they transition into trading with real money because they just don't experience the same psychology and emotions with paper money as they would with real money. Ultimately, it's up to you to when you want to transition from paper money to real money. However, I would recommend doing it sooner rather than later, especially if you're already accustomed to your trading platform. And when you are paper trading, make sure you keep it as realistic as possible. Make sure you're using the same risk with paper money as you would with real money. I know a lot of traders who make a ton of money with paper trading, but then as soon as they transition to trading with real money, they can't make a dime. And it's because of those psychological and emotional differences. Once you transition into real capital, I don't want you to be risking large amounts of money. I want you to start small. I don't want you to risk $1,000 or even $500 or even $100 per trade. I want you to start very small. I want you to pick a number that you are absolutely, no doubt, comfortable with losing. And for most people, I usually just say, start with $1. I much rather you trade with $1 risk or 50-cent risk or $2 risk, whatever, than paper trading, to be honest. Because with $1 risk or 50-cent risk, you are essentially paper trading. You're risking such small amounts of money that even if you have 5 to 10 losing trades in a row, it's not really going to impact your account. And in fact, I think that's better than paper trading. Trading with like 1 share per trade. That's better because at least it's real and you get real life execution, real life fills, and at least the psychology is going to be a lot more realistic. Now, when you begin trading with very small risk, I don't want you to chase perfection. That's what a lot of beginner traders do, where they're only looking for A+ picture perfect setups based off the education they learned. And that sounds really good in theory. In fact, that's what you hear on most of the internet, right? Take high quality setups, picture perfect, and that's the way to become profitable. Well, in the beginning, you don't have enough experience to differentiate an A+ setup from a B setup or an A+ setup from a C setup. And the only way to gain that experience is to take a lot of trades. So in the beginning, don't worry about being perfect. Don't worry about making money or losing money. Don't focus on your results at all. I want you to completely detach yourself from the outcome of your trading. Your profit and loss does not matter. And keep in mind, you have small risk during this entire process. So if you lose 5 trades in a row or 10 trades or 15 trades in a row because you're experimenting, you're trying to get a feel for your own personal style, well, if you're on small risk, that's not really going to impact your account, but you're going to learn a ton from those losing trades. A lot of people, they don't want losing trades. They want to be perfect. They don't want to fail, right? They don't want to lose money. But in the beginning, it's okay to fail. It's okay to make mistakes. It's okay to have losing trades. That's exactly how you gain experience and develop your edge. And if you have an excellent mentor throughout this process of losing, you're going to make significant strides in your trading, because whenever you have a losing trade or you make a mistake or you don't know what you did wrong or you're wondering how you should have managed the position differently or whether that trade was worth taking in the first place, you ask your mentor, you receive instant feedback, and you're able to instantly make that improvement and learn from your mistakes. And that's the power of having a mentor. That's what I did when I first started trading. I would literally ask 1,000 questions a day to my father, and he would literally correct every mistake that I made. He told me what to do, what not to do, and that's exactly why I improved so quickly. After the market closes, I want you to spend 20 to 30 minutes every single day reviewing your trades and doing a little bit of journaling. And I want you to focus on eliminating every obvious mistake in your trading, because in the beginning, it's hard to figure out what you're good at within your trading. It's hard to identify what your edge is, and you don't even know what your own personality is as a trader. You haven't developed your trading style yet. So in the beginning, I wouldn't focus on what you're good at. I would focus on what you're bad at, and I would eliminate all obvious mistakes in your trading. For example, you're noticing that you're holding on to your losers way past your stop loss. Great. That's an easy mistake that you could fix. Just stop doing that. Or perhaps you're noticing that 70% of your losing trades are reversal trades where you are going against the trend. Great. That's excellent feedback from you journaling. From here, eliminate all reversal trades. And you have to go through this process. Instead of trying to do more of what you're good at, try to eliminate everything you're bad at and all of the mistakes that you're making. Now, this application process with small risk should last around 4 to 8 weeks. And throughout this process, you're going to start to notice yourself becoming more comfortable. You're going to start to develop a feel within your own trading. You're becoming more confident, and maybe you're even seeing some results and you're developing a little bit of consistency. And that can give you the green light to begin gradually scaling your risk. And the key word there is gradually. I don't want you to scale your risk aggressively. I don't want you to have massive jumps in your risk. I don't want you to go from $5 all the way to $100 or $10 all the way to $150. That's a huge jump. I want you to go from $5 then to $10, $10 to $20, 20 to 40, 40 to 50, 50 to 75, 75 to 100. That's completely fine. And that could happen pretty quickly. Maybe you go from $5 to $10 in a week, then 10 to 25 in another week, then 25 to 50 in another week, right? And then 50 to 75 in another week. That process could happen quickly, especially if you're seeing consistent results, you're not really losing, you're making money almost every single day, and you're feeling more and more confident, and you're really starting to develop your edge. It's okay to scale your risk quickly, but you have to make sure it's gradual in the sense of how much you're scaling your risk by. And you just don't want to have those big jumps, because those big jumps can have huge effects on your psychology and on your emotional control. If you go from $5 risk and you're used to seeing your profit and loss fluctuate, by a few dollars because you have such small risk, and then you go to $100 risk and all of a sudden your profit and loss is fluctuating like crazy, you're not gonna be comfortable seeing it fluctuate that much. The numbers are too big for your psychology, and you're going to end up making an impulsive exit or an impulsive entry. You're going to FOMO in, or you're going to make an emotional decision. Now, once you start risking $50 or even $100 or even $150 per trade, and you're confident and you've shown a lot of consistency in your trading, and keep in mind, consistency is the most important part about becoming a profitable trader. I don't care how much money you make. I care about how consistently are you making that money. But if you're able to be consistently profitable with $100 risk, well, you could start to see some genuine income, right? And another thing that I want to emphasize is I want you to be thinking in R's, not in dollar amounts. An R is a risk unit. That is the maximum amount you are willing to risk per trade. So if you're risking $100 per trade, that is your R. That is your risk unit. It's your risk multiple. So if you're up $300 in a day, you're not up $300. You're up 3 R's. And this will help you, especially in the beginning process where you're only risking, let's say, $5. If you make $20 in a day where you're only risking $5, right? $20 as a total amount doesn't sound that impressive, but $20 on $5 risk, that's 4 R's. That is pretty impressive. And that can give you a lot of encouragement, because once you start scaling your risk from $5 then to 20, then to 40, then all the way up to 100. Well, if you make 4 hours in a day, that's $400. That's pretty good, right? I think $392 per day is 6 figures a year. So if you can get to the point where you're making 4 hours a day on $100 risk, which by the way, $100 risk isn't even all that much, but if you're able to make 4 hours per day, that's a 6-figure salary. And that's the way that I would think about it. Think in R's, not in dollar amounts. And this is the exact process. You continue this application stage and you begin gradually scaling your risk as you develop more confidence. Now, if you ever have any setbacks within your trading, and by the way, you are guaranteed to have multiple setbacks in your trading, you have to respond to those setbacks in the right way. And the right way to respond to them is to lower your risk and rebuild confidence. A lot of traders do the opposite. They raise their risk because they want to make back the money they just lost, or they're feeling emotional and they're really focused on the money and on the profit. So they end up risking more to have a big day. And when they start risking more, especially when they're feeling emotional and psychologically compromised, well, that's the recipe to have a absolute disaster of a day. You have to understand that struggle is a part of the process. If trading was easy, everyone would do it. You have to enjoy the struggle, embrace it, use it as motivation to actually continue forward and push towards profitability. There are going to be multiple moments within your trading career where your confidence will be shattered, where you feel depressed, where you feel like your ego has been hit, where trading literally hurts your feelings and you question whether you can become a profitable trader in the first place. And when most traders experience this for the first time, what do? They quit and they decide trading is not for me, trading is a scam, trading is gambling. But the real professionals, the ones that are truly committed towards mastering this craft, the ones that actually have profitability within their veins, they're the ones that are going to use those moments as motivation, as fuel for the fire, and they use it to inspire them to actually work harder and achieve that profitability. So I'm going to ask you again, are you all in? Because the process of becoming profitable is honestly pretty simple. It's difficult to execute. It's difficult to achieve. I agree, but so is everything in life. Every skill set that's worth doing is difficult. It's hard to become a doctor. It's hard to become a lawyer or an engineer or to own a very successful business. And guess what? It's also really hard to be broke. It's really hard to work a 9-to-5 job and literally depend on your boss for a pay raise. That's hard too. You have to choose which hard do you want to pursue. But I'll tell you what, if you have the right framework, if you have the right resources for success, you have the right mentor, and you're waking up every single day determined, disciplined, patient, and you're committed to the process, you're putting in the work. You're waking up an hour before the market opens to do your pre-market prep. You're doing things to get yourself mentally sharp for the market open. And then once the market opens, you're executing your plan. You're understanding what trades you're taking. You're experimenting. You're asking your mentor for feedback. You're journaling your trades throughout the trading day. And then after the market closes, you review those trades. You figure out which obvious mistakes you made. You figure out what you're doing well within your trading, and you back test. You reinforce all of the positive habits that you need to be focusing on as a trader. If you're doing that every single day, and if you're also collaborating with other traders in your circle or with other students that are on the same path as you, and you're just all into the process where the only thing you're actually thinking about is becoming a better trader, and you're actually implementing the habits towards getting there, how can you not improve? How can you not see tremendous progress if you do that every single day consistently for 3 to 6 months? And I'll tell you what, you will improve. You will see absolutely amazing progress. The real question is, when is that progress and improvement going to lead to money? When is that going to lead to you having a significant profit for the day? And that, I can't tell you. Everyone's a little bit different. I've seen traders make $10,000 in their first 90 days. I've seen traders where it takes them 6 months or 9 months to actually break through and become profitable. But here's the deal. Don't worry about your results anyway. Focus on just becoming an elite trader every single day, because guess what? I have met a lot of people that want to make money with trading but don't, because they don't have the skill set, they don't have the right habits, they're just not good traders. But I've never met a trader who is elite, amazing at risk management, fantastic at picking high quality plays, that's a really good trade manager, that's just an overall really amazing trader that doesn't make money. Focus on becoming that amazing trader. Focus on becoming elite. And I promise you, the money will come inevitably as a result. I've made over $500,000 over the last 12 months day trading stocks. I've been a full-time trader for over 5 years. And in this video, I'm going to teach you how to replace your 9-to-5 income with day trading. I'm going to give you the framework and the rules that you need to know to become a consistently profitable trader, even if you have a job or a business. And I'm going to teach you how to know when to quit your job and to go all in on trading. Most people think that it's impossible to become profitable if you have a job or a business, but that could not be farther from the truth. I have worked with hundreds of traders who were able to become successful even with a job or a business or other large responsibilities in their life. You have to follow the right framework, and in this video, I'm going to teach you everything you need to know if you want to become a full-time trader and do this for a living. Let's hop right into this video. And by the way, I am a little bit sick, so if I am lacking the energy that I usually have in most of my other videos, it's because of that. And I just wanted to get this video out because it's been a highly requested video. And right off the bat, when you go on social media, when you go on YouTube, TikTok, Instagram, you see all of these traders that are seemingly making $5,000 to $10,000 a day, that are flexing their big P&L screenshots. And now all of a sudden, you think that you need to have those type of days to make a comfortable living from trading. And because of everyone else's results in the trading space, it skews your own expectations. And right off the bat, the first step that you need to focus on when becoming a full-time trader, especially if you have a job, is you need to shift your expectations. You have to understand that in order to make a comfortable living from trading, you don't need to make $5,000 a day, because that completely overwhelms you. As a beginner trader, how are you supposed to get to the point where you can make $1,000 per day or $5K or $10K per day like all these other traders? I want you to reset your expectations and focus on small, repeatable wins. I don't want you to focus on your P&L, your profit and loss, and how much you're making. You need to understand that to make a comfortable living from day trading, you have to make $398 per day. That is a six-figure salary. Most college graduates nowadays do not land six-figure jobs out of school. A lot of people hope that they can make six figures after working for the same company for 5 to 10 years. So 100K a year is $398 per day. Doesn't that sound way more realistic than what all of these traders make, trading seem like online, where you have to make thousands of dollars per day just to make a living? That is not the case. Your goal is to make $398 per day. And that can come from 1 to 3 solid trades a day. You don't need this one massive home run, 300% move to make a comfortable living from trading. So hopefully this gives you a little bit of motivation and inspiration, because $398 a day, I'm not saying it's easy, I'm not saying it's going to happen overnight, but that is doable. When you have the right expectations, success seems a lot more achievable. And I want you to focus on the process. I want you to focus on small, repeatable wins and focusing on managing your risk. Focus on limiting your losses. And here's the thing, I'm not expecting you to hit $398 per day right off the bat. You need to focus on small wins. But if you can master making $100 per day, especially while you're working a full-time job, from there, you could raise your risk, you refine your trading plan, and you could scale that to then $200 a day, then $300 a day, then hopefully $500 a day. And at that point, you're making more than $100,000 per year. Okay, profitability becomes a lot more realistic when you stop trading like you want to become a millionaire. Obviously, you want to make millions. You want to buy a fancy car. You want to live a life of freedom. You want to make thousands of dollars per day. However, that is not realistic in the beginning. You have to shift your expectations and focus on small, repeatable wins. Focus on making $50 a day first. Then focus on making $100 a day, then $150 a day, then $200 a day. And if you follow that right process, you're going to be able to actually hit your goals, which is, of course, at the end of the day, probably $398 per day, which is 6 figures a year. Keep in mind, while you have a job, you're not going to be that reliant on trading income. You don't need trading income to pay your bills. So you want to learn the right way. You don't want to rush the process. This is not a sprint. This is not a race of how you can become as profitable as fast as possible. This is a marathon. This is you saying to yourself, okay, I have a 9-to-5 job. I'm making $5,000 to $10,000 or $15,000 a month from this job. Great. I want to invest in myself and learn another skill set. So in 3 months or 6 months or 9 months or 12 months, this skill set can either be a really good secondary source of income, or it could potentially replace my current income. Okay. And you have to think with this longer term perspective, a longer term time horizon. You're learning a real career. Trading is not a get rich quick scheme. And with any career path, it requires discipline, commitment, work ethic, consistency, and of course, the right framework for success. So zoom out. This is literally an investment in yourself. Focus on building the skill set, start small, and make sure you have the right expectations. If you work a 9-to-5 or if you have a business, you're probably wondering, how much time do I need to allocate towards trading to actually see results? And what you need to understand is that you can trade part-time and still make a lot of improvement. And the goal that I would focus on is to build a repeatable pre-market and post-market routine. I want you to allocate 2 to 3 hours per day on the days that you trade, and I would try to trade 2 to 4 days a week. And that is plenty of time to see significant progress. Of course, ideally, you're trading every single day and for the entire trading session, but that's probably not realistic, especially if you're a beginner and you have a job and you have other responsibilities in your life. Keep in mind, this is not a sprint. This is a marathon. You are investing into a long-term skill set. You don't need to see immediate success because you have income coming in from your job. So even 2 to 3 hours per day on the days that you trade, and if you could trade 2 to 4 days a week, that is plenty of time to see massive improvement. And then as you progress, as you become more and more profitable and you develop consistency, you can allocate more time towards trading. And this works the best if you work remotely. And there are so many jobs out there that are remote now. And trading is probably the best skill set you can learn if you work remotely, because you can allocate your hours more efficiently. You can dedicate, let's say, 2 to 3 hours per day between 8:30 a.m. to 12 p.m. or 9 a.m. to 12 p.m., basically the morning trading session towards trading, and then you go and work your remote job. And what I would do is, every single morning that you can trade, I would focus for the first 15 to 30 minutes on building your watch list, picking out your favorites, which stocks you want to focus on for the morning session. I have YouTube videos teaching you how to do this. And I would mentally prepare, mentally focus. And then after work, towards the evening, what I would do is journal. I would look back at your trading, understand your mistakes, review your entries, your exits, your trade management, and work towards refining your system. And ultimately, you're going to have to review a lot of charts after trading and during the weekend, because you need exposure, you need repetition. In order to get really good at reading charts, understanding price action, and identifying setups, you need practice time. And what you could do is back test. You could use Thinkorswim on demand, which is a feature where you can go back in time and literally kind of trade as if it was real time. So that's what I would do. I would put in the work after hours, looking at charts, reviewing your plan, making improvements, and then I would just try to allocate 2 to 3 hours per day on the days that you could trade, and try to trade 2 to 4 days a week, 2 to 4 days a week. And then during holiday weeks, or maybe on your vacations, right, you could take vacation days to add additional trading days for yourself. Next, I want you to keep it simple. I want you to focus on one system, one methodology, and master it. You shouldn't have 10 different strategies and 15 different indicators that you're using. As a beginner, trading is already going to be overwhelming. So why would you make it more overwhelming by bouncing from strategy to strategy, learning from this mentor and then learning from another mentor and learning all sorts of systems. I want you to keep it simple and lock in on one methodology. And for me personally, I think the simplest things in life are oftentimes the most brilliant. And that 1000% applies to trading. Just because you have complicated lines on your chart, you have complicated indicators, that doesn't mean you're going to be more profitable. That is a fallacy. In fact, keeping it simple is the best thing that you can do for your trading. For me personally, I trade 2 setups. That is it. And I use 2 different indicators. I use the 20 simple moving average and I use the 200 simple day moving average. That is it. And I have videos on all of my setups, all of my indicators on my YouTube channel, but I also have a free 10+ hour trading course that is genuinely better than most paid courses on the internet. You could find that in the description of this video, and it'll teach you my methodology and my system. It's completely free, so watch it, and that could help you build the foundation for your trading. But yeah, that's what I would do. 1 to 2 high probability simple setups. I would use a simple and structured entry and exit system. I want your management to be simple, where when you get into a trade, you know exactly how you're going to manage your exit. You know when you're going to raise your stop loss, what targets you're looking for. I want you to maintain a consistent risk per trade, right? Remember, the first point that we made was to have small repeatable wins. To have small repeatable wins, right, you need to have consistent risk. And what I would do in terms of technology is just get one screen, maybe one 30-inch monitor. You can get them for pretty cheap at Best Buy, or you can go on Facebook Marketplace and get a, kind of a second-hand monitor for super cheap, and just have a simple computer. You don't need 10 different monitors and a crazy setup, right? Once you start making money, that's when you can invest in your setup and upgrade. So keep it simple. And by the way, if you are looking for something a little bit more serious, I do personally help scale and coach traders from zero to consistently profitable, where I take my students under my wing and they trade live with me every single day. So if you are looking for a hands-on mentor, you could apply for my mentorship program, also in the description of this video. Let's go over some rules that you need to follow before you even think about quitting your job and becoming a full-time trader. Number 1, you need to have 6 to 12 months worth of living expenses already saved up. In other words, you need to feel comfortable when you quit your job and go all in on trading. What happens to a lot of full-time traders is that they quit their job and now all of a sudden they feel a lot of pressure that they need to make money with their trading in order to pay their bills and in order to survive. And that pressure is horrible for your trading. It's devastating because it's going to lead to you making emotional and impulsive decisions, where instead of just trading what's in front of you, you're going to be forcing trades, forcing setups that are not there because you have the need to make money in order to just survive and pay your bills, all right? Scared money doesn't make money. You need to feel comfortable and confident with your trading and with your financial situation before you quit your job and go full-time as a trader. So I would really focus on also making sure that your strategy works in all market conditions. For example, right after COVID, when there was a massive bull run in the markets, right? If you went long on anything, if you bought anything, you made money. And a lot of traders made a ton of money during COVID going long, and they ended up quitting their jobs. And as soon as the market, transitioned into a bear market and the market started going down, and of course the trading environment changed, a lot of those traders, they couldn't make money anymore because, a lot of their strategies were long based. And from there, they actually gave back a lot of the profits that they made right before they quit. And now they're feeling way more pressure to make money because they don't have a job. Their strategies aren't working anymore. And that's how most of them end up blowing their entire account. You need proof that you could also handle drawdown. You need a setback in your trading, and then you need to overcome that setback before you even think about quitting your job. So if you're finding some success as a trader, don't rush to quit your job. Make sure you live through that one setback, overcome it, That's going to help you develop more confidence. And that's, after that, that's when you can think about potentially quitting. And you also need proof that you don't tilt after a loss. Or if you do have a setback, you need proof that you're not going to just gamble and blow away all your profits, okay? So make sure you have 6 to 12 months worth of living expenses saved up. Make sure you're in the right financial position. Make sure you're in the right psychological position to be able to quit your job and still feel comfortable. And make sure your strategy works through all environments. Make sure you know how to handle your risk. You know how to handle yourself if you see a setback in your trading. And yeah, make sure you feel comfortable before you go full time. Let's go over a beginner mistake that a lot of part-time traders make, where you start trading, you start to see some progress, you're making a little bit of money, you're starting to get very confident, and then you scale your risk way too quickly. And you never want to scale your risk before you establish consistency. And I get it. You want to become a full-time trader. You want to find every reason to potentially quit your job and go into trading full-time. However, you don't want to rush the process, and you don't want to focus on your results. You don't want to focus on your P&L. That kind of leads into point number 6. Focus on the process, not the result. I want you to detach yourself from the outcome. And what is the outcome we're looking for? The outcome is you making $10,000 to $20,000 a month and you quitting your job. I don't want you to focus on that. I want you to focus on the process of achieving the outcome that you want. I want you to focus on building your trading plan. I want you to focus on building the right habits to become a profitable trader. I want you to focus on your risk management. I want you to focus on the art of identifying high quality setups versus low quality setups. And in the beginning, I don't want you to focus on your P&L. I don't want you to focus on the amount that you're making or the amount you're losing, because it's not a good reflection of the progress you're making. And what happens a lot of the times is a trader will put in a lot of work. They're disciplined, they're consistent for the first, let's say, 3 to 6 weeks, but they don't really see any results. They're not making that much money. And even though they may be improving at an amazing rate, because those improvements are not reflected in the amount of money that they're making, they get discouraged and then they stop putting in the work. And then if you stop putting in the work, well, you're definitely not going to get the outcome that you're looking for. Okay, your goal in the beginning isn't to replace your job income. Your goal is to build the habits that makes a professional and a profitable trader successful, right? That's what you want to focus on. Focus on the process, okay? And the best part about it is, if you're working a 9 to 5 or if you have a business, you're fine. You're making income from your job or your business, and you don't need to rely on your income from trading to make a living. And as a result, the pressure is a lot lower. What you could do is not rush the process, focus on treating it like it's a marathon rather than a sprint, and let your edge mature naturally. Don't try to force the process of you becoming profitable because you want to quit your job really quickly, okay? You want to scale cleanly. You want to scale the right way. You don't want to jump from $50 risk to $400 risk overnight. You want to start with $50 risk, establish consistency, then $100 risk, establish consistency, then $200 risk, establish consistency, etc. And that's how you're going to be consistently profitable. And that is what's going to give you the foundation to make, let's say, $398 a day, which is 6 figures a year, and hopefully a lot more. Hopefully within a year or 2 or 3 years, you're making $500 a day, $1,000 a day, $1,500 a day. That is the goal, but you have to focus on the process in order to achieve the outcome. In summary, I want you to shift your expectations and treat trading like the career path that it is. I want you to work hard. I want you to be disciplined. I want you to be committed. And I want you to zoom out and look at this like it's a long-term skill set. Don't focus on hitting home run trades as a beginner trader. Focus on small, repeatable wins with small risk, and understand that to make a comfortable living from day trading, you have to make $398 per day. And I'm not saying that's easy. I'm not saying it's going to happen overnight. However, that is so freaking doable, especially if you're working hard, if you're focusing on the process rather than the outcome. And of course, if you have the right framework for success, okay? You want to build a routine that will ensure that you're able to get the practice time that you need to become profitable. Allocate 2 to 3 hours per day on the days that you could trade, and try to trade 2 to 4 days a week. It's okay if you're progressing at a slower pace because you can't trade every single day. That is fine, okay? Focus on making as much improvement as you can. And like I said, this is a marathon, not a sprint. The goal isn't to become as profitable as fast as possible. It's to build the skill set slowly over time. So in 6 months or in 12 months, this could either be an amazing secondary source of income, or this could potentially replace your primary source of income. Keep it simple. Make sure you have 6 to 12 months of living expenses saved up. Make sure that when you're about to quit, you're in the right financial and psychological mindset that where you're not going to feel pressure. You're not going to feel like, oh my God, I need to make money with trading. Otherwise, I'm not going to pay my bills and I'm not going to, pay my mortgage. You don't want that to happen. You want to be comfortable. You want to feel secure when you become a full-time trader. So you could just trade what's in front of you versus trading, over trading because you feel a lot of pressure that you need to make money, right? Don't scale too quickly and just follow the right process for success. And if you need help with any of this, like I said, I have a free 10+ hour course that will help you. It's in the description of this video. And I have so many videos on YouTube that will help you as well. So hopefully you enjoyed the video. Make sure you leave a like, make sure you leave a comment with feedback, and make sure you subscribe to the channel, because my goal is to help you become a profitable trader, even if you have all the time in the world or if you can only do this part-time. I'll see you on the next video. Thanks so much for watching. I'm going to teach you how simple it really is to read candlesticks and to read trading price charts. And the biggest mistake that I see beginner traders making right now is that they overcomplicate their trading. They look at crazy diagrams that show them bullish patterns, bearish patterns, and it's simply overwhelming. There's way too many setups to memorize, and it's impossible to apply in real time. The way that you are going to make money as a trader is by keeping it simple. That is the first thing that my father taught me 5 years ago when he mentored me on how to trade. He taught me a simple, repeatable system, and that's what allows me to make money. It's because I keep my analysis simple. And the first thing that I want to talk about here is what we look for as traders in the first place. And you need to understand that as traders, we're not reading financial documents. We're not looking at balance sheets. We're not looking at income statements. We're not on Bloomberg reading the news or calling our grandmother to, figure out what's the next hot stock to buy. That's not what we do. What we do is we focus on price action. That is it. So let's go ahead and define what price action is, because I'm sure you hear that term a lot. Oh, price action, right? But maybe you don't know what it is. Price action, simply put, is the study of how prices move. So we as traders, what we do is we look at price action in the past. How have prices moved, a year ago, 5 weeks ago, 6 months ago? We look at how prices are moving right now, and based off of past price action and current price action, we are able to determine, speculate, and ultimately make money on what prices are going to do in the future. That is the only thing we focus on, price action. And to break that down even further, price action is essentially reading the relationship between the buyers and the sellers. The markets only really move in two directions. They move higher or lower. And of course, you could go sideways where prices kind of stay in one range, but still within that sideways trend, you're really only going higher or lower. The only two market participants are the buyers and the sellers. If there are way more buyers than sellers, then of course prices logically are going to go up. If there's way more sellers than buyers, well, prices are going to go down. So our job as traders is to really identify setups, identify moments where we have strong conviction there's going to be more buyers than sellers. And in those instances, we go long and we make money off prices moving higher. Or we find setups where we have conviction there's going to be more sellers than buyers. And in that case, we either sell our longs or we go short. And that is our job as traders, to read price action and to understand the relationship between the buyers and the sellers. And the first way of doing that is by looking at these price charts, right? So if you're on tradingview.com, or doesn't really matter what platform you use, you want to be looking at the regular candles. You don't want to be looking at bars. You don't want to be looking at hollow candles or volume candles, right? Keep it simple. I think these are the original Japanese candles. And Japanese candles, these red and green rectangles right here, they emphasize the open and the close of every candlestick. And if that sounds confusing, you don't know what that is, I'm going to break that down in a simple way in this video. But that's the first way of us reading price action. We need to understand what these candlesticks are. What are these red and green rectangles? What do they signify? What do they tell us? And every single one of these candlesticks tells us a story on what is going on with price action, on what's going on between the buyers and the sellers. And depending on how every single one of these candlesticks form, that gives us different information, right? So as you can see, this candlestick right here looks, even though it's red, it looks completely different from this candlestick. And because of that difference in the way that they look and in the way that they're formed, that gives us different information. And it's important to understand that information. So let's go ahead and break down exactly the different types of candlesticks and what they tell us, because that is the first step towards reading price action. And the goal of this video is to keep it as simple as possible. And for me personally, I only really trade two different setups, and I'm going to break down each one of those setups in this video. The first step in mastering how to read candlesticks is understanding that every single candlestick represents the price action that occurred during a period of time. And you could select which period of time you want to look at. And that's exactly what this time frame drop down on your platform signifies. So depending on which time frame you look at, it's going to give you a different perspective on what's going on with price action. So let me go ahead and break that down. Let's say you're looking at the daily time frame and you selected 1 day on your TradingView or whatever platform you're using. What that means is every single one of these candlesticks represents 1 day's worth of price action. So for example, this most recent candlestick, that is showing you the price action that occurred on December 12th, 2025, which was this past Friday. You could see that at the bottom. The candlestick before is showing you Thursday's price action, December 11th. The candlestick before is Wednesday's price action. The candlestick before is Tuesday's price action. Candlestick before is Monday's price action, etc. And these last 5 daily candles represents 1 weekly candle, right? So this candle, this candle, this candle, this candle, this candle, these 5 daily candles is represented by 1 weekly candle. And 4 weekly candles represents 1 monthly candle. So that is the importance of using multiple time frame analysis. And that is such an underrated skill set in trading. A lot of traders only look at 1 or 2 time frames. Well, we want to look at multiple perspectives of the stock or crypto or whatever you are trading. We want to see what's going on the higher time frames and on the lower time frames. And we want to see if the price action is telling us the same story across every single time frame. And I'm going to dig a little bit deeper in how to use time frames a little bit later in this video. But what I really want to emphasize before I talk about how candlesticks are formed and the different information they provide us is every single candlestick represents the price action during a period of time. So another example is if I'm on the 15-minute time frame, which is a relatively small time frame, every single one of these candlesticks represents 15 minutes worth of time. So this candlestick right here is 15 minutes worth of time. And 3 5-minute candles, right, is represented by 1 15-minute candle. 4 15-minute candles is represented by 1 hourly candle. And you guys get the idea, and hopefully you're starting to comprehend that. Oh my God, it's actually critically important for me to look at multiple time frames, and it is. But now let's go ahead and talk about how candlesticks are actually constructed in the anatomy of a candlestick. So for this example, let's assume we are looking at the daily time frame, meaning the candlestick that we're about to analyze represents 1 day's worth of price action. Great. So let's break down the different parts of the candlestick. The first part is the body of the candlestick. The second part is the tail or the wick of the candle. So this actual rectangular part, that is known as the body. And if you ever see a tail, right, or this wick or this line sticking out of the body, that is a wick, okay? So those are the only two parts of the candlestick, the body and the wick. And they both tell us different things about what's going on with price action. So what does the body represent? Well, the body shows us where prices opened and where prices closed. So if prices closed at a higher point than which they opened, well, the candlestick is going to be green. If prices closed at a lower point in which they opened, that means prices went down that day, well, the candlestick is going to finish as a red candlestick. So if it's a green body, right, we know prices opened right here. We know this is the open because it's green. And we know that prices closed at the top of the body, right? So if you see a green candlestick, you know that prices opened at the bottom of the body, prices closed at the top of the body. So in other words, let's say this is a daily candlestick. Prices opened at this price at 9:30 a.m. Eastern, right? And they closed at a higher price at 4 p.m. Eastern when the market closes. Now the same thing applies if it's a red candlestick, except it's the opposite. The candlestick is red. That means prices went down. So we know that the top of the body is where prices opened. And the bottom of the body is where prices closed because, of course, it's a red candlestick. So that's exactly how you can tell where prices opened or closed. It's based on the color of the candle. If it's a green candle, we know prices opened at the bottom of the body, prices closed at the top of the body. If it's a red bar, prices opened at the top of the body and closed at the bottom of the body. Great. So that's what the body tells us, where prices opened or closed. And of course, whether it's green or red tells us where prices actually went to. Now let's talk about the wick. The wick or the tail tells us the maximum, or not the maximum, it tells us the highest or lowest price that, the price action went to during that time frame. So let's kind of break it down what that actually means here. So let's look at the anatomy of this candlestick right here. Now notice how there's a tail at the top, right? There's a tail towards the top of the body. Naturally, this is called a topping tail. But what does a topping tail signify? So it's green, right? It's a green body. That means prices opened at the bottom of the body. So we know prices opened here, and we know prices closed at the top of the body, which is right here, close. But we see this big tail. So what actually happened here? What happened was the prices opened, the buyers bought the stock or the crypto, whatever you're looking at, the buyers stepped in, brought prices higher, and then right here, the sellers showed up and they brought prices lower to close right here, right? So we opened here, we closed here. So we opened, the buyers bought this stock up, and then the sellers showed up here and sold the stock all the way down so it can close at the top of the body right here. Now, let's logically think about that. If the buyers came in and they bought the stock, and then the sellers brought the stock back down, is that bullish or is that bearish? Is that showing strength or weakness? Well, the way that I see it is, who took control? Did the buyers take control or did the sellers take control? Who won the battle, right? Remember, we're reading the relationship between the buyers and the sellers. In some sense, it's a battle. Who won this battle? Well, even though the candlestick is green, I would argue the sellers won the battle. The buyers brought prices up, and then the sellers brought them right back down, right? I would say even though it's a green candlestick and we closed at a higher price in which we opened, the sellers won the battle because they were the last ones in charge. They were the ones that brought prices lower, okay? Hopefully that makes sense. Now let's take a look at this candlestick. Well, naturally, this is a topping tail because the tail is obviously towards the top of the candle. In this case, the tail is towards the bottom. This is a bottoming tail. So let's break down what this means. Well, prices open here. I'm going to put O for prices opened here. Prices closed right here. I'll put closed, okay? But we have this big tail. So what actually happened? Well, what happened was prices opened here, and the sellers took control at first, and they brought prices all the way back down. So this, because this is a bottoming tail and the wick is towards the bottom, this represents the lowest prices went to during this candlestick's time frame. This represented the highest that prices went to during this candlestick's time frame. But again, the wick is towards the bottom, so this is showing the low. So the prices opened. The sellers brought prices all the way down here. So at some point, this was a red bar, right? Because we opened here, prices went down here. At some point, this was a red bar. But then right here, the buyers took control and they brought prices all the way back up to a new high. They brought prices all the way back up to close at a higher price in which we opened. This is a bottoming tail. So who took control? The buyers or the sellers? Well, at first, the sellers took control and brought prices down. And then at the end, the buyers took control and they brought prices all the way back up to even close at a higher point which we opened. So the buyers took control. So naturally, whenever you see a red or whenever you see a bottoming tail, you could just think buyers have taken control. Whenever you see a topping tail, you could think the sellers have taken control. And the same thing applies even if it's a red bar, right? Even if it's a red bar, for example. So if it's a red bar, we know prices opened here, and we know prices closed lower, right? Because it's red. So that means prices open here. The buyers bought the stock, and it made a high here. So at some point, this was a green bar. And then right here, the sellers took control, and they brought prices all the way back down to close at a lower point than the open. So this is a topping tail. Topping tail suggests sellers have taken control because the sellers did take control. They took control here and they brought prices back down. And even if it's a red bar, right, we have a topping tail. Oh, I'm sorry, right here we have a bottoming tail. What does that mean? That means the open was right here. Close was right here, right? Because we closed at a lower point which we opened. We opened, the sellers really brought prices all the way back down to here, and then the buyers stepped up and bought prices all the way back up to close here. So even though this is a red bar and we closed at a lower point in which we opened, the buyers still took control at the bottom and brought prices higher. So even though this is a red bar, this bar is still showing strength because who took control? The buyers took control. And the best way you could think of it is, let's look at kind of these diagrams here, right? This is how it's formed, where if it's a green bar, it opens here, right? That's where prices opened. The sellers took control in the beginning. They brought prices down, right? That's the low of this candle or the low of this wick, low of this tail. That's the low here. And then the buyers took control and brought prices all the way here, and that's where we closed. So we opened here, we closed here. But what actually happened is we opened, we sold off, then we got bought and closed at a higher point. So this is a really bullish time frame, really bullish candle. It's a bottoming tail showing the buyers have taken control, and it was green. Now the same thing for a topping tail, right? We open, let's say here, this is an open, which is right here, let's say. At first, we got bought because we formed a tail at the highs. So we started to get bought. And then the sellers took control and they sold off the stock, and we closed here, which is right here. So this kind of shows you how bottoming tails and topping tails are formed on the larger time frame compared to the smaller time frame. And this really shows how the buyers take control, right? Where it gets sold off because of the wick, right? The wick represents the sell-off. The buyers take control and bring prices higher. Same thing here. We open here. The buyers take control in the beginning, but then right here, the sellers take control and they bring prices lower. And that shows why a topping tail is bearish and why a bottoming tail is bullish. So you can always remember that. Bottoming tail, buyers have taken control. Topping tail, sellers have taken control. Now, let me go ahead and break down what a doji bar is. And a doji bar is a very important type of candlestick because I like to use doji bars as my entry bars. I like to enter into my trades and setups using a doji bar. And I'm going to explain exactly how that works a little bit later in this video, but let's try to understand what happens during a doji bar. And it's kind of a funky looking bar. We have a really tiny body, but we have huge tails at the top and the bottom. So what happened here? Well, it's a red candlestick. So that means prices opened here and prices closed at the bottom of the body, right? So it's a red candle. So top of the body we opened, bottom of the body we closed, causing it to be red. However, we made a high here and then we made a low here. So that means the buyers at first stepped up and brought prices to make this high. Then the sellers sold the stock to bring prices here to make a low on this wick. And then we ended up closing here. So then the buyers ended up bringing prices back up. So the buyers took control, then the sellers took control, and then the buyers took control again, which is kind of a unique scenario. What does that actually mean? Let me go ahead and show you a breakdown of how this actually works. So let's say we have this doji bar. Well, we opened here, we got bought, made this high on this wick, we got sold, made this low on this bottom wick, and then we got bought again to basically close kind of where we opened, right? And I want you to ask yourself, who won the battle here, right? We talked about who won the battle during a bottoming tail. Very clear, buyers won the battle. We know who won the battle on a topping tail. The sellers took control. We know during this type of candlestick, well, you know, we opened right here. We closed right here. The buyers won the battle, of course, right? But who won the battle for a doji bar? And if you're thinking to yourself, hey, I can't really recognize who won the battle because it doesn't look like anyone won. You're absolutely right. This is kind of like a tie, right? Where the buyers stepped up, then the sellers stepped up, and then the buyers stepped up again. And that's what a doji bar represents. It represents a tie between the buyers and the sellers. It represents uncertainty. And I love using doji bars as potential entry points. And I'm going to show you how that works with the setups that we look at a little bit later. But yeah, whenever you see a doji bar that essentially represents uncertainty, and actually doji bars can be excellent reversal bars. They could also be excellent continuation bars as well, or entry bars. All right, so I'm going to show you once again how that works in a little bit. Now, quick little question before we continue on here. I have an interesting question for you guys, okay? Which candlestick is showing more strength? This one right here or this one right here? Which one is showing more strength? Which one is more bullish? And I want you to pause the video and I want you to literally think about it, okay? So hopefully you paused it. Hopefully you're thinking about it. Which one is showing more strength? And you might be thinking that, hey, this one is showing more strength. This is a solid green bar. We opened here, we closed here, we went up. That's showing a lot of strength. You might be right. However, number 2 is actually the right answer. And the reason why a bottoming tail shows more strength than a regular green candle is because this candle is battle tested. This is a candle where the sellers actually showed up, but they failed to bring prices lower. The sellers showed up, but then the buyers conquered them and brought prices right back up, right? Like, how is a bottoming tail formed? It's formed by the sellers showing up and then the buyers take control after that. You can think of a bottoming tail as being battle tested, right? Where the sellers did show up, but then the buyers, won anyway. Versus on this candle, who knows, maybe the sellers were asleep. Maybe there were no sellers that day at all. There were only buyers, right? And that's showing, it does show a lot of strength. But with a bottoming tail, it's literally battle tested, right? The sellers did show up. They weren't asleep. The sellers showed up and then the buyers were so strong that they were able to bring prices right back up. So a bottoming tail, in my opinion, is actually even stronger than a regular green candle because, again, the sellers came in and then the buyers still kind of, overtook them and brought prices higher. Same thing if it's a red candle, right? Like, which one is showing more weakness? This one or this one? Well, of course, with this, we opened here, we closed here, sellers brought prices down. But in this example, we opened here, the buyers showed up, but then the sellers, overtook them and brought prices back down. That candle is battle tested, right? How is a topping tail formed? Let me go ahead and kind of erase this just so it's a cleaner picture here. But how is a topping tail formed? A topping tail is formed by the buyers actually showing up at first and then the sellers conquer them and overtake them for prices to go lower. So that's why a topping tail is also more bearish than a regular red candle. And bottoming and topping tails can be huge indicators of where prices are about to go. Now, I really want to emphasize that looking at one candlestick will never tell you the true story of what's going on with price action. And rather, you need to be looking at sequences of candlesticks. And based on how those sequences are formed, well, that could tell you a lot of different information. For example, it could tell you whether the stock is in an uptrend and we have higher highs and consecutive higher lows. In that case, we know that the overall direction is higher. For example, if I'm looking at the QQQ, which is the tracking ETF for the NASDAQ, if I go to the monthly time frame, I could see that stemming all the way from the early 2000s, the Qs have been in a really consistent and solid uptrend. Even if I look at the weekly time frame, I would come to that same conclusion. Now, keep in mind, the weekly time frame kind of gives you a more in-depth perspective because, of course, 4 weekly candles represents 1 monthly candle, but I would come to the same conclusion. Now, if I look at the daily chart, well, it wouldn't really make sense for me to use the daily to look all the way back into the early 2000s, right? Because there's just going to be so many candles and it's going to be almost overwhelming for me to analyze what's going on. So for the daily time frame, right, if I want to understand what's going on over the past 6 months to 1 year, I'm going to be looking at the daily time frame. Same way where if I wanted to see the price action from the 2000s, I wouldn't be looking at the hourly time frame. I wouldn't be looking at the 15-minute time frame. I'd be looking at the weekly or monthly time frames. And this is how you would decide which time frames you're going to use in your trading, right? It depends on the style of trader that you are. Are you a long-term investor where you would be looking at the weekly and monthly time frames because you have a really large time horizon? Or maybe you're a swing trader. In that case, you could look at the monthly and the weekly to develop a bias for where prices are going to go, and then you take your entry off the daily, off the 4-hour, or even off the hourly. Or maybe you're a day trader, and I'm a day trader, so for me, in the morning when the stock market opens at 9:30 a.m. Eastern, I am looking at the 1 minute and the 2 minute. And then as the day progresses into the afternoon, I'm looking at the 5 minute and I'm looking at the 15-minute chart. And during the entire day, as I'm looking at the smaller time frames, I always have an eye on the hourly chart and I always have an eye on the daily chart. And that gives me kind of the longer term perspective of what's going on with price. So the key is to use multiple time frame analysis because you want to look at the story of what's going on with price action across multiple time frames. And it's going to give you multiple perspectives of what's going on. And I'm going to show you guys a few examples in a little bit here. But for example, let's say I'm taking a 15-minute potential buy opportunity. It's really important for me to look at the daily chart to see if the daily chart is in agreement with the 15. You know, is there a catalyst on the daily that would suggest prices have a high probability of actually moving higher? And if there is a strong catalyst on the daily, a strong bullish catalyst, then I can go to the smaller time frames to find a potential entry. So what I'm going to do is show you guys a bunch of examples of trades that I took over the past few weeks. And I'm going to give you an idea of how I look at multiple time frames and how I use the candlesticks that I taught you to actually come to conclusions and to take setups. So just how we would look at the candlesticks to understand what the trend is, whether it's an uptrend or whether it's a downtrend where we have consecutive lower lows and consecutive lower highs, and we know that the overall direction is lower, so we could find potential setups to go short on. By looking at the candlesticks, we could identify high quality setups in the markets, high conviction opportunities for us to make money. And in this video, I'm not going to go super in detail on which setups that I trade and the exact criteria that separate a high quality setup from a low quality setup. I have other videos on this channel and in my free 10+ hour course, which by the way, is genuinely better than most paid courses on the internet. My other videos will go a lot more in depth in the exact criteria that I look for in the setups that I trade. I don't want this to be a super long video. I want this to be more or less basic, and I really want to emphasize how to read candlesticks within these setups. However, to watch, how I actually take these setups, exactly what I look for, the exact catalyst that I look for, how to trade gaps, I have other videos on this channel. So make sure you watch those and watch my free 10+ hour course. But just to keep it super basic, I am a continuation trader. I trade price correction patterns. So what does that mean? So let's say I've established that I'm looking at a stock and I see that there is a established uptrend or there's an established bullish bias on that stock. I know where prices are going. I know the direction of price. From there, I look for opportunities to enter into those trends on corrections. And there are two ways in which prices can correct. Prices can either correct through time in the form of a consolidation where we have a nice move up and then we consolidate for a while before the next leg up happens. This is called a breakout. So that's the first setup that I trade. I trade breakouts, which is a correction through time, right? The markets can't just go up infinitely higher forever. There needs to be periods of time where the markets correct. One of the ways in which the markets can correct is through time in the form of a base. The second way in which markets can correct is in the form of price action. And that is in the form of a pullback where, the stock gets bought, these buyers take profits, we pull back, and on this pullback, it gets ready for the next leg higher. And this is the second type of setup that I trade. So I keep it really simple. I trade breakouts and I trade price retracements. That's the only really thing that I look for, okay, in the markets. I keep it simple. I don't have 100 different patterns. I trade breakouts and I trade price correction patterns. And within these setups, I could use everything that I taught you guys in this candlestick course to identify high quality opportunities, right? So let me go ahead and show you guys a couple of examples that I prepared here. These are just really amazing screenshots that I took over the past couple months that really show how I would use candlesticks within these setups. So for example, we have this LWLG. This was an excellent trade that I took over a month ago here. We had a nice move up. This was on a gap up. A gap is an overnight change in price. So when it comes to me trading stocks, I really like to trade gaps, where I'll trade a stock after it has an overnight gap either to the upside or to the downside. Now, I don't want to get too in depth with how I trade gaps. I have an entire full 1-hour tutorial on exactly how I trade gaps, how I look for gaps, why I trade gaps, and everything you need to know about that. So that's also on this YouTube channel. It's also in my free course in the description of this video, so watch that. But this stock had an overnight change in price to the upside. Let me make this white. And from there, we had a nice move up. Then we had a retracement. So this is a retracement setup. And notice here we have kind of a bottoming tail doji bar. We have another doji bar. And I love to see specifically doji bars when it comes to getting into trades, because doji bars represent uncertainty, represents a tie between the buyers and sellers, and they tend to be amazing bars to potentially enter into trades with. So for example here, we have the pullback, we get a couple of doji bars. I would have entered above the high of this doji bar, and I would have put my stop loss below the lows of this doji bar, okay? Just like, same thing here on the Chegg. Let me go ahead and change the color to black here. Chegg had an overnight change in price to the downside. So this stock gapped down overnight. That gap down gave me a bearish bias on what is going on with price. And from there, I wanted to look at it at the market open for a potential breakdown. And what do we get? We get a nice move lower, and then we begin to consolidate. Now, notice this candlestick right here. What happened here? Well, remember, a topping tail represents that the sellers have taken control, right? Keep in mind, let's go back to what a topping tail, how a topping tail is actually formed, right? Topping tail is formed by the buyers taking control at first, and then the sellers take control at the end and bring prices back down. And we talked about how a topping tail is a very bearish candlestick. And I love to see topping tails within bearish consolidations, and I love to see bottoming tails within bullish consolidations. So let me kind of go a little bit more in depth on what that means so you could apply it to your consolidation setups, right? Let's say we have a nice move up and we begin to base, okay? If this stock attempts to break down and then fails on that breakdown, which leads to a bottoming tail and then continues to base, this is a massive amplifier. I call this a shakeout. This is a failed breakdown. We have a bullish stock that's consolidating at the highs. The sellers attempted to bring prices lower. They failed. The stock continued to consolidate. This is an amazing amplifier. And if I see something like this, it just increases the quality of the play tenfold because the setup is kind of battle tested where the sellers showed up, they tried to bring prices lower, they failed, and then we ended up breaking out anyway. Exactly how if it was a bearish base and we had a potential breakout that failed, leading to a topping tail, this is a shakeout, prices continue to consolidate, that would increase the quality of this play as a breakdown. And that's basically what happened right here, where prices moved down, they consolidated, they attempted to break back up, led to a topping tail, and then of course that led to follow through to the downside. And keep in mind it was also a bearish gap down. So in this case, you could have put your entry under the base, stop loss over the base. You could have even used this topping tail kind of doji bar as an entry bar as well, where you could have placed your entry beneath the lows of this bar, beneath the lows of this breakout failure, and place your stop above. And of course, we saw excellent follow through to the downside. Let's look at another example here, okay? In this case, we kind of have some choppy price action, right? I don't like kind of this choppiness. However, we got a nice pullback and we got two consecutive doji bars. We also have a rising 20 MA on the 5 and we also had a rising 20 MA on the 2 minute at the time. I don't have that screenshot, but it was right into the rising 20 MA in the 2. And I also have other videos on this channel and in my free course on how to use the 20 MA. So make sure you watch those. Okay, but we had a nice pullback, 2 consecutive doji bars. And for me, I went long over these doji bars, entry below, right? And open was also on a gap up. So the gap up gave it a bullish bias. We had an overnight change in price to the upside. We kind of chopped around in the beginning, got a pullback. These 2 nice doji bars, right? And then of course that led to follow through to the upside. And it was into a rising 20 MA on the 5, rising 20 MA also on the 2, okay? Let's look at another example on the Rocket here. Rocket was also an overnight gap up, so it had a bullish bias. We had a move to the upside, pull back, and notice this bottoming tail. Prices attempted to, continue lower, they failed. Then we had basically 3 doji bars in a row. Entry above these doji bars, stop loss either below them or stop loss below this bottoming tail, depending on how tight of a reward to risk you wanted. Of course, we saw excellent follow through to the upside. We even saw kind of a pullback here. We pulled back, right? And then a big bottoming tail. So that's why I love to use doji bars and bottoming tails as potential entry bars because they give me information about what's going on with the stock. Now, in this case, we were a little bit extended from the 20 MA. I wouldn't have taken this because I felt like this was a shallow pullback relative to the huge move that we put in. I wanted to see this pull back closer into the 20 MA. However, still a great setup. Let's take a look at this. This is just beautiful, right? This is just such a beautiful example of a failed breakdown where we have a nice move up and we pull back significantly. We pull back over 100% of this move, which I don't like to see. I want to see a 40 to 60% pullback, right? If you watch my retracement video class, you know that I want to see a 40 to 60% pullback, meaning if we move up, I want to see it pull back into this 40 to 60% range. I don't want it to pull back down here because that shows a lot of weakness. It's hard to get continuation if you buy, after it retraced this entire move up. It's too bearish, right? In this case, we did retrace that entire move, but look at this failed breakdown. We attempted to move lower, we failed, continued to base, break out over the base, stop loss here, or if you want a really tight stop loss, you could put it here. So these are just examples of some breakouts and some retracement setups and how I would use doji bars, topping tails, bottoming tails as potential entry bars and as potential ways to enter into these setups. Now, let's take a look at some more examples on how I read price action across multiple time frames and how I use candlesticks to my advantage when I'm identifying high quality setups. So this is on the CGC. This is a stock from this past Friday. This literally just happened 2 days ago. And CGC had an absolutely beautiful intraday setup twice on Friday. And this stock gapped from 113 to 138 the next day. So the previous day, you could see on Thursday, we closed, there's this doji bar, we closed at around 113 in price, and this is a green candle, so that means it opened right here, and we opened at 138 the next day. You could literally see this overnight change in price. It was a 23% gap up, all right? So we saw this gap up. Now, I did want to be a little bit cautious because I saw a ton of resistance in this area where we saw a ton of candlesticks attempt to basically break above this area. And every time we would hit this area of resistance, we'd get sold off, where we hit it here, sold off, hit it here, sold off, hit it here, sold off, hit it here, sold off. So I did want to approach this with caution. And I figured that this area of resistance could actually be a potential target. Now, keep in mind, we opened at 138. That resistance doesn't really truly begin until like 165, 160. Keep in mind, resistance is not one price level, it's an area of price. So that's why whenever I'm trying to read support and resistance, I'll use a rectangle versus a line. So it shows me an area of price. So I saw that, hey, we have plenty of upside from 139 to this 160 to 170 area where that's where we had prior resistance. Great. So there was upside for this CGC to actually potentially, make a move. From there, I went to the smaller time frames. Let's go to the 5-minute chart. And right off the bat on the 5-minute, in the first 15 minutes of the day, we had at first a big topping tail, which made me a little bit cautious, right? The buyers attempted to take control and they failed. And from there, we actually saw two nice bottoming tails on the 5, where prices attempted to move lower, went right back up and failed. And then here we have a doji bar, prices attempted to move lower and failed again. Now, I called this as a breakout over 139, stop loss 133. And if you look at the 2-minute time frame, or we could even look at the 1 as well, we can actually quite literally see what was going on with price, right? We had that initial breakout, we pulled back, attempted to break down, failed. Attempted to break down, failed. And from there, it based right into the 20 MA on the 1-minute time frame. Now, keep in mind, I like to use the 1 in the 2-minute in the first 30 to 45 minutes of the day. So we attempted to break down twice, failed. So, sellers attempted to take control. They weren't successful, and we consolidated into the 20 MA and the 1. So I called this as a breakout over 139. And my first target was the prior high at 145, which that was that topping tail in the 5, right? That was the prior high. So that's target 1. And it actually wasn't a very good R to R setup on target 1. That's actually why I passed on it. However, it anyway produced really great follow through and it surpassed that target 1. However, the really nice setup on this was actually the next setup on the 5-minute time frame, where we got that nice initial move higher, and then we pulled back, we produced a doji and consolidated into this rising 20 MA in the 5. This was beautiful, and I called this over 143, stop loss 138. And this ended up producing fantastic follow through really until the rest of the day. If you look at the 15-minute, we just continued higher the rest of the day. Even on the 15-minute, there was a pretty nice retracement setup here, where this isn't really a doji, but it's kind of like a narrow range bar. I also like to use narrow range bars for potential entries, which are these right here. So these are also really great candlesticks to potentially seek entries from, right? So we had a narrow range bar on the 15, and then on the 5, we saw a nice doji bar, kind of attempted to move lower, failed, then we based right into that rising 20 MA. Beautiful retracement setup into a continuation move the rest of the day. We could also look at another setup. This was on the Domo, and this was when? This was around a week ago. This was last Friday. So let me go ahead and kind of replay this setup. This is actually a setup I did take advantage of. So Domo had a really nice daily time frame. I mean, if you're looking at this, the only conclusion that I can draw is that there's a downtrend, right? We had a nice move lower. We retraced into the 20 MA, moved lower, retraced into the 20 MA, moved lower, retraced into the 20 MA. And the next day we gapped from around 1156, right? We know that because this is a red bar. We closed at the bottom of the body, 1156. And we gapped around 19% to 932, which is right here. So we were breaking below this daily support. We were breaking below this daily base. And in terms of next areas of support, well, I would say this entire area could be an area of support right here, right? And we had plenty of room to actually drop, right? Gap to 926, that's where we opened. I thought there was significant areas of support at 850 to 750 or so. So I saw that there was potential downside for the stock to continue lower. From there, I went to the 5-minute time frame, and what did we get? We had an initial retracement. We got a doji bar. We got another kind of doji bar, and I called this as a short under 953, under the lows of that doji bar, and stop loss at 980 over the highs of that doji bar. And this was kind of like a retracement setup, right? Where we had that initial move lower, the gap itself, we had a gap down, we had a tiny retracement, and then we continued lower from there. And of course, I went short basically right here. Now keep in mind, we gapped down, so that was kind of the original move. I didn't like how we started to get bought right off the open. However, we got bought. We attempted to move higher here, huge topping tail. Sellers started to take control. We started to base, nice doji bar, and this was basically a retracement setup. And this original move lower was kind of like this gap down, essentially. And then we retraced a little bit, set up as a sell setup, and then we continued lower quite literally the rest of the day, as you could see on the 15-minute time frame. Let's take a look at one more example on how I used a bottoming tail in a potential breakout setup, and this was on the WK. And as you could see, there was an overnight change in price on this stock, where this stock gapped from 63.85 the previous day to 74.45 the next day, which was a 16% gap up. Now, for now, I want you to ignore this green candle and just look at where prices were going in the first place. And as you can see, we're in a pretty established downtrend. We moved down, retraced to the 20, moved down, consolidated in a sloppy way, moved down again, and then basically just went sideways on the daily. Even if you look at the weekly time frame, you know, before this green candle happened, before that gap up, this was a bearish consolidation into a declining 20 MA. So overall, prices seemed like they were about to break down and continue lower, and you even saw that on the daily, right? So the weekly was bearish, looked lower on a base breakdown, and the daily started to break down where people started to either go short or the sellers came in and started to bring prices lower. This looked like it was going to continue lower. And then all of a sudden, prices gap from 63.80 to 74, right? I mean, think about the shock there where it goes from a bearish breakdown to all of a sudden this stock is breaking out in a matter of a day. And this gap also cleared above a ton of resistance. And if you're still kind of confused on gaps, like I said, make sure you watch the gap tutorial in my free course or on this YouTube channel. But think about everyone who sold on this day or anyone who went short. If you went short here and then all of a sudden the next day it gaps against you 16% overnight, all of a sudden now you're underwater. That's going to put pressure on you to actually close your shorts. Maybe you're a long-term trader and you decided to short the WK because it looked bearish on the larger time frames. Well, now all of a sudden you're underwater on your position. And a lot of those people who went short, they may cover their trade, which leads to, of course, buying. Because when you cover your shares short, you're buying back your shares. Or maybe someone sold the bottom here and they see the stock starts to get, gapped up, and now they're feeling FOMO that they sold way too early and they're going to miss out on any potential upside. And from there, I took a setup on the 15-minute time frame later in the day on this almost picture perfect breakout where we moved up, and notice this bottoming tail. This is a breakdown failure, okay, where prices attempted to move lower and failed. And then we continued basing at the highs. This is such a huge amplifier. As soon as I saw this, I knew I wanted to take the play. I identified it here. And then all I was waiting for was for prices to consolidate a little bit closer into the 20. I took this long over 81. I actually got in a little earlier. I got in here at 80.70, and I put my stop loss underneath the base. Then what happened was it popped, based for another 30 minutes, and I basically went long, actually based for 45 minutes, and I went long here again. I added to my position and then raised my stop loss from here to underneath this base, and then was able to participate in this upside move. So, the point that I'm trying to make here is this bottoming tail, this shakeout candle, ended up being a huge amplifier for this position. It basically gave me conviction that, hey, the sellers showed up, but the buyers overtook them, and, it gave me higher confidence that this was actually going to break out and continue higher. Now, I don't want to go too in-depth with the exact qualities of every single setup and too in-depth with the gaps. So make sure you just watch all of my free resources. And yeah, hopefully you understand how I actually use these candlesticks and what these candlesticks mean. More than anything, I want to teach you how to actually read candlesticks in a simple way and how to analyze multiple time frames. Okay, so hopefully that makes sense. Let me know if you do have any questions on this video. Please leave a comment in the comment section with feedback. Make sure you leave a thumbs up and make sure you subscribe to the channel and watch all of my other free resources. They will really help you understand the way that I trade, and you'll be able to use this video in conjunction with all of my other videos to really build the foundation for your trading. Thank you so much. What's going on, guys? Hope you're having a great day. For today's class, we are going to be talking about the 3 different trends that exist in trading and with price action. Okay, so these are super basic trends that you guys should know how to identify, and you should know the implications of these trends as well. So let's get right into it. The 3 different trends. This is probably stuff that you've heard of already. So when we're looking at an uptrend, it's characterized by 2 different characteristics. Number 1, higher highs and higher lows. And number 2, a rising 20-day moving average. So we haven't covered how to use the 20-day moving average, but just always keep in mind that we want a rising and a trending higher 20-day moving average. Okay, so as you can see, we have higher highs, right? We're making new highs, and we're making higher lows, right? This low is higher than that low. This low is higher than that low. Same with the highs, okay? And as you can see, this line, the black line, which is the 20-day moving average, it's under price, and it's also trending higher. And we're going to be doing the 20-day moving average class next, so just stay tuned for that. Okay, so this is what an uptrend is. Very simple stuff. We're looking at a downtrend. It's characterized by, number 1, lower highs and lower lows. Okay, we have lower highs, right? And lower lows. So low here, low here, low here. And as you can see, we have a declining 20-day moving average, which is this line. So as you can see, during a downtrend, we want the 20-day moving average to be overpriced, right? And we see that during the downtrend, it sort of retraces, right? It always rallies right to the 20-day moving average, drops, rallies right to 20-day moving average, drops. But we're going to be looking at the 20 MA during the next class. So this is what a downtrend looks like: lower lows, lower highs. Okay. And we also have a sideways trend, which is characterized by relatively equal highs and lows, right? We rally, we make a high, we drop, right, to the previous low, we rally to the previous highs, drop to the previous low. Okay. And once we talk about support and resistance, this is going to make a lot more sense. But this is what a sideways trend is. So sideways trend, it's not, we don't have one particular bias. We don't have a bullish bias or a bearish bias, right? Overall, we're just sort of fluctuating between the highs and the lows. Okay, so this is what a sideways trend is.
And usually sideways trends, they lack momentum, right? So with uptrends and downtrends, we clearly know what the momentum is, right? For an uptrend, there's clearly bullish momentum, right? We're rising. There's a lot of buyers, right? Over with the downtrend, there's a lot of bearish momentum. There are a lot more sellers. The sellers are dominating the move. But with a sideways trend, it's really, there's no clear momentum. We don't know exactly, are the buyers winning or are the sellers winning, just because we're kind of fluctuating between the highs and the lows. Okay, here's an example of a uptrend. This is a real chart with candlesticks, as you can see, right? We can see that we made a high here, we made a low here. This low was higher than this low. This high was higher than that high. Right here, also make a higher high, higher low. And as we continue going up, you can see that we're continuously making higher highs and higher lows. This blue line is the 20-day moving average. Okay. And as you can see, there's probably a ton of candlesticks that you're already able to identify, whether it's a topping tail, bottoming tail, narrow range bar, wide range igniting bar, which is really good, or doji bar as well. So if you're already looking at these candlesticks and you're able to identify the different ones that we've learned about, that's fantastic. Looking at a downtrend, or actually this is a perfect example of an uptrend, and that's followed by a downtrend, right? We could see here, this white line is the 20-day moving average. We could see we're making higher highs, higher lows until we actually reverse, and now we make lower highs and lower lows, right? So we're uptrending, then we go into a downtrend. And this is actually a screenshot of the NASDAQ ETF, the QQQ. So this is a very recent snapshot. So you can see that we went from an uptrend to a downtrend, right? Uptrend is higher highs, higher lows. Downtrend is lower lows, lower highs. Okay. Hopefully that makes sense. So just make sure you're able to identify whether an uptrend or a downtrend or a sideways trend is occurring. Okay, guys. And during the next class, we're going to be talking about the 20-day moving average, which is this white line. And I'm really excited to talk about that. It's extremely important. And hopefully this all makes sense, guys. And so now you guys should be pretty familiar with identifying several different types of candlesticks, and also identifying different types of trends that are occurring as well. All right, guys, have a good day. See you in the next class. Bye.
Let's hop right into the video. So step number one, you're going to go to indicators on your trading platform. Right now, I am on tradingview.com. Now, for my own personal day trading, I use Thinkorswim. Now, you're going to see tons of different complicated looking indicators. You're going to see crazy names like the Shande Kroll Stop. You're going to see Elder Force Index. You're going to see like Williams Alligator, and you're going to be overwhelmed. You're going to be confused. Which one do you actually use? And you're going to want to actually ignore all of these fancy sounding indicators. And your goal is to keep things simple. So what you're going to do is look up moving average. Okay, you're going to look up moving average, and you're going to see all these different types of moving averages. Now, what you want to do is double click on simple. You're going to click it once, and then you're going to click it one more time. Once you do that, you're going to see these two moving averages pop up in the top left, and you want to hover over one of them, and you want to go to settings. And once you do that, all you need to change is you want to change the length of 9, change it to 20, and then press OK. Now go to the other one and do the same exact thing. Hover over it, go to settings, and from here change the length to 9. And this time, you're going to change it to 200. And voila, these are the only two indicators I have ever used in my trading. Now, I also use volume. I don't really consider that an indicator, and I'm going to make a separate video on that. So make sure you subscribe to the channel to watch that video as well. But I've only ever used two simple moving averages. I think the simplest things in life are oftentimes the most brilliant. I have never used MACD. I've never used stochastics or VWAP or RSI or Elliott wave theory or Fibonacci. I keep it simple. And a lot of you guys are going to watch this video and be like, oh my God, two simple moving averages? Like what? Like I thought you would be using all these complex tools. No, I don't use any fancy indicators. I keep it simple. And funny enough, these are two of the most powerful indicators you will ever use in your trading, and I'm about to show you why. So first, I'm gonna teach you how to use the 20 MA, and then I'm gonna teach you how to use the 200 MA, and I'm going to keep things as simple as humanly possible. But before I do that, I wanna emphasize that you should never be solely relying off of indicators. Indicators are meant to complement your trading. They should never drive your decision making in the markets. And this is one of the biggest mistakes that I see beginner traders make. They have like 3, 4, 5 different indicators on their charts. All of those indicators are fancy looking. Their charts look complicated. So the trader feels like they're doing something right because everything looks complex, it looks sophisticated. And next thing you know, those indicators are all saying different things. And the trader doesn't know which indicator to actually follow. And that trader goes into what's called analysis paralysis, where one indicator is telling them to buy, another indicator saying it's bearish and to sell, another indicator saying there's no momentum and it's sideways, and then the trader doesn't know what to do. And they end up making the wrong decision, and they end up doubting their own judgment or doubting their own conviction. And that's exactly what you want to avoid. And that's why I like to keep things simple. I like to use two simple moving averages. You know, the reason I'm able to make money is because I keep it simple. And these moving averages complement my ability to read price action in the markets. Okay, so the first thing that you need to understand about the 20 MA is that it is the ultimate trend following tool in existence. And as a trader, I want to trade in the direction of the trend. I want to trade in the direction of where price is going. And in order for me to trade in the direction of price, I need to establish what the trend is. And the 20 MA helps us do that. So I want to see the 20 MA either trending higher or I want to see it trending lower. Now, obviously, if it's in an uptrend, I want to see it trending higher. If price is in a downtrend, I want to see it trending lower. Now, you want to ignore the 20 MA. And by the way, the 20 MA, like a moving average, it's just a line. That's all it is. It is just a line that finds the average price of the last 20 days. Now, if this was like the 100 period moving average, it would find the average price of the last 100 days. If it's the 200 MA, which I'm about to talk about in a few minutes, it's the average price of the last 200 days. So the 20 MA is kind of like a medium term moving average that I just love to use. It is incredibly powerful, as you're going to see in this video. Now, we want to see it trending. When the moving average, when the 20 MA is flat, that's when it loses its effectiveness. It's not useful for us. So we don't want to see flat moving averages. In fact, a flat 20 MA could suggest that that stock or that crypto or whatever you are trading actually lost momentum. If a stock or whatever has momentum, you're probably going to see either a rising 20 MA if it's an uptrend or a declining 20 MA if it's a downtrend. So that's a really easy way that you can immediately tell what the trend is or where the trend is going, whether the moving average is rising or declining, or whether it's flat, and when it's flat, it has no momentum and prices are sideways. Now, if it's a rising 20 MA, what we want to see is this moving average under price and trending higher, okay? And oftentimes during a bullish uptrend, you will see prices literally trade off of the 20 MA. Prices will literally retrace and consolidate into the 20 MA. And every time prices come close to or touch the 20 MA, that could present buying opportunities, okay? And we're about to look at a ton of examples, but that's the premise. The moving average is rising, it is under price, and it's an uptrend. And we see prices literally trade off of that moving average, where they will touch it and bounce, touch it and bounce, or consolidate into it and continue higher. Now, the same thing applies if it's a downtrend, except the moving average, we want to see it overprice trending lower. So we get a move down, we retrace into the 20 MA. Move down, retrace into the 20 MA. Move down, retrace, move down, retrace. And every time we get that retracement, that gives us an opportunity to potentially go short. So using the 20 MA, it will allow us to essentially enter into established uptrends or established downtrends. And as a trader, I like to go in the direction of price. A lot of people tend to try to go for reversals. Why? Reversals and picking tops or bottoms is difficult, yet so many beginners kind of gravitate towards that strategy. It is far easier trading in the direction of the trend. So that's what I'm looking for. A rising 20 MA during an uptrend, and I'm looking for prices to trade off of the 20 MA. And the same thing applies in a downtrend, but the opposite. The 20 MA is overpriced trending lower, and every time we see a retracement or a consolidation into the declining 20 MA, that gives us an opportunity to go short. And remember, we don't want to see flat 20 MAs. A flat 20 MA suggests lack of momentum, and it suggests that prices are sideways. So here's a great example of exactly what I just talked about. This is the 20 MA, this thick blue line. And what do we have here? We have an uptrend. We have higher highs, higher lows on the charts, and you could see that the 20 MA is rising, it is underpriced, and look how well prices respect this 20 MA. Prices are using the 20 MA almost as support, where whenever we retrace or whenever we consolidate into that 20 MA, we bounce and we continue the uptrend. This is exactly what I am looking for. Rising 20 MA with an established uptrend. And same thing applies if it's a downtrend. This is the 20 MA right here. It's overpriced, it's trending lower, and you could see we have a consolidation into the declining 20 MA, drop. Consolidation into the 20 MA, drop, right? And look at this. It literally perfectly touched this 20 MA, and that's when we got the breakdown. We retraced, didn't quite touch the 20, kind of got close to it, another breakdown. And this is what I'm looking for, established uptrends or downtrends. And I like to use the 20 MA as a location of where I'm looking to go long if it's an established uptrend, or I'm looking to go short if it's an established downtrend. Finally, we also use the 20 MA to measure what's called extension. Extension is the distance between price and the 20 period moving average. So you could actually use the 20 MA to measure how overbought a stock is. And I don't really like to use that word overbought. I like to use extended. So by looking at the distance between price and the 20 MA, I could tell whether I want to get in, or I could tell whether I even want to go for a reversal, where sometimes prices are so far away from the 20 period moving average that I know that it's going to revert back to the mean, and I'll actually go for a reversal setup. This also gives me information where I know I'm not going to go long up here because we're so far away from the 20 period moving average. It is way too extended. Finally, let's talk about the 200 period moving average, and this is actually even simpler. So what we're looking for is for a flat 200 period moving average. The 20 MA, we wanted that to be trending, whether it's uptrending or downtrending, and we don't want the 20 MA to be flat. It's the opposite for the 200. We want the 200 period simple moving average to be relatively flat. And the 200 MA could act as a ceiling for price whenever prices are trading below it. It could also act as a floor for prices whenever prices are trading above it. So what does that mean? Let's say you have a bunch of price action right here. This 200 MA could act as resistance for this price action, where a lot of time prices will go to the 200 and bounce from it, go to the 200 and bounce from it. So it could actually be a resistance area for prices if prices are below the 200. Now, the same exact thing applies if it's support, if prices are trading above it. Let's say you have a bunch of price action. This 200 MA can act as support for price, where prices will actually bounce from it. And it's literally like a floor for price action. Now, this setup is quite rare. However, I do want to mention it. Every now and then, you'll get what's called a squeeze play, where you have a flat 200 period moving average, and then you have a 20 period moving average that is rising and going through this 200. And what you'll sometimes notice is prices will actually oscillate between the two, where it's going to use the 200 as a ceiling, as resistance, and it's going to use this 20 MA as support, and they'll continue to oscillate and oscillate and oscillate and squeeze until the point where it can't squeeze anymore, and it's just going to break out. And these setups are quite rare. However, they're extremely powerful. So you want a flat 200 MA, rising 20 MA that's going through the moving average, and you want to see prices oscillate between the two until eventually they can't, there's no more room to oscillate, and then they break out. And this honestly works better for like swing trading. So I'd look at the daily or weekly time frame for this. Alrighty, let's look at some fantastic examples on how you could apply the 20 and the 200 MA into your trading. And I'm going to give you my thought process on how I apply it in my own trading. And by the way, these are not like cherry-picked examples. These are all stocks that I was watching or that I traded this past week. Like this KDP, this is Keurig. This had an overnight gap down yesterday where it gapped from $35 and the next day it opened at $32.50. And notice how we gapped directly below the 200 and how we opened below all of this support. So I was going into yesterday with a bearish bias, and I actually really like gaps that open below the 200. But let's take a look at the 5-minute time frame. This is one of the main time frames that I use, and look at how well prices are respecting the 20 MA on the 5, especially as soon as the 20 MA starts to actually establish a downtrend. As soon as the 20 MA is trending lower, right here basically, notice how well prices are respecting the 20. So right here, this is a potential short opportunity directly under the base. Dropped, kind of based into the 5, not quite, dropped again. Look at this, consolidated directly into the 20 MA and the 5. Next day, we gap down a little bit and continue that downtrend. Now, this is the 5-minute. Let's look at the 2-minute, especially today. And this is going to be shocking, but look at this. Look at how well prices are respecting the 20 MA on the 2-minute. I mean, every time it hits the 20 MA here, right here, right here, right here. Every time it hits the 20 MA, and it ends up dropping. And you could have literally went short every time prices hit the 20. And it would have worked for this absolute beauty of a power downtrend. And this is why I use the 20 during established downtrends. Notice how the 20 MA is trending lower very, very strongly. If we look at the 15, it's basically the same thing. Where the 20 MA is trending lower. However, there's a little bit of distance between price and the 20 MA. So the 20 MA isn't being like fully respected on the 15-minute chart. From there, you go to the smaller time frames to find your entries. But unbelievable daily gap that led to a beautiful downtrend where you could use the 20 MA for your entries to capitalize on this trend. Let's look at the BNS. This is a random stock that popped up today. This is the Bank of Nova Scotia. And stemming back all the way from 2024, when this uptrend kind of reversed, you could see that we entered into a downtrend on this stock. And this is the daily time frame, by the way. Look at how well prices are respecting the 20 MA on this downtrend. The 20 MA is overpriced, trending lower. We drop, retrace into the 20. Drop, retrace into the 20. Here we actually gapped down like 8%, and it gapped right into the 200 MA on the daily time frame. So this 200 MA acted as a floor for price. It acted as support for price. We gapped right into it, instantly got bought, then retraced into the 20, hit it perfectly, dropped. Again, hit it perfectly, dropped. And then right here, the trend reversed and we went into an uptrend. And you could see for yourself, look at how well prices are respecting the 20 MA. I mean, I don't even need to explain it. It's literally obvious and it's simple. That's exactly why I use the 20 and the 200 MA. Even here, we had a gap up today. Literally today, we gapped up 2% on a really bullish chart, really bullish trend on a nice gap up. go to the 15-minute time frame to find a potential setup. And even on the 15, look at how well prices are respecting the 20. We have a nice rally, red bar pullback, nice little buy setup here. We kind of move up a little bit right into the 20, and then we take off and make new highs. And this is why I use the 20 and the 200 on the intraday time frames and even on the larger time frames, because they're simple and they allow me to understand what the trend is. When I look at this chart, I know exactly what's going on. Established downtrend, then an established uptrend. And I know where I could potentially get into the trend using the 20-period moving average. Let's take a look at this RR, which had a really nice breakout the last couple days, but let's go back to 2024. And this is a really good example of a squeeze play where we have a rising 20-period moving average, flat 200-period moving average. You could see prices hit the 200, then hit the 20, then hit the 200, kind of oscillated back and forth. It's not a perfect example, but once it broke out, it really broke out. And this thing rallied like over 500%, which is insane. So that's a decent example of a squeeze play, but that's not even what I want to show you in this example. Look at how well the 200 MA is acting as support and as a floor for this stock. Like we hit the 200 here, instantly we bounce. Then we kind of chop around. We retest to 200, we bounce. Here we actually almost break down through the 200, that's instantly rejected. We move right back up. Again, we try to break through the 200, rejected. Again, right here, we try to break through the 200 to the downside, rejected. And then this time it led to a 62% move to the upside. And this is why I like to use the 200 MA. Whenever prices are above it, it acts as a floor, it acts as support. And by the way, this is the daily time frame. Let's look at a good example of using the 20 MA during the intraday time frame. So this stock had a very minor gap up. This was just a few days ago. It gapped up 2%, so it opened higher by 2%. It had a really nice green day. I'm seeing the 20 MA on the daily time frame is starting to trend higher. It's underpriced. So I went into this day with a bullish bias. And just take a look at this 5-minute time frame. Just beautiful uptrend, and it's beautifully respecting the 20 MA where we had a nice breakout here. We moved up, retraced to the 20, kind of chopped around, another move up, retrace to the 20, move up, retrace to the 20, move up, retrace to the 20. And it's just respecting the 20 MA almost perfectly. And every time it hit the 20, that was actually an opportunity to potentially go long. And just a beautiful uptrend with the 20 MA under price trending higher. Let's look at another example where we combine using the 200 MA on the daily time frame, and then we use the 20 MA on the intraday time frame. So this MAT gapped from like 2018, and the next day it opened 6% lower at around 1890. Notice how we gapped directly below the 200, literally directly below it. We didn't gap into it where it would act as support. We gapped right below it. And we also gapped underneath a lot of this support as well. So beautiful gap down. And from there, we go to the intraday time frames to find a potential setup. So off the 5 here, I mean, again, you could see how well prices are respecting the 20 MA. The best setup was right here, stop loss above basically. So this is the 5. Even if we look at the 2-minute, again, every time prices hit the 2-minute 20 MA, we get a move lower. We drop, retrace to the 20 MA and the 2, drop. Then right here, notice, check this out right here. We attempt to break above the 20. We attempt to kind of end this downtrend, break over the 20. That was rejected. Then we continue to base. The 20 acted as resistance, and boom, we got another breakdown. Again, right here, attempt to move past the 20, breakdown. Attempt to kind of go through the 20, breakdown. And you could see how well prices respect the 20 MA during this established downtrend on multiple time frames. Even if we look at the 15, right? It's usually better to look at the smaller time frames for your entries into these day trades, but even on the 15, 20 MA is overpriced, trending lower, confirming that bearish downtrend. This is Coinbase from a few weeks ago. We have a rising 20 MA under price. We have a consolidation into that rising 20 MA. 200 MA is directly above. We gap above the 200, around 12% to the upside, gap above the 200, triggering this base breakout on the daily time frame. 20 MA is under price. You go to the 15-minute time frame for a potential setup, and beautiful uptrend. Let's look at the 5, and you could see, look at that 5, how well prices are respecting the 20 MA. We have that initial move up, we consolidate directly into the 20, breakout over the base, nice move up, retracement into the 20. Look at how well it's respecting the 20, and then we have another leg higher. We retrace, another move up. So you could see how well prices respect the 20 MA, and this is exactly why I use it on multiple time frames. Let's finish off this video by looking at the S&P 500, the SPY. So this bottomed out in April, and since then we have been up only. And during this uptrend, what do you know? Look at how well prices are respecting the 20 MA, even on the SPY. So we have a nice move up, retrace into the 20. Nice move up. Here we consolidate into it. Then we have another breakout from the 20. We try to retest it on this tail. Instantly we move up. Here we actually broke under the 20. This was a few weeks ago. We broke under the 20, instantly rejected, have another nice move higher. Here we have a retracement, nice buy setup into the 20, boom. And now it looks like the SPY wants to continue higher. We could even look at like crypto. Let's take Ethereum. Look at how well Ethereum is respecting the 20 MA over the last few months. We have a rising 20 MA under price. Here it kind of broke below, instantly rejected, and we had a nice move higher. We retraced right into the 20, literally hit the 20, instantly we popped. Another red bar, hit the 20, boom. The next day we have a nice green bar. This was on the Jackson Hole, Jerome Powell speech. Then we retrace, hit the 20, boom. Today, literally another green bar. Even if you look back, just a few months ago, I bought a shit ton of Ethereum right here because I saw that the 20 MA started to transition higher. It's curling up. The 20 MA is underpriced, trending higher. We have a nice move up, base into the 20. This was a beautiful breakout. And what do you know? It hit target at the 200. So the 200 acted as a ceiling for Ethereum, where it hit the 200, retraced, hit the 200, retraced, hit the 200, retraced, hit the 200, retraced. Here we broke through. We kind of had a fake out and then a fake out to the downside. 20 MA is flat, so it's not that useful. And then as soon as the 20 MA begins rising and trending under price, that's when Ethereum starts respecting it and it resumed the uptrend. And I'm still expecting much higher prices for Ethereum. And that is exactly why I use the 20 and the 200 MA for every single one of my charts that I look at. I like to keep it simple, guys. All I use are two moving averages, the 20 and the 200. And by keeping it simple, that's what allows me to make money. So hopefully this could be transformative for your trading, and hopefully this will help you keep it simple. So make sure you subscribe to the channel if you enjoyed this video. Leave a comment if you found it valuable. Leave a like. That's going to help the YouTube algorithm. And hopefully you learned a lot, and I will see you on the next video. Thank you very much. So what I want you to do is look up moving average, okay? And you're gonna see a bunch of different options, but what I want you to do first is click on the simplest one. Click on simple moving average once, and you're gonna see SMA 9 close pop up in the top left corner. That's exactly what you wanna see. From there, you want to click on moving average exponential, and you're going to see EMA 9 close also pop up in the top left corner. And I'm going to explain the difference between an exponential moving average and a simple moving average in just a second. But first, I want to get everything set up on your charts, and you should see something like this. Now, what you want to do is hover over SMA 9 and go to settings. And what you want to do is click on inputs and change the length from 9 to 20. And from there, I also want to change the style. I do like a blue 20 MA. However, I like my line to be a little bit thicker so it's a bit more noticeable on my charts. So I'm going to click on that. It's going to make the 20 MA a little bit thicker, and I'm going to press OK. And this is the 20 period simple moving average. Now, go to the 9 EMA, go to settings, and when you go to inputs, you don't want to change anything. You want to keep everything the same. You want a 9 EMA. The one thing we are going to do is change the style. I'm going to make this one also pretty thick, and I'm also going to make this a bright color. I usually like to make it orange. Now, I am a little bit colorblind. I don't even know if this is orange, but let's just go with this and press on OK. So now I have the 9 EMA on my chart and I have the 20 SMA on my chart. And you're probably already noticing the power of the 9 EMA in this instance. And you're seeing how well prices are respecting the 9 EMA. But now I want to go a lot more in depth on exactly how you could use the 9 EMA and the 20 SMA in your trading. And especially when you use them together, it creates a really powerful combination. And this can sync really well with your strategies. It can really complement your trading. And keep in mind, the purpose of indicators is to complement your ability to read price action. You are not supposed to be entering or exiting exclusively off indicators, right? So I want to make that very, very clear before I continue this video. You should never be buying or selling strictly because an indicator is telling you to do so. These are meant to complement your analysis. So let's talk about why I like to use the 20 SMA and the 9 EMA. And as a trader, I like to trade in the direction of where prices are already going. I like to trade with the trend. I'm sure you've heard the expression that the trend is your friend, and it's super cliche to say that. However, most traders like to trade against the trend, and that's one of the biggest beginner mistakes that you can make. A lot of traders try to pick tops and bottoms with precision, and that is difficult because ultimately you're going against the trend. So if you're a beginner trader, my recommendation is trade with the trend, and that's exactly why I like to use the 20 SMA and the 9 EMA, because these are some of the most effective trend following tools in existence, where I'm able to use these moving averages and I'm able to, number one, identify what the trend is on multiple time frames, and from there I'm able to time my entries by using the moving averages as well. And real quick, before I break down exactly how that works and what you want to see, I want to talk about the general differences between what an SMA is and what an EMA is. So a moving average in general finds the average price of an asset over a specific period of time, okay? And the main difference between an SMA and the EMA is that an SMA puts equal weight across every period when it's calculating that average. However, an exponential moving average puts more weight on the most recent price action that occurred. And I don't want to get into the details and go into the math side of how these moving averages are calculated. That's not really important. But a 9 EMA basically puts a lot more emphasis on recent price action. So it's able to catch up a little bit quicker to price. It doesn't lag as much as the 20 period simple moving average. So the 20 SMA is like my medium term moving average to see what the general trend is. And from there, I like to use the 9 EMA as my short term moving average to see, exactly what is going on with price from a very, in-depth perspective. Okay. So both of these work in almost the same way. And here's what you're looking for. If you are looking to go long, or if you're identifying an uptrend, you want to see the 20 SMA rising, and you want to see the 9 EMA, and I'm going to make this a different color. You also want to see this rising as well. And what you'll notice is that the 9 EMA is always going to be above the 20, because the 9 EMA, of course, it reacts quicker because, number one, it's an exponential moving average that puts more weight on recent price action, but it's also the 9-day, right, versus the 20 SMA. This is 20 periods versus 9 periods. Of course, 9 periods, it's going to move quicker relative to what prices are doing. So you want to see the 20 SMA and the 9 EMA under prices and trending higher. And if you're able to identify this on multiple time frames, and if you have a clear bullish catalyst where maybe there was a gap up on a stock, a gap up is an overnight change in price. As an equities trader, I really like to trade gaps. So every single morning when I create my morning watch list, I like to look for gap ups, and that gap is usually a bullish catalyst, and I'll try to find an entry to potentially enter in long if I do see a setup, okay? So if there's a bullish catalyst or there's a clear, uptrend on a stock, I want to see the moving averages under price and trending higher. And if you're able to see this on multiple time frames, what you'll notice is that prices will begin to respect these moving averages, and you can time your entries off of these MAs, where you'll notice that prices will move up and pull back right into the 9 EMA, or you'll notice that they'll move up and they'll pull back right in between the 9 EMA or the 20 EMA like this, or maybe they move up and they pull back to the 20 EMA. Okay, and you can basically time your entries and gauge where we are in the current trend by evaluating where is price relative to the 9 EMA and the 20 SMA. So that's what I like to do. I like to time my entries off of these moving averages, where sometimes we have a move up and we consolidate right into the 9 EMA right here, and that could be a potential entry point. Or sometimes we consolidate in between. And I've noticed that this little space in between the 9 EMA and the 20 EMA, if you have an uptrend on multiple time frames and price action consolidates or retraces into this space, that is kind of like a buying area. And that's where I like to time my entries into my trades, where it'll consolidate right in between this space, in between the 9 EMA and the 20 SMA, and I will look to potentially go long. And I'm going to show you a ton of examples of this happening, but it's really important that both of these moving averages, the 9 EMA and the 20 EMA, are rising and under price. You don't want to see the moving averages flat. Okay, so you don't want to see the 20 EMA flat, and you also don't want to see the 9 EMA flat. If they're flat, that suggests a lack of a trend, essentially. Prices are sideways. There's no momentum, and you'll notice that price action will, quite literally be sideways during this kind of time. So you don't want to see the moving averages flat. You want to see them under price and trending higher. And the same thing applies if it's a downtrend. If it's a downtrend, then you want to see the 20 EMA overpriced trending lower, and you want to see the 9 EMA also overpriced trending lower. And you'll notice that price action will respect these two moving averages and even trade off of them. And this is exactly how I time my entries. Another concept that you need to know is if we're super far away from the moving averages, you could use that to measure extension. So what is extension? Extension is the idea of being overbought, right? So here's an example of that. Let's say there's, an uptrend, and all of a sudden prices start to accelerate from the 9 EMA and from the 20 EMA. And prices are right here, and all of a sudden we're super far away from these moving averages, right? This is called extension. That is the distance between price and the moving averages. And I don't want to be buying. I don't want to be timing my entries when prices are extended, because you could think of it as we are overbought. What I want to do is I want to wait for prices to correct. I want to wait for prices to consolidate, correct, retrace, and I want to see these moving averages begin to catch up to price, the 9 EMA and the 20 EMA as well. I want to wait for them to catch up to prices, and that's when I can begin timing my entry to potentially go long. So if we're super extended, if there's a lot of distance between price and the moving averages, I don't want to be buying, right? I want to wait for prices to cool off before I time an entry. Now, I want to show you some real life trades that I've taken over the past few weeks, and I want to show you how I was able to apply the 20 SMA and the 9 EMA in my trading. Now, I want to emphasize one more time, I am not exclusively trading off of these indicators. I am using them to complement my trading plan. Trading is not about using a couple of indicators and taking all of your entries just off of those indicators. No, it's about combining several concepts together to identify and trade high probability setups. And that's exactly what I do with these moving averages. They're not driving my decisions, they're complementing my decisions. But I want to show you a trade that I took on the AGAE. This was April 15th. This was relatively recent, and this made me a little bit over $5,700. And the AGAE, we're going to start off by looking at the daily time frame, had an overnight gap up, and that gave me a bullish bias on the day. This was on my bullish watch list. This wasn't even a favorite stock for me. I just wanted to keep an eye on it throughout the day, but this had a 58% gap up. It gapped from 32 cents the previous day, and the next morning it opened at around 52 cents. So as I was scanning my watch list around an hour into the day, I saw on the 15-minute time frame that we retraced, we pulled back directly into this rising 9 EMA, and of course the 20 EMA is rising directly below it as well. I found that pretty interesting. So from there, I checked multiple time frames and I went to the 5-minute time frame, and I noticed that we actually retraced perfectly into the 20 SMA that is rising. And as soon as I noticed that, I found that even more interesting, right? And I went to the 2-minute time frame to look for a potential entry. And I saw it right here where we were, right on the 20 SMA on the 5, and we're also at the 9 EMA on the 15. And on the 2-minute, I saw we moved up and we consolidated right into the 9 EMA on the 2. And my first entry was over 45, stop loss below this base. So this was a really tight base breakout. It started to move in my favor, and from there, I added to the position right here. So notice that we retraced right into the 20 EMA and we started to bounce. And this kind of area between the 9 EMA and the 20 SMA, that was an excellent potential kind of add opportunity for me. So I added to the position right here. We made the next move and we retraced where? Right in between the 9 EMA and the 20 SMA. Now notice how the 9 EMA started to decline a little bit right here, and that may have been a red flag, but it's all good because the 20 EMA, that's kind of my medium term moving average, it's still rising. It's still underpriced and it's still trending higher, and we respected it really well. So this was actually my final add for the position where we moved up, retraced to the 20 EMA, we were in between the 9 and the 20, and from there this had an amazing move to the upside. Even on this pullback right here, we moved up and we retraced right into the 9 EMA, and then we made that next leg higher. And I had about 20,000 shares at an average of 50 cents because I added multiple times, and I got out at around 79 or 80 cents. So I didn't quite catch the top. That's fine. My goal isn't to catch the top for every single trade that I take. My goal is to follow my trade management plan, and my trade management plan called for, I took a little bit of profits at 75, I took one lot at 90, and then I took another lot at 80, and it ended up averaging out to an exit around 79 cents. But yeah, beautiful trade, and I was able to use the 9 EMA on the 15, right? As soon as I saw that, I went to the smaller time frames to find a potential entry, and we were respecting the 20 EMA on the 5, beautiful. And from there, I saw an entry on the 2, where we consolidated right into the 9 EMA right here. So notice how I'm using multiple time frames. I'm not just relying off one time frame. I'm using these moving averages, and I'm looking at the 15. I'm determining what is the setup on the 15. And from there, I go to the 5 and I go to the 2 to look for potential setups to essentially solidify that bias that I had on the 15-minute time frame. And keep in mind that on the daily time frame, there was an overnight gap up. So I already had a bullish kind of bias for this stock going into the stock market open. Let's take a look at another trade that I took on April 10th. This was the OGN, and this made me just shy of $3,200 in the afternoon, actually. And this stock was on my bullish watch list because it had an overnight gap up, from 690, and the next morning it opened at around $8. This was a 16% gap up. This wasn't a favorite for me going into the market open, and I actually took this trade well into the afternoon. But first, I want to show you what the 2-minute looked like in the morning, and I didn't really capitalize off of this move, but you could see how well prices are trading off of the 9 EMA right here and the 20 SMA right here as well. And I actually took this trade off the 15-minute time frame in the afternoon, and the 9 EMA wasn't really useful for me off this setup right here, but we have a nice move up, 40 to 60% retracement. We have multiple entry bars basing into this rising 20 SMA, and I took this as a long over these entry bars, so over 838. Stop loss was 829, and I think I got like 6,000 shares. I was risking about $600 on a 10-cent stop, and I added to the position over this consolidation right here where we moved up and we consolidated, and I added over this base right here. I think I also had an add off the 2-minute time frame right here because we broke out and we retraced into the rising 20 MA and the 2, and I actually added right here, and then I added over the base, and I moved my stop loss up from this original point to 844, and I was able to catch this move to the upside. But you could even see off the 2-minute how well it's respecting the 20 EMA, right? And this is why I like to use the 9 EMA and the 20 SMA in tandem. If you look at the 5-minute time frame, you could see how well prices are respecting the 9 EMA right here. So that's why I like to look at multiple time frames and see what prices are doing relative to what the moving averages are doing. But this was a beautiful, what I call buy setup. This was a nice retracement setup. We moved up, we pulled back, based right into the rising 20 SMA, long over these entry bars, and my target was the prior high, and this was a beautiful retracement setup, and the moving averages really complemented this trade. So I showed you a couple of wins, but now I want to show you a losing trade that I took yesterday, and hopefully this can really emphasize that you should never be exclusively relying off of these indicators. They are meant to complement your trading plan. And although I did not solely take this trade because of the 9 EMA or the 20 SMA, I still want to prove this point. And I lost about $1,000 on the Beyond yesterday morning, but to be honest, I'm absolutely okay with the loss. I would have taken this trade every single day of the week. Losing is a part of the game, and I had a lot of conviction in this setup, and the results are a little bit wacky because I traded it yesterday and then I also traded it today. But this specific setup lost me about $1,000, and funny enough, I actually made money on the Beyond the previous day, and that's what kind of motivated me to trade it yesterday. All right, so I made money on this day where it rallied from 83 cents to 116. I scalped it over $1 and caught a quick move in the afternoon, and then all of a sudden the next morning it gapped from 116 to 138. And I didn't really go over the 200 SMA in this video. I have other videos where I do break down how to use the 200 SMA. I also cover it in my free 10+ hour course, but I thought that that was target here, where we had a nice gap up, and the next target on the daily time frame is the 200 SMA. So I thought, we could have gotten a nice pop from 138 to around 160 or 155. That was my target. And I went to the 1-minute time frame, and I saw this setup right here, where the stock opened, it dropped, it attempted to break down and failed. And the way that I can see that is because I am looking at a bottoming tail. A bottoming tail suggests that the buyers have taken control. The sellers attempted to bring prices lower and failed. And whenever I see a bottoming tail or a failed breakdown, or you can call it a shakeout on a consolidation like this, it just really amplifies the setup. And on top of that, it was basing right into the 9 EMA on the 1-minute time frame. So I thought this was a slam dunk. I went long over 134, and I put my stop loss at 128, and I was risking about 6 to 7 cents, and I was targeting around 160. So that's about 25-cent reward on a 6 to 7 cent stop. So, R to R was excellent I loved the failed breakdown, the shakeout bar, perfect. It consolidated rather nicely into the rising 9 EMA. 20 EMA is also rising, and we had room on the daily. So I thought this was a slam dunk, and it started to go. It triggered over 35, and it was really struggling to break over 140. And that was going to be my next add. I was going to, add to the position a little bit and see if we can get some more continuation. And as soon as it started to go, it essentially instantly failed, and I had to take a loss on this. Now, it did retrace into the 20 EMA and bounce, but I didn't take this setup because it failed on the previous breakout. So I lost about $1,000, and to be honest, I really sized up on this trade because I saw the failed breakdown. I liked the daily. I liked this base right into the 9 EMA. I thought it was super high probability. It was a high conviction setup for me, and unfortunately, it just didn't work. But yeah, hopefully, I'm sure maybe there's some people that saw, rising 9 EMA, we got a base into it, I'm going to go long, right? Like, that's not a strategy in itself. If you did that, if you took this trade just because it had a rising 9 EMA and it based right into it, you would have lost as well. Let's take a look at one more example that unfortunately I wasn't able to capitalize on, but this was an unreal move a couple of weeks ago on the AIXI, and this just proves how effective these moving averages can be if you find a bullish stock that has an established uptrend. This stock rallied from 12 cents all the way to 269 in a matter of 3 days. And just take a look at this 15-minute time frame and look at how well this stock respected the 9 EMA on the 15-minute time frame. It opened on this day and it retraced right into the 9, made a nice rally. Retraced again into the 9 that afternoon and produced an amazing rally. And even the next day, right? Basically every single retracement into the 9 ended up getting bought, and the stock continued its move to the upside. Take a look at the 5-minute right here. And of course, this has to be applied on multiple time frames. But look at how well it's respecting the 9 EMA right here. And then the next morning it opens and it retraced right into the 9 EMA on the 5-minute time frame. And I actually got in right here, but I ended up mismanaging my position. I got in over $1, stop loss, I think it was about 92 cents. And I ended up getting out way too early. But even here, we moved up, retraced right into the 9 EMA, and then continued higher. And later that day, this stock just went absolutely bonkers. I did not catch this at all, but that's the power of these moving averages. If you could find a stock that's clearly uptrending or downtrending, you could use these to your advantage to measure extension and to figure out exactly where you should be timing your entries. And by the way, here's a great example of extension. Like if I'm looking at price action right here, we are far away from the 9 EMA, but we are even further away from the 20 EMA. So I would never be looking to, enter in long after the stock is basically up, 850% in a matter of 3 days, and we're this far away from the 9 EMA and the 20 SMA. And usually when I'm measuring extension, I'm mainly looking at price relative to where the 20 MA is. Hopefully you found a lot of value in this video. Just add these two indicators on your charts and you'll begin looking at price action with a lot more clarity. And remember, never rely off a single indicator. These are meant to complement your analysis. And if you did enjoy this video, make sure you leave a comment with feedback, make sure you leave a like, and make sure you subscribe to the channel for more trading education, and make sure you get started with my free 10+ hour trading course. Thank you so much for watching. I'll see you on the next video. In this video, I'm going to completely reshape the way that you look at time frames. And what if I told you that I don't actually use one specific time frame for all of my trades? And to show you how you should perceive using time frames, we're going to use an analogy. Imagine we have a mountain right here, and let's say you are at the bottom of the mountain. This is you chilling. You're at the bottom of the mountain. I have a question for you. Are you truly going to have a perspective of what's going on around you when you're at the bottom of the mountain? Like, are you going to understand what the landscape is around you, where the hills are, where the birds are, where the creeks are, the lakes, the rivers, whatever? Are you going to have a perspective of what's going on around you? Well, not really. You're literally at the bottom of the mountain. Like, imagine being at the bottom. You can't really see what's going on around you, but as you move up the mountain, right? Let's say you're right here. Are you going to have a better perspective of what's going on beneath you at this point of the mountain? Well, absolutely. You have a much better perspective. You could somewhat see the landscape, the trees, the lakes, etc. You have a better perspective than when you were at the bottom of the mountain. Now, let's say you're at the top of the mountain. Are you going to have a better perspective? Well, of course. In fact, you're going to have the ultimate perspective of what's going on beneath you and around you because you're at the top. You see everything that's down below. You know what the landscape is. You know where the rivers are. You see everything because you're at the top of the mountain. You have the ultimate perspective. And this is the way that I would perceive and understand time frames. When you're at the bottom of the mountain, that's like looking at smaller time frames in your trading. And then as you move up and up the mountain, that's like looking at the higher, the larger time frames in your trading, where the larger time frames, they give you perspective on what that stock or what that crypto, whatever you're trading, whatever it is doing. It gives you the ultimate perspective. It gives you the kind of long-term bias of what's going on. And then as you go down the mountain, you could, your perspective kind of shrinks and shrinks and shrinks. And this is the way that I would think about time frames. And the point that I'm trying to make here is it's not about using one time frame. There are so many videos on YouTube that will tell you use exactly these time frames and you'll find success. No, that's not what trading is about. Trading is about multiple time frame analysis, right? And this is one of the biggest mistakes that most beginner traders make. They don't look at multiple time frames before they enter into a trade. And frankly, you are trading blindly if you're only considering one time frame before taking a trade. I want you to think about the last, let's say, 10 trades that you took. How many time frames did you look at before you entered into those trades? What were you just looking at the 5-minute chart or the 1-minute chart and you entered and then it ended up being a loser and you were like, why was this a loser? I want you to ask yourself, be honest with yourself. Are you actually looking at multiple time frames? And if not, why not? And what we're looking for when we're reading multiple time frames is alignment. Alignment. This is called multiple time frame alignment, where multiple time frames are telling you the same thing, right? They're all telling you what the stock is doing. They're not conflicting, right? So alignment would be like 5-minute is uptrending, 15-minute is uptrending, hourly is uptrending, daily is bullish. That's alignment. Conflict would be like 5-minute is in a downtrend, 15-minute is sideways, daily is in an uptrend, hourly is sideways. Like that's not alignment, that's conflict, right? And we're gonna be looking at really specific examples of how this works, all right? So what I want you to focus on in this little example, in this exercise here, because this concept is actually extremely simple. Looking at multiple time frames is really simple. And don't worry, I will tell you what multiple time frames I use in my trading every single day. That's a little bit later in the video. This is equally as important. I want you to look at the current time frame in each one of these examples. And what we're going to be doing is considering and asking ourselves, are we going to take this trade on the current time frame based on what the lower time frame is doing and based on what the higher time frame is doing? So let's look at this first example. What's the current time frame? Well, it looks like we're in a very strong uptrend. We have a rising 20 MA underprice, and it looks like we have like a buy setup retracement pattern. This looks bullish. It looks like we want to go long on the current time frame. So let's think about, should we go long? What is the lower time frame doing? Well, the lower time frame is in a downtrend and looks bearish, okay? Looking like it's actually going to drop, declining 20. Higher time frame is essentially doing the same thing, right? In a downtrend, declining 20, bearish. Are we going to take this trade on the current time frame? Should be absolutely obvious. No, obviously not, because the lower time frame is bearish and the higher time frame is bearish. Makes sense? Easy enough. Let's move on. What about this situation? The current time frame, same exact thing. We're looking to go long for a buy setup, retracement play, strong uptrend. We want to go long and make money to the upside. Lower time frame looks good as well, almost identical. Bullish, uptrend looks good. Higher time frame is bearish and in a downtrend. I want you to pause the video. Are we going to take this setup? And the answer should be no, we're not going to take this setup. We always put more emphasis on what the higher time frame is doing. So in this case, the higher time frame is bearish. If the higher time frame is bearish, that's like the upward perspective, right? That's like the top of the mountain is bearish, right? And then the bottom of the mountain is bullish. Are we going to take this trade? No, right? Because the higher time frame is just way more important than the lower time frames. This is what gives you the bias. We always want to be trading in the direction of the higher time frame, all right? Makes sense? Should be easy. Higher time frames more important than lower time frames in terms of direction. Next, we have the current time frame right here. Bullish, looks higher, great. Lower time frame looks bullish, higher, uptrend, great. Higher time frame, bullish, uptrend, looks great. Perfect. This is excellent. This is exactly what I want to see because the lower time frame is bullish and an uptrend. Current time frame is bullish and an uptrend. Higher time frame is bullish and in an uptrend. Excellent. This is obvious, exactly what we want to see. This is multiple time frame alignment. Now let's look at this example, and this is going to be interesting. Current time frame looks good. Uptrend, same exact, right? We want to go long. Higher time frame looks good as well, right? You know, uptrend, bullish, uptrend looks great, right? Current time frame and higher time frame looks great. Remember, we put more emphasis on the higher time frame. Everything's looking good. What is the lower time frame doing? Well, the lower time frame is bearish in a downtrend. So what do we do here? And you actually have two options. Your number one option is you could say, hey, I don't care about the lower time frame. The current time frame looks excellent. The higher time frame looks excellent. The longer term bias is on my side. I really like the quality of the setup. I don't care if the lower time frame is bearish because the current time frame and the higher time frame looks good. I'm taking the trade. That's option number one. Option number two, you can be patient, maybe pass on the initial setup and wait for the lower time frame to turn bullish. Wait for this to end the downtrend and begin an uptrend, or wait for the 20 MA to start curling up, right? You essentially wait for the lower time frame to begin aligning, or you wait for the lower time frame to begin aligning with the current time frame with the higher time frame. Jesus, the words mix me up, but you guys get my point here, right? We wait for the lower time frame to begin looking bullish, and that will give us our final confirmation to go long. So those are your two options in this case, where the current time frame looks good, higher time frame looks good to go long. Lower time frame is bearish. You could just take the trade anyway because you like the current and higher time frame, or you wait for the lower time frame to turn bullish, wait for the 20 MA to begin rising, wait for the downtrend to end and for an uptrend to begin forming. Those are kind of your options, and this is the way I look at every single scenario, every single trade in the markets. Excellent. Let's go ahead and look at some real life examples. And this was actually a trade that I took the other day, or that I was considering taking the other day. So let's look at this EOSC on the 15-minute time frame. All right, what do we have? We have a declining 20-period moving average. Looks good. We dropped. We kind of retraced that drop. We moved down, and then we began basing into the declining 20 MA on the 15-minute chart, and we were gearing up for a breakdown. It looks like this wanted to break the lows of this base. That would be our entry. Stop loss above this pivot. It was looking good for a breakdown, right? I was actually considering this. Now let's look at the daily time frame. What do we see on the daily? Well, the day before, we had a nice gap down, big move lower. I actually made money on the EOSC this day. The next day, this is this day right here. So this setup is on this day right here. We gap down again, and then we attempt to move lower. Now notice how we have the 200 period moving average acting as support. So this is an example where the 15-minute time frame looks good to break down, looks good for a short, but the daily time frame is directly into the 200 period moving average, which is acting like support for this stock. And this is an example where we use multiple time frames. 15-minute looks good, but we have to check the higher time frame, which is the daily chart, and then we see that this stock is into support. So what was the outcome of this trade? Well, it didn't end up working. It actually ended up failing, right? It basically triggered, and then immediately failed, and it would have hit your stop loss. But that trade could have been easily avoided by just looking at multiple time frames, by looking at the current time frame and then looking at the larger time frame to see, do we have support below? What is the overall trend on the larger time frame? Does it look good or not, right? In this case, the overall trend was bearish, right? We had a gap down, we were continuing lower even on this day, but we had support at the 200. So the setup ended up failing and I ended up avoiding this loss. Why? Because I looked at the higher time frame. I used multiple time frame analysis. Let's look at another example here. So this stock actually gapped up on this day right here, right? You could kind of see the 20 MA starting to curl under price. It looks like it's starting to form an uptrend, right? We have a low, high, low, high, low, high, right? We have an uptrend. And then we have a kind of like a retracement buy setup here. When we move up, we retrace. We ended up actually gapping right here, right? And I saw this on this morning, right? This was like last week. So on the morning, I saw that we were opening at this price around $27. This was before the market actually opened. So this was the pre-market price that I was seeing for this stock. So what did I do? I went to the daily time frame and I checked, does this stock have room to actually run? Where is the next resistance area if I decided to go long on this stock? And remember, I'm a gap trader. So as soon as I saw this gap up, it's kind of clearing this little resistance here. I was interested in potentially going long on it. And I looked to the left and I saw, hey, we have a bunch of resistance here. This is the next resistance area. And let's see how the trade ended up playing out. All right. And we ended up, moving higher. We had that gap. We opened right here. A gap is an overnight change in price. So you could literally see that there's a gap in price. Maybe I think this happened because of earnings or some news. That's irrelevant. I only really look at the price action, but we gapped up. I saw that we had room to run to the next resistance area, and that's exactly where we ended up kind of finishing off that day's move. From there, once we established there was a gap on the daily time frame, the gap had room to run to the next resistance area. We go to the smaller time frames, in this case, the 2-minute chart, right? And we found a setup. We had a move up, retracement, and this is just a picture-perfect buy setup, picture-perfect retracement pattern, right? 40 to 60% retracement, multiple entry bars. Entry would have been over the highs of these doji bars. Stop loss would be below this bottoming tail, and we saw just an amazing move higher. And I actually teach the buy setup and this retracement pattern in my free 10+ hour course. It is genuinely better than most paid courses on the internet. I 100% recommend that you watch it. It'll actually build the foundation for your trading. It is 10+ hours of just pure sauce. Watch it and combine what you learn in my free education, in my free course, with everything that I teach on my YouTube channel. But hopefully you guys are kind of getting the idea here. I don't want this video to be too long. I kind of want this to be a rapid fire video for you to learn from, but hopefully this makes sense. We start off looking at the daily chart. We identify the gap, identify what the next resistance area is. It was a gap up above resistance, love it. Then I went to the smaller time frames to find a potential entry. In this case right here, I found an entry on the intraday time frame. I checked the larger time frame to see if it looked good, to see what the trend was, to see if we had support beneath us, and we ended up having support. And then I ended up avoiding this trade, and I avoided losing money on this position because I checked multiple time frames. And this is kind of the system that you want to use. Now, let's go ahead and cover what time frames I actually use for trading stocks. And right off the bat, I am always looking at the higher time frames. For everything that I do, I'm always keeping an eye on the daily time frame and the hourly time frame for every single one of my trades. So when the market first opens, I am primarily focusing on the 1-minute and the 2-minute chart. And closer to 10 a.m., I'm definitely focusing on the 5-minute chart as well. Then from 10 a.m. to like 12:30 p.m., I'm focusing mainly on the 2-minute and the 5-minute, primarily really the 5, and then of course a little bit of the 15. As we move towards 12:30, I'm more and more looking at the 15-minute time frame, and then from 12:30 to 4 p.m., I'm mainly looking at the 5 and the 15 for my entries and for my setups. All right, and I do occasionally look at the 1 and the 2-minute charts as well, just for extra confirmation. And this is what I do. And I'm always looking at the daily and hourly, right? So it's in conjunction. It's not like only this time frame or only that time frame. We're looking at multiple timeframes. And that's what gives me an edge compared to other traders. I'm really good at analyzing multiple timeframes, because every now and then you'll get a setup that looks amazing on the 5, amazing on the 15, even looks kind of good on the daily, but then the hourly will be into resistance, right? Or the opposite, maybe the intraday timeframes aren't that great. Maybe the 5 and the 15 are okay setups, but the hourly and daily chart have, a fantastic setup where it was a high quality gap up or gap down. The hourly chart looks amazing, but the 15 and the 5 don't look as good. Sometimes I'll still take that setup because of how good the higher timeframes are. Does that make sense? So it's really, I'm always emphasizing the higher timeframes and the current timeframes. All right. And don't get hung up on the exact time of day, right? It doesn't matter. Like if it's like 9:57, that's not like, there's no like exact time where I transition to another time frame. It's kind of like flexible. I'm very free with my trading. I'm kind of looking at all of them, to be honest. In terms of swing trading, we're primarily looking at the hourly time frame, daily time frame, weekly time frame, or monthly time frame. Monthly time frames are a bit much, right? A lot of times you don't really need to look at the monthly. It's mainly hourly, daily, weekly. If you find a setup off the weekly time frame, you want to go to the daily time frame to find a setup. If you find a setup on the daily time frame, you want to go to the hourly time frame to find a setup, right? So let's say you find a setup on a particular time frame, on a higher time frame, you can go to the smaller time frame to find an entry for that setup, and this will allow you to find potentially a better entry, and you could also even get a tighter stop loss, right? So let me kind of show you an example of this. I'm going to kind of draw it out. Let's say you have like a nice little uptrend and you get a buy setup, and let's say this is the 15-minute time frame. Maybe if you go to the 5-minute time frame right here, you get, a tighter stop where you can maybe put your stop here, entry there. But if you did it on the 15, your entry would be here. Does that make sense? So you're able to use a tighter stop, and as a result have a better reward to risk. This is not the best example. I'm kind of just drawing off the top of my head, but you guys get the point, right? You see a setup, you can go to the smaller time frame to find an entry into that setup, find a stop loss into that setup, and as a result have a tighter stop and have better reward to risk, right? Hopefully this makes sense. So sometimes if I see a really nice daily setup, I'll go to the hourly for my entry. I find a nice weekly setup, I'll go to the daily for my entry. So you could play around with this. You could use multiple time frames and get creative with your entries. In summary, guys, this concept is actually incredibly simple. Always look at multiple time frames, and this will allow you to filter out a lot of the low quality trades that you're taking, because I guarantee you're taking trades that look maybe amazing on the 15-minute time frame, but then when you look at the daily or the hourly, it doesn't look good at all. And maybe by using multiple time frames, that would save you from taking the trade and save you from losing money. Does that make sense? It's a really simple kind of concept, right? And these are the time frames that I use in my trading. And it's all about just using multiple time frame analysis and always looking for alignment. You always want, ideally, you want to see this. You want most of your trades, 80% of your trades, to look like this. Lower time frame is in sync, current time frame is in sync, higher time frame is in sync, everything looks good. There are multiple qualities that are converging together to make it a high probability setup, and you're probably going to make money most of the time trading this quality of a trade. And the other setups you should be taking are like this, where maybe the current time frame looks good, the higher time frame looks good, but the lower time frame isn't quite ready yet. In that case, you could be patient and wait for it to set up. And realistically, guys, unless it's like a small scalp, you should never really be taking setups when the higher time frame is in conflict with the current time frame and the lower time frame. Hopefully this makes sense, guys. Support and resistance is by far one of the most powerful concepts in trading, yet 95% of traders use it completely wrong. You see, most traders just draw lines on their chart, they buy at support, sell at resistance, and then they wonder why they keep losing. You have to understand that support and resistance by itself isn't an edge. It's what you combine it with that can make or break your trading setup. 6 years ago, when my father mentored me on how to trade, he taught me that that support and resistance is most powerful when you actually keep it simple. And he taught me 3 main use cases for it that I still use every single day in my trading. By the end of this video, you're going to learn how to identify support and resistance the right way, how to draw them on your charts, and the 3 main use cases that my father taught me 6 years ago. This information is going to be so simple and intuitive that this will literally be the last support and resistance video you will ever need in your trading. So make sure you save this video, make sure you watch until the end, take some notes, and let's get right into this video. Okay, a couple things before I get started. Number one, I want to make this video as simple as possible, where if you're a beginner trader, you'll still be able to conceptualize and apply all of the information I'm about to teach you into your trading plan starting tomorrow. But I also want to make this video as detailed as possible, where if you already have a few years of trading experience, you'll still be able to take advantage of this information, apply it, and find tremendous value from it. Number two, one of the biggest mistakes that I see a lot of beginner traders make, and maybe you're making the same mistake, is that they are solely trading off of support and resistance, where this is their primary strategy. They draw lines on their chart, they buy at support, and they sell at resistance, and then they expect long-term profitability. You need to understand that support and resistance by itself shouldn't be your edge. This should complement all of the other criteria that you look for in your trading plan. You're not supposed to solely trade off of support and resistance and not consider anything else. I want to make that very, very clear. And I'm going to talk about a lot of the other criteria that I look for in my trading alongside of support and resistance. So now that that's clear, let's go ahead and hop into this video. So first, I'm going to break down what support and resistance is in the first place. I'm really going to simplify it for you. And from there, I'm going to talk about the 3 main use cases that my father taught me. We're going to be looking at some real life trades, some real life examples, and I'll also show you how to draw support and resistance on your charts and how to identify them as well. So let's talk about resistance and support first. So resistance is an area of price, a historical area, where whenever price is going to that area, it typically leads to selling pressure, where this area stops prices from continuing higher. And usually a strong resistance area is formed after 2 to 3 touches. So this is our first touch. This is our second touch. As soon as a second touch happens in this area, that's when we can kind of say, okay, that might be a legitimate resistance area. And once we get the third, that makes the resistance area that much stronger. In fact, the more touches you have, the more attempts of prices going into that area, and the more failed attempts of it going higher, where it's continuing to respect that resistance, the stronger the resistance is. And this also applies for support as well. Support is an area of price where whenever prices go into that area, it typically leads to increased demand, where prices move down and they get stopped, right? Prices are stopped from moving lower and they get bought. It leads to a reversal. And then they go back into that support area and the buyers step up to the plate and they bring prices higher, goes back into that support area. And this support stops prices from going lower and we bounce right back up. So resistance, you could think of it as a ceiling for price. Support, you can think of it as a floor for price. Now, one thing I really want to emphasize here is that I see a lot of traders, whenever they're drawing support and resistance on their charts, they draw it as a line. And that is a mistake. Whenever I am drawing support and resistance, I'm always using a rectangle, because support and resistance is not one price level. This is an area of price. This is really important. So whenever I'm drawing support and resistance, I always use a rectangle, where let's say this is kind of the top. I'll always go a little bit below the top and a little bit above the top. That general area is resistance. Very rarely are you going to see prices go to an exact price target and then reverse. It usually goes into an area of price that is resistance or support, and then it ends up reversing or respects it. So that's really important. Support and resistance is not one line. It's a price area. And there are so many different ways in which you can use support and resistance. I mean, right off the bat, what most people do, and this is really simple, but as soon as prices hit, right, an area of resistance, they'll just go short. They'll short that and they'll put their stop loss above the area of resistance. Or they do the opposite, where at support, right, you get one touch at support, you get two touches at support, right? That creates a legitimate support area. Maybe you get your third, and that makes it that much stronger. And then on the fourth touch, they'll look to go long, they'll trade this reversal, and they'll put their stop loss below the support. A lot of traders do that. And I'm not saying this cannot be profitable. It can, but this is a really simplistic way of looking at it. And what I like to do is combine support and resistance with the actual strategies that I trade, which I'm going to break down in just a second. I just want to go over some more basic information. There's also another way that you can use support and resistance, and I call this minor support or minor resistance. So let's say you have an established uptrend. You have an established uptrend. What you'll notice oftentimes is that a prior resistance area may become support. And I'm going to draw this a little bit better. I didn't really draw it too well there, but you'll notice that a prior resistance area right here can become support for the stock on the next pullback. And you'll notice this quite frequently, especially during established uptrends, where let's say you have a nice resistance area right here, it moved up, and we have a retracement here. You can almost draw a line, or we can make this kind of an area where this is where we want to see the next pullback kind of retrace to. Where if it retraces into that prior area of resistance, which now becomes support, this could be an area of interest where you could look for a potential entry, especially if you're combining it with other high quality criteria. And this is where you could look to go long as well. So that's called minor support, where this prior area of resistance now is becoming support for the stock. So this is something that I really look for, especially on retracement setups. And it works the same exact way if it's a downtrend, where you'll have a stock where this is an area of support, right? We break through that area on the next move to the downside, and this retracement, right, will oftentimes retrace right into this prior area of support, which is now becoming resistance for the stock. And this is one of the amplifiers for what I call a sell setup. This is a retracement setup where prices move down, they retrace, and it retraced right into the prior support, which is now resistance for the stock. And this is an area of interest where I could look to go short and take advantage of this downtrend. So we call this minor resistance if it's a downtrend. And the example I showed you before, when it was an uptrend, that is called minor support. So this is another way in which you can use support and resistance. And again, make sure you're not drawing lines. Make sure you're drawing rectangles, because support and resistance is an area of price. I'm going to go over a few more conceptual things before we get into some of the real life use cases and real world examples. This conceptual information is extremely vital. This is ultimately the foundation behind your trading. And by the way, if you do resonate with this video so far, I highly recommend taking advantage of my free 10+ hour trading course. It is genuinely better than most paid courses on the internet. It's going to teach you my strategies, my system, and it's going to build the foundation behind your trading success. I actually have a lot of support and resistance modules in my free 10+ hour course as well. So take advantage. You can get access to it directly below this video in the description. But I also want to show you another way that you could use support and resistance with your strategies. Let's say this stock is approaching that prior key resistance area right here. And instead of this stock sharply selling off, this stock begins to hold up. It begins to even consolidate and base at this prior area of resistance. This is actually a sign of strength, because at the other 4 touches of this resistance area, the stock sharply sold off. And now, the sellers are not really stepping up to the plate. The buyers are actually holding up the stock really well at this prior resistance area. And this can be an amplifier for your breakout setups. And for me personally, guys, I only really trade 2 different setups. I trade retracements, where stock will move up, it'll retrace, and I'll find a retracement idea, a buy the dip opportunity, and I'll look to go long, or I'll trade a consolidation within an uptrend and I'll trade this breakout. So I find stocks that have an established uptrend or have a clear bullish catalyst, and I will look for trend continuation patterns. And my two trend continuation patterns are retracements and consolidations and breakouts, essentially. So the base breakout. And this is one of the amplifiers that I use for my base breakouts, where if prices are consolidating at a prior strong area of resistance, that shows a lot of strength. That means the sellers are not bringing prices lower at a historical area where that happened multiple times. And what I'll do is I'll place my entry above the resistance, above this consolidation. I'll place my stop loss below, and I'll trade this breakout right here, where I'll get in right here, and I'll trade the continuation of this breakout opportunity. And the same thing applies if it's at support. Like if you have a stock that is consolidating at the lows near support, this shows a lot of weakness, because every other time we hit that support area, the stock bounced really hard. But now we're consolidating. We're holding up at that support area. The buyers are not really bringing prices back up. The sellers are clearly still in control. And this is where I'll look for an entry below the base, below the support, and I'll have my stop loss above the base. All right, and I'll look for a continuation to the downside. Okay, let's go over some of the primary use cases that I use support and resistance with. And the first use case is I use it for potential targets. So let's say I'm looking at a potential breakout opportunity right here. Prices moved up, they're consolidating, and my plan is to get an entry above the base, stop loss below the base. I have conviction this stock is going to move higher. Whenever I am looking for support or resistance areas, I'm always looking to the left, and I'm looking for a prior pivot. What is a pivot? This is a pivot. A pivot is when prices move up and down. And this right here is known as a pivot because prices moved up and they pivoted lower. You know, you could also see a consolidation up here too, and that could still act as a potential support and resistance area. For example, prices moved up, they consolidated for a while, and then they moved back down. This entire area will still be an area of resistance because in theory, it is a pivot, right? We moved up, we did just base for a while, and then we moved back down. So kind of similar to this. That's what I'm looking for. Looking for pivots or consolidations like this. And those are my areas of support and resistance. So I look to the left and I find the next pivot. I go up, I go up, I go up. Oh, here's the next pivot right here. And I could see this pivot aligned with all of these pivots. So this is clearly a pretty strong area of resistance. Okay. Now, if I'm looking at this, I'm going to say, okay, where's my next target? My next target is this resistance area, right? This is where I could expect, this setup to see some turbulence. I could expect that once we go here, we might see a little bit of resistance and we'll kind of either drop or we'll end up consolidating. But, this is clearly my target, right? This is where I can expect prices to go. I don't know if they're going to continue higher. I have no idea if it's going to break out through this resistance. So this is a realistic target. So from there, I'll look at my risk to reward and I'll ask myself, is this trade worth it, right? My entry's here, my stop loss is here, and my target is here. And I'll evaluate, is this trade worth it? Like if this trade hits my target, am I going to make at least 2-to-1 on my trade? And if I don't, then I'm not going to take this trade because the target is right there. We have resistance directly above. So resistance can stop me from taking a potential trade because maybe this setup is directly into a resistance area and we don't have really solid targets. Of course, the same thing applies in reverse. If you're looking for a short, you look for the next support area and you evaluate if you have enough risk to reward to actually take that trade because that first support area is going to be target one. Another way that you could use support and resistance is with breakout and breakdown failures. So let me give you an example. Let's say you take this trade right here. You get in and it's starting to approach that key area of resistance. And let's say you have conviction, it's going to break through that resistance. And let's say the stock is holding up, it's moving higher, maybe it retraces a little bit, sets up as a retracement, and then it actually breaks through that resistance. But let's say as soon as it breaks through that resistance, it fails. And boom, on huge volume, you see a ton of selling pressure and this stock just, tumbles. It just sharply goes down, where this is a clear breakout failure, where the stock moved up to the resistance, looks like it's going to break out. It does break out, and then it gets rejected by the sellers. That's your sign to exit. Look to trail the position, because I am interpreting that as a breakout failure. It attempted to break above that strong area of resistance and it failed. And from there, you could expect a pretty sharp decline. So what I would do in these instances is I would trail your position quickly, where if this is your original stop loss, I would raise the stop loss to right here. Or what you could even do, let's say it doesn't even give you this retracement. Let's say the stock just, goes right through that resistance, right? It goes right through it. And you're thinking, oh my God, we're in the clear. This thing is, going to go bananas because we broke above this key resistance area. But let's say all of a sudden on high volume, right? On high volume, this stock starts to decline. You could look to raise your stop loss, under the lows of this prior area of resistance, where you could say, hey, this is where the resistance is approximately. I don't want to get stuck in a breakout failure. I'm just going to aggressively raise my stop loss to where that resistance is. And you would get out when it stops out, right? So you're protecting yourself in this case from a breakout failure. Prices break out above the resistance, but there's no continuation. It gets rejected on large volume by the sellers. It starts to drop, boom, you're looking to trail your position, get out, and walk away with at least some profit. You don't want to be in a position where there's a sharp decline, and you end up holding the trade all the way back to your original stop loss, where that was obvious. That was clearly a breakout failure. And of course, these illustrations are simple. In the real world with real life trading, it's not always going to play out this way. But I want you to understand this conceptually. We are not trying to predict this breakout failure. What I want you to do is be in a position to react quickly, where prices move up, they break above that resistance area, but they quickly fail. You want to look to raise your stop loss. You want to look to trail your position tight and either minimize your loss or at least walk away with some profit. Okay, so now we're going to go over some real life use cases of how I personally use support and resistance every single day. And we're going to be looking at some real world examples. And I want to highlight a trade that I took on May 14th, 2026. And this was on the DXF. And I made a little bit over $2,600 on this setup where I was heavily using support and resistance. And by the way, this is my Charles Schwab brokerage account. I use Thinkorswim platform every single day, but let me go ahead and break down this trade. So this was my perspective on the stock Thursday morning in the pre-market, because that's when I was creating my plan for trading the DXF. So I saw that the DXF was opening at around 128 on Thursday morning. So Thursday in the pre-market, I was looking at the stock as early as 8 a.m. and I saw that we were opening at around 127 to 126. And this was a overnight gap up, an overnight change in price, where this stock the previous day on Wednesday closed at 75 cents. And then Thursday morning, I saw that it was gapping 67% to the upside to around 127. I really like to trade gap ups and gap downs. And that's one of my primary trading strategies. So I saw this stock was gapping up to 127. From there, I wanted to map out the next support or resistance area. So what did I do? I looked to the left. And I looked to the left and I found a solid resistance area right here. So I went ahead and I drew it right from the top of those wicks, and I kind of drew this resistance area. And I could see that prices, are kind of at the higher end of that resistance. So I was really curious to see what would happen when the market opened. Was this stock just going to tank because it's into an area of resistance? Or is this stock going to hold up and potentially break through that resistance, where this resistance would become support for the stock? So let's go ahead and see what happened. And obviously, the stock went up, it broke out, but I want to show you what it did during the intraday timeframes and exactly how I took this setup. And my idea was that, this area of resistance is going to become support for the stock that we're going to hold, and I might be able to look for a breakout. And that's exactly what I did. On the 5-minute time frame, the stock kind of came in a little bit. It came into that lower end of the resistance, which is now clearly starting to become support, right? It held 115 like 4 times, or this like 115 to 117 area right here. We hit it once, we hit it again, we hit it again, and I got in at 120. I got in at 120 and I put my stop loss at 116. And I wasn't risking a whole lot of money because in my mind, I was like, hey, I'm going to buy this, at this support. And if it breaks below it, I'm out. I'll take a paper cut loss, but I'm going to buy it at that support. And then when it breaks out, I can look to add to it. And notice how it consolidated right into the 9 EMA on the 5-minute time frame. And I don't use, really any complicated indicators. I use the 20 SMA, the 20 period simple moving average, and I use the 9 EMA, the 9 period exponential moving average. I also use the 200 simple moving average as well, which is actually a really good support and resistance moving average. But anyway, it consolidated right at that prior resistance, which is now becoming support for the stock. And it consolidated right into that 9 EMA, and boom, we got the breakout. And from there, look what it did. It retraced where? It retraced back to the prior day's high, right? Where this resistance right here now became support for the stock on the next pullback. And that was also aligned with the 9 EMA on the 5, which is impressive, right? So this is an example where it broke out of resistance and it retraced back into this resistance right here, which is becoming support. And if you guys remember, this is called minor support. This is a minor support area. This resistance became support. And it happened again on the 15-minute time frame later in the day. Look what it did here, where it ended up popping all the way to 198, and then it retraced where? Into that 140 area, right? So let's go back to the 5-minute time frame, okay? This 140 area, right? It retraced perfectly here as well. So we traced once, moved up, and then we retraced all the way back to it on this pullback as well. So this resistance became a really strong area of minor support on this pullback and on this pullback. And that's why these areas of support and resistance, they're so powerful. You could have found a re-entry right here. Not only that, that area of minor support on the 15 is also aligned with the 20 MA, right? This blue line is the 20 SMA, the 20 period simple moving average, where it retraced back to this 20 SMA and to that minor support. And those two, amplifiers, they came together, and that really increases the probability of the setup. So I also like to use moving averages as potential support and resistance areas as well. Okay, now let's go over another trade that I took on May 15th, 2026. This was on the MRNO, and this made me a little bit more than $2,300. So let's go ahead and break down how I used support and resistance for this setup. This was another overnight gap up. So Friday morning in the pre-market, I saw this stock was going to open at around 50 cents. So on Thursday, when the market closed, it closed at around 29 cents, and then it gapped up overnight into Friday morning. This was a 72% gap up. It was an overnight change in price. And I saw in the pre-market, we were going to open at near 50 cents. And I found this gap interesting because it was ending this prior downtrend on the daily, and a lot of these penny stocks that I've been gapping up have been putting in really big moves. So from here, I mapped out my support and resistance areas in the pre-market. And how do we do that? Well, we look to the immediate left. And that's exactly what I did. I looked to the left and I saw a tail right here. I saw a pivot right here. I saw this consolidation. And this area of resistance, this consolidation really lined up, well with this prior area of support where we have a low and then we have another low, right? So I drew that area of resistance basically just like this. And I found this area of resistance concerning because the stock is gapping up to 50 cents and it, doesn't really have that much room to move higher until it encounters this strong area of resistance. So I wanted to see this stock really prove itself, or maybe, I wanted to see the stock kind of retrace first and maybe get a setup off a retracement pattern. And then, 57 to 60 cents could be kind of my first target. That was my plan going into the market open. So let's go ahead and see how it played out. Obviously, the stock went all the way to 81 cents. It was a massive mover, and I caught this trade. So let me go ahead and show you what it looked like on the 15-minute time frame. And that was kind of my primary time frame for this setup. So it actually retraced and consolidated, at the 9 EMA on the 15-minute time frame. It based right into it, which I really liked, but I actually got an entry into this a lot earlier. I got it right here. I got it before this 9 EMA even caught up to price. I got it at like 42 cents, stop loss at 40. And my reasoning was it was such a tight stop loss. It was like a 2 to 3 cent stop that I might as well get a little bit of size and see if, prices can really respect this 9 EMA on the 15. And, it actually got a pop. I remember I also timed my entry off of the 20 EMA on the 5. I got in, I think, right here, where prices based right into the 20 EMA on the 5. I got in at around 42.50, and then it broke out. We retraced, and it never hit my stop. My stop was at 40 cents, never hit my stop, and then it went absolutely insane. But look what it did here. On this first rally, it rallied right into target, right into this prior resistance, and what did it do? It pulled back, right? So that was target 1. You could have actually taken some profit here at target 1. I held, but this prior resistance on the daily, remember that rectangle we drew? That was target 1. It hit it, and then it retraced. But where did it retrace to? It retraced perfectly to this prior high. So this prior resistance now became minor support for the stock. And I didn't add here, but you could have added here. You could have even gotten in for the first time as well. And it also retraced right into the 9 EMA on the 5. We could look at it on the 2 as well, just to look at multiple time frame alignment. And that was also the 20 EMA on the 2. So on this pullback, it was into the 9 EMA on the 5. It was into the 20 EMA on the 2. And it was into this prior resistance that's now becoming minor support. And those are 3 different supports, right? 2 moving averages and 1 resistance that became minor support. They're aligned. And that alignment essentially gave me conviction this trade was going to continue higher. And what I did is I actually put my stop loss, I raised my stop loss to under this retracement once we started moving up again. But this was a beautiful trade, honestly, where I was using support and resistance on the daily. I was using moving averages as well on my entry. And when it did pull back, it pulled back right into that prior resistance, which became minor support. And on top of that, we had a bunch of moving average alignment. Let's take a look at another example where I actually passed on a trade because of a resistance area. And this was on the HLIT, the HLIT this past Friday. And this HLIT had an overnight gap up. It was showing a lot of strength during market hours. Right here, it retraced the 9 EMA, bounced really nicely, and then consolidated at the highs on the 5-minute time frame. Entry above the base, stop loss below the base. And I thought this was a really nice looking setup. However, I passed on this setup because of what I saw on the daily time frame. And you guys can probably see the same exact thing. There was a massive tail right here. This pivot is going to act as a potential resistance area. So, I mapped that out during the day, and I went back to my 5-minute time frame, and I'm looking at the setup, and I'm thinking to myself, I don't really have the reward to risk on this setup to make it worth it, right? Because if my entry is at, let's say, 14.90, stop loss, let's say, is 14.65. So that's a 25-cent stop loss. First target is at 15.10, right? That's where that resistance really begins. Call it 15.20 or 15.30, whatever. So I'm basically risking 25 cents to maybe make 30 to 40 cents. And from there, I just didn't think that was worth it, right? Because there was resistance directly above on the daily time frame. So if you're looking at the daily or the weekly and you're seeing a strong resistance area directly above where your entry would be for a potential trade, that's a red flag because you're buying into a strong resistance area. The targets aren't big enough on this setup to make it worth it. And it actually ended up moving higher. But then it got stuck, at that resistance level. So it would have made money. However, it wouldn't have really been worth it from a risk to reward standpoint because, again, of that strong resistance on the daily. Let's take a look at another example where I actually went long on a stock that was moving into a strong area of support. This was a trade that I took on May 8th. This was a Friday. This was on the KDK, the Kodak, and this made me a little bit over $2,900. So let's go ahead and break it down. So Friday morning, I saw this stock was gapping from 909 all the way to 590 or so. So I saw this in the pre-market on Friday morning. I saw this was a 35% gap down. And generally speaking, around 85 to 95% of the time, I am typically trading in the direction of the gap. So if it's a gap up, an overnight change in price to the upside, we already looked at a few examples of those, I'm typically looking to go long. I trade with the bias of the gap. And if it's a gap down, typically I'm looking to go short. However, there are a couple of exceptions to that rule. And one of my exceptions is if we have a gap into a strong area of support or a strong area of resistance. And in this case, this stock gapped from 910 to 590, which was right into macro support on the Kodak. Why do I call this macro support? Because this is the weekly time frame. And macro support is a strong area of support on the higher time frames. We were gapping right here into that support area. Now, obviously, there's a possibility this stock might break through the support and continue lower. That was certainly a possibility. However, my bias, Friday morning was to potentially look for a long because it was a big gap up into macro support and maybe we bounce really hard off of macro support. And it was the 35% gap down, which is a pretty sizable gap down on a stock like this. So I was looking for a potential long. And this stock went crazy. This stock went from 595 and it ended up closing at around 725 that same day. Now, my first potential target for this trade, if I did get in long, was basically this prior area of support, which now may become an area of resistance. This was essentially my first target if I did look to play it long. And this had a beautiful setup off the 2-minute time frame. This stock opened and just consolidated. And I went long above $6. Stop loss, I believe it was around 588, below the low, like 587, right? And so I went long and the stock moved up, consolidated, and it moved up right into that first target, and then it pulled back hard right into the 20 MA and the 2, and also right into this prior high. So this prior high then became minor support on this pullback. And of course, the rest is history. It ended up moving up all the way to 730. I actually didn't catch the second half of this play. I took profit at around 645, 650 as soon as it hit target 1, and then I stopped paying attention to it, and then I saw it go absolutely insane the rest of the day where it just, continued this established uptrend. But the point here is that first support that is now going to become resistance on the daily time frame. I'll show you guys one more time. This resistance right here, or this prior support, now became resistance. That was my first target. And on this pullback, we pulled back directly into the prior high, where this prior resistance, on this breakout, now became support for the stock. And I see this all the time. These stocks do a really good job of respecting support and resistance areas. And that's exactly why I use support and resistance in my trading every day. I hope you found tremendous value in this video, and hopefully you'll be able to use all of this information in your own trading. If you did enjoy the video, make sure you leave a like, make sure you subscribe to the channel, and leave a comment with feedback. And like I said before, take advantage of my free 10+ hour course. Thank you guys so much for watching. I hope you found a lot of value, and I will see you on the next video.
What's going on, guys? Hope you're having a terrific day. Today, I want to talk about market relative strength. And this applies for stocks, crypto, and Forex as well, but mainly for stocks and crypto. So if you're trading stocks, you should always keep an eye on the market. And what is the market? Well, you can look at two main ETFs. Okay, so I'm going to turn off my camera and we can look at it. So for stocks, right, if you're a stock trader, I would always keep an eye on the QQQ, or keep an eye on the keep an eye on the SPY. And most of the stocks that you're probably trading is either in the QQQ or in the SPY ETF. And maybe if you're trading really low price stocks, you should also keep an eye on the IWM. And IWM has a lot more lower priced securities. So let's kind of write that down here. For stocks, and maybe put this down in your notes here. For stocks, you should be looking at the Qs or the SPY or 3 IWM, maybe. I mean, IWM, honestly, I trade a lot of lower price stocks, and I personally just look at the Qs. Okay, so I just look at the Qs personally. That's what I do. I trade stocks. So that's for stocks. For crypto, right? If you're someone who trades crypto, I would be constantly looking at Bitcoin, right? So if you're trading crypto, you really always want to keep an eye on Bitcoin. So let's go into why are we looking at, Bitcoin or the Qs or the SPY, right? They're going to act as overall markets, right? If we're trading stocks or crypto. Okay, and we should always keep an eye on what the overall market is doing, because that could have there's a lot of implications on that could affect our trading. Let me give you an example. I know a lot of you guys that are in the server, in our community, trade crypto. Let me just give you a quick little example. Let's say you're trading, let's say Gala, right? Just as an example. And you're trading Gala and you find a buy setup, right? We have a rising 20-day moving average. We have a rally. We pulled back to the rising 20-day moving average. We have a pullback setup, right? And we have a rally. Or you're going for a rally, right? You're going for the buy setup, right? Hopefully to capture this move higher. Okay, but let's say before this move even happens, as this buy setup is setting up at this point, you're looking at Bitcoin, and Bitcoin started just randomly tanking, and a huge drop on Bitcoin. Bitcoin is tanking. You could see that there's a lot of selling pressure on Bitcoin. You may want to reconsider this buy setup, because with Bitcoin dropping, this buy setup now might fail, and it might not even work out, just because the overall market, and for crypto, that's Bitcoin, is tanking. Okay, so you could have found an excellent, perfect buy setup on Gala, but because the market and Bitcoin is tanking, that buy setup may not work. And without keeping an eye on Bitcoin and seeing that it's tanking, you might end up playing this long and then losing money. And you're going to be like, oh, wait, hold up, though. Like, why did I lose money? It was a perfect setup. And then you look afterwards and you're like, oh, it's because the entire market tanked. Bitcoin and Ethereum both tanked, right? So you could you could also look at Ethereum as well with Bitcoin. But Bitcoin, I should say Ethereum usually just follows Bitcoin anyway. Bitcoin is the most widely traded crypto, so that's why it serves as the market. So there's really, you should just always keep an eye on how Bitcoin and how, or the Qs if you're trading stocks, how it's trading, what's going on with it, right? And let me give you another example of how to use market relative strength to your advantage. Let's say the market, whether it's Bitcoin or for crypto or the Qs or SPY for stocks, let's say it's tanking, right? The entire day it's moving lower, lower, and lower. But you find a coin or a stock that's actually basing at the highs, right? Where you're seeing that the entire market is dropping, right? Bitcoin's dropping hard, or the Qs or SPY are dropping really hard. Yet this stock or this crypto is basing very bullishly at the highs, and it's not being affected by the market, right? With the market tanking, this is not breaking down. This is actually just continuing to base. You could actually use that to your advantage and say, okay, the market's dropping. Whenever I see the market starting to have a reversal, hold on. Whenever you see that the market is starting to have a reversal, you can keep an eye on this coin or stock and be like, okay, whenever the market has a reversal, there's a solid chance that this is probably going to break out as well, because it was holding so bullishly during the massive drop of the market or the Bitcoin. Okay, does that make sense? So if you're in a situation where you're seeing a stock that's, it's not following the market, where it's actually just acting really bullish as the market is, trending lower, that whenever you see that market reverse, you could see that breakout as well. So same thing, if you have a huge market pop, but there is a coin or a stock that's basing bearishly, where it's basing at the lows, whenever the market starts to drop, you could see this also start to break down, right? So if you're playing short, you want to see a low of the day base while the market is rallying really, really hard, right? Because if this was, think about it, the bearishness is so prevalent that it's not reacting to the market. It's saying, oh, the market, you might be continuing higher, you might be, pumping, but there's so much selling pressure here that the market's not even going to move me. And whenever the market starts to drop, it gives it that extra boost, and some probably cause it to start to break down. Okay, so in general, guys, always keep an eye on the market. If you're trading crypto stocks, always have a separate chart where you could refer to the overall market. Look at Bitcoin or the Qs and see what's going on. How is it trading, right? And usually, I'll give you another example. If the market, let's say, is basing bullishly, right, like this, this is what the market is doing, and you find other stocks that are also basing bullishly, you might notice that as soon as the market begins to break out, those other stocks or those other crypto will also begin to break out. Okay, hopefully that makes sense. So always keep an eye on the market. There's really no strategies you could create from just relative strength to the market, but you could use relative strength to your advantage when you're considering some of the strategies we already talked about, such as the buy setup, sell setup, breakdown, 1, 2, 3, exhaustion or climactic pattern. You could use that, really to your advantage and kind of combine it. Where if the market is rallying hard and it's super bullish, right? If the market is really bullish, you want to buy, you want to look for bullish setups in other stocks or other cryptos. If Bitcoin is tanking, right, and it looks like it's going to continue lower, you want to find shorts, right? Because you're playing with the overall trend of the market, right? Hopefully that makes sense. So always just keep an eye on what Bitcoin is doing if you're a crypto trader, and what the SPY or the Qs are doing if you are a stock trader. Always just keep an eye, and just you'll start to notice different patterns of how different stocks and different coins react to the market or to Bitcoin. So just keep that in mind. Always keep a chart of the market on your trading setup. Okay? And yeah, you'll start to notice patterns. So I just wanted to point this out so you guys could consider that as well. And I'm trying to think if there's any other points I want to make about this. That's really basically it. I don't want to say this is a make it or break it indicator, relative strength. Also, I don't use RSI, by the way. A lot of people are going to ask me, hey, do you use RSI for relative strength? I don't. I just look at whatever I'm trading, right? And then I look at the market, right? And make sure you're like, if you're trading off the 5-minute charts, 15-minute charts, or hourly charts, make sure you have, those time frames for the market as well, right? If you're trading off the hourly chart, make sure you're looking at the hourly chart of the market, right? You don't want to be looking at the weekly chart of the market while you're trading the hourly chart of whatever crypto or stock you're trading. You want to keep the time frames more or less similar. Okay. But yeah, that's really it, guys. I don't use RSI. I just look at the market as I'm trading. I try to notice if anything's going on, and I try to use it to my advantage. And that's really it, guys. So hopefully that's beneficial. There's not too much to take from this. Just keep an eye on the market. Okay. And that's basically it, guys. See you in the next class. Thanks. What's going on, guys? Hope you're having a great day. And today we're going to be talking about another tool that I use on my charts. Okay. We already talked about the 20-day moving average. We talked about the 200-day moving average, and we talked about how to read candlesticks. But I also use another very important tool, and that's called volume, okay? And a lot of people kind of overhype the utility of volume. They say that, they kind of come to these random conclusions about what's going on with the stock or crypto based on volume. They'll say, because we see a volume spike, this, and this is going to happen. And most of what you're going to hear about volume out there is complete nonsense, okay? But I'm going to give you guys the actual way you could use volume to your advantage and the situations where volume is actually pretty useful, okay? And by the way, guys, before I start the class, I just want to tell you a lot of what I'm teaching doesn't only apply to volume. This is stuff I've learned through experience, okay? So you might catch me throughout this class kind of citing specific instances of different things that have happened to me with volume. And it's very experience-based, okay? This isn't stuff that I'm just finding on Google, okay? This is stuff that I've actually gone through taking on thousands of trades and through my years of experience. So how can volume be a powerful tool? And there's really only a couple ways you could use volume. And what is volume in the first place? It shows you how much a stock or a crypto is being bought or sold. It's showing you how many shares are being bought or sold. Okay. And volume is one of the primary ways of predicting price reversals. Okay. And using volume will greatly increase the accuracy of picking tops and bottoms with precision. Okay. There's this really interesting idea of finding tops and finding bottoms, right? Where you're buying at the absolute lows or you're shorting at the absolute highs. A lot of people want to do that. And if you're one of those traders where you just have, affinity towards finding those type of reversal plays, you're going to be using volume and looking at volume a lot. All right. And another thing that, way you could use volume is that it can indicate when a move, usually it's a rally or a drop in price, when it's beginning, ending, or continuing. Okay. And we're going to get into that. So first, I want to kind of classify different, I guess you could say different versions of volume. I guess that's the best way to put it. So the first classification is amateur buy volume, okay? Where let's say we have a multi-move or a multi-bar move towards the upside where we have 1, 2, 3, 4, 5. We have 5 green bars in a row, and we start to get a spike in volume towards the end of the move, right? Towards after you see the 5 green bars in a row and you get a huge spike in volume. That suggests that is the end of that move and a reversal might take place, okay? And you can think of this increase and this spike in volume, and you could think of it as the last group of buyers who have finally bought the stock or crypto, and that stock or crypto is running out of demand, right? You could see that the green candlesticks. And the reason we call it amateur volume, and specifically amateur buy volume, is because what do the amateurs want to do? What do the novice traders want to do, right? They hate missing out on moves. When they see a stock or a crypto go up 1, 2, 3, 4 green bars in a row, right? What do? They're like, oh my God, I don't want to miss out on this rally. This stock or crypto is going to continue higher. I don't want to miss out. And what do? They start buying at the highs, right? That's what amateurs and people who really don't do this professionally, that's what they do. They buy at the highs and they sell at the lows, losing money. So you could think of it, these candlesticks, this is amateur volume. These are the amateur traders who are buying it at the highs with the fear that they're going to miss out on this move. But they already missed out on the move, right? The professionals are buying it down here before the move, right? The amateurs are the ones that are buying it at the highs, right? So you could think of this as the last group of buyers. They're finally getting into the stock. And this is really also effective when this rally is right into resistance. If this rally is directly into a resistance level, it's much more potent, right? If you see this amateur buy volume, it suggests that we're probably, going to see a reversal here. And like I said, think of it as novice or beginner traders finally buying their position. They saw the move already go up without them. They're finally buying the position up here when when the professionals are actually selling it up here, right? Someone is selling their shares or their coins, right, their crypto coins to these amateurs, and those are the professionals. The professionals are buying it down here, and they're selling their shares or their coins to the amateurs up here. And you could see that that's when we get the sharp reversal lower, right? So let's continue. We also have amateur sell volume, where let's say we have a multi-red bar move lower, and we start to get that amateur volume. You could, this spike in volume at the end of the move suggests that a reversal might take place. And you could think of this as the last group of sellers who have finally sold their stock or their crypto, and the stock is running out of supply, or the crypto is running out of supply. Okay, and it's very effective if this is actually kind of dropping into support, and we also get that amateur buy volume with multi red bars lower. Okay, and think of it as novice or beginner traders. They're finally selling it, right? These beginner traders, these amateurs, they were down on their positions here, right? They were losing money here. But then they see the stock or the crypto continue going lower, and their losses are increasing. They're increasing until eventually they can't stomach, right, that huge loss, and they're like, you know what, I'm going to exit the position. And as soon as they're exiting the position, right, they're selling their shares to the professionals who are buying it down here. Okay, hopefully that makes sense, and that's why we get that sharp reversal higher. Okay, so quick summary, guys. If you have several green bars in a row or several red bars in a row, and you get a huge volume spike towards the end of that huge move higher, probably means that you're going to get a reversal, right? And these are the amateurs who are buying it at the top, right? Because they have the fear of missing out on the move. But remember, we're trying to be professional traders. We're the ones who are either shorting it up here or selling our positions that we bought down here. Okay, same thing with amateur sell volume. Maybe the people who, right, they're taking big losses on their position. It's dropping. They can't stomach their losses. They end up selling it down here, and those are the last, group of sellers, and then we get a pop higher. Okay. So another version of volume, it's called igniting, or classification of volume, it's called igniting volume, right? And we talked about an igniting wide range bar, an igniting wide range candlestick. We already talked about that. Okay. So what you guys want to do is couple the wide range igniting candlestick with igniting volume. Okay. So this volume is igniting a brand new move or direction. The professionals, they don't enter a stock at the end of the move. They enter at the beginning. We talked about this. The professionals, they're not buying it up here. They're exiting here. And if anything, they're shorting it up here. They're not selling it down here, right? If anything, they're buying it down here, okay? And so it makes sense, right? The professionals, they're entering at the beginning. And this is also a very potent reversal signal where you're often going to see amateur volume, right, followed by igniting volume, right? So this is amateur volume right here, where the sellers are trying to get out of their position, and the professionals start buying it here, and this ignites the move higher, the reversal higher. There's also something called continuation volume, and this really only applies to a base, right? So we already learned about the base breakout or the base breakdown, okay? So this is something that you want to combine with the base breakout, where let's say you have a rally higher, right? You have pretty high volume during the rally, and then you start to get a base, right? You start to get a base. What you want to see during that base is very low volume. It indicates that there's not that much selling pressure. So when the stock does have a breakout and that igniting volume, it's more likely to succeed, right? So you don't want to see high volume during a base. You want to see very low volume during a base because that is continuation volume. And then when the stock breaks out over the highs of the base, that's when you want to see igniting volume. And this igniting volume, it sparks a new move higher after you haven't really had any volume or any buying and selling at all during the base. Okay, hopefully that makes sense. So if you have a base, you want to have low volume. When you have that breakout, you want it to have igniting volume. Okay. We already talked about the shakeout bar, but let's kind of talk about it again. Why not? So it happens when a stock attempts to break down from a bullish base on large volume and fails to break down, right? So you can combine volume with the shakeout, where you have a base with low volume. All of a sudden, you get that shakeout bar, right? This bottoming tail. It triggers everyone's stop losses. We get that drop, right? We have large volume during the shakeout, and then it comes right back to the highs to finish here. And then we continue basing, and then we have the real breakout where we have huge igniting volume, okay? Why is it called a shakeout? Most people who are in their long positions, who are expecting the rally to continue higher, they're placing their stop losses under the base, right? When the stock attempts to break down, the stop losses are hit, propelling the stock lower, right? All those sell orders, those stop losses that are hit, it causes an influx of selling. The stock or crypto drops. And if the stock is still able to get bought in return all the way back up to the highs, then there's clear confirmation that we're going to continue higher. We already talked about this, guys, but this is kind of a reminder. So it's okay to see large volume during a shakeout before we have the igniting volume during the actual breakout. Let's also talk about potential reversals when we're looking at a base. So this is something I can guarantee you're not going to learn anywhere else. I would highly doubt there's any other course in existence that teaches this very topic, because this is something I personally learned. This is something that over the years, I saw this so often that it's almost become just like its own trading strategy almost, right? So if you have a base, right, we have a rally, we have a base, we're setting up for a base breakout, right? You're looking at it, you want to play it as a breakout. And you have a sudden volume spike that does not lead to a breakout. This can be indicative that a stock or the crypto will reverse in price. And this usually applies more to intraday trading, meaning the smaller time frames, right? So we want to see igniting volume during the breakout, right? When we actually make the move higher, we want igniting volume. But let's say we all of a sudden get igniting volume, we get that volume, huge volume spike, and you're seeing, hey, this stock or this crypto, it's not breaking out. What's going on here? When you see something like that, you should be very cautious, because it usually means that we're going to actually end up getting a reversal. Because, right, if this is a volume spike, if this is igniting volume, these are people, buyers, that are trying to get in and buy the stock or crypto and propel it higher, right? And if this is buying pressure, it's a green volume spike, and it doesn't go higher, well, why, right? Like, there has to be something going on. And just be cautious. It usually ends up leading to a reversal. So if you're in a position, right, and all of a sudden you see a huge volume spike and the stock isn't going in your favor, it probably means it's about to go against you. Okay, so keep that in mind. So let's now talk about breakout and breakdown failures. If you have, let's say, a base breakout, right? You have a rally and you're trying to go for the breakout. Let's say you get the breakout, right? It hits your entry, you're in the position, it breaks out, okay? And you get that igniting volume. But let's say this igniting volume doesn't lead to a continuation move higher, and in fact, you end up failing and you end up getting a red bar that's going lower, right? With a huge volume spike. It basically confirms that this is a failed breakout. If you get a rally and then a sudden drop, right? Like, let's say you're in it, it goes up and then it drops against you on huge volume, then you should maybe immediately exit that position and maybe even play it short, okay? It's considered a failed breakout, and it suggests that the prices are going to actually continue lower. So just understand that if you're in a position and it breaks out on igniting volume, but then immediately starts to drop and come back in, also on huge volume, it suggests that that's a breakout failure and get out of the position, okay? So a lot of the times you can pinpoint failures by just looking at volume. And let's say all of a sudden, we have a huge volume spike, and then it starts going against you on huge volume. You can maybe exit before it hits your stop loss, right? Because then you're like, oh, this is a breakout failure, let me get out, okay? So let's look at some examples here on how we could use volume, right? You could see that we dropped right into the 200-day moving average. We know that acts as a floor, acts as support for our stock or crypto. We drop. Oh, boom, we got a volume spike right here. This led to a reversal, right? All of a sudden here, check this out. This volume spike correlated with this reversal. We drop, right? We don't really have any volume reversal here, okay? It's not going to happen every time. Then we drop, we rally again on large volume. We start to get a big volume spike, right? We drop. It's not too prevalent here. I think this is the best example because we actually have a multi-bar move lower. Like here, it's green bar, red bar. We have a bunch of doji candles. There's not that much momentum here. But here, we're getting, huge red bars in a row. And you could see that. You could see the clear amateur volume and the clear igniting or professional volume, right? We drop, right? We're getting that big amateur volume. All of the people, they're finally selling their position after they took a huge loss. And then boom, we have an igniting move higher. We have ignite on green volume, and boom, we continue higher. So you can see how this is really, it comes in handy when you're picking reversals. Let's look at another example. We have a large move lower, right? Aside from this green bar, this is all straight red bars in a row. We drop hard, huge volume spike, we reverse, right? Right here, huge volume spike, we end up dropping. And I think it's really prevalent here, right? We have a huge 1, 2, 3, 4, 5 red bars in a row. We also have a bottoming tail here, which suggests that this was selling off. At some point, we were selling off to down here before the buyers started coming in, right? So we made a huge drop on huge volume, right? So notice that whenever you're seeing huge volume, right? You could see this is much greater than any other volume that we've had here. Drops, huge volume, that's when we get the reversal, right? And you could see this red volume, that's amateur volume, and then you could see the green volume, that's sparking the new move higher. Those are the professionals buying down here. Let's look at another example. I mean, this is perfect. We have a huge move lower, we have a double bottom, we have a bottoming tail. On huge volume, we get the reversal. So we didn't really get amateur buy volume here, or amateur volume. We kind of did maybe with this candle, but we get a lot of igniting volume that ignites the new move higher. Same thing here. We drop, huge spike in volume, and ignites this move higher. Okay. So let's go over the example where we talked about continuation volume and igniting volume. Notice we have a rising 20-day moving average. We have a really tight base, beautiful base that's based right into the 20-day moving average as it's rising. We get that breakout. Notice how during this base, look how low the volume is. It's beautiful. And then boom, we break out on huge volume and we continue higher, sparks this new move higher. Beautiful. Let's look at another example. Let's not only talk about volume. There's a bunch of stuff to talk about here. Rising 20-day moving average, that's underpriced. Check mark. Right here, we have huge volume igniting this move, right? We end up getting a pullback and we get a buy setup, right? We get a buy setup right here. It's right at the 20-day moving average. Really nice buy setup, right? We have 1, 2, 3 red bars in a row. Kind of a deep retracement, but it's right to the 20-day moving average. Really nice entry bar. We rally to resistance, right? Because the previous highs is resistance. We start to base at resistance. And where do we base into? We base right into the 20-day moving average, the rising 20-day moving average. Beautiful. With continuation volume, really, really low volume. And then we get that huge spike in volume during the breakout. Right, we continue higher, and then we get a buy setup right here, right? Pullback pattern, beautiful, right to the 20-day moving average, doji candle, really small entry bar, really nice risk, reward to risk, rally. Everything is beautiful about this chart. Let's look at another example here. This is actually a gap up, so this happens with stocks. We'll talk about that later, but you could see, right? We're kind of down here. We're kind of just sideways down here. We get a gap up. And on huge volume, and this is professional volume, right? These are the professionals starting the new move higher. It gaps right to the 200-day moving average and ignited a new move higher. Another example, we get a drop, it ignites a new move lower. You could see huge volume spike. Okay, so something that I really want to emphasize here, guys, is, like I said, volume is really useful for reversals, especially when it's when you get a huge move. Like for example, you get a huge drop, then a big volume spike usually means we're going up, right? Huge drop, volume spike usually means we're going up. Same thing right here. I mean, this is a perfect example. Huge drop, 1, 2, 3, 4, 5 red bars in a row. Nice amateur volume, and then boom, we get a igniting volume. So notice how sharp increases in volume during major sell-offs or rallies lead to sharp reversals as well. Okay, and if you guys have noticed, especially looking at this chart, right, you're starting to notice how we're putting everything together in this course. We're putting the 20-day moving average, right? We're combining it with the strategies we've learned. We're combining it with volume. We're combining it with the 200-day moving average. We're combining it with reward to risk, okay? So towards the end of the course, I'm going to try to give you guys more practical kind of tests or practical quizzes on this stuff. But yeah, volume, very, very useful, guys. Hope you guys kind of understand the theory behind amateur volume and igniting volume. This is important stuff here, but just understand that it's mostly used for reversals. And if you have a base, you want to see a base on very low volume. Okay, guys? Hopefully that makes sense. Have a good day, guys. This was a great class. See ya.
So before I explain how to trade this setup and how to execute on it, I want to talk about why we're trading this strategy in the first place. And you're never going to make money off any trading strategy unless you understand the why. Why is this effective? Why is it supposed to make us money? And you need to understand the logic and the reasoning behind the setup in the first place in order to effectively make money from it. So that's the first thing that we're going to talk about. We're going to talk about the fundamentals and the why of the tight base breakout strategy. And the first thing that I look for in any trade that I take is the direction. I want to see an established uptrend or an established downtrend. In other words, I want to see if the stock that I'm trading has clear bullish momentum or clear bearish momentum. And for me as a trader, I trade in the direction of the trend 90% of the time. I am not really a huge reversal trader because why would I be? I like to trade in the direction of where prices are already going, right? That makes my life way easier. If I can identify that prices are in an uptrend, the highest probability is that prices are going to continue higher, then that means I want to look for a long. I don't want to look for a short, right? And the easiest way to do that is to see, is there an established uptrend or downtrend? Uptrend is very simple, consecutive higher highs, consecutive higher lows. If it's a downtrend, it is the opposite. You have consecutive lower highs and consecutive lower lows. And once I understand the direction, that's when I can look for an entry. So I like to find entries within established trends to ride the direction in which prices are already going. And this is where you're going to be finding the tight base breakout. You're going to be finding it within established trends. And within established trends, well, you're going to have this idea called price correction. And the best way that I could frame it is, let's say you just ran a marathon. You just ran 26 miles in the New York Marathon and you're feeling tired and then the marathon ends. Are you going to be able to immediately run another marathon? Like imagine you just ran 26 miles and then you're like, you know what? I'm going to go to Starbucks, get a quick espresso, and I'm going to run another marathon, right? I mean, unless you're David Goggins, unless you're like a superhuman athlete, you're probably not going to be able to do that, right? If you run a marathon, afterwards, logically, you're going to need to sleep. You're going to need to hydrate yourself. You're going to need to eat, relax, get electrolytes. You're going to need to just chill for a while before you can run another marathon. It's logical. And the markets work in a very similar way. After the market or a stock or whatever you're looking at, after prices have ran a marathon where there's a huge rally to the upside, right? They can't just go up infinitely, right? They can't just nonstop go up. At some point, prices are going to need to rest or relax. And this is what's called price correction. And there are two ways in which prices can correct. The first way is through price action in the form of a retracement, right? Where we have a huge run up and then, buyers, they're taking profits and then prices pull back and they pull back before the next run higher. I mean, that's exactly how an uptrend is formed in the first place. The other way in which prices can correct is in the form of a consolidation where prices are literally resting, where you have a nice move up and then prices literally rest for a while and they don't move and then eventually they break out again, okay? And this is the exact setup that we're going to be trading for the tight base breakout. And a lot of traders trade breakouts, okay? This is not a new strategy. It's not like I reinvented the wheel and came up with this new revolutionary strategy. No, the breakout has existed for decades. However, most traders don't know how to trade it effectively. They don't know how to separate high quality breakouts from low quality breakouts. And that is the art of trading the breakout, is being able to identify the highest A+ quality setups, and those are the ones that you want to be aggressive on. So in other words, this setup is very simple. What we are doing is trading the continuation of an established trend, whether that's a bullish trend or a bearish trend, or we're trading the continuation of a stock that has a ton of bullish momentum or a stock that has a ton of bearish momentum. Sometimes you'll have a stock that actually has a gap up, an overnight change in price to the upside, and you could actually trade a consolidation within, that gap up. And I'm going to talk about that a little bit later in this video. And just keep in mind, the trend is your friend, always. I like to trade in the direction of where prices are already going. I don't want to go for reversals. I don't want to pick tops and bottoms. For some reason, every amateur and novice trader, they want to pick tops and bottoms. I don't want to do that. That's too difficult for me. I want easy setups to come to me. And that's exactly why I trade, trends, established uptrends or downtrends. So essentially, you want to find uptrends or downtrends, and you want to trade consolidations within that uptrend and play the breakouts higher. However, how do you practically trade it, right? Like this sounds great in theory, but where is our entry? Where is our stop loss? How are we going to size the position? And what does it mean to find a tight base, right? The tight base breakout. Like what does that actually mean? Well, let's talk about that right now. So the entry and stop loss for this setup is actually really simple. Once you've identified the consolidation, and the consolidation is the resting period. This is a period of time where prices aren't really going higher and they're not going lower. This is the period of time where prices are literally, you could think of it, relaxing, right? So we have a move up and we consolidate. Now the entry for a breakout, for a consolidation play, is always going to be over the highs of the base. So you find the absolute highs of the base, right? And you place your entry directly above it. And you could think of, the highs of the base as being kind of a resistance area where, prices touched it here, came back in, touched it here, came back in, prices touched it here, came back in, and so on. So you could think of it as the top of that base is a resistance point. And as soon as we break above that resistance, we break above the base or the resting period or the consolidation, however you want to call it, right? That is when we want to time our entry over the highs of the base. Now, the stop loss, very similarly, is under the lows of the base. And you could think of the lows of the base as being kind of a support area where prices are kind of touching it, they're touching it, they're touching it, and it's holding that low. And you want to place your stop loss directly below. So if prices go back down and break under the consolidation or under the base, that's when you want to get out of the trade, because at that point, the consolidation is invalidated. If we break above the base and then we break below it, at that point, the trade it's no good, right? So that's exactly where we want to exit. And that's exactly where I like to place my stop losses on all of my trades. I place stop losses at points where the trade would be invalidated, okay? And that's basically the entry and the stop loss. So it's really simple, right? You find a consolidation, entry over the base, stop loss under the base. Now, let's talk about the risk to reward element of this setup, because ultimately, I promised in the introduction of this video that, you can make 3-to-1 R to R on this position where you can risk $100 and make 300 or risk $100 and make 500. Well, let me explain exactly how that works and exactly why we like to look for what I call tight bases. And there's a formula that I like to use when it comes to sizing my positions. And this is a formula that I believe every single trader should be using within their trading plan. And it's very simple. Share size, meaning the amount of shares that you're buying or shorting for your trade, equals your risk divided by your entry price minus your stop loss price. Now, this is also known as the size of your stop. So let me write that down. This is also known as the size of your stop loss, okay? Keep that in mind. I'm going to mention that a couple times in the next few minutes or so. So let me explain what a tight base is. Let's say you see a consolidation that looks like this, right? And then you see a consolidation that, let's say, looks like this, where you could see this consolidation is a lot tighter. Quite literally, it's smaller, meaning, the consolidation doesn't really span that much from the highs to the lows, right? And let me go ahead and break this down. So let's say the entry for this setup is what? It's over the base. Stop loss is under the base. So let's say, in this case, our entry is at $8, and let's say our stop loss is at let's say 780. Okay, great. So that means the size of our stop loss is 20 cents, because $8 minus 780 is 20 cents. That is the size of our stop loss. That's entry price minus stop loss price. Great. Now, notice how this is kind of a sloppier base, right? There's kind of a big distance between the entry price and the stop loss price. Now, let's do the same thing here. Let's say our entry is the same. Let's say our entry is at $8. However, since we have such a tight base, meaning the distance between the entry price and the stop loss price is so small, let's say our stop loss here is $7.95, okay? So we have a 20-cent stop here, right? Entry minus stop loss is 20 cents. Here we have a 5-cent stop. Okay, so we have 5-cent stop here, and we have a 20-cent stop here. Great. Now let's say we're risking $100. Okay, let's say our risk is $100. So let's go ahead and do our formula. Okay, so risk equals $100. Now let's go ahead and share size, right? So share size equals risk. So that means it's $100 divided by entry minus stop loss. In other words, the size of the stop loss, which is 20 cents, right? So 0.20. $100 divided by a 20-cent stop is what? I believe that is 500 shares. Fantastic. Now let's do the same exact formula right here for this. However, keep in mind, the size of the stop is going to be different. It's going to be 0.05. So what's 100 divided by 0.05? Well, that is 2,000 shares. Okay? Now, you should already be seeing the implications of this. For this setup, we're able to get 500 shares for $100 risk. However, on this setup, because we have such a tight base, right, the distance between our entry price and our stop loss price is so small that we're able to get 2,000 shares. Now, keep in mind, our risk has remained the same. This setup where we're getting 2,000 shares is not riskier than this setup. As long as you get out at your stop loss price for both of these setups, the risk remains the same at $100. However, you're able to get quadruple the amount of shares on this setup because you have a tight base, because the base is clean and the distance between your entry price and your stop loss price is so small. And that's exactly what you're looking for. You are looking for very tight bases within uptrends or downtrends because you have such a superior risk to reward. You're able to get literally 4 times the amount of shares just because this base is cleaner and it's tighter. And that's exactly what you want to look for within this setup. So I like to look for tight bases and tight consolidations within uptrends, not just because it has a high risk to reward, but also because tight bases generally produce a lot more follow through versus a sloppy base, where you can think of it as, within the uptrend, it starts to consolidate and it's a really tight base and it consolidates, it rests, it recharges, it builds liquidity for the next move higher. And generally speaking, from my 5.5 years of trading experience, you get way better continuation and follow through off tight consolidations versus sloppy consolidations and sloppy breakouts. So for me personally, I like to avoid sloppy bases. If I see a sloppy base, obviously I don't have the same risk to reward, but I'm also kind of skeptical that it's even going to follow through in the first place. So I don't want to see lots of tails. I don't want to see candlesticks all over the place. I want to see super tight, super clean, and almost pretty consolidations, pretty bases, because I'm way more confident that that tight base is actually going to produce significant continuation in my favor. Now, I know what you might be thinking. There are risks associated to trading setups that have really tight stop losses, right? Where, let's say, for example, maybe you're looking at a really tight base, it triggers, and then it really quickly hits your stop loss, right? Like there's still a probability of that happening. Trading is all about probabilities. Nothing is certain. So if you have a tight base, right, or a tight stop loss, what could happen is, your stop loss is here, but it moves down so quickly that it fills you down here, or it fills you even down here and it fills you late, and you end up losing more than your predetermined risk. And that's certainly a possibility, right? I want to talk about that ahead of time so you understand that that could happen. But here's what you could do. Let's say you have a really tight base, a tight consolidation. You absolutely love the setup, but you're feeling a little bit wary. You want to approach it a bit more cautiously because you don't know if the setup is going to trigger and then fail right away. And you don't want to lose more than your predetermined risk. Great. So what I like to do is, let's say I'm feeling that way. What I'll do is I'll trade this setup on smaller size. I won't use my predetermined max risk. Instead, let's say instead of using $50 risk, let's say I half size it. Let's say instead I use $50 risk instead of $100 risk, right? So $50 divided by 5 cents, right? That is the size of the stop. So that's not 2,000 shares. That's now 1,000 shares, okay? So I'm half sized on this setup and I'm still able to get 1,000 shares compared to a sloppy base that has a 20-cent stop where I can only get 500 shares and I'm risking my full $100 risk, right? So even when I'm half sized, because the size of the stop is so tight and it's a really tight consolidation, I'm still able to get more shares even with half risk, even with only $50 risk. And that's something that you can do where if you're scared of being stopped out super quick, you can undersize the position, go in with half size or 3/4 size, and you're still going to get a pretty decent, risk versus reward setup where let's say this pops to 815, that's 3 Rs, right? 3 Rs, you'll make $150 off $50 risk and you'll make about 1.5 Rs based off your $100 risk, right? So even undersized, you could still make a pretty decent return on your risk, right? And that's something that you can do here where if you're feeling cautious, you don't want to get stopped out super quick, you don't want to really trade a tight stop, you can, go in with a little bit smaller risk. I like to do that all the time, especially when I'm a little bit uncertain on the setup. By the way, I have hundreds of hours of free education on the internet, not only on this YouTube channel that you're watching right now, but I also have a free 10+ hour trading course that is genuinely better than most paid courses on the internet. It's going to help build the foundation for your trading and supplement everything that I'm teaching you in this video. So you can get access to my free 10+ hour course directly below this video in the description. And if you are someone who's looking for something a little bit more serious and you want one-on-one help, I do personally help scale and coach traders from zero to consistently profitable, where I take my students under my wing and they trade live with me every single day. So they learn how to trade by actually doing it with their mentor. So if you are looking for something a little bit more serious, you could apply for my mentorship also in the description of this video. Let's talk about the next requirement, which is extremely important, and that is the 20 MA requirement. That is a 20-period simple moving average. Now, for me personally, I like to keep my trading as simple as possible. I don't like to overcomplicate my charts. I don't like it when my charts are cluttered because it's overwhelming for me. It confuses me. I like to look at clean price action. So I use the 20 MA. And I also use the 200 MA. I use 2 simple moving averages. That's it. I've never used MACD or RSI or VWAP or Bollinger Bands or stochastics or Elliott Wave Theory, just because I don't want to use complex indicators. I want to look at purely price action. And for me personally, right, I don't want to make the price action side of my trading complicated because the psychology and the mindset side of trading is already hard enough. Why would I try to overcomplicate the price action and my strategies and the execution? And instead, I like to keep that part of my trading simple and I focus on my psychology, my ability to execute, and my ability to control my emotions. So to add the 20 MA on your charts, go to whatever platform that you're on and go to indicators. Now, this is TradingView. I'm using this just as an example. This will work with any platform that you're using. And just look up simple moving average. And if you look that up, it should be one of the first ones. Click on it and then go to settings right here in the top left. There should be a settings icon on your platform as well, and just change the length of it to 20, okay? And press OK. And that's all you need to do for the 20 MA. And just judging based off this chart, this is the gold weekly chart, you could probably already see why I like to use the 20 MA. You could see how well prices are trading off of it. And I like to use the 20 MA for uptrends and for downtrends, and especially for my consolidation, for my tight base setups. So essentially what I'm looking for is I want the 20 MA to be either under prices trending higher if it's an uptrend, right? This is the blue line right here. It's under price action, right? The candles, the price action is above the moving average. And notice how the moving average is under price trending higher. That's exactly what I want to see if it's an uptrend. Now, if it's a downtrend, I want to see the 20 MA over prices trending lower. So I want to see price action below the moving average, and I want to see the moving average trending lower. The 20 MA is the ultimate trend following tool in existence. And keep in mind, earlier in this video, I said I like to trade trends. I want to trade in the direction of an established uptrend or downtrend. And that's exactly why I like to use the 20 MA. Now, you could also use the 9 MA or the 50 MA or the 200 MA. I personally like to use the 200. That's my long-term moving average, but I really like the 20 because that's a medium-term moving average. However, if you want to use like the 9 or 10 MA, and that is a moving average that's a lot more reactive to price because it takes the average of the last 9 or 10 days versus the 20 MA takes the average of the last 20 days, you could do that as well. You could experiment. But for me, I like to use the 20 MA and the 200 MA. Now, the 20 MA is not effective when it's flat. If you're seeing a sideways trend, right, with price action, you're going to see a sideways moving average. I don't want to see that. I want to see a trending moving average. And what you want to look for is you want to see prices consolidate base into a rising 20 MA, right? The 20 MA is under prices and it's rising. So let's go back to gold. Everyone has been talking about gold. It's up like, I think it was up 65% last year in 2025. Everyone is talking about precious metals. And take a look, this is the weekly time frame, right? So this is a longer term time frame. Notice how when gold was sideways, the moving average was moving through prices, right? And as soon as gold began its uptrend, right here, the moving average kind of captured price. It's under price. It's trending higher. And then notice every single time prices either retraced, right? Like retraced right here, or consolidated into the moving average, right? That's where it kind of initiated the next breakout. And that's exactly why I use it, because prices respect the moving average. It's almost like a self-fulfilling prophecy because the 20 MA is one of the most widely used indicators in existence. And whenever prices tend to approach it, right, that's usually when the next leg of the uptrend begins, okay? And obviously you have to be looking at multiple time frames, which I'm going to show you that in a second. So that's what I like to look for. I want to see a consolidation into a rising 20 MA, or I want to see a consolidation into a declining 20 MA. And that's exactly where I would be looking to go short. Now, I really want to emphasize, I never take trades solely off the 20 MA or any indicator. I don't trade the 20 MA in a vacuum. The 20 MA is meant to complement my trading. It complements every other criteria that I look for within my setups. A lot of people think that, oh, I can just trade off of one indicator and that indicator is going to tell me exactly when to buy and sell and boom, I'm a profitable trader. No, that's not how it works. An indicator is supposed to complement your trading. It's not supposed to be fully relied on, right? And there's going to be a lot of instances where prices base into the 20 MA, but I don't take that trade because the other criteria or the other qualities of the setup just aren't that good. Okay, so that's something to keep in mind. You should never be solely relying off one indicator. Step number 5, you can combine this tight base breakout strategy with a gap. Now, what is a gap? A gap is an overnight change in price where a stock's price opens at a different price in which it closed yesterday. So the best way to show you this is just to show you an example. So this is the MOFG. This is a trade that I took, I think, a couple of months ago, but this is a really great example of a gap up and, of course, a really tight base where the previous day we closed at 28.19 and then the next day it gapped up from 28.19 all the way to around 37.40 or so. You could literally see the gap in price, right? You could see that's why it's called a gap, because there's literally a gap on the price charts, and it was gapping above all of this resistance, all of it, gapped above all of that price action. And I found this interesting, and I went to the smaller time frames from there, and I tried to find a setup. So we can go to the 5-minute time frame. Now, what do we see here? We have a huge gap up, prices open, and they kind of drop a little bit, they retrace, and then they begin to consolidate. Now notice this right here. Notice this tight consolidation directly into a rising 20 MA, and this is the 5-minute time frame. So this is a lovely consolidation directly into that rising 20 MA. Exactly what I look for, and I traded this, and it went right to target, which was the previous high. And I also traded the 15-minute setup on this as well. And if we go to the 15-minute time frame, right, you could see that we had that initial base, rallied, from there it retraced, kind of consolidated again. This is more of a retracement setup versus a base. However, we retraced very close to the moving average on the 15. You're not always going to touch it perfectly, but close enough. And right here is when it kind of initiated the next breakout higher. And this is a really great example of you could trade consolidations or retracements on gapping stocks. And I have hundreds of examples, and I'm going to show you a bunch more in this video. So we have the initial gap up on the daily, and from there you go to the smaller time frames to find a consolidation. In this case, there was a consolidation on the 5 and a tight base on the 15 as well. Now, if you want more information when it comes to trading gaps, I don't want to go over everything in this video because this video would be well over like 2 hours long. I would watch this video right here. This video on my channel will give you a full tutorial on how to trade gaps, what criteria we look for in gaps, how to identify a high quality gap versus low quality gap, and it'll give you a lot more details around identifying gaps, how to find them, and exactly how to trade tight bases or retracements on gapping stocks. So I highly recommend watching that video. Let's take a look at this example right here. And this was an example from last week, and this was just amazing. And unfortunately, I couldn't trade this stock because it wasn't available on my brokerage account. I couldn't trade the AEHL long, and my orders were rejected. But nevertheless, this stock had a gap up from 112 the previous day, and then the next day it gapped to 172, and it gapped above this entire red bar, effectively trapping all of the sellers from the previous day. And then I went into this day with a bullish bias, and my first call on it was a 1-minute breakout literally at the start of the day, where it kind of retraced a little bit and then it consolidated pretty tightly for 5 straight minutes. And my call was over this tight base right here. That's entry at around 170. Stop loss directly under the base, entry or stop loss at 163. So 170 minus 163, that's around a 7-cent stop. And this in literally 4 minutes rallied all the way to almost 240, right? I mean, maybe you probably wouldn't have taken profits all the way at the top, but let's say you took profits at 215, right? It's 3 minutes, just boom, 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 right? And that would be a, 45-cent gain on a 7-cent stop. And that's just insane. The risk to reward of that is insane off the morning too. So this was a beautiful example just from the other day. There was a really similar play on the nerve where this stock gapped from 262 and it gapped to 673 the next day. This was a 150% gap up. Now, I actually don't like to gravitate towards gaps that are over 100%, but nevertheless, this was such a good example. And you could see this huge topping tail. So let's go to the smaller time frames. And there was a 2-minute breakout literally 10 minutes into the day, right? You could even look at it on the 1-minute time frame where we had a really tight consolidation, and the entry here would have been over 730. That's where I called it, around 732. And the stop loss was directly under the base, call it at 660 or so. So we're talking about a 40 plus 30, around a 70-cent stop, and this within 5 minutes rallied all the way to around $12, right? So we're talking 70-cent stop, and it rallied close to $5. That's a 3 to 5 hour play, depending on where you took profit. So, 2 beautiful examples of tight consolidations right off the open that led to amazing breakouts. Let's take a look at an amazing example of a stock that I've been scalping very frequently over the past few weeks, and that is the DVLT. And first, the DVLT had a really strong move to the downside where we saw red bar after red bar after red bar until we bottomed out, closer to the new year right here. And this was an established downtrend. If you look at the hourly time frame, you could see how well prices are respecting the 20 MA and the hourly. I mean, every time the candlesticks even touch the 20 MA, we see a downward move. Even when prices kind of broke above the 20, they were immediately rejected by the sellers. So if you look to go short, every single time prices approached the 20 MA on the hourly time frame that was declining and you went short, you would have made money on this entire downtrend, and I wanted to capitalize on that. So from there, I used the hourly time frame and the daily time frame to help me set the bias that this is a downtrend. I'm looking to go short. And from there, I went to the 15-minute time frame to look for entries. And I traded this basically every single day for like 2 weeks straight. And the first setup was here back on December 18th. And the DVLT is a stock that's highly liquid, doesn't have spread. Max spread is 1 cent. And it was just a very scalpy stock. And on December 18th, I saw that the DVLT attempted to move higher. The buyers attempted to take control. And then that led to a topping tail. What does a topping tail signify? A topping tail is when the sellers have taken control, right? Thus leading to the huge wick at the top. And from there, we begin to consolidate. And this was the first breakdown, right? Under 131 entry, stop loss at 135. So this was about a 4 to 5 cent stop. And in one motion, within the next basically hour and a half or so, it dropped all the way to 110, which is a 20-cent move on a 4-cent stop, right? Maybe even if you took profits at 115, you still caught 15 cents off a 4-cent stop loss. Maybe you were really aggressive and you used an even tighter stop. Maybe you use a 2 to 3 cent stop, right? Obviously, kind of up to you in the moment how aggressive you want to be, but that was beautiful. And from there, the next day, the DVLT had a very similar move where in the morning it kind of popped, kind of consolidated, chopped around. I didn't see any setups here, and then it had a really nice move to the downside. And then look at this penny base. That's what I call a penny base because, the top of the base is at 105, the bottom of the base is at 104. This base basically, isn't moving. It's a extremely tight consolidation. In fact, you can't get a tighter consolidation than this on stocks that are above $1, right? So it based right into, close to the 20 MA and the 15. If you actually look at the 5, it based perfectly into the 20 MA on the 5, which is right here, right? And I took this, this setup right here made me close to $2,300 where I went short under 104, stop loss at 105 or 106. I had like a 2-cent stop and I was really aggressive on this setup. I think I shorted around 30 to 40,000 shares and I was able to catch this move lower and then I took profits somewhere around here. So I took profits kind of as it dropped lower. So I took some here and then the final lot right here, and it actually ended up continuing lower. All right. And then the next setup, literally the next day, the stock opened higher, attempted to move up, rejected, and then look at this base right into the 20 MA and the 5, and I shorted this as well. I shorted under this base, stop loss directly above, and caught this move lower. Even right here, you can't really see it that closely, but right here, we drop, then we begin to consolidate. There was a really tight base right here, and I caught this move lower as well, right? So I would just find tight consolidations on the DVLT, even right here. You can barely see this 5-minute candle. It was a super tight base on the 1 and the 2-minute time frames, and we caught this move as well. Now, I also caught the DVLT as a long this past Friday, and the DVLT ended up bottoming on the daily and hourly time frames, and from there, it had a 22% gap up on Friday, and just look at how well the DVLT was respecting the 20 MA on the 5, and this was actually the perfect breakout right here. It literally moved up and based right into this 20 MA. It wasn't a perfect base. It wasn't the tightest base of all time, but beautiful setup. I completely missed this one, but entry at 91 cents. The stop loss would have been at around 88 cents, 3-cent stop, and it popped all the way to 101 and then eventually to 112. Now, I did actually catch this scalp right here where we moved up, we consolidated for a few minutes. It was a really tight base. It was like a 2-penny base, and I caught this as a scalp long with my stop loss right here. Let's take a look at another amazing example, and this was on Blink. So looking at the daily time frame first, as you can see, there was a consistent downtrend on the daily. We had 2 strong green bars into the declining 20 MA on the daily. So we attempted to move higher, then the sellers rejected the buyers and prices started to go down. And on this day, I saw that prices were respecting the 20. We started to see a move lower. So I had a bearish bias on the day. And from there, just take a look at the 15-minute time frame. We had the initial drop in the morning, we retraced, moved lower, and then we consolidated into a declining 20 MA on the 15-minute time frame. And take a look at this base. I mean, such a tight base. This is what I call a 1 penny base, where prices literally aren't fluctuating more than 1 penny. It's basically staying at the same price, for almost 3 hours essentially. So the entry would have been under 127. So let's say 126, stop loss at 128. So it was a 2-cent stop, and this dropped over 8 cents. So this was a 4 to 6 hour play, because I actually think it dropped even more. So beautiful on the 15, nice base on the 1 minute, nice base on the 5 minute, and beautiful looking setup on the hourly as well. And the daily was looking very bearish. And I was reading the level 2 the entire way down. There was a consistently stacked offer, meaning there was significantly more selling pressure on the offer versus buying pressure on the bid. There was essentially no buying this entire move lower. So I took advantage of that and caught a brilliant play on the blink on this very tight base breakdown. Now, I don't want this video to be too long here, so one final note. What I like to do management-wise a lot of the time is raise my stop loss aggressively to break even on a lot of my breakouts and breakdowns, and this can be very effective when it comes to limiting your losses. So let's say I identify a nice tight base breakout, entry above the base, stop loss below the base, and the trade triggers, it's looking good, and it's continuing higher. What I like to do is raise my stop loss aggressively to break even. So if the trade decides to fail and it comes right back in and it hits my new stop loss at break even, well, I won't lose any money. And the risk of this is sometimes it might come down to your break even price, maybe a little bit further, bottom out, and then it'll continue higher anyway. And at that point, I would have been shaken out of the trade. And, obviously if I would have stuck to my original stop, I would still be in. So, you have to balance that, where sometimes that's going to happen, where you might get shaken out of a trade because you aggressively move your stop to break even. But then on the flip side, at least, you eliminate your chances of losing on this position. So I'm not saying to do this every single time. I just want to give you an extra tool within your toolkit when it comes to managing your breakouts, where you have the option of raising your stop loss to break even quite aggressively, especially if you have decent size on a tight breakout. Okay, so obviously you'll have to consider whether you want to do that or not based off your trading plan. Hope you enjoyed this video. Let me know your results with actually practicing this strategy, and make sure you either practice it at first with paper trading or extremely small risk so you can get accustomed to actually trading breakouts. And make sure you leave a like, make sure you subscribe to the channel. Thank you so much for watching, and I'll see you on the next video. Buying the dip is by far one of the most popular strategies in trading, yet over 90% of traders have no idea what to look for when it comes to buying the dip. And frankly, most of those traders lose money trading this simple strategy. And in this video, I want to teach you the exact criteria that you want to look for when it comes to buying the dip. And I'm going to teach you how to differentiate between a high quality dip opportunity and a low quality dip opportunity that's just going to continue to trend against you. And this could be applied for day trading. It could be applied for swing trading, for core trading. This could even be applied for long-term investing, where if you like to dollar cost average into your retirement account or into your long-term portfolio, you could still apply this strategy, especially when you're DCAing into the market or your favorite indexes. This could also be applied for stocks, for crypto, for futures, for options, for Forex. So make sure you pay attention. Make sure you watch until the end of this video, because this is something that I've been trading for over 5 years. This is one of my core strategies, and I buy the dip. I trade the retracement setup almost every single day. And the first thing that you need to understand before I dive into this strategy is the idea and the theory behind price correction. And the best way that I could explain this is, imagine that you just ran a marathon, You just ran 26 miles in the New York Marathon and you are tired. You just finished the marathon, right? Are you going to be able to run another marathon? Are you going to be able to, finish that marathon, run the 26 miles, and then immediately run another marathon? Well, unless you're David Goggins, unless you're superhuman, obviously not. You're going to need to hydrate. You're going to need to sleep. You're going to need to rest. You got to drink some water. You got to go home. You got to, visit the doctor. Maybe you have some injuries, right? You can't just run 2 consecutive marathons. You need a resting period. Well, the markets work in a very similar way, where let's say the market puts in a massive rally. The market just ran a marathon to the upside, right? The market can't just continue higher and higher and higher to infinity. No, the markets and stocks, they need a resting period. They need to correct in price. And there's 2 ways in which prices can correct. There's two ways in which prices can rest. The first way is through a consolidation, where the markets run a marathon, prices are moving up, everything is mooning, and then the markets rest and they consolidate, they base, and they rest until that stock or the market is ready to run the next marathon. And this is a way in which prices can correct, through literally resting and just consolidating. And this strategy is called the breakout. And this is one of my core strategies as well. I actually teach this strategy on this YouTube channel in a different video. So I would highly recommend watching that video as well. But the other way in which prices can rest or correct is through price action in the form of a retracement, where the markets run a marathon, they move up, buyers are buying, buyers are stepping up to the plate. And then once the market or the stock runs a marathon, it needs to cool off. It needs to have a resting period, a correction period. And one of the ways that could happen is through literally a retracement, through a dip. And this happens because buyers from down here are taking profits. Maybe there's even some short sellers that think prices have topped and they're shorting, which is causing downward pressure. But I would say it's mostly buyers taking profits. So the markets can rest, the markets can breathe before they're ready to move up again and run the next marathon, so to speak. So a retracement is a temporary pullback before the trend resumes. And you can think of this as the market breathing. The market is resting before the next leg higher. Because if the markets are just going up and up and up and up and up, that trend is unsustainable. Nothing can just go up forever. In the same way, nothing can go down forever. There needs to be a period of price correction. And if you really think about it, this strategy is really you just trading the continuation of an established trend. Remember, the trend is your friend. I see so many traders who gravitate towards taking reversals, especially beginners. Why? And to really paint the picture here, imagine you're driving your car on the highway. Do you want to be driving in the direction of traffic, or do you want to be driving against traffic? Well, I don't know about you, but I don't want to crash head on into another car. I want to trade in the direction of traffic. Yet most traders want to, drive against traffic, right? In the same way they want to trade against the trend. It is far easier trading with the trend, especially if you're a beginner. I'm not saying don't take reversals. I'm not saying you shouldn't have a reversal strategy in your plan. I do. I actually like taking reversals. I don't usually gravitate towards them, but I do have a reversal strategy within my trading plan. However, I always prefer to trade with the trend because it's much easier. So if the trend is your friend, what is the first step when it comes to trading the retracement setup? Well, the first step is you need an uptrend or clear bullish momentum. You need to be confident that prices are going higher. I want to be trading in the direction of the trend. If there is a downtrend, I don't want to be going long. If there's a sideways trend, I also, most of the time, don't want to be going long. I only want to go long when I'm confident what the trend is. So what is an uptrend? And most of you are already going to know this. It's very simple. And by the way, if you can't tell, I like to keep my trading as simple as possible. That's what makes me a profitable trader. I don't like to use complicated indicators. I don't like to use complex strategies. I trade essentially 2 to 3 core strategies. Number 1, the retracement setup. Number 2, the breakout or the breakdown. And I also like to trade reversals at times. However, I would say 90% of the time, I am trading in the direction of the trend through either a retracement, aka buying the dip, or through a breakout. So what is an uptrend? An uptrend, it's very simple. Higher highs, higher lows. Okay, that's all you need to know. All right, we have higher highs right here, right here, right here, and we have higher lows right here. We know that the overall direction is moving higher. Now, your goal as a trader is to essentially time your entries when this dip happens. This is when you obviously want to be getting into the trend. You don't want to be getting into the trend here. Most people actually FOMO here because they think they're missing out just to see that stock move down. They sell here, it starts to move up again, then they buy either here or here just to see it move down. They sell, and then the cycle repeats. And that's how most retail traders unfortunately trade. They buy the top and then they sell the low of the retracement when it should be the opposite. They should be buying the retracement and then, of course, selling this point right here. Or maybe you're going for a much larger move. Maybe you're swing trading, or maybe you're holding your trade intraday when you're day trading for like a few hours and you're aiming for a much bigger gain. You could actually buy down here and then hold through all of these dips in attempt to catch a much bigger move. But you need an uptrend. If you don't have an uptrend, you need clear bullish momentum. And one of the ways that I like to see clear bullish momentum is through a bullish gap up. So what is a gap? A gap is an overnight change in price. This is when a stock opens the next day at a different price in which it closed the previous day. So let's say Tuesday, 4 p.m. Eastern, when the market closes, the stock closes at $5. And then the next morning, Wednesday at 9:30 a.m. Eastern, when the market reopens, that stock opens at $10. That difference in price that occurred overnight is called a gap. And I like to trade the continuation of a bullish gap up. And a bullish gap up gives me bullish momentum. It gives me a bullish bias. So lots of my retracement setups actually occur on bullish gap ups. And I'm going to show you a bunch of examples of that. But here's an example of a gap up. This was on plug. Oh, no, I'm sorry. This was on open, I believe, just a few weeks ago. And this stock closed right here the previous day. And then the next day it opened 29% higher right here. You could literally see the gap in price. You could see this overnight change in price. And of course, the stock absolutely mooned that day. And there was a beautiful retracement setup on this day, which I'm going to show you a little bit later in this video. But this was a gap up that gave this stock clear bullish momentum. We were gapping above resistance. We were also gapping above 2 red bars, which trapped all of the sellers who went short here or here or here. So really amazing gap up. I have other videos that go a lot more in depth when it comes to explaining gaps, but this was a really nice gap up that obviously continued higher. Here's another example. This was on RUM just a couple of days ago. I will also show you this example later in the video, but it gapped from here the previous day and it opened right here, which was an around 11% gap up. All right, and this actually also had a retracement setup. It had a buy the dip opportunity on this day, but this gap up gave this stock a bullish bias, and my bias on this day was to go long. So I was looking for either a breakout or a retracement setup to essentially trade this bias on the intraday timeframes. If that still sounds a little confusing, we're going to be looking at a ton of different examples later on in this video. But essentially my point is I need either an established uptrend or I need a bullish bias. I need bullish momentum. And one of the ways I could see, bullish momentum is through a bullish gap up, a bullish overnight change in price to the upside. So when it comes to identifying a high quality dip buying opportunity, we look for specific pullback criteria. And let's go ahead and go over every single one of these pullback criteria. And from there, we're going to go to real charts and apply everything that I have just taught you. Okay, so I'm going to go through this section a little bit quicker. We're not going to be looking at examples right away. I want to show you all of the material first, and that's when we're going to go and look at examples and apply everything that you've just learned. So first step, following a rally higher, so the market ran a marathon up, we want 3 or more consecutive red bars in a row on the pullback. So we got 1, 2, 3, 4. We want 3 or more red bars in a row. Now, this is like the ideal scenario. You're not always going to get perfectly 3 to 5 consecutive red bars in a row, but this is what you want to look for. You want to see 3 or more consecutive red bars in a row. Why is that important? It's important to know that because you don't want to see Christmas lights. What are Christmas lights? Red, green, red, green, red, green, red, green, and then you move up. You don't want to see this. And the reason you don't want to see this is because as prices start to move up, if you have green bars within this pullback, well, a lot of those buyers, like think about it. If you bought it right here and then prices continued lower and now you're down on your position and then all of a sudden prices start moving back up, you might feel the need to actually just cut that trade because you felt wrong and you were losing money, right? Or especially if you bought it up here and then prices continued lower, if prices move back up, well, at that point, you might just cut your losses or you might just say, hey, this was a failed trade. I'm going to get out, break even. And you're going to have almost like layered buyers within this pullback. And you don't want that. You want there to be clear selling. Okay, you just want the sellers to be taking profits before the next move up. You don't want selling and then a little bit of buying and then selling and then buying and then selling and then buying. You don't want Christmas lights because these layered buyers could actually put sell pressure on this stock as it's moving up. Where as it's moving up, these buyers sell, then these buyers sell, and then all of a sudden you have a really choppy kind of next move higher. You don't want that. You want 3 or more consecutive red bars in a row. You don't want Christmas lights. Criteria number 3, you want to look for prices to retrace into the 20-period simple moving average. I like to keep my trading as simple as possible. I don't use complicated indicators. I don't use MACD or Bollinger Bands or RSI or VWAP or stochastics or Elliott Wave Theory or Fibonacci. I don't use any of that. I keep my trading very simple. I only use 2 simple moving averages and volume. That is it. And the 20-period simple moving average is the ultimate trend following tool in existence. Now, pay attention to what I just said. Trend following tool. That is our first step for trading the retracement. Is we want to have an uptrend. We want to have an established trend higher. And that's exactly why I like to use the 20 MA. Now, what we want to look for is we want the 20 MA to be under price, trending higher. I want you to say that out loud. You're watching this YouTube video. I want you to literally say it with me. Under price, trending higher, under price, trending higher, under price, trending higher. We want the 20 MA to be under price, trending higher. And we want to be timing our entries when prices are close to or near the 20 MA. That's what we're looking for. When prices are, let's say, really far from the 20 MA, that means there's extension. Extension is the distance between price and the 20 MA. We don't want to be entering when there's a lot of extension. So you could use the 20 MA to figure out whether prices have corrected enough, whether prices are extended, or you could think of it as overbought. So the closer we are to the 20 MA, the less extended we are, the less overbought we are. And that's why we want to be timing our entries when prices are near the 20 MA. And let me show you an example. It's going to be a lot easier when you actually just visualize this. Take a look at this uptrend. Take a look at every single retracement setup here. This is the 20 MA, the blue line. What is it doing? It's under price, trending higher. It's not flat. When the 20 MA is flat, it's not effective. That suggests that prices are trendless, that their prices are sideways. We want it to be under price, trending higher. And notice, every time we got close or we touched the 20 MA, we bounced. And that was honestly a very good dip buying opportunity. Literally every time it hit the 20 MA, every single retracement here, 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 here. You get the idea. Every single retracement got bought. And this is exactly why I like to use the 20 MA in conjunction with everything else that I'm going to teach you in this video. Whenever I teach the 20 MA, people are like, oh, well, you're just using an indicator for your entries. No, I use it as a complement. It complements every other part of my analysis. It complements the other criteria. I use it to my advantage. I don't solely rely off of it. Here's another example of a downtrend. We base into the 20 MA, drop. Base into the 20 MA right here, drop. Retrace a little bit, we come a little close, drop, okay? That's why I like to use the 20 MA. Here's another example. And we weren't quite, right at the 20, but we're pretty near the 20. And this was actually on the 15-minute time frame. On the 5-minute time frame on this chart, we were actually right by the 20. But this was an excellent buy the dip opportunity where we moved up, retraced, and that was an excellent buying, buy the dip setup. So we want the 20 MA to be under price, trending higher, and we want to see prices retrace into the 20 MA or at least come close to the 20 MA. This is a very important requirement. Criteria number 4 is actually pretty simple. We want to see the stock retrace 40 to 60% of the prior move. We want it to pull back 40 to 60% of the original rally. Retracement, if you want to define what a retracement is, it's just the amount that the stock pulls back. So we want to see this pull back into what I call the golden zone. And that is between 40 to 60% of this rally, right? So let's say this was 0%, the bottom of the rally. This was the top of the rally. That represents 100%. We want it to pull back around 40 to 60% of this rally, which is like this area right here. We don't want it to pull back deeper than 60%. We don't want it in this area right here because a deep pullback suggests weakness. If that stock was really that strong, if that trend was really that established and really that strong to the upside, why would it retrace over 60%? And the same thing applies almost in the opposite way if it's under 40%. So let's say a stock pulls back here, right, into this area. That shows lack of correction. And, just through my experience, when you have a very shallow retracement where it's not into this golden zone, where it's like 20% retracement or 30% retracement, whenever it attempts to move higher, it fails because it just hasn't corrected enough. It hasn't gone through enough of a resting period for prices to continue higher. And similarly, if you see a really deep pullback into this area, well, prices are really weak. And what tends to happen is it starts to move up, you get excited, and then it fails. And that's just through my personal experience. You want to see it into the golden zone, the 40 to 60% retracement of this prior move. That's really the sweet spot. Criteria number 5. Before I enter into any single trade in the markets, I need a predetermined entry, predetermined stop loss, and of course, predetermined target, because that's going to add structure to my trading. I hate operating randomly. I want to know where I'm supposed to get in and where I'm supposed to get out if the trade doesn't go in my favor. A lot of traders operate completely randomly and then they expect consistent results. That makes no sense. If you want consistent results, you need consistent input. That means you need a structured approach towards entering and exiting a trade. So the entry and the stop loss for the retracement setup is actually really simple. So your entry is going to go over the last candlestick of the pullback. I'm going to show you what that looks like in a second. Your stop loss is going to go under the lows of the retracement. So you find the lowest point of the retracement, your stop loss is going to go below it. And the target is the previous high. So where are the last candlesticks of the pullback? Well, right here, these two. So entry over these two candlesticks, stop loss below the lows of the retracement, and you're going to be targeting the previous high. That is target number one. Now, that's super simple. And ideally, you want your entry bars, right here. These are our entry bars because we're using these bars to base our entry and stop loss off of. We want these to be narrow range bars or doji bars. We want these to be relatively small candlesticks. And the reason we want that is because it's going to give us a far better reward to risk. So how do you size your position? If you watched my risk management video, you should already know this, or if you've watched my free 10+ hour course, you should know this. The share sizing formula is risk divided by entry minus stop loss, and then entry and stop loss, they're in parentheses. So you calculate this first before you do the division. So let's say our entry is at $4, stop loss is at $3.90, and our risk is $100. $100 divided by $4 minus $3.90. So that's $100 divided by 10 cents. $100 divided by 10 cents is 1,000 shares. So that would be our share size for this position. If we get 1,000 shares at $4 and it hits our stop loss at $3.90, we would lose $100. All right. Now, why do we want small candlesticks? Well, let me give you this example. Let's say this is a really large candlestick like that. Let's say these candlesticks are larger. And then all of a sudden we have a much bigger stop where instead of our stop being at 390, let's say our stop is at 370 all of a sudden. Then we have to go and actually change the formula around because our entry remains the same, right? But our stop loss is different. So instead of 390, this would be 370. So now our share sizing formula would be $100 divided by 30 cents because $4 minus 370, that's the distance between our entry and our stop, 30 cents, right? So $100 divided by 30 cents, that means we would only be able to get 333 shares for this position because we have a much bigger stop loss and therefore we have a much lower R to R. So we want smaller candlesticks, we want smaller entry bars so we can get a tighter stop, and as a result we could have a better reward to risk for our same risk. Keep in mind with having a 30-cent stop now versus a 10-cent stop before, our risk hasn't changed. What's changed is the amount of shares that we can get so that if the trade does hit our stop loss, right, we're only going to lose $100. So we want smaller entry bars because we have a better R to R. Criteria number 6, we want to look for a retracement into what's called minor support. This is when prior resistance of that uptrend becomes support for the next dip. So for example, let's say we are right here and prices move up. Fantastic. We want to see this next dip basically dip into the prior resistance, right? Like at this point right here, this prior high, it's going to act as resistance. That's why this prior high is target 1 because that's the next level of resistance. But on this dip, we want to see this prior resistance, this area of resistance become support. And this is a really nice amplifier where if we could have a nice move up and then a dip into what was before resistance, that's exactly what we want to see. This is a really solid area to potentially buy the dip for the next move higher. So if I draw it out, we have an uptrend, right? We have an uptrend. This is an area of resistance. We want this area of resistance to now become support, and it moves up. Same thing here, this area of resistance, okay, right here, now becomes support for the next dip before we move up. And this is a really nice amplifier, and it's really simple. Prior resistance, the prior high, basically becomes support for this stock within the uptrend. Now, before I show you some real life examples and some recent trades that I have taken where I was trading the retracement setup, I want to emphasize that you don't need every single one of these criteria to hit in order to buy the dip. And that somehow rhymed, but you don't need every single one of these qualities, right? You can pick and choose which qualities you want to put into your trading plan. For example, let's say I'm looking at a retracement setup and it's into the golden zone. Great. It's into a rising 20. Great. It has 3 or 4 red bars in a row. Fantastic. It has a nice entry. It has a really good reward to risk, but it's not retracing into minor support. I will still probably take that trade because it hit enough of my criteria. Let's say instead, maybe it did retrace into minor support, but it's not quite into the golden zone. Maybe it's like right here, like 65% retracement, but it's into the rising 20. It has a really bullish catalyst. It has 3 or more red bars in a row. It has a really nice R to R. I might still take that trade, right? So you could pick and choose which criteria you want to specifically focus on your setups, because you're not always going to get picture perfect retracement setups. If you do, great, you should just take it, but you're not always going to get picture perfect. So you can decide which one of these qualities you want to include in your game plan, and you can decide which one of these qualities are like necessities versus maybe some of these are more optional for you. So right off the bat, I want to show you what a power trend is first and how you can capitalize trading retracements within a power trend. And a power trend is exactly what it sounds like. It's a powerful trend. And most of the time you're going to see the 20 SMA under prices trending higher, and you will see it kind of trending in a 45-degree angle. When you see the 20 MA trending in a 45-degree angle, it suggests that the trend is sustainable. When you see it trending at a little bit, greater than a 45-degree angle, that's when the trend is kind of getting exhausted. And you could see this was on Wayfair just recently over the last few weeks. I mean, look at this beautiful uptrend. Every time it retraced to the 20 period moving average, literally every single time, it respected the 20 MA and then started to rally right after that. Even here, we broke below the 20, instantly rejected and continued higher. Even here, almost broke below the 20, instantly rejected and continued higher. Here's another really good example of that going both ways. Here we have a solid power trend to the downside where we dropped, retraced to the 20 MA, dropped, retraced to the 20 MA. And this is also, a retracement setup just to the downside. So everything that I taught you in this video could also be applied if you're going short. You would just apply it the opposite way, where the 20 MA is overpriced, trending lower. And all of the same criteria would apply the same exact way. So retrace to the 20 MA, dropped, retrace to the 20 MA. This time it gapped down all the way to the 200, respected it, right? Retrace back to the 20, dropped, retrace back to the 20, dropped. And then the same thing happened on this uptrend. You could see how well prices are respecting the 20 MA on this power uptrend. And every time we got a retracement to the 20 MA, we ended up rallying. We could even look at the S&P 500, which has basically been on a power uptrend since the tariffs happened in early April. And we've rallied 36% since then. And take a look on this uptrend, every single dip into this rising 20 MA got bought. We dipped right here, right to the 20, instantly moved up. Dipped into the 20, moved up. Dipped into the 20, moved up. Even here, we broke below the 20, instantly rejected, continued higher. Dipped right into the 20, perfectly respected it. Same thing here, same thing on this tail, same thing recently here. So if you're noticing that you're looking at a stock or any type of asset that is power trending and closely following the 20 SMA, you could actually use every dip into the 20 SMA as a buying opportunity, especially if it matches up with the other criteria that I have taught you. Let's look at some individual retracement setups that we can understand and analyze. So the first one is Plug. We already looked at this gap earlier in the video, but this gap from 284 the previous day and it opened around 13% higher at 321 the next day. It was gapping above a red bar, and it was also gapping above resistance. So this was a really bullish gap, and this gave me a bullish bias for the day on plug. From there, we go to the smaller time frame. So I like to use the 5-minute chart, especially around 30 minutes into the day. And funny enough, I will be honest, I actually got stopped out on plug because I originally tried it as a breakout here. I was super aggressive. It was extended from the 20 MA, so really aggressive setup, and I took a full stop on this. And funny enough, right after that, I called this as a retracement setup, and I had a lot of my students actually take this play and make money, but I ended up passing on it. And then looking back at it, it was just a beautiful retracement by the dip opportunity, but I already kind of took a stop on this, so I stopped watching the plug and I started focusing on other stocks. But wow, what a setup here. Really nice pullback. We had 3 or more red bars in a row. We did have one doji, but it's never going to be exactly perfect. So nice pullback into the rising 20 MA. I would call this a 40 to 60% retracement, right? Maybe 60%, 55%, something like that. But we're into that golden zone. Perfect. We had a gap up, so we can't really look at minor support. So, that criteria doesn't really apply. And the entry would go over these candlesticks, over 345, stop loss around 335. So it was a 10-cent stop, and this ended up moving all the way to 392, which is around a 40 to 50 cent gain. So this was like a 4 to 5 hour trade, it would have been. And maybe you took profits at target 1, and then you left a runner, and maybe you took those profits somewhere up here, but really nice retracement setup. And obviously I didn't take advantage of this, but I had a ton of students who did. And yeah, this is a really great example of a bullish gap on the daily time frame, and then you trade that bias via a retracement setup on the intraday time frames. Let's look at another example, and this was on Rumble Rum, and this was also just a few days ago. This was just this past Friday. This was the same day that the plug happened, and I know that because I actually called this trade in my group, and this stock gapped from 739 to 823, which was an 11% gap up. So that gave me a bullish bias for the day because we were gapping above this resistance. And the next major resistance was honestly the 200 period simple moving average. So I thought that this stock could actually run up to around $9 for that day. And I go to the 5-minute time frame, and we'll look at the other time frames in just a second here, but we get a beautiful retracement setup. We get a nice move up, 4 red bars in a row. Perfect. We don't see any Christmas lights. We are kind of far away from the 20, but you got to keep in mind, because of the big gap up, it's going to take time for the 20 MA to catch up to prices, but it's still rising. It's still under price. And the entry would be over this red bar, stop loss directly below. And we would enter this trade basically as this green bar is forming. We don't wait for this green bar to finish forming and then take it. As soon as it hits above this entry, above, 833, we would get into the trade. So you don't need to wait for this green bar to actually finish forming. And this was kind of a deep retracement, maybe a little bit above 60%, but still really nice retracement setup. And of course, TP1 would have been this prior high. And then TP2 would be the next target, which I said was around $9, and we hit around $8.95 on that setup. If you look at the 15-minute, it looked really, really solid too. So I always like to look for multiple time frame alignment. We had a nice green bar, red bar, and a nice doji bar. I like doji bars, right? So entry above the doji bar, stop loss directly below. So you could have taken this retracement setup also off the 15. And by the way, we kind of got one, later in the day. Even though I didn't really like this one, it was a really deep pullback. But hey, if you wanted to trade this retracement setup right before the close, you could have entered above this little base, above these candlesticks, stop loss directly below. Let's look at the RKLB, Rocket Lab Corporation. This was a few months ago, but I remember taking this trade, and this was just a fantastic retracement setup. We had a very minor gap up from 2540 to 2665. So we were just clearing above this resistance, and that small little gap up actually gave me a bullish bias on the day. We were clearing above this resistance, and I thought we had upside to move higher until this prior resistance area. So we go to the 5-minute time frame, all right, and we got a really nice retracement setup here. Green bar, we got one big red bar, then a small little kind of topping tail, narrow range bar, right? So entry above, stop loss below, and obviously this had really nice follow through, but I think this was actually way nicer on the 2-minute time frame. So I always like to look at multiple time frames, and that gives me a lot better of a perspective on what that stock is actually doing. And as you can see on the 2-minute, it was actually much nicer. Nice move up, red bar, bottoming tail, and then we had like 2 doji bars in a row. Really nice. So we didn't see 3 to 5 red bars in a row, but it didn't matter because it was still a really nice retracement setup, entry above, right? Stop loss directly below. And you could have even entered it here. Let's say you missed this setup and moved up kind of based. You could have put your entry here, stop loss directly below. I would say this would be a little bit tougher because it's right into the prior high. But of course, it didn't matter. It continued up, and even here had a nice little retracement setup. Moved up, retraced 3 red bars, bottoming tail. You could even played this. I wouldn't have, and I didn't. But, you know, in theory, this is also a retracement setup. Entry there, stop loss above, and you would have taken profits at the previous target. Let's look at another one, and this was on APLD just a few months ago as well. Terrific trade that I called and actually executed on. And APLD had a nice move up, retracement, almost had a retracement setup here into the rising 20, 4 red bars in a row, and it triggered this retracement setup on a gap. So we gapped up, triggered that setup, and of course we had really nice follow through to the upside, and I traded it on the day of the gap. So this gap was gapping above those 4 red bars, above resistance. I thought it was really interesting. It gave me a bullish bias on the day. And if we go to the 5-minute time frame, we got, you know, basically a picture perfect, you know, retracement setup. Nice move up, 3 red bars in a row. Then we had a bottoming tail, narrow range bar, close to the 20 MA. Okay, around a 60% retracement or so, you know, a little bit more than that, but still really nice. And entry would have been over that candlestick, stop loss directly below. And of course it hit target 1. It actually exceeded target. In fact, we kind of got another retracement here and another retracement setup here that you could have played. So really nice setups. And even though it didn't hit every single criteria, it's still an effective setup because we combined the daily time frame and looking at the gap and establishing that bullish bias. We knew that there was a bullish direction, there was a bullish catalyst, and we combined that catalyst with a retracement setup on the intraday time frames. Let's look at some retracement setups that actually work the other way, that actually worked as shorts. So this stock gapped from 2022 to 1888 the next day. So this was like a 6% gap down, but notice how it was gapping below the 200 and below a lot of this resistance. So really bearish gap down. I had a bearish bias for this stock on that day, and we got a picture perfect, almost power trend lower. But take a look at this retracement. We moved down. We had 3 green bars in a row. Remember, we want 3 red bars if we're looking to go long. If we're looking to go short, we want 3 green bars in a row, 40 to 60% retracement into the golden zone, near the 20 MA, so nice. And entry right below these candlesticks, stop loss directly above. And then literally every single time it retraced near to the 20 MA, it actually just continued lower. So beautiful, picture perfect retracement setup, you know, in the opposite direction where we would be going short instead of long. So all the criteria that I just taught you, it would just be the opposite if you're going short. Let's take a look at the FNKO, and I remember this setup very clearly because I couldn't get filled on it, and it was an unbelievable trade, but I couldn't get filled any shares short on my Thinkorswim. I just couldn't get a fill, so I couldn't take advantage of it. But this was gapping from 365 that day to around 298 the next day, around 18% gap down. This stock had a nice move down, based, and it triggered this breakdown via a gap on the daily chart. So I had a bearish bias going into this day. And if we go to the 5-minute time frame, we could see a beautiful, just beautiful retracement setup right here. It's a little bit choppy because TradingView doesn't really like represent this data all that well. But we had a nice move down, 40 to 60% retracement. Not a perfect retracement, but it was still good enough to take. Near the 20 MA, right? 20 MA was starting to catch up to price. And basically the entry would have gone under 264 or under 265. Stop loss 275. And it was a 10-cent stop, and this thing dropped all the way to 232. So unbelievable trade. This was actually scalpable as well. Really nice retracement setup for a short. And in fact, it worked as a retracement here. It retraced to the 20 MA, kind of based, dropped. Retraced to the 20 MA, dropped. But at this point, it formed a higher low. So, you know, that's obviously a red flag, and it obviously started to kind of transition higher after that. But beautiful retracement setup to the downside. Like I said, entry under 265, stop loss 275. And if you look at the 15-minute, I mean, look at that. Really nice move lower. Couple of green bars. We had a doji bar here, and beautiful continuation to the downside. Hopefully you found tremendous value in this video, and I want you to actually test this strategy first in your own trading with either paper trading or really small risk, so you could develop a feel for trading the retracement setup, and you could practice applying all of the criteria that I've taught you today. All right, before you actually use significant risk, I want you to test it out. I want you to kind of develop your own intuition for this setup and be selective with your trades. Don't just take any retracement. I pass on like over 95% of the dip opportunities I see in the markets because I only like to go for high quality A+ retracements. So make sure you're paying attention to these criteria and make sure you're practicing this setup before you actually use heavy risk. Let me know in the comments what you think about this strategy and whether you think it's going to be very effective for your trading plan. Make sure you leave a like on this video and make sure you subscribe to the channel for my other education. And lastly, make sure you get started with my free 10+ hour trading course. Like I said, it is genuinely better than most paid courses on the internet, and you're going to find that out, and you're going to learn more about this strategy in my free course as well. So I will see you on the next video. Thank you so much for watching.
What's going on, guys? Hope you're having a great day. Today we're going to be talking about another trading strategy and another trading setup that you guys need to add to your arsenal. And this one is going to be focused on picking reversals. It's called the exhaustion and the climactic pattern. And what this strategy is all about is, picking reversals with precision. So far, with the base breakout, with the buy setup, with the 1, 2, 3 pattern, we've learned how to play with the trend, right? If we're in a solid uptrend, we've learned how to find setups in that solid uptrend, or how to find setups in that downtrend so we can play short. But today we're going to be talking about how to go against the trend. Okay, and before I hop into the presentation, I want to give you guys a little diagram of exactly what I mean showing you guys this. So let's go to my little drawing area. Okay, let's say we have a 20-day moving average that's, let's say, trending higher just like that. Let's make this moving average this orange. And let's say we have price. Let's make this actually yellow. Let's say we have price, respecting the 20-day moving average and continuing this uptrend. Okay, so let me just draw this real quick. Very good. So right now, and we could even make this a little flatter, maybe make it more like 45 degrees. Perfect. Okay, so what we have here is a gradual uptrend. We have an uptrend that it's just grinding higher and it's gradually continuing higher. Okay, so this isn't where we're going to find a reversal. Why? Because price is near the 20-day moving average. We talked about in some of the other classes that extension is when we have distance between price and the 20-day moving average. And we're really going to be diving into this idea of extension during this strategy. But let's say all of a sudden, we talked about how the slope of the 20-day moving average matters, right? And, the higher the slope is, the more unsustainable the move is, right? So right here, let's say we have let's just call it a 45-degree angle. And let's say all of a sudden, let's make this same color, yellow. the 20-day moving average starts to, it becomes basically steeper, right? It starts to kind of curl even higher and make a kind of a higher angle. This is 45 degrees. Maybe at this point, this is more like 60 degrees, right? And we see price start getting really extended from the 20-day moving average to the point where there's even, let's say, even higher, right? And you see that there's a ton of distance between price, right? Let me make this a different color. Make this like orange. Let's say there's a lot of difference between price up here and the 20-day moving average down here. You can see this is the price, this is the distance that's representing that. So what do we do up here? Well, we don't want to play long up here, right? Why? Because number one, we're extended from the 20-day moving average. Remember, we talked about we want to take entries that's at or near the trending 20-day moving average. At this point, we're really far from the 20, right? The other thing is we had a huge move higher, and we don't want to buy at the highs. So what do? This is actually the exact point where we're going to be trying to find a short where we have extension in this sort of acceleration. So now that you guys get the general idea of what I'm talking about and how we're finding this reversal setup, let's actually go into the presentation and talk about details and specific things that we're looking for. So this is called the exhaustion play. You could also call it the climactic pattern. And this is honestly the most potent reversal setup. This is the only way to pick reversals, right? I think there's this amazing idea where traders, they just want to pick the tops, they want to pick the bottoms in stocks, right? There's just this like idea behind it where it's just like, oh, you're buying it at the absolute bottom or you're shorting it at the absolute top. And that idea is so appealing. So if you're one of those traders who is really trying to find reversals and that's just what you're inclined to do, that's just like what makes sense to you, then this strategy is going to really help you with that and help you take, your trading to the next level, especially with the strategy. So something to understand, guys, I think truthfully, this is the most difficult trading pattern. If you're a beginner, I would say stay away from this pattern until you're a little bit more experienced. And the reason it's the most difficult is because your odds of success is always greatly increased when you play with the trend. You usually want to be going with the trend, right? If the charts are saying bullish, if there's an uptrend on several time frames, right, and everything is screaming bullish, well, you should play long, right? You should go ahead and look for buying opportunities because everything is telling you that there's a lot of buying pressure. So going short in an environment where there's a lot of buying pressure, that's difficult. And a lot of times you're going to take some trades with the exhaustion or climactic pattern, and it's not always going to work out. They have a lower likelihood of success, right? Especially when you don't know the specific details that you need for the setup. So it's difficult. Just stay away from it as a beginner and start doing it when you're a little bit more experienced, I would say, but it's up to you, obviously. So like I said, you typically don't want to play against the overall trend. However, you should still be equipped with the knowledge of how to do it correctly. And the thing is, guys, since we're trying to catch tops and bottoms, this setup might take more than one try, right? Like if you're finding one of these setups, you might have to enter it more than once because you have a high likelihood of getting stopped out if it continues like in that direction. You know what I mean? And that'll make sense in a little bit here. So let's talk about the setup. So first requirement is we have, in this case, this is a climactic buy setup, right? Or exhaustion buy setup because we're going to be buying in this situation. So number one, you need a declining 20-day moving average, right? And ideally, we talked about slope. Ideally, the slope is very steep with the 20-day moving average. So declining, it's overpriced, perfect. Acceleration. So let's talk about acceleration. We kind of mentioned acceleration, and I kind of showed that idea. Oh, where did it go? I guess my drawings got deleted. No problem. So in terms of acceleration, notice here that these red bars are becoming increasingly larger. And for the climactic pattern, for this pattern, you need to have at least 5 or more red bars in a row. Actually, let's start over here before we go on to acceleration. So yeah, you need ideally 5 or more red bars in a row, and you need 5 consecutive lower highs, right? So 1, 2, 3, 4, 5. That's 5 red bars in a row, even 6 actually. And you could see we're making lower highs on each red bar. Those are requirements. And we're going to be looking for clear extension and acceleration. And the whole idea of the setup is we're trying to buy the stock or crypto when supply is about to run out. Like there's a lot of selling at this point right here. We can be confident that supply is starting to run out, and that's when we're going for the long, and that's when we're trying to buy it, because there doesn't need to be a lot of demand to bring this stock or crypto up from here. Because if there's zero supply, if there's zero people selling it down here because they already sold, then any amount of buying pressure will bring this back up. So we talked about acceleration. Notice how these red bars are becoming increasingly larger and larger. Notice that the distance between price and the 20-day moving average is becoming increasingly larger, right? Like here, there's not that much different distance. Here, there's more distance. Here, there's even more distance. And all the way down here, there's a lot of distance. That's what I mean by acceleration. The candlesticks are becoming increasingly larger. So we need to see this acceleration. It cannot just be a steady and gradual decrease. Okay, this is a really, a lot of people get this wrong, where they'll see a very steady and gradual downtrend and they'll try to find a reversal. No, you need to have this acceleration. We also talked about, extension from the 20. These are kind of connected, the acceleration, the extension. As it's accelerating, it's going to become more and more extended. And the larger the distance between price and the 20-day moving average, the more oversold the stock or crypto is. So if there's a lot of distance between price and the 20-day moving average, like in this scenario, you could think of it as this is oversold and there's probably going to be a correction higher. We also talked about volume already, or if we haven't talked about volume yet, it's going to be in the next class. And you could think we also need a large volume spike here. And the volume spike, we talked about amateur and professional volume or igniting volume. So we want to see a ton of amateur volume down here. Okay. And so hopefully those are the 3 requirements there. We have acceleration that causes, right, the acceleration, increasingly larger red bars that causes the extension from price and the 20-day moving average. We have a huge volume spike indicating a reversal. And once we have one of these entry bars that we talked about that with the buy setup. Once you get one of these entry bars, you place your entry over the entry bar and your stop loss under the lows of the move. So that's what's key. It has to be under the lows of the move. So let's talk about the importance of entry bars. We already talked about this with the buy setup. You guys should already know this. We're looking for narrow range bars, or we're looking for doji bars, or for bottoming tails. Because remember, if we get a bottoming tail right here, it suggests that that the buyers have started taking control. So an entry bar provides us a clear entry and a clear stop loss, right? Entries above the entry bar, stop loss below it. It increases our reward to risk. And we're always going to put our stop loss under the very lows of the drop. So wherever the lows is of the drop, that's where we're putting our stop loss. So if it continues lower, it'll hit our stop loss and we'll exit immediately. Let's look at the opposite. This is a climactic sell setup or an exhaustion sell setup. You could see here we have a rising 20-day moving average. You could see price. Well, number one, we need ideally 5 or more green bars in a row and 5 consecutive higher highs. You could see we have higher highs. Okay, 5 green bars in a row. We're looking for acceleration. Notice how the green bars are becoming increasingly larger and larger, causing extension from the 20-day moving average. You can see the distance here. Okay. Obviously, the larger the distance between price and the 20-day moving average, the more overbought it is. So if you see a lot of distance between, or you see a lot of extension between price and the 20, you could assume that it's a little bit overbought and a correction might take place. And of course, we have a volume spike at the highs indicating a reversal here. Okay, it's the same exact thing, except obviously the opposite. Our entry in this case would be shorting under the entry bar, stop losses over the absolute highs of the move. Okay, so whenever you have a huge rally like this and you get narrow range bars or topping tails or even bottoming tails, doji bars, small bars like this, those are entry bars. They enhance the shorting opportunity. It gives you a clear entry and stop loss. Obviously better reward to risk, and we're always going to put the stop loss over the highs of the rally. Okay, hopefully this makes sense for you guys. Now let's look at some examples and let's kind of check off everything we need to know here. So number one, do we have a rising 20-day moving average? Yes. Is the 20-day moving average, is the slope increasing? Well, you can see it's curling. You can see the slope is slowly increasing to the point where here you could see that this is much greater than 45 degrees. This move is probably, based off this moving average, the move is probably not sustainable, right? Now, do we have, acceleration? Okay, well, first we move up, then we kind of base, then we start to grind higher until eventually we start to see some clear acceleration, right? The bars are becoming bigger and bigger and bigger. We kind of had 2 little breaks with these bars, but right after that we get one huge bar, another huge bar. And with this topping tail, this was being bought before. The highs was up here, right? So you could see clear acceleration. The bars are becoming increasingly larger. There's clear acceleration, right? We also have extension. I mean, look, at this point, we're kind of close to the 20. We're close to the 20. We're close to the 20 until boom, huge rally. At some point, we were all the way up here. Look at the distance between price and the 20-day moving average. Clear extension. And we also, at the top right here, right, huge spike in amateur buying volume up here. Huge spike in volume, suggesting a reversal. Where would our entry be in this case? Under this candlestick, that would be entry, and then stop loss up here. Okay? We also get a topping tail, by the way, which shows that the sellers have taken control. Let's look at another example here. We started from the 20, huge rally higher, right? This might have even gotten halted because we have a gap here. Oh yeah, by the way, guys, for this setup, the target is always the 20-day moving average. So this would be this is target. The bars are becoming increasingly larger. This is not a perfect setup. I kind of want to show you guys, not the best setup, just to show you guys that, you don't need a perfect setup like this to play this pattern. Entries right here, stop losses over the highs. We have the extension as well, so nice. This is a really, really beautiful setup here. So let's take a look at it. You could see move starts from the declining 20-day moving average. You could see the 20-day moving average is starting to curl lower and lower and lower and lower, right? And we drop, we kind of base here, we drop again, little retracement. We start to drop, base, and all of a sudden you could see the acceleration right here, really starting where we really accelerated, right? You could see the bars are becoming larger and larger. We don't get the volume spike. So in this case, we didn't get the volume spike. That doesn't mean that this is not a good pattern just because we don't get the volume spike. Everything else, the acceleration, the extension from the 20-day moving average, it was telling us that it was climactic and it was exhausted. And the reason it's called exhausted, right? The reason I say exhausted is because in this case, the sellers have been exhausted. In this case, the buyers have been exhausted up here. There's no more demand up here, causing the sellers to bring it down. Here, there's no more supply, causing the buyers to bring it all the way back up to the 20-day moving average as target. Entries over the highs, stop loss under the lows. Let's look at another example. So guys, what if you guys are looking at this, you should immediately be able to identify the setup that this is stemming from. This is a breakout, right? We have a rising 20-day moving average that's curling under price. We base into the moving average. We start to break out. We start to get the acceleration, right? Huge volume spike up here, showing amateur buy volume and then professional igniting volume, right? Because that's when we started to move lower. We have distance between price and the 20-day moving average, right? There's clear acceleration, really nice shorting opportunity. These are incorrect. This should say stop loss. This should say entry, okay? And that's our target. Same thing here, guys. Clear, we have a base breakdown, curling 20-day moving average pointing lower. Really nice breakdown here. Huge drop, right? We see clear acceleration. There's clear extension from the 20 in price. We get a bottoming tail suggesting the buyers have taken control. The 20-day moving average is our first target. Huge volume spikes up here showing a reversal. This is a really, really nice setup here. We play it long. Entry here, stop loss here. Let's look at, I think you guys have seen this before in our other classes. Several setups here. We have a breakdown, right? Under this base breakdown with a 1, 2, 3, 4 pattern. 1, 2, 3, 4 setup. We drop, clear acceleration, clear extension, huge volume spike indicating a reversal. First target is a 20-day moving average, and this actually formed a sell setup. Okay, this formed a sell setup, and then we ended up going lower. Okay, same thing here. What happened here is we have a rising 20-day moving average. We the acceleration wasn't very clear, but it is sort of climactic because the 20-day moving average started, the slope was pretty huge. Rallied. We got a double top, making a higher low right here. And boom, nice setup here as well. Same thing here. We dropped into the 200-day moving average in this case on large volume. Okay. Reversal setup. Boom. So guys, let's talk about multiple time frames for the setup. Using multiple time frames is key. And why is it key? Well, if you don't have a clear entry on the time frame you're looking at, you should shift to a lower time frame. And you can even go down to the 1 or 2 minute charts for a potential entry. Okay? So let's kind of talk about this. Let's go to an example. Let's look at this example. You might be saying to yourself, "Hey, I understand this setup, but one thing I don't understand is we talked about entry bars, right? How we want entry bars, but on a lot of these setups, like for example, this is not a great entry bar. This is a huge topping tail, right? If our entry is over here and our stop loss is over all the way up here, that's a huge stop size." And you might be thinking, there's no entry bar here. Like there's a topping tail, but this is not a small bar like this. So in those scenarios, let's say we're looking at the 15-minute chart here, right? This is the 15-minute chart. If you see something like this on the 15-minute chart, and you're saying to yourself, I want to play this, but I need a better entry bar. What you would do is you would drop to the 5-minute time frame, or the 1-minute time frame, or the 2-minute time frame, and see if you can spot a potential entry bar. And then, play the setup off the lower time frames, wherever you could find an entry bar. However, always place your stop loss over the absolute highs or absolute lows of the move. Hopefully that makes sense though, right? So let's take a look at this example. You can see we don't have an entry bar, right? Our entry's here, stop loss is here, but in this case, go to a smaller time frame and see if you could spot an entry bar off the lower time frame, okay? And if you can't, then you're just gonna, and you really still like the setup despite it not having an entry bar, then you're gonna have to just have a larger stop loss than you want to. You could even just, sometimes when they move really fast, and I can't find an entry bar, I'll just short it right here, right? And I'll just place my stop loss above the highs, right? Like you could even do that. And it's technically not a textbook, but let's say you're over here. You could just, and you think this is the reversals coming, just buy it. Calculate your risk, make sure you're not risking too much, buy it wherever, and just place your stop loss underneath the lows. And if it hits the lows and continues lower, well, you're going to be already out of the position. Okay, so you could do that as well. Same thing here. We have a large entry bar. Go to the smaller time frames and try to find a better entry bar, a better entry into the trade. Okay, so hopefully that makes sense. And looking at the climactic and exhaustion pattern, something to note here: if the daily chart and the intraday charts are both climactic, meaning let's say on the daily chart, you also see that there's clear extension, there's clear acceleration, right? And on the lower time frames, right? Like for example, on the 15-minute chart or on the hourly chart, you're also seeing that that there's acceleration, we have extension, right? And if both the daily and the intraday time frames are both exhausted and climactic, that makes a much more potent setup, right? Because all of the time frames are climactic, all of them are exhausted, and that setup has a much higher likelihood of working out. Okay, hopefully that makes sense. Hopefully you guys understand what I mean about the multiple time frames. I'm trying to think if there's anything else I want to mention with this setup. So yeah, guys, this is a difficult setup, but it's really not that hard if you think about it. There's not that many, requirements we need. We need acceleration. That's pretty easy. Extension, pretty easy as well. Just distance. And just make sure you're following all of these qualities. Make sure you're looking at several time frames. Don't make the mistake of just finding a gradual uptrend and just shorting that. That's not correct. You need that extension. You need that acceleration. You need, hopefully, ideally, you also need the volume spike as well. This could work on the smaller time frames for scalps as well, for 1 or 2 minute time frames if you're scalping, or 5 minute. So this works for scalping, swing trading, whatever, doesn't matter. I will say one thing, guys, before I forget. And there was this example. So I see this mistake a lot. Let's say you have a climactic move, that we have that acceleration, we have that extension, right? Usually the first sell setups after that move, right, we drop. Remember, a sell setup is when we retrace back to the 20-day moving average, right? And then we short it again. Usually, whenever you have a sell setup, after a huge drop like this, they usually never work. Okay, so let me kind of paint that out on here real quick. Let's say we have a huge drop, climactic drop, and then we retrace. This, shorting this position right here, right, doesn't work. Don't do this. It works right here, but this is an anomaly. It usually never works, okay? So if we have that climactic drop, right, we have that acceleration, that extension, the volume spike that we talked about. It's a clear climactic pattern. And you buy it, let's say down here, right? Right, remember our first target is the 20-day moving average. So let's change this color, let's make this white. Let's say, it got to the 20-day moving average. I know it's kind of sloppy, but that's the 20, right? And you took profits off this long. You bought it here and you took profits there. Don't short it, right? Because this rarely ends up continuing lower. This usually fails. And let me show you what that looks like going long. Let's say you have a climactic long, right? Where a huge increase. We have literally picture this, right? We have that here, okay? And you decide to short it up here, right? You're shorting it up here, and it drops in your favor. right? And remember, the target is what? The 20-day. The target is the 20-day moving average. So let's say that's white. And you go, remember that that's where our target is too, the 20-day moving average. You took profits right there. This is technically a buy setup, right? Because we're retracing to the rising 20-day moving average. This doesn't work. This buy setup after a climactic move does not work, right? You can see it here. We had a climactic move higher. We dropped. We retraced, right? Technically to the 20-day moving average. The first buy setup after a climactic rally usually doesn't work. You could see tried to move up and it failed, okay? Let's see if we could find another. So this is an anomaly, it working here. Let me see if I can find another example. Like here, right? This is technically a sell setup, right? We buy it down here, right? Climactic, retrace to the 20-day moving average. This is a sell setup. You could see the sell setup did not work. We ended up continuing higher. Same thing right here. A lot of people are going to go ahead and buy this and be like, okay, we have a rally. We have a pullback into the rising 20. This is a buy setup. But remember, buy setups after climactic moves like this, where we have that extension, they never work. And this ended up failing. Okay, same thing here. Technically, over right here is a buy setup. These don't work. So in summary, after a climactic rally, where after exhaustion or climactic rally or a climactic or exhausted drop, and we get that retracement to the 20-day moving average here or the 20-day moving average here, this sell setup doesn't work. And this buy setup never works. So never take buy or sell setups after exhausted or climactic patterns. Okay, that's basically the last point I wanted to make. Now you guys should be able to also play reversal patterns and understand what to look for specifically. Remember, multiple time frames is key. And that's basically all I wanted to talk about, guys. So thanks. See you in the next class.
When my father first taught me how to trade 5 years ago, the very first lesson that he taught me was risk management. And I didn't realize it then, but it ended up becoming the single most important lesson of my entire trading career. Most traders on YouTube hype up indicators or fancy strategies or some new secret setup, but they don't talk about the one thing that actually separates an amateur losing trader from a true professional, and that is risk management and the art of limiting your losses. In this video, I'm going to give you the ultimate guide on controlling your risk. I'm going to teach you how to never lose more money on a trade that you intend on. I'm going to teach you how to size your positions correctly. I'm going to teach you how to calculate reward to risk on the fly. I'm going to give you rules that you can implement into your trading plan starting tomorrow. And finally, I'm going to give you the confidence to walk into the markets every single day without fearing that you're going to blow up your account. I don't say this lightly. This may be the single most important video that you will watch for your trading career. So make sure you pay attention and make sure you watch until the end of this video. Let's not waste any time. Let's hop right into it. Moving forward, I don't want you to think of yourself as a trader. I want you to think of yourself as a risk manager, because that's exactly what you are. And your first priority as a risk manager is to protect the capital that's in your account, to protect your hard-earned money. The second priority is to make money using that capital, but capital preservation is always number one. And if you really think about it, the only thing that you really can control in a trade is your risk. You can't control whether the trade hits your stop loss. You can't control when the trade triggers your entry or when it's going to hit target. That is out of your control. You really don't know what that setup is going to do. You don't know the outcome before you take the trade, but you can control your risk. You can control your downside. And that is a massive part about becoming a profitable trader. And the funniest thing is, risk is the only thing that you can control. However, most traders don't control their risk. Most traders fail because they ultimately risk too much and they end up losing all of their money, and they're not disciplined enough with controlling and managing their risk. And if that's you, hopefully this video will change that. And you got to keep in mind that as a trader, I'm not paid based on whether I'm right or based on whether I'm wrong. There is no right or wrong in trading. There's either you're making money or you're losing money. And my goal is to maximize my profits on my winning trades. When I am right, I want to maximize my results. However, when I'm wrong, I want to limit my losses, because being wrong in trading is inevitable. I am wrong every single day. I have losing trades every single day. However, what makes me such a good trader is that when I'm wrong, it never leads to a devastating loss. I am so good at limiting my losses on my losing trades, and I'm good at being wrong. I'm a really good loser. That's what makes me a profitable trader. And if you actually notice, most of the best traders out there, they are really good losers because they focus on capital preservation and managing their risk. I don't care about being right or wrong. I care about limiting losses when I'm wrong and maximizing my profits when I'm right. And ultimately, as a trader, your goal is to look at a setup and ask yourself, okay, if I'm risking X amount on this trade, can I make at least double or triple my risk? If I'm risking $100 on this setup, can I potentially make $200 or $300 or $400 if this trade hits my target? And you need to have that reward to risk sort of mindset. And you want to be focusing on taking asymmetrical trades with big upside and, of course, limited downside. And like I said, it's okay to be wrong. You don't need to be perfect. There is no perfection in trading. Even if you have a 50% win rate, you could still make money in the markets. For me, I'm not going to lie to you and say that I have an 80% win rate. You know, maybe if there's a day where I'm just feeling it that day, we're getting a lot of really good setups, I'm trading really well, I'll have a 70 to 80% win rate. Sure, however, that's not my average. There are days where I have a 30% win rate. There are days where I have a 20% win rate. However, I'm still able to make money on those days because I focus on limiting my losses, where I can have 4 losing trades and 1 winner, and I'll still make money on the day. I can have 5 losing trades and 2 winners, I'll still make money. There's been days where I had 10 losing tickers, right? I'm a scalper, I'm a very active trader, so sometimes if it's a really busy day, I'm taking quite a bit of trades. I'll have 10 losing tickers, tickers meaning just different stocks that I trade, 3 winners, and I'll make money that day. Why? Again, I focus on maximizing my profits on my winning trades and limiting my losses on my losers. So you don't need a high win rate to make money. You just need to learn how to cut your losers quickly and how to limit your losses on your losing trades and how to be disciplined with risk management. So let's go ahead and talk about that. The first step towards becoming an elite risk manager is ultimately mindset, because the mechanics of becoming good at managing your risk aren't that difficult. Like, I'm about to teach you how to calculate reward to risk. I'm going to teach you how to size your positions. That isn't that hard. The hard part is staying disciplined. The hard part is holding yourself accountable, because when most traders look at a setup, they're not asking themselves, how much am I going to lose if this setup fails? What they do is they think about the upside first. They think about how much money they're going to make, and that gets them excited, and they end up making emotional and impulsive decisions that lead to them losing money. Your first thought when you're looking at a potential trade should be, how much am I going to lose if this setup hits my stop loss and fails? You always have to think about the downside first. You have to think about the negatives, right? And I hate to sound pessimistic, but as a trader, you have to be somewhat pessimistic when you look at setups. You can't just be overly excited for every trade and you're ready to take every setup. No, you have to be a little bit pessimistic, almost a little bit negative, because you want to find trades that are excellent, that are high quality, and that can give you a high reward to risk. When I look at a setup, I don't think about the positives first. I think about the negatives. What is wrong with this setup? Why shouldn't I take this setup? And that allows me to avoid a lot of losing trades. It's really easy to get excited over every single trade and think about all the money that you're going to make, but that is ultimately a trap. That's a trap that's going to lead to you losing money, to you making impulsive decisions and taking lower quality trades, or taking trades that seem to have huge upside, but of course they're also quite risky, and it can lead to huge downside. So whenever you're looking at a setup, you have to ask yourself, how much am I going to lose if it fails? And you just got to stay disciplined with the risk, okay? You have to be conscientious. You have to be sizing your positions correctly for every single trade that you take. I'm about to teach you that. And you just have to have this risk manager mindset. You have to be conservative. You have to constantly think about what's your downside. The next step in becoming an elite level risk manager is figuring out your risk. To manage risk, you have to know what your risk is in the first place. You have to know what your maximum loss is per trade. And if you're a beginner trader, you're just starting out, I would start really small. In fact, I would paper trade. For a couple days to a couple weeks, I would get accustomed to your platform. I would try out different strategies just to get comfortable with actually executing your orders. And once you're feeling comfortable, I would transition into real money. However, I would start really, really small relative to your own risk tolerance. For some traders, $1 risk is small enough. For other traders, they have higher risk tolerance. They want to start off with $10 risk or $20 risk or $50 risk, whatever it is. Pick an amount that is extremely small relative to your risk tolerance so you could experiment with your trades. You could figure out what trading management style works for you, and this will allow you to make mistakes and learn from those mistakes without actually damaging your account, without, losing a ton of money. So you want to start really small, experiment, see what sticks in your trading, and through journaling and through the process of improving your plan, you're going to see improvement and you're going to see things start to click. And once you're seeing some consistency, you could start to raise your risk, but become a lot more selective with your trades. And you want to pick a risk amount that isn't so low where you literally won't care. For example, if I risk $10 on a trade, that is such a small number for me that I don't even care if I lose a trade or win the trade. It won't even matter because it's such a small amount. For me, $500 risk is a really good sweet spot because you also don't want your risk to be so high where it's going to impact you emotionally, where if you lose that amount, it's going to hurt you and it's going to, impact your confidence. You don't want that to happen. So you have to find that sweet spot where it's not so low where you won't really care about it, but it's not so high where it's actually going to impact you emotionally. For me, that's usually around $500 per trade. I do raise my risk at times on certain high conviction setups where I'll risk like $600 or $700 on a trade, but that's the sweet spot for me. And this could be a dollar amount or it could be a percentage of your account. I actually recommend choosing a dollar amount, and I'm going to explain why in a second. Next, when you are looking at your results, I want you to think in R's. I don't want you to think about how much money you're making or how much money you're losing. I want you to think in R's. An R is a risk unit. A risk unit represents your maximum risk. For example, if I'm risking $500 per trade, that is 1 R for me. So if I say I lost 1 R today, that means I lost $500. If I say I made 4 R's today, that means I made $2,000. And the reason I want you to think in R's is because, for example, let's say you hear someone that made $10,000. That sounds like, wow, that's a lot of money. Well, 10K, I want to make 10,000, right? But it means nothing unless you know how much they risked. If they were risking $30,000 to make $10,000, well, that's not that impressive at all. In fact, that's horrible reward to risk. However, if they were risking, let's say, $2,000 to make $10,000, well, that's 5 R's. That's a really, really good trade, right? So it's all relative, to how much you are risking. And that's why I recommend thinking in R's versus dollar amounts. You hear a lot of people online that will make $100,000 trading and they don't really tell you how much they're risking. So you don't really have a good perception of what their actual reward to risk is or how well they performed on those trades, right? So just think in R's, and this will allow you to gain a lot of confidence in the beginning of your trading journey. Because if you're starting out and let's say you're risking $5 per trade and you have a day where you made $20. $20 isn't a ton of money. That might not get you that excited. However, if you're thinking to yourself, hey, I made 4 R's today, right? 4 R's. I was risking 1 R per trade. I made 4. That's a pretty good result. And then that can give you insights on what your expectations should be when you actually start raising your risk, right? So if you're making 4 R's a day risking $5 a trade, well, if you raise your risk to $50 a day, you could say, okay, well, if I'm making 4 Rs per day, now on $50 risk, well, I'm making a lot more money, etc. And that, of course, as the risk scales, right? If you're making the same amount of Rs per day or per week, the amount of money you make will also scale, right? So this is what I want you to do. Don't think about dollar amounts, think in Rs. Next, position sizing is everything. It blows my mind the amount of traders that share size their positions completely randomly. And then they wonder why they're losing way more money than they intended on losing. When you enter into a trade, you should know exactly how much you're going to lose if that trade hits your stop loss. And keep in mind, we already figured out your maximum risk. We already figured out your R, your risk unit. That is your maximum loss per trade. So when you enter into a trade, you have to size your position accordingly for that risk. So if the trade hits your stop loss, you're only going to lose your risk unit. Keep in mind that a stop loss tells you where you're wrong on the charts. Position sizing will determine how much you're going to lose when you are wrong. And this is a really simple formula. And if you could apply this formula for every trade that you take, you will automatically manage your risk way more effectively, because you're not going to have trades where you lose way more money than you intended on. And this is really the way to never lose more than your risk unit. And of course, freak accidents do happen. Sometimes trades go crazy and they don't trigger your stop loss. However, that doesn't matter. You still have to size your positions correctly for every trade that you take. So the formula is share size equals your risk unit, right, divided by entry minus stop loss. And keep in mind, entry minus stop loss, this is in parentheses. So you have to do this subtraction first, and then you do the division, okay? And let's go over an example, but this is actually very, very simple. So let's say the entry is at $7. Your stop loss is at $6.90. So this is what you determine before you take the trade. You're looking at the setup and you're saying, okay, my entry for this setup would be $7 and my stop loss would be $6.90. Great. Let's say your risk unit, your maximum risk is $100. From there, you would apply this formula, right? So maybe pause the video, do the calculation, and then you could actually compare it with the answer. And we'll talk about spread in just a second here. But if you go ahead and do that, it's very simple. $100, which is your risk, right? So you put 100 in the risk, divided by entry price, $7, minus stop loss price, $6.90. So $7 minus $6.90, you do this first, equals 10 cents. Great. $100 divided by 10 cents, if you whip out your calculator and do the calculation, is 1,000 shares. What this means is if you purchase 1,000 shares at $7 and it hits your stop loss at $6.90, you will only lose $100. And of course, your share size is going to change based off your entry price, based off your stop loss price, and based on what risk you have chosen. And if you don't know what spread is yet, you don't really have to worry about that yet. However, if you do know what spread is, maybe you're an experienced trader, or you have a solid foundation, what you could do is add spread to the formula, where let's say this is your entry, this is your stop loss, and let's say that stock that you're trading has 3 cent spread. What you could do is add 3 cents to this number. So it'd be $100 divided by 13 cents. Or let's say the stock has 5 cent spread. You would just add that. So $100 divided by 15 cents. So you can adjust your formula also based off the spread, because spread could lead to slippage, which could actually increase your risk. So you could add spread to the formula. Next, let's go ahead and talk about really fast calculating reward versus risk. So in order to calculate reward versus risk, this actually has nothing to do with the share sizing formula. What you would do is you look at your entry price, you look at your stop loss price, and you look at your target price, and you ask yourself, is there enough upside for the risk that I am taking on this trade? So what is the size of our stop? The size of our stop is actually just our entry price minus stop loss price. That's just the difference between our entry price and our stop, right? So $7 minus $6.90 equals 10 cents. We just calculated that. However, what's the upside here? Well, if our target is $7.30 and our entry is at $7, that means there's 30 cents of upside, right? Because 7.30, that's the target, minus our entry price is at $7, that's 30 cents. So I'm taking on 10-cent risk for this trade for 30-cent upside. Is that worth it? Well, I'm risking 10 cents per share to make 30 cents per share. That is 3-to-1 R to R, and I would say that is worth it, right? I want my trades to be at least 2-to-1 reward to risk. And this is all you do when it comes to calculating reward versus risk. You look at the entry price, you look at the stop loss price, and you look at the target price. You subtract your entry minus your stop, and that is the size of your stop loss, right? The difference between your entry and your stop. And then from there, you also subtract your target price minus your entry price, right? And that is your upside, okay? And maybe thinking of it as like doing subtractions is makes it a little bit more confusing. I think it's really intuitive, right? I'm risking 10 cents to make 30 cents. That is 100% worth it in my book, and that's exactly how I calculate reward to risk. Now, if you want to size your positions based off your account size, you could do that as well. So let's say you have a $25,000 account and you want to risk 1% of your account. What you would do is just figure out what 1% of $25,000 is. That is $250. And then you would use this dollar risk for the formula. And that's it. That's all you really have to do. So based off whatever your account size is, you figure out how much of your account do you want to risk percentage-wise. You figure out what the dollar amount of that is, and you would just input the same numbers into the formula. So share size equals $250. That's 1% of 25,000. You input the entry, $7, input the stop loss, $6.90. So it'd be $250 divided by 10 cents equals 2,500 shares. So it's essentially the same exact process. Next, I want to talk about a very important concept, and that is the tighter your stop loss is, the better the reward to risk is going to be. So for example, let's go ahead and compare these two situations. Right here, we already calculated the share size for these parameters. Entry is $7, stop loss is at $6.90, risk is $100. Great, we calculated for $100 risk, you can get 1,000 shares. Fantastic. However, if you had a tighter stop loss, you would end up getting more shares for the same risk. And that would provide you a better reward to risk for that trade. So let me go ahead and actually demonstrate that. So let's say the entry is the same. The entry is at $7. However, let's say our stop loss is at $6.95 instead of $6.90. So there's a tighter stop loss. The difference between the entry and the stop is smaller, right? Here, it was a 10-cent difference. However, here, it's a 5-cent difference. And let's talk about the effects of that. So same risk. Let's say our risk is $100. It would be $100 divided by $7 minus $6.95. So it would be $100 divided by 5 cents. That would allow you to get 2,000 shares for this position. Now, a lot of people might think that, oh, because you have greater share size, you're taking on greater risk. However, that is not the case. The risk remains the same. The risk is still $100. However, you can get twice the amount of shares because it's a tighter stop, because the difference between your entry and stop loss is smaller. And this is really important because you want to find trades that have a relatively tight stop, because you're going to be able to buy more shares or short more shares with the same risk, which is going to increase your reward to risk. You're going to end up making more money if the trade hits target with the same risk, right? So I'll say it one more time just in case it's still confusing. It's the same exact parameters, same risk, same entry. The only difference is this setup has a tighter stop. This setup, the stop loss is at $6.95. The stop loss here is at $6.90. As a result, the size of your stop is 10 cents here. The size of your stop is 5 cents here, which allows you to get 2,000 shares with a $100 risk for this setup versus only 1,000 shares for a $100 risk on this one. So, right off the bat, it's very clear that this setup has a way better potential reward to risk. So you want to find setups that have a relatively tight stop. And then from there, you could look at the target. In this case, let's say our target's at 730, right? And there's a 5-cent stop. That means I'm risking 5 cents to potentially make 30 cents. That means I can make potentially 6 Rs. That's a way better R to R versus I'm risking 10 cents to make 30 cents. Does that make sense? So you want to find setups that have a really solid R to R, that have a nice tight stop. However, keep in mind, I want to also give you the potential negative of it. If it's a really tight stop, a lot of times some setups might shake you out, where let's say you're trading a breakout. Let me zoom in here. Let's say you are trading a breakout and it's a really tight stop, entry over the base, stop loss under the base. What might happen is it might trigger, drop on you, trigger your stop ever so slightly just because you have such a tight stop. The difference between your entry and stop loss is really small. It might briefly hit your stop and then continue higher anyway. So you might have a higher likelihood of getting shaken out where, you know, the trade stops you out and then actually still heads to your target and goes in your direction. So now that you understand how to size your positions correctly, you know how to calculate reward versus risk, and you understand the dynamics between having a tight stop versus a loose stop, let's go ahead and discuss some strategies where you can limit your losses on your losing trades. And I figured out very early on in my trading career that the easiest way to become more profitable and to make more money is to simply limit your losses on your losing trades, where instead of losing 1 full R, which is your predetermined max risk per trade, what if I could lose half an R on my losing trades, or a quarter of an R on my losing trades, or maybe I can even break even on a trade that would have been a loser. And instead of implementing new strategies and learning new indicators to try to make more money, I figured out that if I could just limit my losses on my losers, I'll become more profitable in the long run. And there's a few strategies that you could use to do this. So there's this term called trailing that I'm going to refer to frequently in this section. And whenever I say trailing, that just means I'm adjusting my stop loss. And a lot of the times I'm adjusting my stop loss to break even. So let me go ahead and show an example of that. So let's say I am taking a potential breakout. So my entry would be over the base, my stop loss is under the base. So let's say the trade triggers, I get filled right here, and now I'm in the trade, and it starts to move up. And let's say my target is all the way up here. This is target 1. This is where I would make 2 Rs on the trade, okay? Now let's say the trade triggers, it starts to move up, and then all of a sudden it kind of pulls back and starts to go sideways, right? My stop loss is right here. So for me to lose 1 full R, the trade would actually have to pull back all the way to my stop, and I would lose a full R right here. Well, a lot of the times, if I could see that the trade isn't really following through, it's not really continuing in my favor, and there's not a lot of momentum on this setup, a lot of the times, instead of waiting for this trade to go all the way down to my stop loss to lose 1 R, I could raise my stop loss to break even, right? And in that case, if the trade does hit my new stop and if the trade fails, I am going to break even on the setup. And what would have been a losing trade actually becomes a break even trade. And in this case, I'm actually saving 1 R. And that will, as a result, help me make more money on the day because I'm saving money on what would have been a loser. So a lot of the times you could actually trail your position to break even. Another situation is what you can do is, let's say you have a setup, you have a breakout, and you get the breakout right here. Here's your stop loss. And let's say the trade is approaching 1 R, right? This is your 1 R right here. And you're in profit and you're feeling pretty good. You can create a rule for yourself where you say, hey, if the trade hits 1 R in profit, I automatically raise my stop loss to break even. And that could be a structured rule within your system. So automatically, as soon as you hit 1 R, you raise your stop to break even. And in that case, you know exactly how you're going to manage the position before you're even in the trade. Perhaps maybe from there, let's say the trade continues and it hits 2 Rs in profit. What you can do to maximize profits and also kind of limit your downside is at 2 Rs, you could say, okay, once this trade hits 2 Rs, I'm going to take 50% of my profits. And from there, I'm going to raise my stop loss on the back half of my position to 1 R in profit, right? So you raise your stop loss now to this point where you're guaranteed to make 1 R on the other 50% of your position. Okay, so I'll repeat that one more time. The breakout triggers right here. Your stop is here. The trade goes to 2 Rs. You take 50% of your profits because maybe that's a part of your trading plan. And then you can move your stop loss to this 1 R profit area. In that case, you're going to make 2 Rs on 50% of your trade, and you're going to make 1 R on the other 50% of your trade. So this is also an option. And you can experiment with different management strategies to ensure that you maximize your profits and also protect your downside. This is a strategy that I use all the time, especially when I'm scalping with big size. And I love to scalp. That's like my bread and butter strategy. So sometimes I will take a high conviction scalp. It'll start to move in my direction. I have size in the trade, and what I will do is immediately move my stop loss to break even. So from there, it's either I'm going to make money on the setup, or worst case scenario, I'm going to break even. So in some sense, it's almost like a free trade. However, let me also talk about the flip side and what you need to consider when it comes to raising your stop loss aggressively to break even. So let's say we have the same situation. We have a breakout setup, entry over the base, stop loss under the base. It triggers your setup right here. It starts to move in your favor. And from here, let's say it starts to pull back. And from here, maybe you're losing a little bit of confidence and you tell yourself that, hey, I'm going to go ahead and aggressively raise my stop loss to break even. And sometimes what will happen is the trade will come in, it will go down, it will hit your stop loss right here, and then reverse back and make new highs. And you might be looking at the setup and you're thinking to yourself, if I didn't move my stop loss so aggressively, and if I just stuck with the original stop loss, I would have actually participated in this upside move. And because I raised my stop loss too soon to break even, I ended up getting stopped out and I missed out on profits. So you need to balance the two. You need to have a balance between when you're going to stick with your original stop loss versus you're going to raise your stop aggressively to break even or to another point. And the only way to figure out this balance is to take a lot of trades and journal your results, journal your management, journal, hey, out of 50 trades, if I moved my stop loss to break even, what would have been the result on those trades? Would I have made more money, or would have I maybe missed out on a lot of profits? So this is something that's going to really vary from trader to trader, because every trader is going to gravitate towards different setups, different styles of management. So this is just something that you should consider, and maybe you can implement in your trading. You could back test it and see exactly what management style works for you. Let's talk about another management strategy that you could use to limit your losses on your losing trades. What you could do is trail to a major pivot. So let's talk about the same setup. You have a potential breakout, entries over the base, stop losses under the base, and you get triggered in right here. And let's say the trade starts to move in your favor. It's approaching 1 R, let's say. However, it didn't quite get there, and it starts to pull back. It bases for a little bit, right? And then it starts to pivot higher. What you can do is raise your stop loss to the next major pivot. What is a pivot? That's just an area where prices go down and then they pivot higher. So this is a pivot where prices go down and then up. And we could use pivots as locations for our stop loss. So this is your original stop loss. What you could do is raise your stop loss to this pivot point right here. So from here, if the trade, let's say, starts to move, but let's say hypothetically it starts to reverse, right? You can get out right here. And in fact, you would still be slightly up on the position because this stop loss is still higher than your entry point. So this is what I like to do, especially if you have a really established uptrend. Like let's say you have a really nice trend higher, and let's say you got in right here. What you could do is it moves up, pulls back, starts to move up again. You could raise your stop loss to right here. Then you could raise your stop loss again to right here. Then you could raise your stop loss again to right here. And you would only get stopped out if this uptrend starts to break. So if you find a stock or a crypto that's trending really nicely and you want to capitalize on the entire trend, this is what you could do. You could raise your stop loss to the next major pivot. Let's go ahead and go over the 10 commandments of risk management so you can implement every single one of these rules I'm going to go over into your trading plan. And like I said before, risk management is overall pretty simple. It's not very difficult. What is difficult is being disciplined. It's difficult to hold yourself accountable and make sure you don't succumb to your emotions and to your impulses. So let's go ahead and go over these rules. And a lot of these rules are going to be pretty obvious. Number one, only risk what you're mentally and emotionally okay with losing, and you should only be risking 1 R per trade. We already talked about that. You have to know exactly how much you're going to lose before you take the trade. And you should only be risking an amount that you're mentally okay with losing. If you're over risking, that's going to impact the quality of your decisions. It's going to impact your mindset. So you want to pick a risk that isn't so low where you're not really going to care if it's a winning trade or a losing trade, but you also don't want your risks to be so high where it's going to impact your decisions. You have to pick that sweet spot like we discussed earlier. Number two, you need to have a daily maximum loss limit. And my recommendation is to make it 3 or 4 Rs. So if you're risking $50 per trade and you lose $200 on the day, you have to shut down your computer, close your trading platform, and take off for the day. You need a daily max loss limit, and this will allow you to never have like a one horrible day that will just blow up your entire account, and you have to stay disciplined. In fact, there are some platforms where you can auto program this, where as soon as you lose 3 or 4 Rs, it will automatically log you out of the platform. But if it doesn't have that functionality on your platform, you have to stay disciplined and stop trading after you lost 3 or 4 Rs or whatever your daily max loss limit is. Number 3, always respect stop losses. This is obvious. The reason the stop loss is there is for you to know exactly where you should exit if the trade doesn't work. So always respect your stop losses. Let's go over the next set of rules. Number 4, never add to a losing position. I know what's going through your mind. You're in a loser. You want to add to the trade to average down your position. So if the trade bounces, you can quickly break even, or you may even be in profit. However, when you do this, you're actually increasing your risk on what is a losing trade. Why would you do that? Why would you add to a loser? I understand maybe adding to a winning trade, but why would you ever add to a losing trade? Never, ever do this, okay? Never try to average down your position when it comes to trading or investing. Number 5, keep your sizing relatively consistent, and this will actually become discretionary over time as you gain experience. So what I mean by that is, if your R, let's say, is $100, you want your risk to be $100 for every single trade that you take. However, once you start to gain experience and you'll start to maybe size a bit more on your high conviction plays, what you can do is develop a range for your risk unit. Like for me, my range for my R is between $300 for my lower conviction plays all the way up to $700 for my high conviction plays. And I only do this because I'm a very experienced trader. I know how to identify a really high quality setup that's A+ versus a setup that's decent, but maybe it's not quite high conviction. So for me, my R is within a range and my risk has become a lot more discretionary. If you're a beginner trader, I recommend just keeping your risk consistent at 1 R, let's say it's $100, and you keep your risk $100 for every single trade that you take. But as you gain experience, you could actually size up a little bit more on your high conviction plays and then lower your size on the lower conviction plays. Number 6, when in doubt, lower your risk. Whenever you feel emotional, whenever you lose confidence, whenever you feel like there's something not clicking in your trading, lower your risk. Most traders actually increase their risk. And then they take another trade that ends up being a loser, and then they end up ruining their entire day or even blowing up their account. You don't want to do that. When there is something going wrong within your trading, you need to lower your risk, figure out what's going wrong, fix it, reestablish consistency, and that's when you could re-raise your risk back to your normal R, okay? And I would never scale your risk either without establishing consistency. For example, if you're risking $100 per trade, you want to be making 2 to 3 Rs on average per day for at least 2 weeks to 1 month before you raise your risk to, let's say, $130 or $150. You want to pick a risk, establish consistency, and then raise your risk by 20 to 30%. And once you have your new risk, establish consistency, and after that, you could re-raise it again, 20 to 30%. And that's how you could scale your risk from, let's say, $100 all the way to $500, okay? Number 7, if you have 2 or 3 losing days in a row, lower your risk unit, lower your risk. So if you have 2 losing days and your risk is $100, lower your risk back to 50 or 40 or 30 so you can once again regain your confidence, reestablish consistency, and once you're profitable again for 2 to 3 days in a row or a week, that's when you could re-raise your risk back to $100. Number 8, if you're up 2 Rs on a trade, you have to secure at least 1 R for that position. So if you're risking $100 and you're up $200 on a winning trade, you have to walk away from that trade with at least $100 in profit. And this rule will help you secure profits on every single one of your winning trades. I've talked to a lot of traders that they're in a winning trade and then all of a sudden they forget to take profits, or they choose to not take profits because they're going for a home run setup, and then they end up losing on that trade, or they end up breaking even on a trade that was up 2 Rs. You don't want that to happen to you. So this rule will help you achieve that. Number 9, always protect 50 to 70% of the profits you make per day. If I'm up $1,000 on the day, I must leave that day with at least $500 to $700. And this is a rule for me. So if I'm up $1,000 and all of a sudden I take 2 losing trades in a row, and let's say now I'm at $600 for the day, I might just stop trading, honestly, because I want to make sure I always walk away with 50 to 70% of the profits I make. I protect my profits like with my life. I see a lot of traders that make some good money, but they don't know how to protect that capital, and they end up actually losing all their profits and even finishing in the negative. You don't want that to happen to you. You have to have a rule. If you're up $1,000, you have to protect 50 to 70%. If you're up $100, you have to walk away with at least $50 to $70, all right? Number 10, whenever you're feeling emotional, whenever you're not feeling confident, we kind of already talked about this, just lower your risk. I hope you found tremendous value in this risk management guide, and please take all of this information to heart and make sure you implement it within your trading plan, because I want you to succeed. And the only way to succeed in trading is to protect your capital and master risk management. Make sure you leave a comment under this video with feedback. Make sure you leave a like on this video, and make sure you also subscribe to the channel, because I'm always striving to make the best educational content for you guys. So thank you so much for watching, and I'll see you on the next video. What I'm going to teach you in this video has single-handedly saved me hundreds of thousands of dollars over my 5-year trading career, and it's quite literally the reason I'm a profitable trader today. This rule is unbelievably simple. However, 90% of traders don't apply it, and in fact, they do the exact opposite, which destroys their trading. This is something that you can immediately apply in your trading today by the end of this video, so you can increase your trading results by 20, 30, even 50% by the end of this year. I don't want to waste your time. This can genuinely impact your trading performance right now. So make sure you watch until the end of this video, and let's hop right into it. So when my father began mentoring me 5 years ago on how to trade, this was quite literally the first thing that he taught me. He told me that this should be the backbone behind my trading, and that's exactly what it is today. And this is the reason I'm a successful trader today. And this is more than just a rule. This is a mindset. And a lot of you guys watching this video may listen to this video and kind of blow past it, kind of, oh, whatever, yeah, I know that, but you need to take this to heart. You need to instill this way of thinking into your trading and into your analysis. And I guarantee you, it's going to end up making you more money. And this rule is incredibly simple. When in doubt, lower your risk, right? It's not sexy. It's not this crazy new indicator, but whenever you are feeling uncertainty, stress, high emotions, lack of confidence, whenever you're feeling anything that is negative in your trading, you need to lower your risk. When in doubt, just lower your risk, because 80% of your trading success isn't going to come from price action or knowing the right indicators or knowing how to read patterns. It's going to come from your ability to handle your emotions, handle your psychology, and of course, manage your risk. And your emotions and your psychology are very directly correlated with your risk. So if you are feeling emotional, if you're feeling anything that is remotely negative, you're starting to feel doubt, you need to lower your risk. And this has saved me so much money in my career, having this risk management type of mindset where I go into trading, I go into every setup that I take. In my mind, I'm not thinking, oh, how much am I going to make off this setup? Oh, I might make 1,000 to 2,000 and perfect. That's going to put me up 10K in the week. Amazing. No, when I go into a setup, I'm thinking, what is my downside here? Like if this thing goes against me and hits my stop, how much am I going to lose? How volatile is this stock? Is there a high probability this stock is going to actually blow past my stop and I'm going to lose more money? I always think of the downside first. I always try to protect my capital. And that's what you need to understand as a trader. Your priority isn't to make money as a trader. Your first priority is to preserve the capital in your account, capital preservation. Your second priority is to make money on that capital, to make money on the, capital you have in your account. That's your second priority. First is capital preservation. And most traders, unfortunately, don't have this mindset. Most traders don't really care about their bottom line or their downside. They just care about making money. They just care about quitting their job, living this life of freedom. And yeah, those are some of the best perks when it comes to trading, but you'll never realize them unless you adopt this risk management mindset. And there's a very common cycle that most traders go through here. And I kind of drew up a little rough representation here, but a lot of times a trader will make a mistake. Maybe it's an honest mistake. Maybe you under-risked on a trade, or you over-risked on a trade, or you messed up your management, or you took the wrong trade, maybe you FOMO'd in, whatever. You make a mistake. What does that lead to a lot of the times? An emotional crash out, right? And guys, we are not robots, right? Like I hate this advice that you constantly hear on the internet that's like, oh, if you're a trader, you have to trade like a robot. You have to trade like an algorithm. Bro, we are human beings. We feel emotions. Unless you're like a psychopath, you feel emotions. And especially in trading, those emotions are strong. They're almost violent, where a lot of the times, we sometimes feel like completely different people when we trade. Like we go into the trading day feeling composed, feeling good, ready to follow our plan. And then as soon as the market opens and you begin trading, right, things happen, prices move, you lose money, you make money, and that changes your psychology, changes your emotions. And next thing you know, right, if you make a bad mistake or two, you're having a full-on crash out. You're getting emotional. You're starting to sweat. You have that psychological pressure, right? And this happens to a lot of traders. Maybe it doesn't happen to you every day, but maybe let's say once or twice a month, you have this sort of emotional crash out. Now, my biggest suggestion, honestly, is to just step away from your desk. But that's hard for a lot of people, right? Let's be real. It's going to be difficult for a lot of you guys to step away from your desk, but the least you can do is decrease your risk. But unfortunately, what most people end up doing is they have this crash out, right? And they're like, oh my God, I have to make back the money that I just lost. Oh, I was up 1,000, now I'm only up 200. I have to make that back, right? What do? They increase their risk. And as soon as they increase their risk, they have this mindset of, I need to make money, right? It's ultimately greed. That's what's causing this. You're increasing your risk because of greed. And greed is what's stopping you from making money in the first place. Isn't that ironic? Greed is our desire to make money. Your desire to make money is what's stopping you from making money. So you increase your risk, and what happens? You take another trade and you end up losing money, right? Because you over risked, or maybe from there you took a low quality C plus setup, maybe a D setup, and you end up losing more money because you increased your risk. And that usually leads to another emotional crash out, or you making even more mistakes. And this is how the cycle begins. And the thing is, you only have to go through one of these cycles to ruin months of progress. You could be perfectly trading according to your plan for 2 months, managing your emotions, and you have one day where this happens, where you have this crash out, everything's going wrong, and all of a sudden you increase your risk. Now you're losing money, and you're giving back months of profits, months of progress. And some traders even just blow their entire account. And this is just the unfortunate reality of most traders. This is what happens. And you need to avoid this at all costs. And ideally, you just decrease your risk when this happens, right? So the real cycle should actually be, you make a mistake, you have that emotional crash out. That's fine. Sometimes I get frustrated too. It's a part of trading. From there, you lower your risk, or you just step away in the first place. Let's say you don't step away. Lower your risk. And from there, you can rebuild your confidence, right? You take trades with smaller risk, right? Then let's say those end up being winners. Yeah, it's still on small risk, but you're rebuilding your confidence. And once you're back to like, okay, I'm feeling myself, I'm feeling good, right? I'm not emotionally unstable anymore. I'm feeling great. Maybe 1 to 2 days later, after you've rebuilt the confidence, you're able to re-raise your risk to where it was originally. And from there, even if a mistake happens, right? Maybe even if you get emotional, you have like a protocol ready where you're ensuring that you're not going to lose a lot of money in your account. You're protecting yourself, right? You have a protection protocol where you decrease your risk when you find yourself feeling doubt or uncertainty or stress, high emotions, or lack of confidence, any one of those things. So before I go over some key situations that I guarantee you have faced as a trader and show you how to actually apply this rule in practice in the moment, I want to talk about the risk management formula. And it blows my mind that people don't know how to calculate this. They don't know how to size their positions. And I'm going to show you by how much you should decrease your risk by if you are feeling doubt or uncertainty. So right off the bat, before we enter any single trade, our risk is predetermined. We don't go into a trade not knowing how much we're going to lose if the trade hits your stop loss. We go into the trade knowing that if it hits our stop at this specific price, I'm losing X amount. That risk is predetermined. As a result, you need to size your positions correctly. So if the trade does hit your stop, you're only losing your predetermined risk. And your sizing is like your share size or your lot size, right? And the formula for this is really, really simple. It's risk, your dollar risk, divided by entry price minus stop loss price, right? So let's say you on average risk $500 per trade. And let's say the entry price for that trade is $3, right? Let's say you take like a breakout opportunity, entry is at $3, stop loss is below the base, is at $2.90. Great. So if it hits your entry at $3, you get into the trade. And if the trade goes back down and hits your stop loss at $2.90, you exit and you get stopped out. Now, you need to buy an appropriate amount of shares to make sure that if it does hit your stop, you're only losing $500. And this is the reason why we use this formula. So you take the entry price, you put it here, stop loss price, you put it in here, and then $500, which is your risk, is divided by that. So $3 minus $2.90 is 10 cents. 500 divided by 10 cents is 5,000 shares. So if you get 5K shares at $3 and then it stops you out at $2.90, you're going to lose $500. It's very important that you do this calculation before any trade that you take. I have to include it in this video because it's crucial. You have to do it. It's not optional, right? And let's say you're starting to feel uncertainty. What you can do is you lower this risk amount from, let's say, from 500, and let's actually type it. Let's then say from 500, you're feeling uncertain. You're not feeling good about your trading. You're like, you know what? I want to decrease my risk. I'm going to decrease it by half. So now it's $250. Great. These numbers don't change, but your risk changes. And as a result, your share size changes as well. So now you're getting less size for your positions, right? Your share size is decreased because your risk has decreased. And I recommend doing it maybe by half or by 60%. It depends, honestly, how you're feeling. This is more discretionary. It's up to you how much you want to decrease your risk by. But I recommend half if you're feeling really, really down on yourself and you're just not trading the way that you know how to trade and you're just feeling off, lower your risk by half, okay? Now let's talk about some key situations where this could be truly, truly applied. So let's kind of go over it here. So there's a bunch of situations. We'll start off going through kind of the first one here. So let's say you're up $1,000 on the day. You're feeling good. You see another quality setup. You want to make another 500 to 1,000 on the day, right? So let's say it's lunchtime. You're up $1,000, feeling great. You traded well. You see another really nice setup, and you're like, hey, I think I can make 1,500 to 2,000 bucks today. I'm feeling good. Let's make some money, right? You're feeling pumped up. Then all of a sudden, you completely mess up that setup, and instead you end up losing $200. And now you're at $800 for the day, right? Let's say $200 is your predetermined risk. So you lost your predetermined risk. Everything's fine. But now you're like, I was up 1,000. Now I'm up now I'm up only 800. You know, maybe that $1,000 is like a psychological level that you want to see your profits above 1,000. You're like, no, I need to get back up above 1,000. And what you do is you raise your risk, you end up over trading, and then you finish the day in the negative. So what went from a nice, solid $1,000 day, you take a trade, you lose your risk, you're only up 800 now, and you're like, no, I need to be up more than 1,000. You overtrade, you lose your confidence, you increase your risk, and as a result, you give back everything. I guarantee this has happened to you, and you need to avoid this, right? And general rule of thumb is always protect 70 to 80% of your profits in a trade, right? So if you're up 1,000, you need to at least finish the day up 700 to 800, okay? General rule of thumb. This is a great situation. So maybe when you're up 1,000 and you're like, okay, I'm good here. I'm feeling good. I want to make sure I finish above 1,000. Lower your risk for the rest of the day. If you're feeling like you're good with your profits, right? Now, if you do see a really high quality trade that's like A+, sure, use your regular risk. I'm not saying don't do that, but I'm saying lowering your risk could be a good solution for you to make sure you're not giving back too much. Next, let's say you take 3 really nice high quality setups and lose. You take 3 good setups that fit your plan, but they lose you money. Now you're starting to feel emotional and frustrated. You increase your risk, and next thing you know, you're down 5, 6, 7 Rs, right? You don't want to do that, right? You don't want to do that. If you take 3 high quality trades in a row, you know, you're following your plan, you're taking the right setups and they lose, that's fine. That's going to happen sometimes. The worst thing you could do from here is raise your risk to try to make back what you lost, right? If you are feeling a little bit uncertain and frustrated after 3 losses, lower your risk, rebuild confidence, and then raise your risk back up. Or if you have a 3-day losing streak, you're down 3 days in a row. Maybe it's your fault, maybe it isn't. Maybe it's a tough environment. Maybe there's other external factors in your life that's stopping you from trading to the best of your ability. It could be for any reason. If you have a 3-day losing streak, I don't care what the reason is, lower your risk. Hands down, lower your risk by 50 to 70%. Or it's a heavy news day and there's, you know, crazy things going on in the market. Markets are really volatile. The market might be changing, right? The environment might be changing. This happens a lot to a lot of new traders where they make a bit of money 3, 4, 5 months, and then the market kind of switches and they fail to adapt, right? Like, or maybe goes from a bullish market to a bearish market, or a bearish market to a sideways market, and traders fail to adapt. And the same strategies that they were making money on before, they're not making money on those strategies anymore. And next thing you know, they're feeling frustrated. They're feeling nothing is working. They increase their risk. They try to make their money back and they blow their entire account, right? If you're noticing that's a weird day in the market, heavy news day, the market is adapting, decrease your risk, find comfort in that market, start to develop confidence in that market. And once you're feeling good, increase your risk back to the normal amount. Or guys, honestly, maybe you're trading in a new location. Like I was traveling in Europe this past month. It was I was in the hotel rooms with a different monitor than I'm used to. The Wi-Fi was a little bit weird. Different location, different setting. I'm trading now in the afternoons versus the morning. That kind of affects you as a trader. I'm a creature of habit. I like consistency. I like having a structured day. And when I was trading a little bit in Europe, I traded a couple days per week, honestly, just for my students. It was weird. So what did I do? I decreased my risk until I felt comfortable enough to increase it back to the normal amount, considering my environment changed, okay? Hopefully this makes sense, guys. And the reason this is so important, guys, genuinely, most people think that you need new strategies, you need a new methodology, you need new indicators, you need much higher reward to risk to make more money. And that couldn't be farther from the truth. The easiest way, nothing is easy in trading, I'm saying the simplest way to make more money is to simply limit the amount that you lose. And the way that I came up with this number right here, 378,000, is this, right? There's 252 trading days per year, I believe, somewhere around there. I've been trading for 5 years. Call it give or take 1,200 trading days. It's a nice round number. If I'm able to have this mindset and this rule of lowering my risk when I'm in doubt, or just having that risk management mindset, like just living my life being fiscally conservative and being conservative with my trading, just having this overall mindset of worrying about my downside over my upside, if that can save me an extra $300 per day, I'm gonna make an extra $378,000 over 5 years. That's an extra $75K a year, guys, by doing nothing but adopting this mindset. It's the only thing I changed. Risk management mindset and having this rule. If this rule saves me $200 to $300 per day for the rest of my career, which I risk around $500 to trade, around there, between $300 to $700, I have more of like a range. If this is able to save me $200 to $300 a day, and that might be even conservative, right? It might even save me way more money. I'm making an extra $75K per year just because of that. Not by learning new strategies or trying out different things, new indicators. No, just by having this mindset, I'm making more money, right? By the end of the week and the month, if you're just able to limit your losses on your losing trades, you're gonna make more money, right? And no one talks about this. Everyone talks about exciting new stuff in your trading, new whatever strategies and indicators like I mentioned, but no one talks about this. And this is how I've saved so much money in my career, by just applying this rule and not getting so emotional and not increasing my risk and then losing all my money, right? When in doubt, lower your risk. I don't care, if you're not feeling good, frustrated, stressed, whatever. It could be because of reasons outside of your trading. Maybe you got into a fight with your spouse, or maybe someone upset you in your personal life. You're going into trading not feeling the best. Lower your risk, okay? Just trust me, just do it and rebuild that confidence, and then re-raise your risk, okay? And yeah, make sure this is not your cycle, okay? So this is a nice little summary. Yeah, hopefully you understood the share sizing formula, and yeah, guys, use these situations, okay? When in doubt, lower your risk, have that risk management mindset. This is what's made me a profitable trader. I haven't had a losing month in over 5 years, and that sounds crazy, but I'm happy to post my statements. I've done it many, many times on my channel and on my TikTok. I'm happy to be as transparent as possible. The reason I'm so consistent is because I have this mindset. All right, guys, that's it for the video. I hope you enjoyed, and if you need to help build your trading foundation, you need more help with risk management or your strategies or the way that I trade, I have a free 10+ hour course that is genuinely better than most paid courses on the internet. Seriously, any course you've ever taken, my free course will trump it. It's just significantly better. I know it is. So make sure you start watching it. It's in the description of this video, and it'll help build the foundation for your trading, and it'll teach you a lot more stuff It'll expand about everything that I talked about today. So start the free course. Let me know what you think of it. Watch my other YouTube videos in conjunction with that education. And yeah, leave a comment, leave a like, subscribe to the channel if you found this valuable. I will see you guys in the next video. Thank you so much for watching, and hopefully you'll take this to heart, and hopefully within weeks you could actually apply this, and as a result, make more money. I'll see you guys in the next video. Thank you. Change of scenery here. The hotel kicked me off the terrace because they knew about the value I was about to drop. But in this video, I'm going to explain what the gap trading model is, how it works, why it works, how to apply it within your own trading starting tomorrow, how to scan for these massive moves that I'm about to show you, and how to take advantage and trade those moves using predefined simple setups that even a beginner could take advantage of. And if you haven't realized it yet, I like to keep my trading as simple as possible. And this model is incredibly simple. It's not complicated. It's not complex. It's very easy to understand, as you're about to witness. But the real sauce is applying it correctly. There are details, there are nuances that are important to understand to find high probability trades on high momentum stocks, right? I, as a trader, pass on like 98% of the opportunities in the markets. I only focus on high probability, high quality. And you have to differentiate yourself from all of the other traders who take low quality setups. There's a lot of traders who trade gaps, who are kind of familiar with this model, but not a lot of them succeed because they focus on low quality gaps and low quality setups. But that kind of begs the question, what is a gap in the first place? So if you search up on Google, what is a gap in trading, you're going to get this definition. So feel free to pause the video and actually read this definition, but I'm going to simplify it even further. A gap is an overnight change in price. The stock market closes at 4 p.m. Eastern on weekdays, and it opens the next morning at 9:30 a.m. Eastern. So all of the price activity that happens overnight, whether it's buying or selling, that price activity is reflected the next morning as a gap. So let's say a stock closes at $5 at 4 p.m. Eastern on Tuesday, and then the next day on Wednesday, when the market opens at 9:30 a.m. Eastern, the stock opens at $8. That $3 difference in price is called a gap. So it's just an overnight change in price because there's trading activity that occurs either in the post market or the pre-market. And these gaps occur because of news, because of earnings within the company, like positive earnings or negative earnings, or events in the company, or maybe there was a new law that was passed where that affects the company. And as a result, investors either panic or they get really excited during the after hours trading, and that causes the stock to gap and change in price overnight. However, it's very important to understand that we don't care about the news. I'm not sitting there every morning and reading earnings reports or reading the news about why that stock gapped or why, the investors panicked. I don't care about any of that. All I care about is the price action. What effect does that gap have on the charts? So let's go ahead and look at some examples so you could literally visualize what a gap is, and you could literally see the gap in price on the chart. It's not really important where the price was for this example or what day this was. I'm just trying to prove a point here where we closed right here on the previous day, and then the next morning we opened up here, and you could literally see the gap in price on the chart. And that's exactly what a gap is. It's an overnight change in price. This was on J&J just a couple of weeks ago where we closed right here, and then the next morning we gapped down and we opened right here, right? You could literally see the gap in the chart. So we have gap ups and we also have gap downs, and these were pretty significant gaps. But take a look at this one. This one was actually a pretty small overnight change in price. And always remember, the amount that it gaps isn't really relevant. What we care about is where it's gapping to on the charts, and we're about to talk about that in just a second. But right here, we closed at this price the previous day, and then the next morning we gapped up right here. And like I said, you could literally see the gap on the charts. And it's really simple. A gap is just an overnight change in price. So before I teach you how to identify high quality gaps and how to trade them step by step, it's very important that I debunk a very common misconception and myth that I always see, that all gaps fill. And this is complete nonsense. A lot of traders will tell you this, but it is not true. And what a gap fill is essentially when the price of the stock returns to the price it was the previous day. So let's say a stock on Tuesday closes at $5 at 4 p.m. Eastern. And then the next morning on Wednesday, it opens at $8. A gap fill would be where the stock opens on Wednesday at $8 and then drops back to $5 and just goes back to the original price it was the previous day. So for example, like on J&J, we closed right here and then the next morning we open here. This is the gap. A gap fill would be where when it opens on this day, it just goes back to the original price, right? Or for example, right, let's take it on Chegg right here. We closed here and then we opened here the next day. And instead of moving up, a gap fill would suggest that it would drop back down to this original price, essentially where it was the previous day. And that's what a lot of traders will tell you. They'll tell you that all gaps fill. And you shouldn't really focus on gaps because they all fill. But that is nonsense. And the reason I know that is because I trade gaps for a living. I do this every single day. I've done it every day for the last 5 years. And 90% of the time, I am looking to trade in the direction of the gap. I trade the continuation of the gap. So if it gaps up, I'm looking to go long. If it gaps down, I'm looking to go short. Now, there are exceptions to this where I'll go for the reversal, where if it gaps up, I'll be looking for a short, or if it gaps down, I'm looking for a long. But those are pretty rare. And yeah, it's like 5 to 10% of the time. 90% of the time, the majority, I am trading in the direction of the gap. And you might be wondering, why do I trade gaps in the first place? And it's very simple. Gapping stocks move way more than non-gapping stocks, and they just have way more momentum. And as a day trader, I want to trade stocks that have a high probability of moving 10, 20, 30, 40% in a single day. And the gap is like a catalyst for that stock. I like to trade stocks that have a catalyst because the catalyst causes it to just move way more than non-gapping stocks or stocks that don't have a catalyst, right? So it's very simple. Gapping stocks just have a higher probability of moving and having momentum in one direction. And they also provide me a clear bias and direction in which I should trade in, right? Where if it gaps up, I'm looking to go long. If it gaps down, I'm looking to go short. It gives me what the trend is. It gives me that bias in which I should be trading in. So let's get into how to trade gaps for a living step by step. And step number 1 is finding gaps in the pre-market. So every single morning at 8:30 a.m. Eastern, around 1 hour before the stock market opens, I begin my morning preparation where I go to my trading office and I begin scanning for gaps. And what you're essentially scanning for is percent change or percent difference between yesterday's closing price and today's opening price. And there are a bunch of different tools, scanners, websites that could actually help you accomplish this, and they're 100% free. And I'm also going to show you the specific site that I use every single day to scan for gaps. Now, the first website that you could use is finviz.com, and this is actually a really popular site for traders and investors, and I have used it in the past to scan for specific stocks. Now, I don't use Finviz for my current scanning right now. I just want to give you different options and different tools that you could play around with to see what you personally prefer. But don't worry, I'm going to show you exactly how I do my pre-market scanning to find gaps every single day in just a second. But once you're on finviz.com, and by the way, this is also a free site, so I want to show you free websites that you could use so you don't have to pay for anything, or you don't need to sign up for a specific brokerage that may or may not be available in your area. So once you're on finviz.com, just click on screener right here, and it's going to bring you to this page. From there, navigate to technical, and if you click on right here, gap, if you kind of hover over it, it'll tell you the difference between yesterday's closing price and today's opening price. Now, it might not show today because it's Saturday. However, if you click on that, you could scan for all gap ups or you could scan for all gap downs. Now, they also give you functionality of like specific percentages, but I don't see how that would be useful. I would just scan for all gap ups and all gap downs. The next site that is super useful is marketchameleon.com. And once you are on the site, you just hover over to stocks and then you go to features, pre-market trading. Just click on that. And this website actually gives you a big list of overnight gap ups or overnight gap downs, where it gives you this list of gainers, percentage change, and it'll list them in descending order based on the biggest gap ups all the way to the smallest gap ups. And then for the decliners, the same exact thing. It gives you the biggest gap downs all the way to the smallest gap down. So you could literally just copy and paste these tickers onto your watch list every single morning. And there's other really cool functionality with this site. It'll give you the most active tickers traded that day. And sometimes I do kind of scroll through Market Chameleon during the intraday. For example, if I want to see like the top gainers on high volume, and I'll just kind of see what stocks are popping off that day. You could also use tradingview.com, where you head over to products, you go to screeners, and then you go to stocks. Now, I haven't actually used TradingView, so you guys could experiment and let me know if it works or not. But if you go to extended hours, it'll actually tell you pre-market change percentage or pre-market gap percentage. And then you're able to sort by ascending order or sort by descending order. And it'll give you a bunch of stocks that have overnight changes in price, whether it's a gap up or a gap down. Now, in terms of what I personally do every single day, I do most of my scanning on my actual Thinkorswim platform, just because it makes it easier for me. So whenever you're on your watch list on Thinkorswim, if you right click this thing right here, go to customize, you could actually look for percent change or percent change since or percent in the money, or this wouldn't make sense, but percent change. I like to use mark percent change. I found that to be super useful, but you can kind of experiment. Sometimes I use other ones, but this is what I would do. You can kind of go to this column and type in percent change, and it'll give you a bunch of different options. And this is exactly how I scan for gaps every single morning. It's usually a combination between Thinkorswim and using percent change or mark percent change. And then I also use Market Chameleon in case I like missed out on some gaps, or maybe my scanner on Thinkorswim didn't include some. That's exactly what I do. Step number 2, now that you have your gap list, you have that list of stocks that are either gapping up or gapping down. Now it's time to assess the quality of every single gap and pick the specific stocks that you want to focus on for the stock market open and throughout the trading day, because you may have 20, 30, 40 stocks on your gap list, sometimes less, sometimes more. It really depends on the time of year. For example, during earnings season, when companies are reporting quarterly earnings, they usually report either in the pre-market or in the post-market. So we have tons of gaps during earnings season, and that's why earnings season tends to be a really busy time of year. And you don't want to overwhelm yourself looking at like 20 different gaps. You want to pick, the specific gaps that you want to focus on for the market open. And there are specific criteria and qualities that separate high quality gaps from low quality gaps. And I'm about to teach you how to do that. But first, you need to check the price in which the stock is gapping to. So for this, depending on what brokerage you use or what scanner you use or what platform you use, it's going to tell you where it's gapping to. Like, what's the pre-market price of that stock? And that's what you're going to look at. And from there, you're going to go to the daily time frame on whatever platform you are using, and you're going to look on the charts, where is the stock gapping to? So for example, on Apple, we closed on Friday at like $200. If Apple opens at 190 versus, let's say, 173, that is a massive difference. And that could have massive implications on the quality of the gap. So it's important to identify the location in which the stock is gapping to, because it could have a dramatic impact on the quality of the gap. So it's very important that in the pre-market, you're looking at the daily chart, you're looking at the pre-market price, and you're checking where the stock is gapping to. Now it's time to learn about how to assess the quality of every single gap that you look at, so you could pick which stocks you want to focus on for when the stock market opens and throughout the trading day. And this is by far the most important component of your gap scan and your pre-market analysis. You need to identify the high quality gaps versus the low quality gaps. And this is really what's going to differentiate you from all of the other gap traders out there. This skill set is beyond beyond important when it comes to pre-market scanning and then even intraday scanning as well. So let's keep it simple, right? So even if you're a beginner trader, you're going to be able to understand everything that I'm about to talk about. We are looking for gaps that, number one, are clearing directly above a resistance area if it is a gap up. Remember, I like to trade 90% of the time in the direction of the gap. So if it's gapping up, my bias is to go long during the intraday time frames. For that case, we want it to be gapping above a resistance area. We don't want it to be gapping into resistance. We want it to be clearing and gapping above that resistance. And I'm going to break down exactly what that means in just a second. I just want to kind of go over all of the points real quick, and then we're going to go into the specifics. And the opposite applies if it's a short. If it's gapping down, my bias is to go short. I want it to be gapping below support. All right. I want it to be clearing a key support area. So that's the first thing we're looking for. Number two, we look for gaps that are either ending a long-term or short-term trend, or that are surprising buyers or sellers, or shocking buyers or sellers, or even trapping buyers or sellers. And this is so powerful. I'm going to show you how this works. These are the most powerful gaps that you could possibly find. Gaps that end trends and that shock buyers or sellers. We also like gaps that trigger high time frame setups off the daily time frame or off the weekly time frame. And we also like gaps that have room to move. So let's say we're clearing a major resistance area. We want to make sure the stock has room to actually move up before it hits the next resistance area. So these are all the points we're going to look for. And now let's get into the details. So off the bat, let's start off with support and resistance requirements. So let's break this down. We have a very established downtrend, and then we begin consolidating at the lows, and we close right here the previous day. The next morning, we gap down, and notice how we are gapping down beneath this consolidation. We're gapping beneath this area of support, and that's exactly what you're looking for. You don't want it to gap into the consolidation. You want it to gap underneath support, underneath the consolidation. So it's actually clearing every single low, right? You want it to be opening below every single low right here. And that would effectively mean it's gapping below support. Same thing applies if it's above resistance. Established uptrend, and then we begin to consolidate at the highs. We close here the previous day, and the next morning we gap up. Notice how we're not gapping into the highs. We're gapping over the highs. We are clearing these highs, right? So we're gapping above that resistance area, and that's exactly what you want to look for. Now, another really key point is that notice how I said directly above resistance. I didn't say a massive amount above resistance. I said directly above, right? So we don't want massive gaps above resistance or below support. A lot of people think that the bigger the gap, the better the gap, and that's not necessarily true, right? So let's say instead of us opening here, we opened all the way down here, way below support. We don't want that, right? We want it to be gapping directly below support, not like crazy far away from support. Does that make sense? Next, instead of it opening directly above resistance like it is here, imagine it opened all the way up here, which, has a massive distance between yesterday's closing price. It's way above this resistance area. We don't want that. We oftentimes actually call these mega gaps when the gap is so big that it almost loses its power. It loses its effect because it's just completely gapping off of the charts. And a lot of the investors, right, like imagine you were in it short right here and all of a sudden it gaps all the way up here, right? You might like panic sell, but you might also just be like, okay, well, I'm just going to wait until it comes in. I'm already down so much money. I'm just going to wait until it comes back down. So we want it to be directly above resistance, directly below support, not like a massive amount away from support or resistance, right? And that's really demonstrated here as well, right? So we don't want it to be gapping into support. We want it under support. So this is an example of it gapping into support or gapping into resistance. We don't want it to be opening into the previous low or into the previous high. We want it to be clearing the previous low or clearing the previous high. Does that make sense? All right, now let's go ahead and move on. We also look for gaps that end trends because they could be unbelievably powerful because they ultimately trap and shock the buyers or sellers. So here's a really good example of that, where you have a really established downtrend, right? You close right here the previous day, and then all of a sudden the next morning you open right here, right? Like, think about how shocking that could be. Let's say you're in it short, either from here or from here or from here. You know, you're going to sleep at night feeling good, your position is up, it's looking lower, everything's great, making money, and all of a sudden the next morning it gaps all the way up to basically right here, where it essentially just ends the downtrend. Like, think about how you might feel waking up to your position now down hundreds and hundreds of dollars, or thousands of dollars, or hundreds of thousands of dollars. Think about if you're an institution who went short right here, for example, and all of a sudden the stock is opening up here, right? That's going to put pressure on you and everyone who went short to ultimately cover their position. And when they cover their position, they're buying their shares back. That's what gives prices the momentum to move higher, right? Or a gap that ends in uptrend, right? Let's say you went long right here and the price closed here the previous day. You're feeling good, you're making money, and all of a sudden it opens down here. Next morning, prices are down here. Aren't you going to panic? You're gonna be like, oh my God, I'm down, I'm losing a lot of money, and let's say it begins to drop. Let's say it starts to drop a little bit. And then you're like, oh my God, it opened, my position is more and more in the red, I'm losing more and more money, right? That's going to put more and more pressure on you to just cut your losses and sell. And that's what gives prices the momentum to continue lower. And this is why gaps that end trends or that shock buyers or sellers are powerful, because it puts those buyers and sellers in a position that they don't want to be in. It puts them in a position where they have to cut their losses, or otherwise they're going to lose way more money. Alrighty. And we also like to look for gaps that are below green bars if we're going short, right? Or above red bars if we're going long. So if it's opening below a green bar, it is trapping all of the buyers from the previous day. And if it's opening above a red bar, it's trapping all of the sellers from the previous day, right? So a gap below a green bar is powerful. A gap above a red bar is powerful. And I know we kind of just went over theory, but let's look at some real life examples here. So let's take the PLCE. This is a gap from a couple of weeks ago, where on the previous day, we closed right here. And then the next morning, we opened right here. So let's see if it fits the criteria, right? We want a gap that opens below support. This is a support area. This is a support area. Yep, we're opening below this support area. We're also essentially ending this uptrend, right? We have this kind of mini little trend here. We're ending that trend, and we're also gapping below all of these green bars. Like, think about it. Everyone who bought it this day or this day or this day, they're waking up to now prices moving against them. That's going to put pressure on them to cut their losses and sell. And that's exactly what happened. And we saw really nice follow through on this day. And we actually, dropped right into this prior support area. So this support area was kind of like target, right? We gapped right here. Next support area, we looked to the left. Next support area was target. And that's exactly where it dropped to. Really beautiful gap. And in fact, it continued lower. And this is the daily chart. So it continued lower the rest of the week. So you could see how powerful this could be even for like swing trading, right? Where you could find really powerful daily gaps that are ending trends, that are clearing support, that have room to fall. And you can even look for ways to swing trade it. Take a look at this gap right here. So we have this kind of like multi-week consolidation. We have a very clear support area right here. We gap directly below it. We gap directly below a green bar. And we also kind of have a setup on the chart. We're kind of consolidating here, consolidating. So we have a setup on the higher time frame. We have a breakdown, and we trigger that breakdown through a gap down. We open here, which, like I said, below support. And if you look to the left here, we do have kind of a bunch of resistance. We have this resistance area right here, and we also have this pivot right here. But this stock just didn't care. It had so much momentum to the downside. I don't know what the news was, but it had so much momentum. This was such a massive catalyst for the stock that it just ripped through all of that support. And it was just a picture perfect gap. And I remember I remember kind of writing this stock off in the pre-market because I didn't think it was liquid enough to trade. And then funny enough, it was, and it just produced such a massive move. All right. Now let's look at the NASDAQ. Let's look at the Qs real quick. And there was just an unbelievably powerful gap on it right when the tariffs really came out, where we topped here. We moved down, then we kind of bounced around. And I think a lot of people were saying that we bottomed on the NASDAQ right here. This is the QQQ. This is the tracking ETF for the NASDAQ. A lot of people were telling me, I was reading on Twitter, a lot of people thought that we bottomed, and a lot of people were going aggressive with longs thinking that the market bottomed. We had 3 green bars in a row, and I think we ended up gapping down the next day from here to right here. And look at the effect that this had on the chart. And by the way, we're gapping below 3 green bars. And notice how it's a downtrend. Or we have a high, we have a low, we have a lower high, then we have a lower low and a lower high, and then we gap down right here, and it just shocked all of the buyers who bought it the previous day. And you could see that, I mean, look at the move that it triggered here. And we literally just basically capitulated right after that. Unbelievably powerful gap, right? It trapped all of the buyers who bought it the last 3 days on this gap, and then it just completely tanked. Beautiful. And you could even say that this was kind of a higher time frame setup, that this was like a sell setup. This was a retracement into the declining 20 MA on the daily time frame. Going over what those setups are and how to apply them with this gap strategy. However, I highly recommend watching my free 10+ hour trading course. It is genuinely better than most paid courses on the internet, and you can combine everything that you learn in my free course with a lot of my YouTube videos to really build the foundation for your trading. So I highly recommend going to my free course and learning about the sell setup that I just talked about, or the buy setup that I am about to talk about, and of course the breakout, the breakdown, the 1, 2, 3, and all of the other setups that I trade. So let's take a look at this APLD. We bottomed here. We went on a nice little uptrend. We have a rising 20 period moving average below price. We have a high here, and then we begin to pull back, and we have 3 red bars in a row. And then the next day, I believe we opened somewhere right here. So we opened above those red bars. We have an established uptrend. We also opened above this resistance area. And I saw this in the morning, and this is actually a setup that I called in my mentorship community as well. And you could just see the move that it produced. I mean, take a look at this. Look at this move. And this was that day, but you could see even the next few days. I mean, this thing just mooned like crazy, but look at this gap, right? This gap right here. And that gap was the catalyst for this massive move to the upside. We cleared over this resistance area. We gapped above 3 red bars, and we also triggered a higher time frame setup. We had a very clear buy setup on the daily time frame. We have established uptrend, rising 20 MA, pull back into the rising 20 MA. We have an entry bar, and we trigger that buy setup through this gap, right? Where we gap up, we trigger the buy setup, and boom, we just go off on a rocket ship. And there was even a daily 1, 2, 3 here as well, where we had an igniting bar, we had a resting bar, entry over that resting bar, stop loss below, and it continued higher. So like I said, watch the free course, because like the 1, 2, 3, the buy setup, it's important to know that for this video. All right, but I am going to go over briefly what that is in a second, and I am also going to show you how to trade these gaps on the intraday time frames. Let's look at Coinbase. This is another just beautiful gap. Very similar to the APLD. We bottomed here, we moved up. 20 MA is now under price. Prices are respecting it, and we kind of had a little bit of a breakout here, and we triggered that breakout by gapping right here. We're gapping above this resistance. We're gapping above this resistance. We're gapping above the 200 period moving average. We're opening right here. You look to the left, we have plenty of room to the next resistance area, which is really like right here. So we have plenty of room to move higher. And let's take a look at the move that it produced. And Coinbase was just brilliant that day. I mean, such a nice gap, right? Above the 200, above all of this resistance. Beautiful setup on the charts, right? We have kind of a move up, basically a breakout. We have a breakout right here, and that breakout was triggered by this daily gap. All right, let's move on. Let's look at the UNH. And this was the company that there was a lot of news on it. A lot of people were talking about it on Twitter, and a lot of people were discussing how United Health, you know, this was like, I think it was like $600, and you'll see where it ended up gapping to. But I think we opened right here, somewhere around there, right? So this thing, very solid uptrend. This thing looked like it was going to make new all-time highs, and all of a sudden it ends this uptrend completely. I mean, this is an extremely established trend to the upside. It looks higher. If anyone, any professional or retail trader looks at this chart, they're like, yep, that looks higher. This is an established trend. And we open right here below this pivot, right? We are kind of into a little bit of an area of support, but it just didn't matter at all. because you could see what happened directly after. On that day, we just had such nice follow through to the downside. And this is what happened afterwards, right? So this was that day, and you could see where the stock ended up falling to. This gap essentially ignited a brand new trend because it shocked all of the buyers who were in it long, basically this entire trend higher, right? It shocked everyone. It trapped all of these buyers, all of the long-term investors, all of the traders. And you have to understand, when you have a really powerful gap like this that ends a trend or gaps below a lot of green bars, it's almost like a snowball effect of selling. Because think about it, right? It opens here, it starts to drop. Maybe there are some traders or investors that are like, hey, this is a good company. I'm just going to wait until this moves back up, right? So it drops. Then it drops again. Then it continues to drop. And all of a sudden, their position is becoming more and more red. And it becomes a snowball effect of selling. And that's why these gaps have such a strong catalyst. And that's why they move with so much momentum. And we as professionals could take advantage of that snowball effect. We could take advantage knowing that those investors and traders are trapped and they're likely probably going to sell. So this is a really good example of a gap that's ending a trend. Let's look at Chegg. This was, oh my God, picture perfect. So we have a really established downtrend. I mean, look at the 20 MA. Look at how well prices are respecting the 20 MA. I actually have a video on my YouTube channel that teaches how to use the 20 period moving average. I also teach it in my free course. But so we move down and we have basically, a little base breakdown. We have a little bit of a consolidation here at the lows. And maybe there were some investors that thought that, hey, this thing double bottomed. I'm going to start buying here. And it started to move up. People thought that, hey, maybe Chegg bottom, maybe Chegg is about to move higher. They started to go long, and all of a sudden we opened like right here, directly below this support. We trapped the buyers who bought it the last 3 days, and we're continuing also the long-term trend. And it was just beautiful. And I remember trading in this day. I mean, it made me a bag. I don't remember, this was weeks ago. I don't remember exactly how much it made, but it was such a nice trade. And look at this. I mean, picture perfect. It closed at the lows. It closed literally at the lows of the day because it was such a powerful gap. It was continuing this long-term trend to the downside. It shocked the buyers who bought it the last 3 days. And also it triggered basically a sell setup break daily time frame. We have a sell setup, consolidation at the lows. We triggered that setup by a gap down. Beautiful. And notice how we didn't gap down here and dropped. We gapped directly below support. Beautiful. Trapping all the buyers. Just picture perfect, honestly. All right, let's continue onward. We have the Yext. So this was essentially just a base breakout on the daily time frame. I think we opened right here or so. So we were clearing essentially this entire area of resistance. And the next resistance was basically all the way up here, right? And it didn't really shock any buyers or sellers, right? Because you look at the previous day, it was actually coming off a green bar. So it was already getting bought. It just essentially continued that momentum the next day. And let's look at what the gap ended up doing. And boom, I mean, insane green bar. Notice this is literally the biggest green bar on the chart. Look at all of the candlesticks. The biggest green bar was ignited from a gap where it essentially triggered a base breakout above resistance, and it actually cleared the previous resistance as well. It literally cleared it. It was such a powerful gap. Beautiful, beautiful. All right. And by the way, all of these charts, this is not me cherry picking. I do this pre-market scan every single day, not only for myself, but for every single one of my mentorship students that trade live with me every single day. We do this analysis every morning at 9 a.m. All right. So all of these stocks are stocks that were just on my personal scanner that we either traded that day and made money off of, or it was like on our radar and maybe we didn't catch that specific trade, but it was on our watch list. Let's look at the Chegg, another great example here. Right here, we have a red bar. We closed right here, then we opened right here. Now, this wasn't that great of a gap, and I'll tell you why. We do have an established uptrend, right? Respecting the 20 MA, respecting the 20 MA. This was a really nice buy setup, by the way. Moved up, retraced, really nice buy setup. We had a nice red bar the previous day, so it started to get sold. I'm assuming the people who bought it started to take profits, and then all of a sudden it was gapping from here to right here. But it was gapping right into this area of resistance, and it was also gapping into the 200 period moving average. Now, it didn't care. It still went higher. But the point that I'm trying to make is not every gap is going to be a picture perfect gap. They're not always going to be perfect, right? Like A plus. I don't want to say they're rare, but you're not going to get them every single day. You're not going to get 5 a day. Sometimes you could still make money off of like B gaps or even C plus gaps, right? And we do that, all right? But generally speaking, you do want to trade the highest quality of gaps. Okay, so I just gave you a ton of different information to understand for how to assess the quality of a gap and what we specifically look for. But you probably are a little bit still confused on how to actually trade these gaps. Like, where do we enter? What do we actually do when we see a high quality gap on the daily time frame? And you need to understand that the gap sets the bias. And from there, once we know what the bias is, once we know what specific stocks we want to focus on, the ones that have the highest quality gap, once we know the direction, right, we go to the intraday time frames to trade that bias. We don't just buy a gap up, right? Let's say you have a really interesting gap up. It's clearing over resistance. It's trapping sellers. It's ending a downtrend. It's looking really good on the daily time frame. We don't just buy it. No, you need an intraday setup. So the gap sets the bias, it sets the direction in which we want to trade in, and from there we combine that with the intraday predefined simple setup, and we're about to talk about that. But I know people are going to ask me about time frames. So in the pre-market, I'm scanning for gaps. I'm picking which stocks I want to focus on for the market open. And then when the market does open, as I'm looking at the daily chart and where the stock is opening, I'm looking at the 1 and the 2 minute charts from like 9:30 to 10 a.m. And I'm also looking at the 5 minute as well, closer to 10 a.m. Then from 10 a.m. to 12 p.m., and this is Eastern time, by the way, I'm looking at like the 2 minute chart and the 5 minute charts. And I'm also starting to look at the 15 minute chart as well. And then from 12 to the end of the day, I'm primarily looking at the 5 and the 15 minute time frames. Now, even when I'm scanning for new stocks to trade that day, I'm always looking at the daily chart first. I'm always assessing what is the gap, or is there a gap in the first place? And a lot of times, if there's no gap, I don't even look at the intraday timeframes. If the daily chart isn't interesting, there's no quality gap, there's no momentum, the daily doesn't really have anything to be interested in, I don't even go to the lower timeframes. I look at the daily chart, I assess, is there a gap? Yes, great. Is there a high quality gap? Yes, great. That's when I go to the intraday timeframes to look for a setup. Now, what setups do we trade? And it's really simple, guys. Like I said, just watch the free course. It'll teach you all of this. But we look for either a retracement setup or a consolidation. So this is essentially a buy setup or a breakout. That is exactly what I trade. All right. We keep it really, really simple, right? I don't like to overcomplicate my strategies. I don't like to use crazy indicators. I keep my trading as simple as possible. I think the simplest things in life are oftentimes the most brilliant. I keep it simple. So once I have the bias, to trade that bias, I either trade a retracement pattern, which is a buy setup, or I trade a breakout, which essentially is like a consolidation pattern. Now, I also want to show you a strategy that you can implement literally in the first few minutes of the day, because there are times where I will hop into a trade that has a really high quality gap right off the open, like the first 5 minutes of the day. Because sometimes these gaps, let's say you have a really nice gap down, it won't set up, it'll just go. And sometimes you kind of have to just jump into it to capitalize on the trade. However, we don't want to just randomly jump in. We still want structure for our trades, even if they're right at the open. But, you know, at the open, there hasn't been enough time to pass, right? If we're 2 minutes into the day, there's only 2 1-minute candlesticks. You can't really read a setup from that. You can't read a breakdown or a sell setup or anything. So what you can do is use the high-low pattern. And I think a lot of people call this the orb strategy, like the opening range breakout. Listen, I really don't care what you call it. I don't study the orb. Like, I saw that on TikTok and it was kind of similar to what I know as the high-low strategy, but doesn't matter. This is the strat. So what you're going to do is you wait for either the first 1 minute, 2 minute, 5 minute, or 15 minute candle to form. So the first one forms either 1 minute into the day, 2 minutes into the day, 5 minutes into the day, or 15 minutes into the day, depending on the time frame you're looking at. Now, if you're going long, right, let's say it's a bullish gap up and you want to go long, what you can do is you place your entry above the first candlestick, stop loss below. So you could put your entry above the first candlestick right here, okay? And you put your stop loss below that first candlestick. And this provides structure. So you have a really nice gap up. You're noticing that it looks like it's about to pop. It looks like it wants to really get going and move to the upside right off the bat in the morning. Instead of just hopping in randomly with no risk management, no stop loss, no predefined entry, you now have structure for the trade. You put your entry below the highs of the first candlestick. You put your stop loss below the lows of the first candlestick. Now, the same thing applies when going short. It's just the opposite. You would place your entry below the lows. You place your stop loss below the highs. And right off the bat, I already know what you're thinking. You're like, okay, this is easy. Just wait for the first candlestick to form. And then if you're long, entry above, stop loss below. Going short, entry below, stop loss above. Makes sense. But which time frame do we use? Which time frame do we look at? Do we look at the 1 minute or the 2 minute or the 5 minute or the 15 minute? And ultimately, that is up to you. It really depends. Right? So my suggestion is if you do it off the 1 minute or the 2 minute, especially right off the market open, that stock could be so volatile that it's going to quickly stop you out. My recommendation is to wait for either the 5 or the 15 to form. Maybe if you want to be super aggressive, you could do it off the 2 minute where the first 2 minutes pass by, you have a 2 minute bar, and that's what you do the high-low strategy off of. My recommendation, I think a really good sweet spot is doing it off the 5 minute. And the issue with doing it off the 15, right, is you might end up having a massive 15-minute candlestick, right? And then all of a sudden you put your entry above, stop loss below, you have a really big stop. So now you have limited reward to risk. And then the upside of doing it off the 1 minute time frame is you might have a super small bar, right? So you have really entry here, stop loss here, you have a really small bar, you have a really tight stop, you have a high reward to risk, but this thing might end up triggering, right? And then immediately stopping out. And then you end up losing a full R 1 or 2 minutes into the day because the stock is so volatile because it's right at the open. Does that make sense? So you need to find a sweet spot. My recommendation is just to do it off the 5 minute personally. But if you see a 2 minute high low where the first 2 minute bar is formed, it looks good. The stock is readable. It's not too volatile. It's an amazing gap. You feel like it's about to move. You can do it off the 2 minute and use the high-low strategy off the 2. Entry above, stop loss below if you're going long, or entry below, stop loss above if you're going short. So now we understand that the gap sets the bias. It gives us the direction in which we want to trade in when the market opens, but we don't just randomly buy or randomly short on a gap up or on a gap down. No, we need a predefined intraday setup, and that's exactly why we go to the smaller time frames to find that setup, whether that is a retracement or a buy setup or a consolidation or breakout, or whether that's a high-low strategy. If it's in the first few minutes of the day, we never enter randomly. We need to have structure in our trading. That's why we trade predefined, simple setups that are not complicated. They're easy to understand, and they're easy to know where our entry is and where our stop loss is, which allows us to easily manage our risk. Now, let's go back to the previous setups and gaps that we were looking at, and let's look at the intraday setups on those. So we have the APLD. Right? So this stock gapped up above 3 red bars over resistance. We already went through it. And let's look at the intraday setup that occurred on this day. And I actually distinctly remember this day because we traded this intraday setup. I called this in my mentorship group and we traded and capitalized on it. Now, let's take a look at it. So we have a very, very clean 5-minute buy setup, right? So what is a buy setup? That is a retracement pattern, where we have a move up, 3 red bars in a row, great. Now we have a bottoming tail, entry bar, perfect. Entry would go above that bar, stop loss below, target is the previous high, and we actually surpassed that previous high. And if you look even later into the day, we kind of had another little buy setup right here, right? Where we moved up, retraced, moved higher. This one wasn't as high quality, but I definitely like this one where we kind of moved higher, 3 red bars in a row, entry above, stop loss below, and we made a new high. But the best one was really this one. It was just such a clean buy setup. And you might be thinking, hold up, for a buy setup, especially if you've gone through my free course, you're definitely thinking if it's a buy setup, then it needs to be close to or near the 20 period moving average, which is this line right here. I understand that there is some distance between price and the 20 MA. However, you need to understand that on a big gap, on a sharp gap up, it's going to take time for the 20 period moving average to catch up to price, right? Because it randomly just popped, right, overnight, And you could see why, the 20 MA is really has such a sharp slope because it's trying to catch up to prices. So in the first like 30 minutes of the day, even first like hour to hour and a half of the day, you could use the 9 MA in conjunction, or the 10 MA in conjunction with the 20 MA, right? Like these can serve as your 20 MA in the first hour of the day, especially if it's a big gap either up to the upside or to the downside. But you could see we had a beautiful gap down or gap up that was bullish, triggering a buy setup on the daily here, above 3 red bars, above resistance, and we traded that bias through a 5-minute buy setup. Now let's look at the Coinbase. We already went over this gap, above resistance, above the 200, above a couple of red bars, triggering a breakout, has plenty of room until the next resistance area. Lovely. Now let's look at the intraday time frame, and we see that, what do we see? And I want you guys to kind of answer that. I want you to pause the video and really think about it, but I'll tell you the answer. We just have an amazing uptrend where prices just are respecting the 20 MA. And right off the bat, we have a nice breakout right here over the highs, stop loss under the lows. That kind of chopped around for a while until the 20 MA caught up. And then as soon as the 20 MA caught up right here, that's when it decided to really run. So you could have even traded it as a breakout here. With your entry above the base, stop loss below this tail. You could have even put your stop loss below this base if you wanted a tighter stop. And in theory, if you want to be super aggressive, we have somewhat of a 5-minute 1, 2, 3 here, where we had a igniting bar, doji bar. You could have even put your entry above that doji bar, stop loss below if you really wanted a tight stop, but that's super, super aggressive. And then even here, we got a buy setup and buy setup again. And you can see how well it's respecting the 20 MA. Just beautiful, beautiful gap and beautiful uptrend on the intraday time frame where you could have traded either a breakout here and then you saw it chop around for a bit, or you could even enter the breakout here, or you could have traded as a buy setup here. Just a bunch of different setups that you could have traded on this stock, right? But that's the idea. Gap, then you go to the intraday time frames and you find a setup. Let's look at this. Same exact thing on the UNH. And this is actually a great example. We already talked about the UNH. This is a great example of a high-low where you could have, right, you have this first 5-minute candle that formed. You could have put your entry below that first 5-minute candle, stop loss above the first 5-minute candle, and you would have capitalized on this move lower. Now, it would have been a really big stop. That's the only issue. So what I would have personally done is I would have traded this as a 5-minute 1, 2, 3. Igniting red bar to the downside. We have a resting doji bar, entry below that 1, 2, 3, stop loss above. And like I said, watch the free course. I keep saying it, but all these setups, it's important to understand it. I teach the 1, 2, 3 in that free education, so watch it. But this could be a nice 1, 2, 3, and it continued lower. Just amazing trade, honestly. So you could have done it as a high-low or as a 5-minute 1, 2, 3. All right. So bearish gap down, and we traded that bias through those setups that I just mentioned. Let's move on. Chegg. Let's look at the Chegg. We already talked about it. Beautiful gap down below these 3 green bars, continuing this long-term trend below support. And let's look at the intraday setup. And we have just a really clean breakdown. We move lower, we consolidated. Check this out. You know what this is right here? This is what's called a shakeout bar. This is called a breakout failure, where notice what happened. We dropped, we began to consolidate. From there, we attempted to move higher and failed. And then we got the move lower. Just beautiful, right? You could see that topping tail. The buyer stepped in, tried to bring prices higher, and then the sellers were like, nope, this is bearish. There's a bearish gap. You're not bringing it higher. And they brought prices right back down. So it was like a failed breakout. Either put your entry here, stop loss above, right? So entry below the base, stop loss above. Or you could have, even if you want to be aggressive, like I remember trading this, I entered below this doji, stop loss above, which obviously isn't textbook, right? For a breakdown, we want it to trigger underneath the base. As soon as I saw a breakout failure on a really bearish gap with a really bearish base breakdown on the 15-minute time frame, I was just like, yep, I'm hopping in. And I think I went to either the 5-minute chart or the 2-minute chart for a much tighter stop and a much tighter entry. Let's move on to the Yext. We already talked about the gap above resistance, triggering this base breakout. And let's look at the intraday setup. And we have just such a clean, this is the 5-minute time frame, such a clean high-low. Entry above, stop loss below, and look at that move. Wow, just insane. And then it consolidated. Literally, it consolidated for a while right here. And you could have traded this as a breakout. Entry above the base, stop loss below, and capitalized off this move, right? And then this would have been the target, which basically that's where it got to. All right. Do we have any more? Yes, we do. Let's look at the Chegg. This is actually a pretty recent trade. This is the one that I said it wasn't that good because it was into resistance. But let's look at the intraday setup here. And we kind of have like a 1, 2, 3 / breakout. So I remember I called this over this candle, stop loss below, and we caught this move. But then there was also a really nice 5-minute buy setup. So a lot of my students and we caught this move off this breakout. But then you could have even traded this 3-bar pullback, nice entry bar as a 5-minute buy setup, really close to the 20 period moving average, entry above, stop loss below, and you would have literally just caught number one, this move that it pulled back, one more buy setup. And then funny enough, it had a base breakout. So entry above, stop loss below. So you're seeing this like on literally just a Chegg on this uptrend. How many opportunities did you have to enter it? You had this initial opportunity, number one, 5-minute buy setup, number two, another 5-minute buy setup, number three, and a 5-minute breakout. 4 potential setups. You can even say 5. You could say this was a buy setup as well. That's 6. Right? And by the way, this was like a low quality gap. This was like maybe a B- C+ gap. But even on a B- C+ gap, you see so many potentially, interesting opportunities on the intraday to trade that bias. Before I do a summary of the entire video, this chart essentially explains why we focus on gaps. I want you to identify the 2 biggest candles on this chart. Literally pause the video and find the 2 biggest candles. And if you did that, you would see that it's this one and this one. And both of those candles were ignited by a gap where we have a really nice uptrend right here, respecting the 20 MA. We move up, we consolidate into the rising 20 period moving average. We have a really nice daily breakout. That breakout was triggered by a gap and boom, it just mooned from there, right? And we did have resistance to the left. It didn't care. It just ripped right through it. Looking at this one, another really nice established uptrend, higher highs, higher lows. We moved up, had a nice buy setup into the rising 20 period moving average. We triggered that buy setup through a gap up and boom. And by the way, we had resistance as well to the left here. Did not care and it just ripped right through that resistance, right? And by the way, I always like to look to the left to find the next resistance area. So in this case, the first resistance was right here, which it cleared that. And the second resistance was right here, which it literally it cleared that as well. But usually I like to use resistance areas and support areas as my target for trading gaps and trading the intraday setup on the gap. Now, quick little summary, guys. We learned exactly why we trade gaps. They have way more momentum. They have a catalyst behind its movement, and they just move way more than non-gapping stocks. 90% of the time, I am trading in the direction of the gap, right? There are exceptions to this. There are times where I'm going against the gap, but I'm not going to talk about it in this video. We already talked about a ton of different stuff. One more thing I should note is that if you have a gap up, right, we are looking to go long, but let's say we have a gap up and it starts to sell off and it starts to drop. I just don't focus on it anymore. I don't trade it short. I just don't focus on it. So I don't like to trade the gap fill. I trade in the direction of the gap. And if it starts to fill the gap, I just ignore it. Same thing if it's a gap down, I'm looking to go short. That's my bias. But if it starts to move up, most of the time I don't focus on it anymore, right? We learned about how to find gaps in the pre-market, all the different websites. I like to use Thinkorswim and I do use Market Chameleon at times. We check the price and from there we check, is it clearing above resistance? Or is it clearing below support? Is it shocking any buyers or sellers? Is it triggering a breakout or a buy setup on the daily time frame? Does it have room to the next resistance area, right? We talked about what we look for when it comes to support and resistance requirements. And then from there, we talked about just a bunch of gaps and what we specifically look for in gaps. And remember, we want gaps that are powerful, that are shocking buyers or sellers, that are making buyers and sellers uncomfortable to be in the positions that they're in. And that's where the biggest opportunities lie. It's very, very important. And the final note I would say is that always remember, we don't trade the gap. We need a setup, right? We can't just enter randomly into a nice gap up. We need an intraday setup, whether that's a retracement or a consolidation or a high-low strategy. I see so many traders overcomplicate what top-down analysis is when it's actually an extremely simple concept. And the goal of this video is to simplify top-down analysis so you can begin implementing it into your trading, literally starting after this video. And this was actually one of the first trading concepts that my father taught me 5 years ago when he mentored me on how to trade. And it's been a game changer in my trading career in honestly two different ways. Number one, it helps me prevent losing trades. And number two, it helps me differentiate between low quality setups and high quality setups. And that is invaluable whenever you're looking at a potential trade. And the way that this video is going to be structured is I'm going to break down first what top-down analysis is. I'm going to explain why it's important. I'm going to show you what specific time frames that I look at. And from there, we're going to be looking at some real life examples so you could actually understand my thought process when I'm looking at a trade, and you can understand what I'm looking for in each specific time frame and exactly how I make my decisions. And by looking at real life examples, that's going to help you apply everything that you're about to learn into your own trading. So all that top-down analysis is looking at multiple time frames. And one of the most common questions that I get asked as a trader is, Emmanuel, what time frame do you trade off of? And I'm not looking at one singular time frame. I am always looking at multiple time frames so I can have multiple perspectives of the stock that I am trading. And that's what allows me to have informed decisions. That's what allows me to see the bigger picture on what's actually happening with that trade. And this is what helps me prevent losses. And all that top-down analysis refers to is looking at the larger and higher time frames first to determine and develop a bias. And from there, you go to the smaller time frames to trade and execute on that bias. And all that a bias is essentially your determination on whether prices are bullish and likely to go up, or bearish and likely to go down, or if prices are sideways and they're likely to just chop around and not really do anything. So on the larger time frames, let's say your bias is bullish. You think prices are going to go up and you're liking what you're seeing on the larger time frames. From there, you go to the smaller time frames to find an identifiable setup and an identifiable entry for that bias on the larger time frame. So that's all it is, starting off at the larger time frames and then going to the smaller time frames. Now, one of the biggest mistakes that I see is traders completely ignore the larger time frame. They're only trading off the smaller time frame, and then they get confused when a trade doesn't go their way. And it's like, yeah, obviously you have to see what the bigger picture is doing. So why is top-down analysis so important? And it's important for a few different reasons. Number one, it's critical to establish that bullish or bearish bias before you take the trade so you can understand the direction of the trend. And this is another massive mistake that I see a lot of beginner traders make. A lot of beginners always want to go against the trend, and they resonate with this idea of catching the top or catching the bottom of a stock. And that's actually extremely difficult to do. Even the most professional traders, they can't really predict tops and bottoms with precision. Obviously, some are better than others, but if you're a beginner trader, why would you want to go against the trend? That's like driving against traffic on the highway. You want to trade with the trend because your likelihood of success is much greater when you're trading in the direction that price is heading in, right? So it's really important that you look at the larger time frames and make sure that you're trading with the trend, not against it, all right? Number two, it's really important to establish support and resistance areas, places of supply and demand on the larger time frames. This is going to affect how well your trade could actually continue in your direction. Like, for example, if your trade is, let's say, into a really heavy area of resistance, it's kind of unlikely that it's really going to continue higher. It might end up kind of chopping around that resistance and even failing on that move higher. And this is also really important for targets to know when you want to exit the trade and when your target is actually hit. Number three, we want to look for alignment. It's impossible to have alignment if we're not looking at multiple time frames. And the way that I would think about this is, let's say the daily chart is bullish. The hourly chart is bullish. The weekly time frame is bullish. The 15-minute chart is bullish. And then you have a 5-minute breakout setup. Don't you think that setup has a lot higher of a probability of actually moving in your favor because all of the other time frames are bullish? And that's what you're looking for. You want all of the time frames to communicate the same thing. You don't want one time frame to tell you one thing, another time frame to tell you a different thing, another time frame to be bullish, another time frame to be sideways. The larger time frames are bearish, right? That's not alignment. That's conflict. You don't want conflict among the time frames. You want the time frames to be telling you the same exact thing. And that's what allows you to take higher probability setups because all the time frames are communicating the same thing. It also helps you find higher reward to risk entries. A lot of times I'll have to look at multiple time frames to find my best entry into that trade, because not only do I want to take a trade that's going to go in my favor, I want to make sure I have a solid reward to risk to the point where if that trade does work, it's actually going to make me a solid return on the money that I'm risking. So let's go ahead and break down the exact time frames that I'm actually looking at for my day trading. And at all times, I am looking at the daily and hourly time frames, and those are my higher time frames. So I'm always starting out looking at the daily and hourly time frames. That is what provides me the bias that I need to trade that stock. And from there, I go to the smaller time frames. So in the morning, when the market first opens between like 9:30 and 10:30 a.m. Eastern time, I'm primarily looking at the 1 and 2 minute time frames. And by the end of 10:30, I'm already starting to transition to the 5-minute time frame. And then for the rest of the day from 10:30 a.m. to 4 p.m. Eastern, I'm primarily focusing on the 5 and the 15. And this makes it really simple for me. My higher time frames are the daily and hourly time frame. That's what I look at to establish my bias. And from there, in the morning, I look at the 1 and the 2 minute. And for the rest of the day, I'm looking at the 5 and the 15 minute. I don't need to see the 10 minute and the 20 minute and the 45 minute. I really don't need that, right? I like to keep it simple. And looking at the 1 and the 2, 5 and the 15, keeps it simple for me. And of course, the daily and hourly are my higher time frames. Now let's go ahead and break down top-down analysis when it comes to swing trading. So let's say you're looking at a monthly setup. Maybe you're doing some longer term swing trading. I actually call that core trading. Or maybe you're making a long-term investment. And before you make that investment, you want to take a look at the charts to make sure that everything is aligned. So let's say you see a monthly setup. From there, you could find an entry on either the weekly time frame or the daily time frame that could be a bit more higher, reward to risk. Now, let's say you see a weekly setup. What I would do first is take a look at one time frame above and also take a look at the time frame below. So if you're looking at the weekly chart, I would look at the monthly just to make sure that everything is aligned. So let's say you see an opportunity to go long on the weekly chart. Check the monthly to make sure it's not in like an all-out downtrend or extremely bearish. You don't need the monthly to be a picture-perfect setup as well. Just make sure it's overall aligned, because you don't want to go long on the weekly time frame while the monthly is just flat out bearish. So take a look at the monthly, make sure it's overall bullish. And once you get that confirmation, from there, you can go to the daily time frame to actually find an entry for this weekly setup, all right? And the same thing applies if it's a daily setup. You look at one time frame above, and then you look at one time frame below for your entry. So if it's a daily setup, check the weekly time frame for confirmation. So let's say you're actually looking to go short off the daily setup. You see a daily breakdown, you think prices are gonna go lower. Take a look at the weekly to make sure that prices aren't into support, or make sure that prices aren't in an uptrend or all out bullish. If the weekly chart confirms that that stock or whatever you're trading is indeed bearish, right? There's alignment between the daily and weekly time frames. From there, you can go to the hourly time frame to trade that bias that you created on the daily chart, right? So the daily chart looks short, you check the weekly looks good, it's in a downtrend, it looks bearish, great. That's when you go to the hourly time frame to find a high reward to risk setup to trade that bias you established on the daily chart. So overall, it's pretty simple. Just use multiple time frames. It doesn't have to be this exact procedure for every trade where it's like, I have to look at this and then that, and it's like a step-by-step. If you're looking at a trade, look at the higher time frames, look at the lower time frames, and make sure everything is aligned. It's also really important to understand that you should only be looking at relevant time frames. And like I just mentioned, the general rule is to look at one time frame above and one time frame below. So let's say you have a 15-minute breakout as a day trade, and you know you're going to close out that trade by the end of the day. Well, looking at the monthly chart isn't really going to be useful. In fact, the monthly time frame is completely irrelevant if you're day trading, because the monthly chart is such a high time frame that it's not really going to influence day trading. So looking at it for a day trade is actually only really going to waste time and energy. So don't worry about the monthly at all. In fact, you also don't even really need to look at the weekly chart unless you're like looking at higher time frame support or resistance. However, though, if it's a day trade, looking at the daily time frame is going to be very significant, and I'm going to explain exactly why that's the case in the next section right here. It's actually blacked out right here, but we're going to talk about why the daily is so important. All right. Now, let's say you have a 15-minute and 1 hour breakdown setup. Looking at the 1 minute chart also isn't really going to be all that relevant for you. Maybe you could take a look at it just for confirmation, but if the 5 minute looks good, then there's no point of even looking at the 1 minute chart. It's just not going to be relevant. It's not going to make or break the setup. So if you're taking a 15-minute and 1 hour breakdown, maybe you could look at the 5 minute chart for confirmation, and then as long as the daily chart looks good as well, you're golden. Now, let's say you're taking a daily breakout for a swing trade. Looking at the 5 minute chart isn't going to be relevant. It's not going to matter at all. Maybe looking at the hourly, that could definitely matter. The hourly could play a part. And maybe looking at the weekly, like we just mentioned right here. Check the weekly for alignment, find an entry on the hourly. That could be significant. But looking at the 5 minute chart for a swing trade doesn't really make sense. Now, let's say you're taking a 1 minute scalp. Maybe this is a quick move. You know you're only going to be in it just for a few minutes. Looking at the 1 hour may not be that relevant because you're going for such a small move for a quick trade. Now, maybe looking at the 5 or the 15, that could definitely provide some useful information. But the 1 hour, it's just too large of a time frame to really play a significant part in your 1 minute scalp. And the reason why my top-down analysis is so unique and why I'm always starting off looking at the daily time frame for my day trading is because I am a gap trader. I like to trade stocks that had overnight changes in price. And every single morning before the stock market opens at around 8:30 a.m. Eastern, I do a scan and I look for stocks that had overnight changes in price. And these are called gaps. And the reason these overnight changes in price occur is because of the company reporting earnings, or maybe events within the company, or macroeconomic data, or some random news that dropped. And it causes traders and investors to buy or sell that stock in the post-market or in the pre-market. And it literally causes that stock to gap, where that stock is opening at a different price in which it closed the previous day. And this is a really good example of one. And this is actually a trade that I took today, and I'm going to break down the intraday setup a little bit later in this video. But this stock the previous day closed at around maybe like 1180. And then the next day, today, it opened at around 1350. And you could literally see the gap in the price charts. You could literally see that prices closed here the previous day, and then the next day they opened right here. You could see the gap in price, and that's why they're called gaps. But this is an overnight change in price. And I think this happened because of earnings. And that's the reason why I really like to day trade during earnings season, because a lot of companies, they report earnings either in the post market or in the pre-market, and it causes their stocks to gap. And when their stocks gap, they present amazing opportunities for day trading. So that's why in the morning I scan for gaps. And that gap, right, that difference in price on the daily time frame is what gives me the bias to potentially day trade it. Because remember, in the beginning of this video, we talked about that we look at the larger time frames first to develop a bias. And from there, we go to the smaller time frames to actually trade that bias. And that's exactly what gaps do for me. They help me determine that bias on the larger time frame. In this case, it's the daily chart. And from there, we go to the smaller time frames to actually trade that bias. And that's exactly what we do. All right. So when it comes to the smaller time frames in the morning, I'm looking, like I said, at the 1 minute chart, and then on the 2 minute chart. And then later in the day, I'm looking at the 5 minute chart and the 15-minute chart, exactly what we talked about right here. And my overall bias is if a stock is gapping up, meaning it has an overnight change in price to the upside, my overall bias, I would say 95% of the time, is to go long. If it's a gap up, I want to go long. Now, if it's a gap down, meaning it's an overnight change in price to the downside, my bias, I would say 95% of the time, is to go short. I want to trade in the direction of the gap. Now, there are some exceptions to this rule where I'll actually fade the gap. However, those types of trades don't come by. They don't happen every single day. So I'm not going to talk about the exception. I'm just going to talk about the rule. 95% of the time, I am going in the direction of the gap. And a lot of people are going to tell you that all gaps fill. Don't trade gaps or always go against the gap because all gaps fill. There's this idea, maybe you've heard it before. That is a myth. That is a complete myth, that all gaps fill. I'm a gap trader. I've been doing this for 5 years. Some of the best opportunities that I see in the markets are actually trading in the direction of the gap, where if it's gapping up, I want to look to go long. And if it's gapping down, I want to look to go short. Now, something that I really need to emphasize here is just because a stock is gapping up, opening in price to the upside, or gapping down, has an overnight change in price to the downside, it doesn't mean I'm going to trade it. Because every single morning, like there are some mornings where you'll see 100 gaps or 50 gaps or 200 gaps. I'm not going to be trading every single one of those stocks, right? Just because it's gapping doesn't mean I'm going to trade it. I need not only a high quality gap, and I actually have another YouTube video that I will link at the end of this video that will break down a lot more of the detail that goes into gaps and how to identify high quality gaps. I have a YouTube video just for that, so I'll link it at the end of this video. But not only do I need a high quality gap, I also need a high quality intraday setup. I need a high quality setup on the smaller time frames, and that's where we're performing top-down analysis. We look at the daily chart to look at the gap, to understand what the gap is doing, assess the quality of the gap, determine a bias, and from there, we go to the smaller time frames, whether it's the 1 minute, 2 minute, 5 minute, or 15-minute time frame, to trade that bias and to find an identifiable setup. And if you guys have followed this channel, if you've seen any of my videos, right, you know I only really trade two types of setups. I really only trade retracements or I trade breakouts, okay? This is called a buy setup. This is called a breakout, okay? That's all I trade. I trade retracements within an uptrend, or I'll trade a retracement on a gap up or on a gap down, or I'll trade a breakout on a gap up or a breakdown on a gap down. So it's very, very important. This is how my top-down analysis works. I look at the larger time frames, the daily chart, to assess the gap, and from there I go to the smaller time frames to trade that bias. Now, I just gave you a ton of different information, but from here, I want to show you some real life examples of some real trades that I have taken over the past few weeks where I actually applied top-down analysis. But before I do that, I have hundreds of hours of free education on the internet. A lot of that is on this YouTube channel, but I would also check out my free 10+ hour trading course that is genuinely better than most paid courses on the internet. It'll actually help build the foundation for your trading, and you could actually combine my YouTube material with my free 10+ hour course as well. I do tons of free trainings that are live like every other week or maybe once a month, so I would definitely attend those. And for anyone who is interested in personalized mentorship, you're looking to actually pursue trading seriously and you want a hands-on mentor and you want to potentially trade live with me every single day, I also help scale and coach a small group of students to become full-time day traders in my mentorship. So if you're interested in that, you could also apply for that in the description of this video. So the first few examples that we're going to look at is how I would use top-down analysis to actually figure out support and resistance areas. And support and resistance is extremely important in your trading because of a couple of reasons. Number one, it helps you pick targets. It helps you understand when you need to exit out of the trade. And it also helps you differentiate high quality setups from low quality setups. It also helps you understand whether your trade even has the potential to continue in your favor or whether it's actually, trading into a very congested area on the chart. So we have the ZVRA here, where earlier this week it gapped from 1175. That's where it closed the previous day. And then the next day it opened at 1031. You could literally see this gap in price on the chart. And this gap was actually pretty interesting because it was clearing this pivot. And pivots are going to act as an area of support. So we were gapping below this support, below this pivot, which is interesting. Now, let's say I wanted to potentially trade the ZVRA as a short on the intraday timeframes. What I'm going to do is ask myself, okay, great. This stock gapped below this support, it gapped down, so I'm gonna have a bearish bias. But how much room does it actually have to fall? What could my potential targets be? So if I do take this trade on the intraday time frame, what kind of reward to risk should I expect? What type of targets should I aim for? So I'm on the daily chart. That's where I always assess what the gap is doing, right? And from here, whenever I am determining support or resistance, I always look to the left. So the stock is gapping here. I'm going to look to the left. All right, great. What's the next area of support? Where I'm going to go down. I'm going to go down until I find that area of support. So I see a pivot right here. I see a pivot right here. And then I see this prior high over here. So this entire area right here, where's the rectangle, is going to act as support. This is a potential target area if I wanted to short this. Not only that, you guys see this 200 period moving average. By the way, in my trading, I only use the 20 period moving average and the 200 period moving average. That's all I use. So you guys see this 200, that could also be an area of support. And that would basically be my target. And that's exactly where this trade ended up falling to. This trade broke down in the morning, and that's exactly where the target was basically. It fell directly to the 200 period moving average on the daily chart. So this is an example of me assessing a potential target on the daily chart and then going to the intraday time frame to potentially capitalize on that target. So there wasn't honestly that clear of a setup here. You could say that this is actually a 5-minute 1, 2, 3, right? And I would highly recommend watching my free course to understand that setup. But basically we have an igniting bar, that's number 1. We have resting bar number 2, and then we have this triggering bar, which is number 3. So that's the 1, 2, 3 pattern. And then of course this ignited this move lower. So my entry would be below these two candlesticks, okay? And my stop loss would be over the highs of the resting bar. That is what a 1, 2, 3 is. Entry below the lows, and then the stop loss over the resting bar. And I could have capitalized on this move lower and hit that target, which is the 200 MA on the daily, or this prior support area. Here's another example of using top-down analysis to find a resistance or potential target area on a trade. And this AAL, the American Airlines, was called as a long in my group yesterday. And I think the call was over like $13, somewhere around here. And it was more or less just a quick trade. It was like a scalp because prices were really closely following the 20 period moving average. And that's exactly why I use the 20 period moving average, especially this breakout here. This was beautiful. It went up, retraced a bit, based into the 20, nice breakout. But there was another mini breakout somewhere around here on the 15-minute time frame. And I actually recommended against this, right? And seemingly, it looks kind of good. It's respecting the 20 MA. It's in a really consistent uptrend. Looks good on the 15-minute chart. Let's look at the 5-minute. 5-minute overall looks good as well. In an uptrend, looks higher. Fantastic. Let's look at the hourly. Hourly is kind of extended. That's definitely a red flag. Extension is basically the distance between price from the 20 period moving average. So whenever I say extended, you could think of it as like overbought. So it's kind of extended, but you know, it doesn't really have that much resistance to the left, maybe at 13.16, right? Could definitely have one more pop higher, maybe to like 13.30, 13.40. So that could definitely make money as a scalp. However, you look at the daily time frame and what do you see? You see this 200 period moving average that is going to definitely act as resistance. And that's exactly what stopped me from taking the trade, because I'm noticing that, hey, this stock attempted to hit the 200 already, and it was rejected. And once again, it's attempting to hit the 200, but that 200 is a strong area of resistance, and it's kind of unlikely that it's going to break. Maybe it does break. Maybe it doesn't care about the 200 and it rips right through it. But from my perspective as a trader, and I'm looking at the reward versus risk, I'm taking a long that's directly into a, strong area of resistance on the daily time frame. And keep in mind, the daily time frame, that's a higher time frame. I'm going to respect the daily and what's on the daily, you know what I mean? So I looked at this and I decided not to take the trade, and funny enough, it never ended up breaking this 200. So this is an example of looking at multiple time frames and looking at what the next resistance area is. And that's why I love the 200, because whenever the 200 MA is flat, it acts as an amazing area of resistance or support. I'll show you one more example of a stock that's actually gapping into resistance. So this stock closed the prior day at around 48.69. And then the next day, which is this day, it opened up here at $57. Now you see a massive red bar, and this thing just absolutely got sold off. But I was never even interested in this gap as a long in the first place because it was gapping directly into a resistance area. So it gapped from 48.69 to $57, and that $57 is directly into these prior highs right here. And we could even look at the weekly to see if there's any other resistance. And what do you know? We have resistance up here as well, right? This is kind of like an equal high situation. So this stock basically gapped into a weekly and daily resistance. So if you ever want to look further back in time to find resistance or support, you can actually go to the larger time frame. So that's what I did there. I went from the daily to now the weekly time frame to see, is there any more resistance? And you could see that resistance right here. And that this stock gapped into that resistance, and it instantly got sold off extremely hard. Literally, as soon as it opened, it just collapsed right back down. Now, I didn't trade this. Keep in mind, I like to go in the direction of the gap 95% of the time. So I didn't take this trade short, right? And I wouldn't have taken it short. Even now that I know that it dropped so hard, I still wouldn't have taken it short because that's not my strategy. That's not what I do. But here's a good example of a stock that gapped into a larger time frame resistance area, and as a result, it was a gap up. So gap up, in theory, we should actually continue higher, but it got completely sold off. Now let's look at an amazing example of a trade on a gap up. So this is the Joby, and as you can see, this is in a really nice uptrend. You can see how well prices are respecting the 20 MA, and we make this really strong move up. At this point, we're extended from the 20 MA, and this stock needs to correct. And the two ways in which prices can correct is either through a pullback, which is a correction via price action, right, like a retracement, or through time in the form of a consolidation. And Joby actually consolidated through time. This thing just went sideways for basically 2 weeks. And on this day right here, it gapped from 11.12 to 18.38. And we were essentially clearing the highs of this resistance area. And that's why it's so important to look for gaps that are either clearing resistance to the upside if you're looking to go long, or clearing support to the downside if you're looking to go short. You want it to gap above resistance for a long, or you want it to gap below support if it's a short. In this case, we were gapping above resistance since it was a gap up. And this actually triggered a really nice move higher. So I saw this in the pre-market. I saw that we were gapping above this base. We were essentially triggering a higher time frame breakout. And we also had 2 red bars the previous day. So there might have been actually some short sellers that went short these past 2 days and are now waking up to their positions underwater, which could put pressure on them to cut their losses and essentially cover their trades and buy back their shares, which leads to buying, which leads to prices moving up. Or some people maybe sold. They're seeing it's gapping up. They feel FOMO and they're going to hop back in. Regardless, when I saw it this morning, it was clearing resistance, triggering a breakout on the daily time frame. What's top-down analysis, right? At the top, daily time frame is bullish, triggering a breakout on this gap. Great. I go to the smaller time frames to find a potential setup. And what setups do we see? Well, right off the bat, we see a great little buy setup. We see a retracement. We have a nice move up. We have a pullback. Nice little entry doji bar. I have a whole video that talks about entry bars and the importance of having an entry bar for your setup. I highly recommend watching that video. Nice doji bar. Entry would be above this retracement right here, above the doji bar. Stop loss below the doji bar. We got this move higher, then another buy setup right here, another pullback, and boom, we have another move higher. Really, really nice. We look at the 15-minute time frame. We honestly see sort of the same thing. Okay, we see basically the same thing. It's not as clean, so that's why like off the 15, you're not gonna find a great entry. That's why it's so important to go to the smaller time frames, right? Look at the 5, great, we have a doji bar, we have an entry bar that we could use for our entry. Same thing here, we have a couple of doji bars and resting bars, entry above, stop loss below the lows of the retracement. We can even look at the 2-minute for confirmation. What do we have in the 2-minute? 2-minute looks overall pretty good as well, a little bit more sloppy, but nevertheless looks good based directly into the 20 period moving average. But I would say it looked the most clean on the 5. So I would just use the 5-minute for my entries. And that's the importance of using multiple time frames, because if you looked at the 2 or the 15, the setups were like okay. But if you looked at the 5, you saw some really nice entry bars. You saw some really nice ways to actually play the bias on the larger time frames. Here's another just beautiful example, and this is actually a gap down. And this stock gapped from 2019 the previous day on the daily time frame, and the next day it opened at 1885. Now notice it opened directly below this 200 period moving average, and that's the importance of looking at the daily time frame to not only assess the gap but also assess where is their support. And you could see that like right here, it hit the 200, popped, hit the 200, popped, hit the 200, popped. Every time it hit the 200, it ended up rallying. Even here, it broke it, but then immediately shot right back up. So this 200 was a very clear support area for this stock. And then on this gap, we basically gapped directly below it, and we were gapping almost below all of these tails. Now, we did have some support right here, but overall, it's a pretty powerful gap, all right? And so this gap gave me a bias to go potentially short on the intraday timeframes. Great. I don't just short if I see a good looking gap down. I need to look at the intraday timeframe. So let's start off looking at the 15-minute chart. What do we have here? Okay, so right off the bat, we have a sell-off and a retracement. Okay, great. I kind of like this retracement. Let me go to the smaller timeframes to find an even better entry. And do we have a better entry? Absolutely. I mean, look at this 5-minute. This 5-minute, I mean, almost picture perfect. Drop, retrace, and notice how this retraced basically like 40 to 60% of the prior move. Like this was the move. It retraced around probably 60% of this move, which is what I like. I don't like to see super deep retracement, so I wouldn't want this to pull back all the way up here. If it retraced 100% of this move, then that's a little bit too bullish. But it retraced around 40 to 60% of this move. You could use Fibonacci levels if you want. And from here, it's a sell setup, right? I teach this in my free course. Entry below these resting bars, you could put your entry below this tail or right here, all right? And put your stop loss directly above. And by the way, this literally just continued lower the rest of the day. Absolutely beautiful setup. And by the way, you could have even went short every time it kind of got close to the 20 MA, right? If we look at the 2, let's see if we have any setups. On the 2, we actually have a bunch of setups, right? If you didn't catch this, right here we have kind of a breakdown. We attempted to break above, let me kind of zoom in. We attempted to break above the 20, and then we got rejected. Could have went as a breakdown here. Or even here, it was respecting the 20 period moving average. And this is why I like to use the 20, because prices and the 20 MA, this is that blue line right here. This is why I like to use this blue line, the 20 period moving average, because prices respect it during established trends. So, but I would say honestly, the best setup here was the 5-minute. And you could just look at the 2-minute or 15 for confirmation. And obviously the daily chart was so freaking bearish. But this is just a nice retracement, move lower, retraced, sell setup, move lower. Beautiful. And then the daily chart confirms that. We can even look at the weekly. Let's say we do want to look at the weekly. Weekly, we know that once we clear this support, we basically have plenty of room to drop almost until like right here, or right here at the very least. And that's exactly where we dropped to. So weekly looked good, daily looked good. And that's how you perform top-down analysis. Now let's take a look at an example actually from today. So we're starting off on the daily time frame, and I actually saw this gap literally first thing in the morning at like 8:30 a.m. So this wolf had a nice uptrend, rising 20 period moving average, and this thing was actually consolidating between this like 550 area and this 470 area. So consolidated for a while, and then today it gapped from 545 and it opened at around 719. And as soon as I saw this, I'm like, okay, interesting gap. It's triggering this breakout on the daily time frame. Great. Does this have room to run? It's gapping to 720. Okay, I'm on the daily time frame. Let's do top-down analysis. Let's look at potential targets. So if we look to the left, what do we got? All right. Well, I'm noticing that right off the bat, this is kind of an area of resistance, right? There's a pivot here. There's a pivot here. We have kind of a big choppy area here. So this is going to act as an area of resistance. Excellent. Are we gapping above it? Yes, we are. Great. So we've cleared this area of resistance. Fantastic. What's the next area of resistance? Well, look to the left. We move up, find a pivot or a base right here. Okay, we have a kind of a pivot here. You know, it went up, moved down. Pivot here, went up, moved down. We have a pivot here, pivot here. We just have a lot of choppiness and congestion here. So this entire area is going to be an area of resistance. So draw that out, okay? And that could be potentially target. And honestly, let's put it like kind of like up there, just like that. So that could be potentially target. And that's the way I interpreted it. So I'm like, okay, 719, it has room to run to anywhere between 820 to like $9. And that was actually my first target. I thought $8 was my first target. $9 would be my second target. So great, this has 80 cents to $2 to run. Fantastic. Now let's go to the smaller time frames to find an entry. And the first entry that I saw was actually, it was off the 1 minute time frame, in fact. So this was actually very early in the morning. Let's go ahead and find it. It was right here. This was my first call out on the wolf. It was over this base right here. So that's over 740. And I saw this small little consolidation, stop loss 720. And it kind of chopped around for a bit, and then it absolutely took off, and it actually hit $8, which was my first target. So 1 minute looked good, but when I was looking at the 1, I also took a look at the 5. 5 looks good. In fact, it triggered, kind of based again, and set up for another breakout. Fantastic. So 5 minute looks good. What about the 15? The 15, let me kind of erase these. 15 doesn't honestly give us that much information, but looks good as well, right? We have a big bottoming tail, which suggests that the buyers took control, right? That means the sellers tried to sell the wolf off, and then the buyers rejected it, so that looks good. So all in all, great. And then, by the way, what do we have here? We have a buy setup, which is a retracement pattern. We have a nice move up, pullback, nice little entry bar, resting bar, entry above, stop loss below, and then boom. And this wolf was just fantastic. But hopefully you understand my thought process. We look at the daily, understand the resistance, understand that it's a gap up, triggering a breakout on that daily chart. And from there, we went to the smaller time frames. We looked at the 1 minute, the 5 minute, and the 15 minute. And that's how we developed our bias, and that's how I was able to capitalize on this trade. The last stock we're going to look at is the DLO, and this was actually a trade that I took today. And this stock had a nice sideways kind of consolidation, and it was gapping from 1166. It was already starting to move higher, and it was gapping from 1166 to around 1360. Now, this wasn't really a favorite because it was already moving up, and then it just kind of continued that move. I like gaps that actually shock buyers or sellers. So for example, let's say this was actually moving down and then it gapped up. It would be shocking all of the sellers from the previous day, but that's fine. It was already moving up, gapped up. So I'm thinking to myself, okay, what's the next resistance area? And I'm looking at it, I'm like, okay, there's kind of some strong resistance right here. So it's kind of gapping into this prior high, which I didn't really like. And even if you look at the weekly, right, we had a bunch of congestion here too. So it wasn't really a favorite for me when the market opened. It was on my radar, like I had it on my watch list, but it wasn't a favorite just because it was kind of gapping into the resistance, and then it kind of got sold off into that resistance as well. So it wasn't a favorite, but then as I was doing my intraday scanning, I just saw an absolutely amazing setup here, and I just had to play it. So this thing actually cleared that resistance, went right through it, and then just consolidated for literally, 2 hours? Not even. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. Yeah, I don't even know. 2-3 hours, literally consolidated. And I mean, you could just see it. Picture perfect breakout. Entry above the base, stop loss below. It was a tight stop, right? Like the stop was what? It was entry, I called it over 1454. Stop loss 1430 or 14, no, it was 1425. So it was like a 30-cent stop. And this thing popped to 1570. So you could do the math. That's like 3, 4, 5 Rs, depending on exactly what stop you used. Beautiful. So on the 15, it looks amazing. I mean, we can check the hourly. Hourly looks good. Looks good, right? Looks strong. What about the 5? The 5 looks amazing as well. Look at that 20 MA. See how the 20 MA started to hug prices higher? Beautiful. And then, by the way, we had kind of a retest here. We moved up, kind of retraced a little bit, and then boom. So you could have, if you missed this original breakout, you could have actually went long here, stop loss below. And I bet if you go to the 2 minute, you could see that kind of retracement. Yeah, you see how it kind of broke out, retested this prior resistance. Now that resistance became support and liftoff. Beautiful. And this is the thought process, right? Look at the daily, establish what the gap is doing, assess the quality, go to the intraday timeframes to find a potential setup. And that's why my that's why my top-down analysis is so unique, because it's all about looking at the daily chart to assess the gap, and then we trade the bias of that gap on these smaller time frames. We'll actually do one bonus one, and this was a trade from yesterday, and this was the Paramount Skydance. There was some like crazy news about it about like UFC or something. I don't even know what the news was, but all of a sudden this thing literally went up like 56% in a single day. Massive green bar, and it was coming off a green bar the previous day. You look at the weekly, I mean, by the way, right into weekly resistance, right? Remember this 200 period moving average around 18 bucks. Huge, huge daily candle. And I saw this on the 5-minute chart. So what happened here, right? We went climactic. We went exhausted. Nice move up, kind of retraced right into the 20 period moving average. That's why I like to use the 20 and lift off. And notice how this stock accelerated. This is why I liked it so much for a potential reversal, because the bars became increasingly larger. Like these green bars started off small, kind of retraced, small, 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 and then it started to get bigger. Then doji, then a little bigger, then a little bigger, red bar, bigger bar, and then boom, the biggest bar was at the top. Did we get a volume spike? We didn't get a big volume spike. I like to see spikes in volume at the top that can indicate a reversal, but we accelerated and we were really extended on the 5-minute time frame from the 20 period moving average. So we were overbought. And if you look at the 15, I mean, you'll see the same exact thing. Let's look at this 15. I mean, look at this. I mean, this thing went vertical, and that's why I liked it as a potential short. Went vertical. And from there, I went to the 2-minute chart for a potential entry. And actually, it wasn't even the 2-minute, it was the 1-minute. And I'll tell you exactly where I got in. I didn't see an entry here because it kind of just reversed, chopped around right here. You guys see this really small base? I got in below this base, and I basically just put my stop loss above. And boom, it just continued lower, right? So this is the importance of using multiple time frames to find an entry. Like on the 15, I don't see an entry. It just mooned and then dropped. I don't see a clear entry here. Even on the 5, I don't see a clear entry at all. You just have to hop in. That's why I went to the smaller time frame and I was waiting for something, and then I got this small little base and I was able to kind of trade it as a base breakdown, basically. And it was just an amazing setup. And by the way, go back to the 15. That was basically target. The 20 period moving average was target for this stock. And I liked it so much because on the daily, it was also exhausted, had a massive daily candle. And on the weekly, it was directly into that resistance area, right? So you guys see this thought process. I'm looking at the weekly for potential resistance or support. I look at the daily to find some information. I look at the 15, look at the 5. Then if I don't see any setups, I go to the 1 or a 2, right? I'm like almost a detective. I'm trying to find clues on how I could trade this setup. And that's why looking at multiple time frames and performing this top-down analysis is so important, because by looking at multiple time frames, you could find unique entries. You could find kind of make or break information, like before that, American Airlines, it was right into resistance, which was the 200 MA. So I couldn't take the trade, right? So you find make or break qualities in the setup, right? It's all about looking at multiple time frames and collecting clues. And when all of your clues signal that this is a great setup, there's nothing wrong with this, that's when you want to take the trade. All right, guys, that was probably a long video, but I really want to show you enough examples to make sure that this sticks. And it's really easy, right? We go to the daily time frame, understand what's going on with the gap, establish a bias, look if that gap is into support or resistance, understand the quality of the gap. And by the way, the linked gap video is going to be somewhere on this screen, and it'll teach you way more about gaps and how to actually identify high quality gaps. So watch that video as well. And then from there, we go to the smaller time frames to find entries and to find setups and to find ways to trade that strong bias on the daily time frame. And even if you're not trading gaps, I still want you to use this same thought process of looking at different time frames to collect clues, and always look at multiple time frames. It's going to give you so much information. If you're only looking at one time frame, you're trading blindly. You could be the best at identifying high quality setups in the market. You could be the best at entering those setups, but unless you know how to manage your position when you're actually in the trade, you're never going to see the results that you're looking for. In this video, I'm going to explain the importance of trade management. I'm going to explain why it is the missing link between you having good entries and you having a profitable trading career. And finally, I'm going to equip you with trade management strategies that you can begin implementing in your trading as soon as this video ends, so you could start scaling your profits on your winning trades. And what you need to understand about trading is that it's not about being right versus wrong. You could be right on a trade and still lose money. And you could be wrong on a trade and still be able to limit your loss. Trading is about getting paid for how well you can manage your risk, how well you can limit your losses, and of course, how well you could extract profit from your winning trades. And you could have two traders who enter literally the same exact trade, the same exact entry to the penny, and one trader can leave that trade with a massive winner, home run trade, and the other trader can lose money. And the difference between those two traders is how they manage the position. And I see lots of people online talking about finding the right entries, having the perfect entry model, but they don't talk about how to manage your trades effectively. And some of the most common mistakes that I see with beginner traders, especially with trade management, is number one, panic selling on retracements. This is when you're in a winning trade, it's going in your favor, you're feeling good, and then all of a sudden it starts to retrace. It starts to pull back and you are seeing your profit slip away. And what happens? You start to feel fear, you feel doubt, and all of a sudden you panic sell right here just to see that trade continue in your favor and hit target. And this happens because you don't have a system. You're entering, let's say randomly, and you're exiting randomly, right? Another really common mistake is having a huge winner turn into a loser because you don't know where to take profits. You don't know when to get out of the position and secure profits. This is sort of the same thing right here, failing to hold a winner. I see this all the time, especially with beginners, where they're making, let's say 20, 40, 60, $100 on that trade. And instead of letting the trade hit their target, they get out right away, right? And I think this usually happens because of self-doubt, because of succumbing to their emotions, where maybe they're not confident in themselves yet to really hold on to a trade. They don't know whether they're, picking the right setups yet. And as a result, they succumb to their emotions and they impulsively exit the position, or they impulsively even add to the position when they're not supposed to. Another very common mistake is not cutting losses quick enough. This is when a trade is approaching your stop loss or where you're supposed to exit and you don't get out. You freeze, you hesitate, you feel fear that you're about to lose money, and then the trade blows by your stop loss and continues against you. Now, the only way to fix these common mistakes, and it's actually pretty simple, it's to have a predetermined management system. What does that mean? That means when you enter into a trade, you know exactly how you're going to manage the position before it even hits your entry. And if you've watched my channel long enough to this point, you know that I stand for consistent input, consistent action will lead to consistent results. And there are way too many traders out there who randomly enter trades, randomly manage trades, randomly exit, and their input is completely random, and then they expect consistent results. How does that make sense? How can you ever find consistency if your input is random? It doesn't make sense, right, at all. So that's why you need a predetermined management system. So when you enter into the trade, you're not guessing what to do. You're not guessing, oh, should I take profits here or should I raise my stop loss there? You know what to do before you even entered into the trade. And you can even write it down on a piece of paper, put it on your your desk or your monitor or your wall so you know what to do. And what you need to understand about trade management is that very small tweaks, very small fixes in your trading could lead to massive profit increases. I always like to show you guys on this channel that trading is very much, your progress and your results is very much exponential. It doesn't go linearly, right? Like, it's not like the more time you put in, the more money you make. No, your progress is like this. It goes exponential. And you don't want to quit before this point right here. And in order to have that exponential kind of move, you might just be a few small tweaks in your trading management plan away from having that exponential rally in your trading. And there's ultimately only two outcomes that can exist when you enter into a trade. Let's go over outcome number one. Let's just assume that you just entered into a new trade. You've opened a new position and you've already identified your entry, your stop loss, and your targets for this position. And by the way, if you don't know what your entry, your stop loss, and your targets are for that trade before you enter into the position, you have a lot of work to do. You are not where you should be in your trading. And if you do need help with this, you need help with predetermined setups, I highly recommend watching my free 10+ hour course. It is genuinely better than most paid courses on the internet. It's going to build the foundation for your trading so you could actually identify high quality setups, and you're gonna know where the entry, stop loss, and targets are going to be. So make sure you start watching my free course ASAP. It's in the description of this video. So you open up a new position, and let's say the trade doesn't work in your favor. You get in, it looks good, but the trade just doesn't work, right? Losing in trading is inevitable. You're obviously going to have losing trades at times. It's part of the game. So it doesn't work in your favor and it hits your stop loss. What do? You exit the position and you take the loss. There's no confusion here. There's really almost no management here. If you get into a high quality trade and it hits your stop loss, it hits your max risk for that position, I don't care what your emotions are telling you. I don't care what your inner thoughts are telling you. I don't care if you think that's about to go up or about to go in your favor. Does not matter. If it hits your stop loss, you exit the position. And there's really no management even required here because you already identified your stop loss before you took the trade, right? So that's really simple. You get into a trade, it hits your original stop loss, you get out, no questions asked. There's really not much management there. The second outcome is, let's say the trade actually goes in your favor. The trade is a winner and it's starting to approach your target. What do? Do you exit the entire position? Do you exit half of the position at target? Do you ignore target one and go for target two? Do you exit some of it, right? Do you trail it? Do you raise your stop loss, right? And you have to be thinking to yourself, what if this trade continues even more in your favor, right? You don't want to miss out on potential profits by exiting the trade too early. And you need to have a plan of execution on what you're going to do if the trade approaches your target or starts to move in your favor. And that's exactly where trade management comes into play. So let's say the position is approaching your target and it hit your target, right? You honestly have three options here. You could take profits right here, where you just take 100% of your profits, you take the W and you move on to the next trade, and you don't really care if it continues higher in your favor, right? Number two, you trail the position and you raise your stop loss. And this is really where trade management comes into play, and I'm about to talk about exactly what trailing your position is. Number three, you take partials, where you, let's say, take 50% of profits here, and then you aim for a bigger target up here to see if the trade kind of continues in your favor, right? So you exit half of your position and you leave the other half of the position still in the trade, and then you end up trailing the rest of the position. So that begs the question, what does trailing your position mean? Like, what does that actually entail? And that's where trade management really comes into play, in my opinion. And trailing your position is just a fancy way of saying you're adjusting your stop loss. You're raising your stop loss if you're in a long, or you're lowering your stop loss if you're in a short. Now, your goal is to place your new stop loss, right? Because when you entered into the trade, you have your original stop, right? Let's say the trade's starting to go in your favor, then you raise your stop loss. And the goal is to raise it to a location where you're not going to get shaken out easily, but you're also maintaining a high reward to risk. So what does that mean? What is shaken out? Like, what is that term? So let's say, for example, you have a consolidation pattern like this, right? And let's say this is the pattern here, right? You have a low here and you have this consolidation. Getting shaken out is basically where, let's say you enter into the position right here. It hits your entry and then it starts to pull back. And let's say you have your stop loss right here. It begins to pull back, it hits that stop loss, and then it just continues in your favor. And it actually continues and the trade actually works. You getting stopped out right here just to see the trade actually continue in your favor, that is called getting shaken out of the position, where it hits your stop loss and then it continues higher in your favor, right? But at that point, you're not in the trade because it already hit your stop. And this happens to all traders, getting shaken out of a trade where it hits your stop and then it goes in your favor anyway. Now, let's say we'll take this same example. Instead of putting your stop loss here, let's say you put it here, right? And it hit your entry and it started to pull back. And let's say it pulled back to right here and then continued higher. Well, if your stop loss was here, you would have gotten shaken out. But if your stop loss was here, you would have stayed in the position and you would have actually realized the profits on this move up. Does that make sense? So depending on where you place your stop loss is going to impact the probability of you getting shaken out of that trade. Where if you gave this trade more room, you placed kind of like a larger stop loss down here, you would have stayed in the trade. But since you placed such a tight stop loss right under this base right here, it shook you out and then it continued higher. So the goal for us is to trail our position, adjust our stop loss in a way where we're not going to get shaken out easily, in a way where you're allowing the trade the room to fluctuate, but you're also maintaining a high reward to risk. And if this is still kind of confusing, don't worry. This is all going to make sense once we look at some examples and once we understand the strategies that we could use for trade management. But all in all, guys, what I want you to understand about trading is that trading is not a science. Trading isn't something that you're going to read in a book, you do exactly what that book says, or you do exactly what another trader says, and you're going to make money. This is why I'm so against these Discord groups where there's no live trading and they literally just call out plays and then they send you the management, right? That management, that trade, and the way that specific trader trailed or managed his position might be different from the way you should manage your position. Every trader is different. No two traders are alike. And this is what makes trading such an art. And I always tell my students that never just directly copy me. You don't want to do that. You could take the same trades that I take, but I want you to manage it the way that you think you should, the way that makes sense to you. Trading is an art. And in order to understand this art, you need to have your own personality and your own style. You are your own artist in a sense, right? Like when you see painters paint stuff, every painter is a little bit different because they have their own style. Same thing with trading. You're going to have your own management style, and that's fine. That's the way you figure out your trading personality and you figure out what works for you. Now, let's talk about the first way in which you can manage a trade, and this is called a pivot trail. This is when you adjust your stop loss from your original point to the next pivot. So what is a pivot? A pivot is just it moves up, it drops, and then moves up. This right here is a pivot point where it moved down and then up. This is a pivot, right? So when you're raising your stop loss to a new pivot, you essentially get into the trade here. It moves in your favor. let's say it actually hits your target, right? And let's say you get out, I don't know, 50% of your trade here. Great, you're out 50% in profit. You still have the other 50% of your position. It starts to pull back, it forms a pivot low, and from there you could raise your stop from the original point to that pivot low, because the pivot is basically a way of like the sellers tried to take control and bring prices lower, and then the buyers stepped up and they brought prices higher, thus creating this pivot. So you could actually move your original stop to that pivot point. So this is actually a fantastic strategy if you have an established uptrend. Like let's say you have an uptrend like this, right? And you're in this thing long. What you can do is just continuously raise your stop loss, right? So let's say this is your original stop right here. As soon as it starts to move up, it pulls back and then continues higher, you move your stop loss from this original point to under this pivot. As soon as it starts to move up, retraces, continues higher in the uptrend, you move it from this stop loss to under this pivot, and you continuously raise your stop loss. Let's say it's here now, you raise your stop loss once again, and then as soon as this starts to retrace and it breaks below this low, you exit right here, and that's going to be your trail. And you're essentially allowing the trend to continue higher in your favor. You're giving the trade the opportunity to make you more money by continuously raising your stop throughout the entire uptrend. So this is a really effective way of managing your position if it's an established trend. And the same thing applies if it's a downtrend, right? So let's say we have something like this, and then let's say we have something like this, okay? Where your original entry, let's say, is right here, stop loss here. Moves down, retraces, begins moving lower again. You lower your stop to this pivot high. Then it does the same thing. You lower your stop to this pivot high. Then let's say now you have a consolidation. Then the consolidation breaks down, continues lower. You could lower your stop to the highs of that consolidation. And then let's say again, right here, pivot point, lower your stop here. And let's say it starts to reverse. That means the trend has been broken. It's no longer a downtrend anymore, right? Maybe it goes sideways from here or whatever, or maybe it goes into an uptrend. Well, you're out right here. And you're still in the trade until the downtrend is broken. So this is really, really effective for trending markets. For a stock that just keeps going up and up and up, or even the market. Let's say the market is in a really established uptrend on the daily time frame, you can continuously raise your stop like that. And you give yourself the opportunity to realize more profits using this type of strategy, okay? So this is actually really simple. I feel like most of you guys should be able to understand this. And it's a very common strategy as well that I use all the time. But let's go over another strategy that's a little bit more, I don't want to say complex, because it's really not that hard, but it's a little bit more nuanced, right? And this is called bar by bar management, or a bar by bar trail. So I'm going to read this. It's going to sound confusing. And then once I show you it on the charts, it's going to make a lot of sense. So when your target is reached, like let's say this is your target right here, and you entered right there, okay? So let's say that's target, that's T1, target 1, and let's say this is your entry. Fantastic. So when target is reached, trail the position to the prior bar's low. When I say prior bar, I mean candlestick, so the prior candlestick's low. So you're raising your stop loss when the candlestick has finished forming. So what does that mean? So it hits target 1 right here, right? This is your target 1. What you do, and let's say this is your entry, let's say your stop loss is down here. This is your original stop. SL, that's stop loss. Let me actually zoom in a little bit. Perfect, stop loss. And this is your OG stop loss, original, just so you guys understand. It hits target right here. From here, you can go bar by bar. So you raise your stop loss to the previous candlestick's low. So in this case, as it's surpassing target, you raise your stop loss from this point, the original point, to underneath this candlestick's low. And then as soon as this candlestick finishes forming and this one starts forming, right, and it starts to kind of base here, right, from there you raise your stop loss from this point to underneath this candlestick's low. And then as it starts to break out, right? Let's say it's moving up, you raise your stop loss from this point to this candlestick's low. And then you raise it to this candlestick's low. And as it's continuing in your favor, you're continuously raising your stop loss to every candlestick's low. In this case, let's say this is our new stop and it's continuing higher. We raise it again. After this one starts forming and this one, or after this one starts forming and this one's finished forming, right? You raise your stop loss again to this bar's low. And then as soon as this one's finished forming, you raise it again to this bar's low until you get a red bar. It takes out the lows of that candlestick and now you're out of the position fully. Does that make sense? So you're raising your stop loss to every candlestick's low as the trade is progressing in your favor, right? So you have moves up. Let's say these are all candlesticks. You raise your stop loss from here to here, then to here, then to here, then to here, then to here, until eventually it takes you out and this is where you exit. And this is called bar by bar management. And as long as the current candlestick doesn't take out the prior candlestick's low, you're still going to be in the trade, right? So let me kind of draw that out. So let's say you have this current candlestick that just finished forming and your stop loss is under it, right? As long as the next candlestick, right, doesn't like go down and take out the low of the prior candlestick's low, right? You're still going to be in the trade. Does that make sense? So you continuously raise your stop to every candlestick's low as the trade is heading in your favor. Hopefully this is making sense. It's going to make a lot more sense once we look at some examples, okay? And the same thing would apply if it's a short, okay? So if it's a short, it's the same exact thing. So let's say this is a candlestick, right? And it's progressing in your favor. The stop loss originally is here. Then you raise it to this bar's high. Then you raise it to, or lower it to this bar's high. Then you lower it to this bar's high. Then you lower it to this bar's high. Then you lower it to this bar's high. And as soon as it takes out the prior bar's high right here, you're out of the trade and you exit, okay? Does that make sense? So let's look at some examples and it's going to make a lot more sense in just a second here. And in terms of trailing bar by bar, most of you guys watching this video are going to be like, okay, I get that, right? You're just raising, as each candlestick is formed, you're raising your stop loss to its low gradually. Great, but how do we know what time frame to actually do this on, right? Because different candlesticks are going to represent different time frames depending on what chart you're looking at, right? So when it comes to swing trading, it's really easy. I would trail it either 1 hour, 4 hour, 1 day, or weekly bar by bar. Okay, if you're day trading, it's a little bit more nuanced. You can either trail it 1 minute, 2 minute, 5 minute, 15 minute, or 1 hour bar by bar. Now, this is easy. This sort of management is easy. You just raise your stop loss to the prior bar's low. It's actually really straightforward. What's difficult about this is figuring out which time frame am I going to apply bar by bar management on, right? And if you want a tighter trail, meaning you want to secure profits more quickly without giving the trade the room to fluctuate, like let's say it's hitting target, you feel great about the position, you want to manage tightly. You don't want to allow the trade to go that much against you in an attempt to move higher, right? You want to trail it quicker. You want to take quicker profits. You're going to want to use smaller time frames with your bar by bar management. But if you want to give the trade way more room to fluctuate and operate in order to go for a much larger move or gain, where you're going to use the larger time frames for your bar by bar management. Does that make sense? So if you want tighter management, you want to take profits quicker, you want to secure your profits quicker, you don't want the trade to fluctuate or go against you that much, you want to secure your profits sooner, you're going to use the smaller time frames, like the 1 to 2 to 5 minute, to manage your position. If you want to give the trade way more room to fluctuate against you in an attempt to go for a much larger gain, or to an attempt to capture just way more profit, that's when you use the larger time frames, and you could use like the 15 and the 1 hour. Personally, I usually use the 1, 2, 5, and the 15. I rarely use the hourly for my day trading in terms of managing my position. Okay? So I just gave you guys a ton of information. Now let's go ahead and look at some practical examples, and I'll show you how to actually apply this. So every single example that I'm about to show you are actually trades from this past week. I didn't like cherry pick trades from like 5 months ago. These were literally setups that were on my watch list this prior week. The first one that we're going to talk about is actually the MAT, and this was just such a terrific trade and gap, right? So MAT, we're first looking at the daily time frame. I just want to show you why I even was looking at this trade in the first place. We had a beautiful gap down from here to right here. You could literally see the gap on the chart. I think this was because of earnings. I can't remember, but we gapped directly below the 200 MA. We gapped below this area of support. And it was just, and we were also gapping kind of below this move higher. So it was shocking the people who went long during this move up here. And it was gapping under the 200, which is an area of support, and also kind of gapping underneath these candlesticks. And it had just tremendous follow through. And I had a bearish bias on this stock going into the day. So I went to the smaller time frames to look for a potential setup. So a very obvious setup that I see is move down, move up, base, and this is literally a textbook sell setup. Textbook sell setup is a retracement within a downtrend. You get a move lower, you retrace. This is a sell setup, and you attempt and you essentially make money in the next move lower. Now, I teach the sell setup in my free 10+ hour course. So if you're not familiar with that term, you don't know what we look for in a sell setup, watch my free course. It's going to teach you all of this, and you could use this video in conjunction with my free education. Now, what would be the entry here? Entry underneath these entry bars, stop loss directly above. And obviously this continued lower. Now, let's say this is our first target right here, the prior low, and it hit target right here. Now, what can you do? You could take profits. Sure, take 100% of your profits. You're out of the trade. You made your money. Great. Or you can trail your position. So let's say this starts to move down. Now, do we have a pivot? Do we have kind of like a retracement up and then a move down? Not really. You could say this is a pivot right here, but it's really not a pivot, right? Remember what we talked about right here. Like, can you guys really find a pivot on this chart? Not really. We don't really have a pivot like that. So our best method of management is bar by bar. Now, let's say you go 5-minute bar by bar. It hits target right here, and you lower your stop from this point to, let's say, this candlestick's high right here. So you lower your original stop from here to right here. And let's say you continue to go bar by bar. This bar finishes forming, and then you lower your stop again right here. But you would have gotten stopped out on this green bar. It would have stopped you out just for it to continue lower. And remember what we call that? We call that getting shaken out. So if you went 5-minute bar by bar here, right, and you lowered your stop, you lowered your new stop from right here to right here, you would have gotten shaken out on this green bar just to see the trade continue in your favor. However, if you went to, let's say now, instead of the 5-minute chart to a higher time frame, the 15-minute time frame, and you went bar by bar, well, the outcome would be completely different. So let's say it hits target right here, and you lower your stop from this point to this candlestick's high, 15-minute bar by bar. Well, let's say it's starting to continue lower. This candlestick finishes forming, and this one begins. Great, you lower it again. Now it's here. This candlestick finishes forming, and this one begins. You lower it again. This candlestick finishes forming, and this one starts. It's basically the same stop, right? Same thing here. You lower it here. This one stops forming. This one begins. You lower it again. You lower it again. You lower it again. Again, and you literally just continue to lower it, right? You could see that during this move lower, not a single 15-minute candlestick took out the previous one's high. So you're still in the trade until right here when this green candlestick surpasses the high, and now you're out of the trade. Now, By going 15-minute bar by bar, you were able to capitalize on this entire move lower versus if you went 5-minute bar by bar, well, you're getting shaken out, what, right here. And you're missing this entire move. Does that make sense, guys? So the art of managing is figuring out which time frame should I actually manage it off of. Should I give the trade more room to fluctuate? Like in this case, by using a 15-minute bar by bar management, you're giving the trade more room to breathe. You're giving the trade more room to fluctuate. And as a result, not a single 15-minute bar took out the previous one's high. So 15-minute bar by bar would be valid the entire way down until right here. By that point, you've already made your money. I think this was a 20-cent stop. This is like 7 to 8 Rs. If you were risking $200 on this trade and it went 7 Rs, you made $1,400 off $200 risk because you went 15-minute bar by bar, right? And this is the importance, and this is how trading is like an art. Managing trades is an art. Let's look at another example. All right, we'll start off with the daily time frame to establish the bias and understand the gap, right? So this is the daily chart. So we gapped from here all the way to down here. This was a pretty massive gap. It was actually gapping right into support. So I actually wasn't that aggressive with this one this past week, but nevertheless, it did produce tremendous follow through to the downside. Great, so it was a gap down, bearish bias. Let's look at the intraday time frame. So right here, we kind of have this like 5-minute base. This is not very nice, kind of sloppy. So I'm actually going to go to the 15-minute time frame because this is where the setup really was. This is a 15-minute 1, 2, 3. We have 1, that's the igniting candlestick lower. We have 2, the resting bar, and then 3, the triggering bar. This is like a 1, 2, 3 play. Some people call it the ABC, right? And the entry for the 1, 2, 3 is under the resting bar's low, stop loss over the highs, and of course this continued lower, right? Now, let's say you enter here, it's going in your favor, and you wanna go bar by bar, right? There's no pivot here. I guess if you held through this, right? This is a pivot, and let's say it continued lower, you could have actually lowered your stop loss from this point to that point right here because this is a pivot, right? This is what we talked, this is the first strategy that we talked about. Then let's say it moved down, moved up again, moved down, boom, you lower your stop loss from this pivot to this pivot. Same thing happens. It drops, bases, attempts to move low, attempts to move higher, continues lower, then you lower your stop loss again to over the highs here. And by doing this, you're continuously lowering your stop, right? So it was originally here, now it's here, now it's there, now it's there, and you're in the trade essentially the entire day. The other way you could have done it is 15-minute bar by bar, where this one finishes forming, so you lower it to here. And then as soon as this one finishes forming, you lower it to here. And then of course you would have gotten stopped out on this on these green bars right here. Or what you could have done is done it on a smaller time frame where the stop is right here. Then you go 5-minute bar by bar. Instead, this is the 5-minute chart. So you're using tighter management, right? Tighter management since it's a 5-minute time frame. So it's a smaller time frame. Remember what we talked about, guys? That looser trail, right? It's a higher time frame. You're giving the trade more room to fluctuate. A tighter trail is on the smaller time frames, and you're securing profits quicker, right? So off the 5-minute, the original stop is right here. Then you would lower it to here. Then you would lower it to here. Then to here. Then to here. Then to here. And then you would lower it to here, and you would have got stopped out on this green bar. But I guarantee by going 5-minute bar by bar versus 15-minute bar by bar, you're actually securing more profits because you're doing it on a smaller time frame. And you could even do the same on the 2-minute chart or the 1-minute chart, right? This just makes sense. So depending on the time frame that we choose, it's going to impact what our management is going to be. Let's look at the next setup here. This is also from this past week on the EME and the ME, okay? Just really nice uptrend, respecting the 20 MA here, respecting the 20 MA here, 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 here. We get a gap up, right? We closed the previous day here. We gapped up right there. You can see the overnight change in price. So bullish gap, right? It's continuing this trend higher. okay? We go to the smaller time frames for a potential setup. So this is the 5-minute time frame, okay? And this was the 15-minute time frame. So let's say we're taking a trade off of the, actually, let's say we're taking a trade off the 5. Let's say we're taking this as a buy setup right here, right? We have a move up, it retraced. We have a buy setup retracement pattern. What is a buy setup? That is a retracement within an uptrend, right? Keep in mind, it's a daily uptrend and it's a bullish gap up. Since it's a bullish gap up, that gives us a bullish bias on the day. So it's a buy setup. It's a retracement within an uptrend, right? Entry here, let's say stop loss below the lows of the retracement. It starts to move up and it consolidates, and eventually it sets up as a potential breakout. What can you do? Well, as it's starting to break out here, you could actually add to the position, or yeah, you could add to the position and then raise your stop loss to here or even here, right? Or you could just raise your stop. You could just raise your stop loss to that low right there, right? So if you look at the 15, right? If you trade this as a breakout entry here, and you could put your stop loss there, you could put it here, and you could put it there. This is a really loose stop, meaning like you're giving the trade a lot of room to fluctuate in an attempt to capture the move higher. But when you have a looser stop, you have worse reward to risk because you can't get as many shares since you have a wider stop. But if you have a tighter stop, you have better reward to risk because you can get more shares on your position. I would watch the risk management video in my free course or some of the videos on this YouTube channel that go over risk management, and it'll explain the way you could size your positions. But okay, let's say it triggers, it starts to go. It moves up, forms a pivot, and then continues higher. Great, you could actually raise your stop loss, let's say from this point right here. Perfect. And then let's say as it's continuing in your favor here, you just go bar by bar. And now you did pivot, trailed it to this pivot, and then you went bar by bar. And now you go bar by bar here, then raise it to there. And then as this one finishes, this one begins, you raise it again. Then this one finishes forming, and this one begins, you raise it again, and again, and then again. And then right here is where you would have gotten stopped out because this bar took out the low. It took out this 15-minute bar's low, and as a result, you're out of the position. You could have also done it 5-minute bar by bar, but if you did a 5-minute bar by bar, you would have probably gotten stopped out like even here or definitely here because this bar took out this low, right? So it's a balance. You have to figure out which time frame you want to do it on. Next, we have the Comcast. This was a bearish gap down from last week where we gapped from here to right here. We kind of gapped below this pivot. We did have a ton of support to the left. So I wasn't in love with this gap, but nevertheless, it did produce nice follow through. So gap down, bearish bias. Fantastic. We don't have an amazing setup here, I'll be honest. In the morning, we don't have an amazing setup, but I just want to use this more as an example. So we have actually here the 15-minute time frame, the 5-minute time frame, and we also have the 1-minute time frame. So let's do off the 1 minute because we haven't looked at a 1-minute chart quite yet, right? Let's say you got in, like hypothetically, you got in here, stop loss over the highs because you really liked the bearish gap and you wanted to go short. It starts to move in your favor, it retraces and then moves lower. Great. What you could do is you lower your stop from this point to right here. Boom. It moves down, right? It moves down, retraces, moves down again, continues that downtrend. You lower the stop from here to over here. Same thing right here. Lower the stop again. Same thing right here. Retraces, moves lower. Fantastic. You lower the stop again until I would say probably like this point maybe. And then in that case, you would have gotten stopped out right here, but you would have captured a majority of the move. So that's one option you could have done, right, off the 1-minute time frame. The other option you could have done is you could have done 5-minute bar by bar, where let's say the original stop is like right here, right? You go 5-minute bar by bar, you lower to that high, then to this high, then to this high, then this one finishes forming, this one begins, you lower it again. This one finishes, you lower it again. This one finishes again. Again. This one almost took out the high, barely did, so that's our new stop. boom, and then you would have gotten stopped out right here when this green bar formed, right? So whether you did it off the 1 or the 5, it would have probably actually led to the same result. But nevertheless, you would have stayed in the trade. Even here, we have an entry long, right? Big move lower, beautiful doji kind of bottoming tail, almost kind of extended. The trend was exhausted. Plus we gapped. Remember, we gapped into support. So this kind of like swept the lows, swept this support, and then it bounced right back up, right? And in that case, entry over this entry bar as a reversal, stop loss below. Let's say you went 5-minute bar by bar as a long. You raised your stop to here, then to here, right? It never took out the prior low, then to here, then to here, then to here. You could have gotten stopped out right there, kind of barely. So sometimes what I suggest is give it a little bit more room. Like this is starting to consolidate. Use a wider stop so you don't get shaken out. And then boom, green bar, right? Raise your stop here, raise your stop here again. And then on this red bar right here, you would have gotten stopped out. But that was basically target. You basically got this entire move higher by going 5-minute bar by bar. You could have even done it going 15-minute bar by bar, right? It's here originally, then here, then here, then here, and you would have gotten stopped out there, right? So the purpose is to show you how you could do this on multiple time frames and the implications those time frames are going to have on your management, where you can clearly see that doing it on the 15-minute time frame, you're giving the trade more room to fluctuate, more room to breathe, in an attempt to capture more profit. And on the smaller time frames, you're securing profits tighter. You're not giving the trade as much room to fluctuate. Okay, fantastic. Now that you have those strategies kind of equipped in your trading toolbox, let's talk about creating a trade management plan. And by the way, I have a whole video on this YouTube channel that talks about creating a trading plan, and I really go in depth with this stuff, but I did include some in this video as well. So trade management. Before you enter a trade, you know exactly how you're going to manage the trade before you enter it. You know what your targets are going to be. You know where you're going to take profits. You know how much profits are you going to take. Are you going to take, like in this previous example, right? Let's say like on this trade right here that we just discussed. Let's say, let me shift it lower. There you go. Let's say this was your target, right? And it dropped and it hit your target and you got out 50% of your position, and then you have the other 50% in the trade, right? It starts to come in again. That's when you lower your stop to right here on your back half of your position. And then you manage the back half using the pivot strategy. Does that make sense? So you have to know like how much profits are you taking, 50%, 25%, 75% at target 1. So how much profits are you taking? Are you leaving a runner? Exactly what we just talked about. When are you going to raise your stop loss? Are you going to do 15-minute bar by bar? Are you going to be doing the pivot strategy? Are you going to be doing 5-minute bar by bar? Are you going to be doing 1 or 2-minute bar by bar if you're looking for a really tight trail? Let's say you're at like target 2. The trade is approaching target 2. You're up 5-6 Rs, right? If you're up so much, you're probably going to want a tighter management. You're probably going to want to secure your profits quicker. That's when you do 1 or 2-minute bar by bar, right? You have to have all these things figured out. And once you're experienced, like once you're at my level, guys, or I'm 5 years into the game, you know what I mean? My decisions are a lot more discretionary, where I'll decide when I'm in the trade based off just my intuition and based off like me taking that similar setup hundreds of times, right? But when you're a beginner, you want this entire plan to be a lot more systemic, to be a lot more predetermined, where you almost have a sheet on exactly what you do, right? And what I would recommend for you guys is take like 50 to 100 trades and manage it with a specific predetermined plan, right? So let's say this is our predetermined plan. I have like a sample plan for you. Let's say it's not at 2-to-1 reward to risk. You stick with the original stop loss. Great. You hit 2-to-1 on your trade, hit targets 2-to-1. You take 50% profits, move stop loss to break even, and then or you trail the back half 5-minute bar by bar. That's like a predetermined setup, right? Hits target, you're out half of the position, back half 5-minute bar by bar on your management. Great. Let's say it exceeds 2-to-1. Let's say you're at 3-to-1 R to R. You take another 50%. So now you only have a quarter left in the trade. and you trail the rest of it super tightly, you manage the rest of it super tightly, 2-minute bar by bar. Let's say you're at 5 to 7 Rs. From there, you take profits no matter what, or you do 1-minute bar by bar, right? You do really tight trail. Another thing you could put in is if the trade triggers, but it doesn't give you follow through, meaning like, let's say you have like a consolidation like this, right? And let's say it triggers you in, but then ends up continuing to chop. From there, you could raise your stop loss quickly so you can get out of the position without incurring a big loss, right? Ideally, you want when you have an entry, you want it to trigger in your favor. You want to see like a push on your entry. You want to see the setup trigger. You don't want to see it hit your entry and then like chop around. You want to see a real trigger, like it actually like hit your entry and then move in your direction, right? So let's say that doesn't happen, it starts to chop around. You could look to raise your stop and trail tightly, right? Let's say you have a really high conviction trade. You know this is going to go higher. You found a perfect setup. You know it's going to hit big targets. You do looser management. You do 15-minute bar by bar. You do a pivot strategy on a larger time frame, or you do hourly bar by bar. Or if you're swing trading, you're doing daily or weekly bar by bar. You're giving the trade a lot more room to fluctuate. And if you have lower conviction on that trade, you do tighter management. You go 1, 2, 5-minute bar by bar. So you need to create a plan. This is just a sample plan. This isn't like me telling you do this. Like you have to come up with your own plan. That's what makes trading so interesting. It's because everyone's a little bit different, right? So take like 50 to 100 trades with your sample management plan. If you want, you could copy this, right? And once you take your 50 to 100 trades, from there you journal. You journal what's going on in your trading. You're journaling how much profit are you leaving on the table? Are you managing the trade too tightly? Are you managing the trade too loosely? Are you leaving profit on the table? Are you getting out way too early? Are you getting out way too late? Notice what's going on in your trading by taking a sample size of trades. And from there, through journaling, you know what to fix in your trading, what to refine in your trading. Let's say 5-minute bar by bar is too tight of management, right? And you're leaving a lot of profit on the table at 2 to 1 R to R. Great, you change this to 15-minute bar by bar. And you essentially manipulate your plan in a way that suits your trading and suits what's working and not working for you as a trader. And you have to notice, are you leaving a lot of profit on the table? Are you not getting out quickly enough? And find out what's your issue and then adjust your management based off of that issue and based off all the strategies that I discussed in this video. All right, guys, so let's do a quick little like recap here. Trade management is incredibly important, guys. Like ultimately, it's the difference between you being, you having amazing entries and you making money. That in-between step is trade management. You could have the best entries in the world. You could be the best at picking setups. It won't matter. You won't make any money if you don't have a good trade management, right? All these common mistakes that we talked about happen because you don't have a system. You don't actually have a repeatable edge. What you're doing is you're entering and exiting randomly, right? Always keep in mind you have to respect your stop. Always get out your stop loss. And then when it comes to having a winning trade, right? You have these strategies. You have this pivot trail that you could use on whatever time frame that you're looking at. You have the bar by bar management style. We went over exactly how that works, exactly how bar by bar can differ based off what time frame you're looking at. And the real art of all of this is knowing when to give the trade more room versus when to secure profits more quickly. If you want to secure profits quicker, well, you use the smaller time frames to trail your position. If you want to aim for a bigger target, you use a looser trail. You use the larger time frames for your management. Does that make sense? So this is where trading really becomes an art and everyone's a little bit different. I'm going to teach you how to build a profitable trading system within the next 90 days. And I can almost guarantee that 95% of the people that are watching this video, and yes, that includes you, are trading without a system. You walk into the markets and take random setups. You use a different indicator every other day, and you have no clear criteria that separate a high quality setup that you should be aggressive on from a low quality trade that you should absolutely avoid. In other words, you have no game plan. You're essentially winging it every single day, hoping that one day you'll magically become a profitable trader. Well, by the end of this video, I'm going to teach you how to build a trading system that is specifically tailored to you, to your strengths, to your weaknesses, to your personal trading style. And if you could apply this correctly, this could 2x, 3x, or even 5x your personal trading results. It doesn't matter if you trade on a small account or a large account, or what market you trade in, whether you trade stocks or crypto or Forex or futures or options, or whether you're a day trader or a swing trader. This video is going to save you hundreds of hours, because I'm not here to give you a fish. I'm here to teach you how to fish for yourself so you could build a consistently profitable trading system that you could rely on every single day. I would highly recommend watching until the end of this video, because this video can permanently change your trading forever. So let's hop right into it. Now, before I get into the video, I want to quickly introduce myself in case you're brand new to the channel. My name is Emmanuel. I've been day trading for over 5 years, and my father is actually the one who taught me how to trade. He was my trading mentor. He is the reason why I'm a profitable trader today. And in 2025, I was able to make a little bit over $461,000 day trading stocks at 26 years old, which is a cumulative rate of return of over 200% on my entire trading account. And if you're thinking this is Photoshop or a screenshot that I edited, I will go ahead and refresh the page on my personal Schwab brokerage account. I use Thinkorswim platform. And if I click on 2025, there's the $461,000. And the reason I'm showing you this is because I think transparency is something that is severely lacking in the trading space. And my goal as a trader and as someone who has a YouTube channel is to be as transparent and as real as possible. And one of the very first things that my father taught me 5 years ago is that if you don't have a system, if you don't have a method to your madness as a trader, you are never going to become profitable, and that you will only become as profitable as how sound your system actually is. And it's really interesting because most people, when they wake up every single day and they get ready to trade, they're not thinking about a system. They're just thinking about stepping into their office and taking setups, stepping into their office and making money, versus you want to change your approach where you wake up every single day and you're focused on following your system. You're not even focused on trading. You're focused on following your system to a T. And it's really important to define what a system is, because if you don't know what a system is, well, how are you supposed to build one? And the best way that I would think of this is, think about a pilot that's about to fly from the United States all the way to Europe. Do you think that pilot has a flight plan on exactly what direction they're going to take, exactly what altitude they're going to fly in order to get to their destination? Of course. I mean, if you're a pilot, of course you're going to have a flight plan. What about if you're a chef and you want to cook a 5-star dinner and you're a Michelin star chef? Don't you think that those chefs have a plan of action? They have a system behind how they manage their kitchen? Well, of course they do. So, just like in any other profession, you need a plan, especially if you run a business, you need a business plan, you need a marketing plan. The same way you need a trading plan or a trading system. And it's important for me to define what a trading system is, because a lot of people may think that a system is a strategy, or it's an indicator, or it's support and resistance, or it's a Discord alert that gives them an edge, or it's a secret setup that they learned off some random, YouTube guru who's promising, an 80% win rate. That is not what a system is. A system is a repeatable process. It's not just a strategy. It's not an indicator. It's not about looking at candlesticks. It's a repeatable process that you could execute every single day. A system is predetermined, meaning before you trade in the markets, you know exactly what setups you're going to trade. You know exactly what stocks you're going to trade or what assets you're going to trade. You know what criteria you're looking for in your setups. You know exactly how you're going to manage those setups once you're in the trade, right? When you get into the trade, well, you have to extract as much profit as possible from that position. In order to do that effectively, you need a plan. You need a system. In fact, every single decision that you make in the markets should be predetermined. It should all fall under your system. So it's a repeatable process from the market open, that goes into your execution, that goes into how you exit your trades, that goes into your trading rules, that goes into, when you could walk away from the markets or what days you even trade in the first place. And it even includes journaling and review. It includes the process of actually becoming a better trader. And your job isn't to become a better trader. Your job is to develop and refine your trading system. And as a result, you become a better trader. And in reality, what we don't want to have in our trading is randomness. We don't want random setups, random execution, random entries, random exits. We want to eliminate as much randomness as humanly possible, because how do you expect to see consistent results if your input is random, right? Like, that absolutely makes no sense. If what you're putting into your trading is completely random, how can you expect consistent profits? Yet most traders think like that. Most traders just wing it. They don't really have a setup. They don't have criteria that separate high quality setups from low quality setups. They don't have a game plan. They just sort of wing it. The market opens, they trade random stuff, and then they get frustrated that they don't see consistent results. It doesn't make any sense. You need to have a system. And in this video, I'm going to teach you how to build a system that's tailored to you. So like I said, watch until the end. So I created this really simple framework that you could follow called the 90-day roadmap, where in the first month, you're going to focus on building the foundation for your system. In the second month, you're going to focus on edge discovery. And in the third month, you're going to focus on refinement and consistency. And I'm going to break down the necessary steps that you need to make every single month to actually build that profitable trading system. And the first one that we're going to focus on here is the foundation for your system. And I would say that the foundation is arguably the most important part of your system. And the best way that I would visualize this is, imagine a skyscraper that is being built in New York City. Well, all of the architects, the engineers, the project managers, they're going to be spending the most amount of time and effort constructing and planning the foundation for the building. Because without a rock solid foundation, well, that building in 5 or 10 years may collapse because of a hurricane or because of an earthquake. And the engineers and the architects always spend the most amount of time on the foundation to make that building structurally sound. And that's exactly what you need to do within your system. You need to focus on that foundation so you could set yourself up for long-term profitability. So let's break down exactly what you need to do. So number one is choose one market that you want to trade in. I wouldn't trade crypto and stocks, or Forex and options, or futures and stocks. Just pick one market that you want to focus on. I personally trade stocks. So in this video, I am going to be creating this system for day trading stocks. Number two, choose your trading platform. Now, if you want to trade stocks, I would personally use Thinkorswim by Charles Schwab. That's my personal trading platform. I think the execution is excellent. There's a great hard to borrow list. You could scalp on it. It's very intuitive. Once you get a feel for the platform, it's fast. That's the one that I would recommend. If it's not available in your region, you could also use TradeStation. You could use E-Trade. You could even use Fidelity or Interactive Brokers. But if it's available in your region, I would use Thinkorswim by Charles Schwab. Number three, focus on one methodology. Stop strategy hopping, where you listen to one YouTuber and you learn his system. Then you listen to another person and you learn their strategy. Then you listen to another person and then you use their indicator. You don't want to do that. You want to keep it simple. The simplest things in life are oftentimes the most brilliant, and that's exactly what you need to apply for your system. Keep it simple. 1 to 2 setups max. 1 to 2 indicators max, and I want you to focus on your education. Okay, that's the most important part in the first month. Focus on your education, right? If you want to become a lawyer or a doctor, do you go on YouTube and search up how to write a contract? How to, talk to the judge? No, you go to law school and you actually learn from professionals, right? So you need to lock in on your education. It's the same thing with trading. If you're going to try to wing learning how to trade, well, you're going to get those type of results, right? Number four, begin preparing a preliminary trading plan. So once you've learned a methodology, once you have the education under your belt, you have a solid kind of foundation of a system, you want to build a trading plan. And lucky for you, we're going to build a trading plan in this video. So we're going to get to that in a second. Number 5, begin paper trading. So once you have a preliminary trading plan where you have a couple of setups that you're focusing on, you know how to use a couple of indicators, you know support and resistance, and you have somewhat of a trading plan, you're going to start paper trading, okay? Or you could start trading with real money. However, I'd recommend starting with very small risk. I'm talking like $1 to $5 per trade. I recommend paper trading to get accustomed to your platform for at least a couple days to a couple weeks. And then once you're really accustomed to your platform, that's when you can move to real money, but start off really, really small. I think it's a lot better to trade with like 10 shares or 50 shares or 100 shares or something really, really small versus paper trading. Because if you're trading with that low of share size, you are essentially paper trading, but at least it's with real money. So it's real execution, real fills, and it gives you a perspective of what it's like to trade with real money. So that's what I would do. Start with really, really small money, small risk after you paper trade for a couple days to a couple weeks. Number 6, if you don't have anywhere to go for your methodology, you don't know what education to study, I have a free 10+ hour trading course that is genuinely better than most paid courses on the internet. It will help build the foundation for your trading, and it's going to supplement everything that I'm going to teach you in this video. So I would just watch my free course. It will literally build this methodology. It'll teach you all my setups, teach you all my indicators, and all that good stuff. So you could find my free course actually on this YouTube channel. I put it on this YouTube channel, but you could also find it in the description of this video directly below the video. Next, we have days 31 to 60, which is edge discovery. This is you applying your methodology. This is you practicing all of the education that you just learned, and you're probably thinking to yourself, but what do I actually practice? What do I do? And we haven't really created a trading plan yet. However, that's exactly what we're about to do in this video. I'm going to show you step by step how you can build a trading plan, and we're going to build one together. And the first thing that you need to consider about your trading plan is not about strategy requirements or the setups that you're trading. The first thing that you need to think about is what assets are you actually trading? And we already talked about choosing one market to trade in. However, what assets are you going to be trading in that market? So as an example, if I'm day trading stocks, right, am I going to focus on large caps or mid caps or small caps or penny stocks or gapping stocks or high momentum movers or the Mag 7 or name brands? Am I going to be trading 1 to 3 tickers every single day, or am I going to be trading different stocks every single day, right? You need to figure that out, and you're not going to have the answer to that question right away, and that is completely fine. You will figure that out through practice and through experience. However, it's something that you should be thinking about from the very beginning. Now, the next step is strategy requirements. We do not want to trade random setups. Remember, we want to eliminate as much randomness as possible from our trading, and we need to define our edge, and our edge needs to be repeatable. And again, you might not know what your edge is in the beginning, and that is fine. Your edge comes to you over time through practice and through you refining your system. So if you don't have an edge yet, or you don't know what your edge could even be, do not worry. So what I would do is, once you know what setups you are trading, and that's going to come from your education, you want to create a template of the requirements that you need to see in order for you to take a trade. So as an example, I basically trade only 2 setups. I trade breakouts and I trade retracements. Now, I keep my setups extremely simple, right? I don't really like to have complicated patterns or complicated strategies. Now, the setups are simple. However, the criteria that go into those setups can be a little bit tricky, right? Where I am very, very selective with what I look for on those simple setups. So what I would do is write down on a piece of paper pattern, and then write down the setup that you are trading, whether it's the breakout or whether it's a retracement setup or whether it's a reversal or any other trade, or any other setup that you're taking. I don't know what methodology you're learning. I don't know if you're learning from my free course or maybe you're learning something else. However, I'm just going to show you an example, and then you can use this as inspiration and change whatever you want with it, okay? So pattern, base, breakout. Have that written at the top. Perfect. So what I would do is have a section where it says must have, meaning qualities that I need to see in order for me to take the trade. Another section that says would like to have, meaning these are not, deal breakers, but I would like to have these within the setup. And then you also need cannot haves. And these are deal breakers, where if you see a cannot have in your setup, that means you can't take the trade. So base breakout. And for anyone who's done my free course, this is going to be a beautiful kind of recap, and this is going to be really nice for you to review all of the education that you learned. So for me on a base breakout, I need to have a rising 20 MA. I need the 20 MA to be underpriced, trending higher. I need a tight base. I need a base that's really tight, tight consolidation that's clean, that gives me a high R to R, risk to reward type of play. I do not want to see a really sloppy base that is all over the place. I don't want to see sloppy. I don't want to see tails everywhere. I want to see a nice, clean, tight consolidation, just like this one right here, where we moved up and we consolidated. And take a look at this. There's not a lot of tails. All of the candlesticks are like narrow range bars. And this was a really clean and tight consolidation that gave me a really nice risk to reward setup. I need a high quality overnight gap. I have tons of other videos that talk about how to read gaps and how to evaluate gaps. So I would highly recommend watching those. So I need a high quality overnight gap. That's what gives me the bias for me to take that setup, okay? And I look at the gap on the daily time frame. That gives me that larger term bias, by looking at the higher time frames, and then I go to the smaller time frames to find a potential setup. And I need a 2-to-1 R to R. If the trade doesn't have the potential to, at least double what I'm risking, like if I'm risking $100 on that trade, if I don't think it has the potential to make me at least $200, I'm just not going to take the setup. Now, I'd love to have a 3-to-1 risk to reward. Not always going to get that. I would love to have the volume requirement where during a base, you actually want to see really, really low volume. And then on the breakout, you want to see a volume spike, and that shows the buyers are stepping up to the plate and, buying and igniting the move higher. But during this consolidation, you actually want to see really low volume. So that's the volume requirement. Shakeout candle, that is actually this right here. This is a shakeout where, the sellers attempted to bring prices lower, and then the buyers stepped up to the plate right here and they brought prices right back up, because keep in mind, this is a bottoming tail. A bottoming tail suggests that the buyers have taken control. This is a shakeout. Sellers attempted to take control, they were rejected, and then we continued to base. Love that. I would love to see a shakeout bar. However, it's not a requirement. I also need a readable level 2. I'd like to have that. I am a huge level 2 order flow trader, so if it has a nice looking level 2, perfect. That's something else I want to see. And market alignment, where I want to see the market also potentially consolidating for higher when I go for my breakout. Now, cannot have. I don't want conflict between the time frames. I don't want the daily to tell me one thing, the hourly tells me something else, right? Where the daily's in an uptrend, hourly's in a downtrend, 15 minutes sideways, and there's a 5-minute breakout. I don't want that. I want, time frame alignment, where every single time frame is telling me the same story, where the 5-minute is bullish, 15-minute is bullish. There's an hourly breakout, and daily chart has a beautiful overnight bullish gap, right? I want to see alignment across the time frame. So they're all telling me the same story. I don't want to see sloppy. If it's sloppy, I'm not going to take it. If it's really spready, which is correlated with low liquidity, don't want that. Just not going to take the setup if it's really spready or if it's not doing a decent amount of volume. For me, I want my stocks to be averaging at least a few million shares every single day. And if it has less than 2-to-1 R to R, risk to reward, then I'm not going to take the setup. And this is what I would do, right? I would get a piece of paper and write down what the pattern is, whatever setup you're trading, and write down must-haves, would like to haves, cannot haves. And this will give you structure. So when you're looking at a setup in real time, you could refer back to this paper and say, okay, great. It has this, it has this, it has that, but it doesn't have this, and it does have one of these cannot have. So you know what? It has a cannot have. I'm not going to take the setup. Or, hey, it has all of my must-haves. It has all of these. It even has 2 of the would like to haves, and it has no cannot haves. Perfect, and that's a setup that you would potentially take. So this will give you structure when you actually look at a potential setup. By the way, like I said before, I would highly recommend starting my free 10+ hour course. It is genuinely better than most paid courses on the internet, but if you are looking for something a little bit more serious, I do personally help scale and coach traders from zero to consistently profitable, where I take my students under my wing and they trade live with me every single day. So if you are looking for more one-on-one, hands-on mentorship, you could also apply for my mentorship program in the description of this video as well. The next part of our trading system is our risk management. And in order to practice risk management, we need to determine our risk. And your risk is the maximum amount of money that you could lose per trade and the maximum amount that you could also lose per day. Now, I want you to ask yourself, what risk are you psychologically comfortable with losing? If you're not comfortable with losing $200 on a trade, and you know that if you lose $200, it's going to make you stressed out, it's going to make you make an impulsive decision, it's going to make you emotional, then don't risk $200 per trade. You need to pick an amount that you're completely okay with losing, where it's not going to make you emotional. And keep in mind that as a trader, you are a risk manager. Your number one priority is to protect the capital in your account. Your second priority is to make money using that capital, but you need to protect your hard-earned dollars. And the only way to do that is to size your positions correctly. So that is determining, right, how many shares should you purchase or should you short for that trade? Are you getting 100 shares or 500 shares or 1,000 shares or 10,000 shares? And in order to correctly size your positions, you need to know the entry and the stop loss for the trade that you're taking. So let's go back to the breakout. Let's say I'm taking this breakout setup. How would I go about my risk management? Well, number one, for the breakout, I know that my entry is over the base, and I know my stop loss is under the base. And that is my entry and stop loss parameter for every single breakout that I'm ever going to take. It's always, entry over the base, stop loss under the base. It's structured, it's predetermined. I know exactly where I'm going to be entering and when I'm going to be getting out for the breakout. So once I have determined what the entry price is and what the stop loss price is for that breakout, I can go ahead and perform the share sizing formula. So this is what you need to know: entry price, stop loss price, and what your risk is. And once you know those three numbers, you could size your position correctly. And this is the formula that you're going to follow. Share size equals risk divided by entry price minus stop loss price. So $200, you put that in the risk, divided by entry price, which is $5, stop loss price, which is $4.90. $5 minus $4.90 is 10 cents. $200 divided by 10 cents is 2,000 shares. So what does this mean? That means if this breakout triggers at $5 and you purchase 2,000 shares, and then it actually goes and hits your stop loss at $4.90, that means you're only going to lose $200 because you have 2,000 shares. If it drops 10 cents to your stop loss, you're going to lose $200. So what you've done here is you've protected yourself, where you know exactly how much you're going to lose if the trade doesn't work. And I actually know exactly how much I'm going to lose for every single trade that I take. It's predetermined. I'm not like wondering or stressed out about, how much am I going to lose on this trade? This one looks risky. I'm getting worried. I don't know how much I'm going to lose. Like, that doesn't happen because I size my position correctly every time. I know exactly what the worst case scenario is, as long as I get out at my stop loss price, which that requires discipline. You have to make sure you actually, hold yourself accountable and get out at the stop loss price. But I know exactly how much I'm going to lose if the trade doesn't work out before I get into the trade in the first place, okay? So use this formula. If you're paper trading, I'd recommend using the same risk you would use if you were trading with real money. If you're paper trading, don't risk like $100,000 per trade. It's not realistic. Don't risk $1,000 per trade as a beginner with paper trading. It's not realistic. You're not going to be risking $1,000 with real money. Start small. Use the same amount that you would if you were trading with real money. And again, if you're a beginner, just risk small. Okay, like during this entire experimentation phase where you're practicing your methodology, you're practicing your education, just risk small amounts, risk like $1 per trade. So even if you lose 20 trades in a row because you're experimenting, you're trying to figure things out, you're trying to figure out what your trading style is, you're not actually blowing your account. Okay, if you lose 20 trades in a row, $1 risk, okay, you lost $20. Okay, you lost 20 bucks, big deal, but you're probably going to learn a lot from that $20. Most beginners, right, they start off with a lot of risk, they experiment, and they lose all of their money before they've even put themselves in a position to actually learn and succeed, right? You don't want to blow your account before you're in a position where you could actually make money, okay? So start really small. $1 to $10 risk per trade in the beginning, and just focus on risk management. Focus on protecting the capital that's in your account. So now that you have a structured way of looking at your setups and determining whether they're high quality or whether they're low quality, and now that you know how to manage your risk, you know how to size your positions and the importance of that, from there, what do you do when you're actually in the trade? What's your game plan after the trade triggers? And that is called trade management. And this is where you need to figure out how you're going to manage the trade before you enter it. And what is trade management? So what are the things that you might need to think about? Well, number one, where are you going to be taking profits? Do you have a specific target? And if the trade hits that specific target, how much profits are you taking? Are you taking 50% and leaving a runner? Or are you taking 100% of your profits and fully exiting out of the trade? Are you going to be trailing your position at any point where you raise your stop loss? Are you going to raise your stop loss to break even? Or are you going to be raising your stop loss to a certain point on the chart, right? You need to have all of these questions kind of figured out, and it needs to be predetermined before you take the setup in the first place. Another example is if you're up 2 Rs on the position, meaning if you're risking $100, if you're up 2 Rs, that means you're up $200. An R is a risk unit. And I think it's really good to gauge how much you're up on the day, not based off how much money you're up, but based off how many Rs you're up. For example, if I'm up $10,000 in a day, that sounds really impressive, but that doesn't really mean anything, because what if I was risking 20,000? If I was risking 20,000 to make 10,000, then that's horrible. Versus, I'm risking $500 and I ended up making 2,000. Well, that's a lot more impressive, because $500 risk, and if you made 2,000, that means you made 4 times your risk unit, and that's pretty impressive. So whenever you see online someone say, "Oh, I made $50,000 on this setup," and you're like, "Oh my God, I want to make 50K." Well, most of those traders never actually reveal how much they're risking on that setup. They're not telling you how many Rs they're making, and that's really important. And that's how I would judge a lot of your trading results. I would judge it based off of Rs, not the amount that you're making. So if you're up 2 Rs, right, that means if you have $100 risk and you're up 2 Rs, that means you're up $200. If you're up 3 Rs, that means you're up $300, right? How much profits are you going to take? Right? Like our target for each of our trades is minimum 2 Rs. So if it hits 2 Rs, are you going to be taking any profits? Or are you going to be waiting for a different target? And a lot of these questions, they're going to become a lot more discretionary. Like your trade management is going to become a lot more discretionary with experience and with time, where you can make a judgment call in the moment. However, in the beginning, as a beginner, I recommend keeping it systematic, where you actually have a pen to paper trading plan that you're going to follow, where you get into the position, great, it hits 2 Rs, you take 50% profits, and then you move your stop loss to break even. And what I'm going to do is help you guys build a sample management plan. And before I go into it, I want to emphasize that everything that I'm going to be covering in this video, I'm not telling you to copy this. This is just inspiration. This is just, something that you could use as an example. And from here, once you have this example, you put your own touch, because every single trader is different. So I'm not telling you to copy this. This is just an example plan. This may not work for you. So make sure you don't just copy this, right? I want you to copy the thought process, not the actual details of the plan. So sample management plan. Let's say the trade is under 1 R, meaning you still haven't even made 1 R on your position. Stick with the original stop loss. Let's say it's past 1 R. That means if you're risking $100, now you're up, $100 on your position. You're up 1R. From there, let's say you move your stop loss to break even. That could be a good structured way where you're up 1R, right? Instant, boom, you move your stop loss to break even, just as an example. Then when you're up 2Rs, you take 50% of profits, and then you move your stop loss to break even. And from there, you trail your runner, the other 50% of your position, 5-minute bar by bar. 5-minute bar by bar is one of my management strategies. I'm not going to go over it in this video. I don't want this video to be that long. However, I cover it in my free course. So watch my free course and you'll learn 5-minute bar by bar. Next, let's say it's over 2Rs. Maybe you're approaching 3Rs or even 4Rs or 5 to 7Rs. Well, what you could do is take another 50% of your position where now you have a quarter left in the trade where you took 50% here. Then you took another 50%, so you would have 1 quarter left, and then you trail the rest, let's say 1 minute bar by bar. 1 minute, right? Bar by bar, BBB. And then if you're up 5 to 7Rs, take full profits no matter what. So this is a really solid, just sample management plan. Okay, just a great example. And this is kind of the way that I would structure it, where if you're under 1R in profit, what are you doing? If you're over 1R in profit, what do you do? Are you moving your stop loss? Or maybe you're sticking with the original stop loss, even if it's past 1R in profit. If you're up 2Rs, are you taking any profit? Or maybe you want to stick with the position. You want to go for a much bigger winner. You want to aim for 3 to 7Rs. In that case, you wouldn't take any profit at 2 to 1 risk to reward, right? And then maybe, at 3Rs, you take 50%, and then the other 50% when it hits 5Rs, right? Like, this is what you have to figure out, okay? Next, I really like to have a condition within my management plan where if a trade triggers me in, but doesn't immediately follow through in my favor, and it kind of just chops around at my entry, I want to look to trail tightly. So for example, let's say I'm in a breakout and it triggers, and then it kind of just starts to chop around, right? Where it triggers right here, but then never really follows through. It just sort of chops around for a while. I am going to look to trail really tightly and to move my stop loss very aggressively so I could, trail the position and not take a full 1R stop loss, okay? So that's something I like to do. If it doesn't immediately follow through in my favor and it's kind of chopping around, I want to look to trail the position. If I have a lot of conviction on the trade, I'm going to have looser management. I'm going to give the trade a lot more room to fluctuate in an attempt to catch a much bigger move. And if I have less conviction on the trade, then I'm going to trail a lot tighter, where I'm going to move my stop loss up a lot more aggressively. Next, if a trade hits target really quickly, I'm going to take profits aggressively, right? So let's say, for example, in a breakout, right, my target is up here and the trade triggers and instantly pumps to my target. If that happens, for me personally, I usually just take profits really aggressively and I'll just take my entire position. I won't even leave a runner. I'll just get out right away. Now that you know how to build your trading management system, let's go ahead and talk about trading rules. And this is so incredibly important because you are only going to be as profitable as how strict the rules are within your trading plan. And most traders honestly fail because of discipline and because they fail to follow their own rules. They don't hold themselves accountable, and it's very important to have a very strict set of rules. So let's go over a few that I personally have within my own trading system. Number one, protecting profits. If I'm up $1,000 on the day, I want to walk away from that day up at least $700. I want to protect at least 70% of my daily profits. I don't want to make $1,000 and then give back $1,000 to the markets. I don't want to do that. Okay, I want to protect at least 70% of my daily profits. Now, when it comes to a trade by trade basis, if I'm up 3Rs on a trade, so if I'm risking $100 and let's say I'm up now $300 on that position, I want to make sure I walk away from that trade with at least 2Rs, with at least $200. So in that case, that kind of goes into the trading management section where I will trail my position in a way where I will 100% secure at least 2Rs if I'm up 3+ Rs on a position. So I really want to protect my profits on my winning trades and on my winning days. Number 2, lower your risk after 2 to 3 consecutive losing days. You don't want your losing days to snowball, and you don't want your losses to snowball. So what I would do is lower your risk by 25 to 50% if you have more than 2 to 3 consecutive losing days. It's very simple in theory, but it's difficult for traders to actually stay disciplined with that, but it's very simple. Just lower your risk by 25 to 50% if you have 2 to 3 consecutive losing days. It's very important. It's important to manage your losing streaks because, every trader is going to go through a rough patch at some point in their career, and most likely you're going to go through a couple of rough patches every single year. So it's really important that you manage your risk during those rough patches. Number 3, never add to a losing trade. Never try to average down your position. You're just going to end up incurring more risk, and it's going to end up leading to a far greater loss. Just never add to a losing trade. It's one of the worst things that you can do. I learned that very early on in my trading career because I saw my dad do it one time, and it wasn't good at all. And he looked at me right afterwards. He said, never do that again. Like, don't ever do what I just did, and learn from my mistakes. So yeah, never add to a losing trade. Number 4, step away. You need to know when to stop trading. In fact, in trading, it's even more important knowing when not to trade versus knowing when to trade. So if you're too tilted to trade objectively, where you're just feeling emotional, you're feeling like, you're not in the proper headspace, just walk away. Just turn off your monitor, go on a walk. If you lose more than 5 trades in a row, walk away. If you lose your max daily risk, walk away. If you break more than 2 of your trading rules that are on this list, walk away. Basically, you don't want to make emotional and impulsive decisions when you're not in the right mindset and you're not in the right mental state. Because I know a lot of traders that, are consistently profitable, and then they have one bad day where everything snowballs. They get really emotional, they overtrade, they over risk, and they end up losing all of the profit that they made on the other days. You don't want that to happen, okay? So if you're feeling emotional, just step away. Go on a walk, do something to get yourself back into the right mental state to continue trading. Number 5, don't trade reversals unless A+ quality. I'm not a big reversal trader. 90% of my trades are me trading with the trend. Only 10% of my trades are reversals. So I only take reversals if they're A+ quality. That's just a personal rule of mine. But you could, use this rule as inspiration where, maybe for you, you don't like taking breakouts. And, if you do take a breakout, make sure it's A+ quality, okay? For me, it's reversals. I don't like taking reversals, so that's within my trading plan. Number 6, no spready or illiquid stocks. If there's a stock that's really spready, or if it's a liquid, I just can't trade it. It's part of my plan. I can't trade it, okay? If I lose on a stock 2 to 3 times in a row, I have to remove it from my watch list. So for me personally, I like to do a lot of scalping. So I'll scalp like the same stock numerous times throughout the day. But if all of a sudden I start scalping it and I take 2 to 3 losses in a row on that same stock, I have to stop trading it. And that's a part of my rules. I just have to stop trading it because otherwise I don't want my losses to really kind of stack, okay? Number 8, do not check your P&L throughout the trading day. That's for me. I don't like looking at my profit and loss throughout the trading day, and I mean like my cumulative total. I don't like to check that because it impacts my decision making. It impacts my objectivity. So that's a rule for myself. I don't like to check my P&L throughout the trading day. In fact, I'd recommend that for you. Don't check how much you're up or down throughout the day because you're going to end up trading not based off the setups in front of you. You're going to end up trading based off your profit and loss, and it's going to affect your decision making. So trust me, just put a piece of tape over your P&L, and I guarantee you're going to end up, thinking way more objectively, and you're going to just trade what's in front of you versus trading, the profit and loss on your screen. Number 9, limit the amount of market orders you place on entries. So for me personally, I like to enter into my trades using limit orders, not market orders. So that's a rule within my trading plan. I don't want to be using market orders when I enter into trades because then there's the possibility of incurring slippage, and I don't want to get a late entry, and I don't want slippage on my entries. So that's a rule for me. And there's a lot of other rules that you can include, such as, obviously over risking, never over risking on a trade, or never, losing more than your maximum risk on a certain day. We already talked about that. And yeah, these are just my personal rules. You can use some of them, but what you want to do is really create a list of rules for yourself that you strictly follow. And most of your rules are going to be around emotions and around your trading psychology. Okay, and yeah, these are my trading rules. Let's do a quick little recap before we go into the third and final month of this framework. And in the first month, you're going to be focusing on your core methodology. You're going to be focusing on the education and building a preliminary trading plan. And from there, in the second month, you're going to start trading that plan. You're going to be applying all of the education that you just learned in month number 1. And I want to be completely honest and transparent with you. The first version of your trading plan or trading system is going to be really bad. It's not going to be effective, and it's not going to be profitable, and that is completely okay. In the beginning, it's very likely that you're going to feel a little bit overwhelmed. You're going to feel like everything's a little bit complicated because you're not going to know which exact setups you want to focus on. You're not going to know which criteria to focus on within those setups. And it's not going to feel super comfortable sizing your positions quickly. In fact, you might even miss out on a bunch of trades because it's taking you a while to actually apply this share sizing formula. You might not have the risk management mindset right off the bat. You may not be disciplined right off the bat, and that is completely okay. You also might not know how to actually manage your positions because maybe you're still kind of stuck on your entries and placing your stop losses and sizing your positions correctly, where you don't even know what to do once you're in the trade. You don't know when to raise your stop. You don't know when to take profits. You don't know when to leave a runner. You are going to have difficulty building a sample management plan, and you might not even know which rules to actually follow because you don't know exactly what emotional and psychological triggers exist within your trading. You're not sure what mistakes you're making yet. And that is completely okay. It's going to feel overwhelming in the beginning. You're not alone. We all have to start from somewhere. So what I want you to do in this second month is to just take a lot of trades. And this is why I encourage you to paper trade in the first month, where you're actually applying the methodology and you're applying the education. I want you to paper trade or trade with very small risk so you could experiment, so you could take lots of setups, lots of trades. Remember, your first goal isn't to become profitable. It's to develop a feel. It's to just gain experience. Don't worry about the money. I want you to detach yourself from the money and focus on the process and just take a ton of trades, okay, and practice. Get the reps in, okay? And after you practice and take, let's say, 50 trades or 100 trades or 500 trades, right? Everyone's trading plan is going to be different. This is also based on your style of trading, whether you're a scalper or whether you like to hold on to your positions for a few hours. And that's still something you have to figure out. You have to figure out your exact trading personality. Are you a scalper? Or do you like to hold on to trades for a little bit longer? Or are you a swing trader? Or are you someone who likes to take reversals or breakouts or retracements, right? You have to figure this out. And the only way to figure that out is to gain experience. So I want you to take a ton of trades in month number 2 and just gain experience every single day. Don't worry if you're not profitable. Don't worry about that, okay? And after you do that, and let's say you've already taken 100 or 200 trades, whatever the case is, we go into month number 3. And this is all about refinement and consistency. And I really like this framework that's called PAIR. It's prepare, execute, analyze, refine. So number 1, prepare. What are we preparing? We are preparing our preliminary trading plan. So we did that in month number 1. We execute that plan. We do that in month number 2, where we're actually taking a lot of trades. We're practicing. We're experimenting. From there, it's about analyzing. Now, what are you analyzing? You want to analyze strengths and weaknesses in your trading. What setups are making you money and what setups are losing you money? Next, you want to figure out, are you sizing consistently? What's your risk management like? Are you actually approaching the market with a risk management mindset? Are you undersizing certain setups because of emotions? Are you oversizing other ones? Are you sizing consistently? Are you actually following the share sizing formula? If your predetermined risk is, let's say, $10, I want you to go back to your losing trades and see, are you losing $10 or are you losing more than that? Because if you're losing more than your predetermined risk, that means something's going on, right? There's something, whether you're not respecting your stop loss or maybe you're taking really volatile setups and they're blowing past your stop. You have to figure that out. Are you actually losing your predetermined risk on those losing trades? Which setups fit your personality? After you take tons of trades, you're going to gravitate towards a specific trading style that just makes sense to you, right? And I know that's a really vague explanation, but there's going to be certain trades that you'll just resonate with. They make sense to you and they're going to be rather easy to trade and it's going to be rather easy to execute, while other trades are going to feel really difficult. Like for me personally, I don't like taking reversals. I don't know what it is. From the beginning of my trading career, I've never liked reversals and they're just hard for me, right? I don't know why. I like breakouts, and I like retracements. I don't like reversals. And that's me, okay? Next, what you want to do is identify any psychological and emotional mistakes. And more than that, what you want to do is identify obvious mistakes. Because in the beginning, it's going to be very challenging to know exactly what you're doing right? Let's say you're taking, you took 100 trades. You're not going to know exactly which setups are making you a lot of money and what exactly you're doing right within your trading. And that's okay. It's much easier figuring out your obvious mistakes. And the way you're going to improve in the beginning isn't to do more of what you're doing good at, it's to eliminate obvious mistakes. For example, you're noticing on a lot of your losing trades, you are oversized. Great. Pay more attention towards sizing it correctly. Let's say a lot of your losing trades are reversals, where you're going against the trend. Great, you could see that, okay, hey, a lot of my losers are reversals. Let me go ahead and eliminate reversals from my trading plan, or let me be a lot more selective with reversals where I only take A+ reversal setups, okay? Maybe another example is whenever I have an all or nothing approach, I tend to not make any money, right? So instead of taking profits when you're up 2 Rs, you don't take profits and you aim for 5 Rs on your trade or 10 Rs on your trade. And this all or nothing kind of home run seeking approach is, a losing strategy for you, where none of your trades are actually following through 5 to 10 Rs, and then you end up losing money on those trades when you could have secured 2 Rs, right? So maybe the home run style of trading isn't really your niche, or that's not what your style is, okay? Or perhaps you don't really like scalping. You don't like that quick in and out, and you like to hold on to your positions longer. Or maybe you don't like to hold on to positions because you're not able to stay patient and you like scalping, right? You have to figure all of this out. You have to figure out which exact mistakes are you making within your trading. And once you identify those mistakes, you eliminate them. So you analyze, right? Which mistakes are you making? And you refine your plan. You refine it where you eliminate those mistakes. You do more of what you're doing well at, right? For example, breakouts are making you money. Your best setup are breakouts. Great. Trade more breakouts and eliminate what's not working. And from there, after you refine your plan, you're basically kind of re-preparing it. Great. And then what you do is you execute it again. So you refine that plan and you execute it again and take another 50 to 100 trades and you trade for a few weeks. From there, what do? You analyze it again. What are you doing wrong? What's actually successful within your plan? And from there, you analyze it again, going through this entire process, and then you refine it again. And it's this constant cycle of taking trades, analyzing, refining, re-preparing your trading plan, executing more trades, analyzing your results based off all of the new changes you just made to your plan. From there, you analyze that, refine it again, and then trade your plan again. And after like 5 to 10 iterations of that over 3 to 6 months, you're going to improve. I mean, it's impossible to not improve as long as you stay disciplined, you journal, you focus on the process, and you detach yourself from the outcome and from the profits. So this is exactly what I would do. I would learn the education, build a plan, even if your first version of the plan is really bad, trade that plan, analyze your mistakes, analyze what you're doing well, analyze what setups you're gravitating towards, analyze your risk management, analyze your trade management. From there, refine your plan, and then take another 50 to 100 trades, trade for a few more weeks, and then do it again. And what you have to do is continue to do this. And if you do this for a few months, you will improve. Your trading plan will get immeasurably better. And that's how you become a more profitable trader. I wish there was an easy way where I can turn on a switch and you can become profitable, but that's not how it works. And this is exactly what I do. And if you have a mentor, that makes the entire process easier, especially if you are trading with your mentor. That's something I highly recommend. If you're actually serious about this, you have to be trading with your mentor every single day. And ideally, your mentor is actually going to help you build this plan and give you his analysis or her analysis. And that's going to help you refine your plan and actually know what to focus on for, the next few weeks of trading. Okay, hopefully this makes sense. It's honestly a very simple framework. You learn the education, you apply the education, you refine it, and then you do it all again. All right, so hopefully you enjoyed this video, and I will see you on the next video. Make sure you subscribe to the channel for more trading education. Make sure you leave a like, and make sure you leave a comment with feedback. Thank you so much. I'll see you in the next video. The craziest part about trading is the more that you chase the money, the further it runs away from you. But the moment that you're able to detach yourself from the money, that's when it starts chasing you. In this video, I'm going to explain how I made $450,000 over the last 8 months and over 7 figures in my entire trading career by mastering a principle that most traders don't talk about: the law of detachment. While most traders obsess over money and ultimately lose, I'm gonna teach you how to rewire your mindset so you can naturally attract money, success, and profitable trades. Detaching myself from the money was the single greatest shift in my own trading career. And by the end of this video, it may be the greatest shift in yours. So make sure you watch until the end. Let's not waste any more time and let's hop right into making you a more profitable trader. So in this video, I'm going to break down what the law of detachment is, why it's important, why it could be the missing piece from you becoming a profitable trader. And from there, I'm going to show you practical and actionable steps on how you could apply the law of detachment in your own trading. And as soon as I started applying it, it was the greatest shift in my own trading career. And I'm confident it could be the greatest shift in yours. And this law also solves one of the biggest beginner trader mistakes that I see. And this law is actually really simple. All that it states is you need to detach yourself from the outcome or result of whatever you are doing. And in trading, that result is money. It's profits. And I get it. The reason you want to become a trader is to make money. I want to make money too. However, your strong desire to make money is what's stopping you from making any money in the first place. That greed, that focus on the end result is causing you to lose money. And it's almost counterintuitive, but the more you focus on the money, the more that it runs away from you. Because when you're extremely attached to the result or to the outcome of something, you completely ignore the process and you fail to think logically or think objectively because the only thing that's on your mind is the money. It's the outcome, and you end up acting from a place of fear and control. You're trying to force what you want. And the more you force it, the more it runs away from you. And the goal is to detach yourself from the money, to not even think about the money. The money is just a byproduct of your process. And when you do detach yourself from that outcome, you can operate from a place of trust where you trust your setups, you trust your conviction. You could operate from a place of confidence where when you enter into a trade, you trust your edge and you're able to execute effectively. You operate from a place of conviction where, you trust your trading plan. And you have almost this free flow type of, disposition where you're not overthinking, you're not kind of like, always pressed and stressed out. You're kind of able to operate from this flow state. And that's what you need to focus on. You need to focus on the process, not the result. The more you focus on the result, the more it runs away from you. The more you focus on the process, that's when you can give the results the opportunity to come to you naturally. So this law is super simple. You need to detach yourself from the money. You need to release your attachment to the outcome of a trade. So when you do take a trade, ultimately, you don't care whether it's a losing trade or a winning trade. What you care about is you following your process, you following your trading plan. And I see a lot of people that talk about the law of detachment and they tell you to not care. That is not what this law is about. It's not about not caring. It's about what you care about. Do you care about the money and the outcome, or do you care about following your system, following your trading plan without being controlled by fear or greed? Because once you focus on the money and the outcome, that's when your own emotions are gonna basically almost attack you. And being attached to the money could have devastating consequences. Like, have you ever gotten into a trade and it starts to go up and you start to get excited, and then as soon as it goes back to break even, then you're like, oh, you don't feel so good anymore. And then it becomes red, and then all of a sudden you become fearful, and it feels like every tick up or down in that trade feels personal. It feels like the market is out to get you, and then you end up blaming the market for your own emotions. And that's what you want to detach yourself from. It's okay if it goes up or down, because you're focused on following your process. And when you are in a trade and you're just focused on that red or green number moving up or down, right? You're focused on the fluctuation. And it's happened to me as well. When I'm sitting in a trade for like an hour, it's not going up, it's not going down. And every fluctuation causes like an emotional response. And at that point, you're P&L trading. That's what I call it. You're trading based off your profit or loss. You're not trading off of logic or off your trading plan or off the criteria that, is in your trading edge. No, you're making decisions based off you seeing red or green in the profit column. And the problem with that is, as soon as you begin to make decisions off of that fluctuation in price, that's when you make impulsive and emotional decisions. And those decisions end up being destructive for your trading. Your brain automatically goes into fear or greed mode, not in objective, free flow, calm trading mode. No, you're reacting off of fear and greed. You're reacting from your emotions. And that's what's stopping you from reaching the next level in your trading. And yeah, you have to stop looking at your P&L, which is actually the first piece of advice that I could give you. When you are trading throughout the day, if you want, get a piece of tape and put it over your P&L. Put it over that small section where it tells you how much you're up or down on the day. I don't check my P&L until the end of the day. I don't check how much I'm up or down until the stock market closes or until I'm finished trading for the day, because it impacts me. If I'm up $800 and I see that I'm up $800, that might impact my decision making for the next trade that I make. Or let's say I'm down on the day. I'm down $600 or $700. I look at that, I start to get a little bit fearful because I'm down on the day, and then I mess up the next trade that I take. I end up undersizing it, or I end up not taking it in the first place because I'm operating from a place of fear. So the best way to not get impacted by your P&L going up or down, or you being green or red, is by just don't look at it, right? Control your risk and don't look at it until the end of the day. And you need to choose a risk that you're emotionally comfortable with losing. Like, if you're a beginner trader, are you really going to be comfortable with losing $1,000 on a trade, or $500 on a trade, or even $200 to $300? Probably not. You lose $500 on a trade, that's going to impact you emotionally. And that's going to impact your decision making. It's going to cause you to operate from a place of fear or greed. For some traders, when they lose money, then they feel like they have to make up for it. They have to revenge trade, and then they end up digging themselves an even bigger hole. You need to risk an amount that you're totally okay with losing, where if you lose that risk, that dollar amount or that percentage amount, you're not going to feel emotional. It's not going to impact you. But you also want to risk, an amount that's not so low where you just won't care about the loss. Like, for example, if I risk $10 per trade, I'm not really going to care at all. like that's not going to impact me at all. Like I don't care if I lose $10, right? Now, if I, let's say, lose $400 to $500, right? That's still within my risk. I'm not going to feel emotional, but I'm definitely still going to feel it, right? So you have to find that balance. You can't risk such a low amount where it's almost irrelevant to you, but you also can't risk too big of an amount where it can emotionally impact you. Seriously, the best way that you could almost immediately detach yourself from the outcome of your trades is to just stop looking at your P&L throughout the day. This was like a game changer for me. I literally saw instantly better results, and just always make sure you're risking an amount that you're emotionally comfortable with losing. Next, let's talk about practical steps on how you could apply the law of detachment for, every single moment within a trade. So let's say your entry. I see a lot of traders almost fall in love with a setup, or they have an attachment to a certain stock where they developed this bias in their brain on why that stock should go up or down, and they can't detach themselves from that bias. And sometimes that bias comes from news. Maybe it comes from them already making money on that trade maybe a week ago or that day, or maybe it comes from revenge trading where they don't feel satisfied with losing on that trade and they need to make their money back. This is when you want to detach yourself, and you have to look at that setup in a vacuum based off the probability of it working. You have to look at the quality of the setup right in front of you and decide whether you should take it or not. Stop trading off emotions. I see a lot of traders, they mostly make money on a stock and then they'll trade that same stock again, later that day or the next day or that week. And they're like, oh, I already made money off of that stock. I can make money off of it again. Not necessarily. It depends on the quality of the setup. Just because you made money on it once doesn't mean you're going to make money on it again. Past results are not indicative of future results. You have to look at every single setup independently, and you have to stop attaching your ego to a specific stock or to a specific trade. You need to detach yourself entirely, where you're only looking at that setup and whether that setup meets the criteria within your trading plan. By the way, I have hundreds of hours of free education on the internet, including my free 10+ hour trading course that is genuinely better than most paid courses on the internet. It'll help you actually build the foundation for your trading. You could find my free course in the description of this video. And if you're someone who's looking for a little bit more serious mentorship, I do personally help coach and scale traders from zero to making $10,000 to $50,000 per month, where I take my students under my wing and they trade live with me every single day. So if you're looking for something a bit more serious, you want more personal mentorship, I'm happy to potentially work with you, and you can fill out the application in the description of this video as well. Let's hop right back into the video. Next, we have stop losses, and this one's actually really simple. True detachment means that you honor your stop loss regardless of the circumstances. If you're in a trade and it hits your stop loss, you get out, no questions asked. And what you're actually detaching yourself from is the hope that that trade might turn around and go back in your favor. And hope is a very powerful emotion. And you could actually use it in a very productive way in your trading, where when you're in a winning trade, you're hoping that that trade will continue higher in your favor. And that's how you could actually have a winner turn into a massive winner. But what most traders do is they use hope the wrong way. They apply it in the wrong situations in their trading, where they'll apply it when they have a losing trade, where the losing trade it's going against them, and they have hope that it's going to turn around. And what do? They end up adding to their losing positions, and then those losers become far greater losers. You need to detach yourself from that hope that the trade is going to turn around and go back in your favor. Instead, you just have to take the loss, take the stop out, and move on. Losses should not give you emotional trauma. If losses are giving you trauma, If losses are causing you to react emotionally, that means you are risking far too much on your trades. Losses are business expenses, and that's the way that you need to think about losses in your trading. Next, we have profit taking, and I see so many traders attach themselves to this idea that they need to hit a home run trade every single time. And their desire to catch a massive winner is what's stopping them from making money in the first place. You need to be realistic with your targets, and you need to be following the management strategies that are within your trading plan. There's a lot of traders that will break their trading plan because of greed, because they want to catch this home run trade, and then they end up giving back all of their profits on a nice winner. And you don't want to do that. You need to take what the market gives you. And I'll be completely honest, sometimes having 5 singles is way better than aiming for 1 home run and then completely missing. A lot of my really nice trading days come from catching like 4 to 5 smaller winners. And then those small winners add up to a nice profit at the end of the day. You don't need to catch these like banger, crazy trades to be a profitable trader. Focus on consistent wins, okay? You don't need home runs every day to make money. You can make a living in your trading by catching smaller trades, and those smaller trades add up to a nice result at the end of the day. So don't let that greed of catching a 10R play stop you from making money off of a 2R play. Next, we have risk. And I know I already talked about this, but this is such an important concept that I'm going to talk about it again. And this is actually the hardest part for most traders when it should be the easiest, because your risk should be predefined. You should know exactly how much you're going to lose if the trade hits your stop loss before you even enter the trade in the first place. And when you're truly detached from the outcome, you've already accepted the risk. You've accepted the loss before you're even in the trade. You know what the worst case scenario is. You know that if that trade doesn't work, the setup fails and it hits your stop, you know exactly how much you're going to lose. And what I would do to really detach yourself from the outcome is to almost visualize the loss happening. Like, assume the worst when you enter into the trade. Now, I'm not saying to not hope that your winner can turn into a bigger winner, but what I'm saying is accept the loss before you're even in the trade in the first place. Basically, account for the fact that that trade might be an L. And when you do visualize that loss, you're almost kind of liberated when you're in the trade because you've already accepted the risk. You know the worst case scenario. You know what the downside is. So make sure you're risking an appropriate amount that you're emotionally comfortable with. We already talked about that. And make sure your risk is predefined. Make sure you're sizing your positions appropriately for every single trade that you take, and accept the loss, accept that risk before you take the trade. Next, you need to detach your trading performance from your self-esteem or ego. You need to understand that making or losing money does not define you as a person or as a trader. Even the best traders in the world, true professional traders, have losing days. They have losing weeks. Sometimes they even have losing months. They make mistakes too. And the outcome of one trade or one day or 1 week does not impact your long-term success as a trader. And you need to zoom out. You need to be thinking in months or years. You shouldn't be thinking in days or weeks. You need to zoom out, and you need to have a lot more of a long-term perspective. And you can't allow your own trading performance to impact how you feel about yourself. Because if you do that on your losing days, you're just gonna feel like shit. You're gonna feel horrible about yourself. You're gonna feel like you suck, that you're worthless, and that's going to snowball into you making, bad decisions in your trading. It's gonna snowball into more losing days because you're letting your emotions get the best of you. You need to detach yourself and understand that your ego, your self-worth, your skills as a trader it's not linked to one trading day or 1 week, right? Everyone makes mistakes. No one is perfect. And you need to link your self-esteem or ego to your ability to follow your process over a long period of time. And what happens when you don't detach yourself from the outcome, you end up forcing trades that inevitably lose you money. For example, let's say a stock is moving higher, it's ripping up, and all of a sudden you feel the need that you need to be in that setup, that you don't want to miss out on the upside. And what do? You FOMO in. You have the fear of missing out, and you have a really late entry just to see that stock do a complete reversal against you, and then you end up losing money. Why did you take that trade? Literally because of your own emotions, because you are attached to the idea of making money, and then you forced a really late setup. Or perhaps you're trading out of boredom where there aren't any high quality setups in front of you, but you want to make money. You're attached to the idea of finishing that day green. So what do? You end up taking a low quality setup that loses you money. And it's like counterintuitive. Your desire to make money and finish the day green actually caused you to finish the day red. Or maybe revenge trading, where you take a trade, you lose on it, and then you trade it again to make your money back. Why are you trading that stock? It's not because of a quality setup in front of you. It's because of your own emotions. It's because of your desire to make your money back. Or trading even though you don't see your edge, right? You're trading out of boredom again. And ultimately, your desire to make money today is destroying your ability to make money tomorrow. And I'll explain how that works. Like, let's say you trade out of boredom, you take a low quality setup and it fails, and all of a sudden you finish the day red. That red day is going to impact your psychology for the next day, for the next week. And all of a sudden, one trade out of boredom causes you to trade emotionally and to not have confidence the next day. And this is why it's so important to have consistent good habits and to stop forcing trades, to detach yourself from the money, because one decision, one trade can impact the next 10 trades that you take. So one of the best ways you can detach yourself from the outcome is to make sure that all of your trades are predetermined, to make sure that you have a system behind your trading, and that within your system, you know exactly what setups you're taking, you know exactly where the entries are for those setups, you know where the stop loss should be, you know where potential targets should be, and you need to know all of these numbers before you take the trade, where you know exactly where the entry is, you know exactly what the stop loss is, you know what target you're aiming for, you know where you're going to exit, you know how you're going to manage the trade. And by having a system, it eliminates a lot of the randomness that could exist in your trading. And the funniest thing is, I see a lot of traders expect consistent results when they have completely random input. If you want consistent results, you need consistent input. And that's the importance of having a system behind your trading. Finally, you need to redefine what it means to have a winning day. And I know you're probably thinking that a winning day is a green day. It's a day where you made money. And yeah, that's technically true, but you need to change that definition. A winning day is a day where you remained disciplined, where you stuck to your trading plan, where you followed your process, and you need to celebrate how well you executed on your edge. And there are days for me where I'll finish up like $4,000 to $5,000, and I'll still be pretty disappointed because I had lapses in my execution. I don't judge how well I did that day based off my profits. I judge it based off how well I executed on my edge. And the same thing applies the other way around. Let's say you have a losing day, you're in the red, right? That's not necessarily a bad thing, depending on how well you followed your plan and whether you executed on your edge. There's going to be some days where the trades just don't continue in your favor. They don't work. It's a part of trading. Losing is inevitable. So you don't want to get down on yourself on a losing day where you were disciplined. You did follow your plan, right? There's plenty of losing days that I have where I'll actually be happy after the trading day because ultimately I stuck with my process and my plan. You always have to remember that the money is a byproduct. The money is just the result of you trading well. So in summary, your trading success is honestly like a paradox. The more you focus on the money, the more that the money runs away from you. But as soon as you detach yourself from the outcome and you attach yourself to the process of becoming a profitable trader, that's when the money is going to chase you. So focus on journaling. Focus on following your risk every single day. Focus on back testing. Focus on developing that trading system. Focus on refining it. Focus on building the right habits for your trading success. Stop thinking about the money. Stop thinking about the profit, because you're going to end up forcing it. And then you're going to end up making emotional decisions that will ultimately be a detriment to you. When you focus on the outcome, that's when the outcome runs away. And I don't want you to make these emotional decisions from fear or greed just because of your desire to make money. So hopefully this video was very valuable for you. Make sure you watch my free 10+ hour course. Like I said before, it's genuinely better than most paid courses on the internet. You can find that in the description of this video. You could use my free course in conjunction with all of my material that's on my YouTube channel. Leave a comment if you enjoyed this video. Leave a like, subscribe to the channel, and I can't wait to see you guys on the next video. Thank you very much.